Chapter 1. Introduction to the Art and Science of Technical Analysis. Technical analysis is a fascinating field of study. It is as much science as it is art. Its main strength is that a lot of it is visual, giving practitioners a better feel of the underlying dynamics of the markets. We shall also be looking at the various challenges to technical analysis, their resolution, and how technical analysis affects trading in general. The classification of technical approaches, market participants, and various markets will also be discussed in detail. 1.1 Main objective of technical analysis. It is generally accepted that human beings are born with certain instincts, tempered and molded by evolution via the passing of time. Every human being strives and seeks to fulfill these powerful instinctive forces. Learning objectives. After studying this chapter, you should be able to understand the key concepts underlying technical analysis, identify the different forms of chart analysis, describe the objectives of technical analysis, understand what subjectivity means in technical analysis. Recognize the strengths and weaknesses of technical analysis, categorize market participants according to style and time in markets, identify the various styles and approaches in technical analysis. 1. 2. The three main motivational instincts are 1. The instinct to survive. 2. The instinct for comfort. 3. The instinct to propagate. The instinct to survive is probably the strongest and most overpowering. Survival almost always precedes the need for comfort or to propagate the species. The instinct to survive includes the instinct to stay alive, the instinct to satisfy hunger, the instinct to seek safety, that is, being in a group/herd, the instinct to avoid danger, by having natural fears like the fear of fire, loud sounds, heights, etc. This powerful instinct to survive is the main driving force in life for striving to make a profit. But in order to make a profit to ensure continued survival, there must be a positive change in the actual or perceived value of something that we own. This change in value of some variable may be anything that will allow us to profit from change. One very popular and convenient variable of change is price. We can participate in this price change by satisfying a very simple mechanical rule that will ensure profitability every single time, which is to always buy when prices are low and sell when they are higher, popularly referred to as the buy low, sell high principle. See Figure 1.1. Unfortunately, in order to satisfy this simple rule of guaranteed profitability, we need to be able to do more of one thing, which is to be able to determine the direction of price ahead of time in order to know exactly when to buy low and subsequently sell higher. Hence, it is not only the mechanical action of buying low and selling high that counts, but also the timing of the action itself that is critical. This Figure 1.1 The mechanics of profiting from a change. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Introduces an element of chance or probability into an otherwise fairly straightforward mechanical venture. Profitability therefore requires effective and efficient action in two dimensions, that is, price and time. Traders and analysts keep track of this action using a two-dimensional visualization tool, that is, a price-time chart, which tracks price on the vertical axis and time on horizontal axis. In short, the ability to forecast or predict price or market action in a reasonably accurate fashion represents one of the skills that may be critical for longer-term success as a professional trader or analyst. 1.2 Dual function of technical analysis. Technical analysis essentially serves two main functions. 1. For identification, it identifies and describes past and present price action. It serves as a historical record of what has transpired in the markets. It provides a descriptive representation of market action. This allows the market practitioner to observe how the market has performed in the past, which includes its average volatility over a specified period, its highest and lowest historical price extremes, the common areas of consolidation, average duration, and price excursion of trends, the amount of liquidity and participation in the markets, the average degree and frequency of price gapping, the impact of various monetary economic announcements on price, and so on. This information is especially critical prior to any investment or trading decision. 2. For forecasting, once a particular price or market action is identified, the practitioner may now use this information to interpret what the data actually means before inferring future price action. This inference about potential price action is wholly based on the assumption that price patterns are repetitive to some reasonable degree and therefore may be used as a basis for price predictions. 1.3 Forecasting price and market action. There are three main approaches to predicting potential future price action or behavior, namely via 1. Fundamental analysis. 2. Technical analysis. 3. Information analysis. See Figure 1.2. Forecasting stock prices using fundamental analysis. One way to gauge the potential price of a stock is by analyzing the company's performance via its financial statements and accounts in order to determine its intrinsic value or the worth of the security in light of all its holdings, debt, earnings, dividends, income, and balance sheet activity, cash flow, and so on. This accounting information is NOR. 3. 4. Figure 1.23 Approaches to price forecasting. MALI represented in ratio form, as in price to earnings, P/E, price to earnings growth, PEG, price to book, price to sales, and debt to equity ratios, to name but a few. The logic is that a strongly performing company should continue to perform well into the future and garner more demand from investors excited to participate in the expected capital gains derived from the stock's price and appreciating dividend yields. The price of a stock is expected to rise if there are sufficient buyers, signifying a demand for it. Conversely, the price of a stock is expected to decline if there are sufficient sellers, signifying an oversupply in the stock. Demand is potentially generated if the current stock price is below its estimated intrinsic value, that is, it is currently undervalued or underpriced, whereas supply is created if the current stock price is above its estimated intrinsic value, that is, it is currently overvalued or overpriced. See Figures 1.3 and 1.4 for illustrations of using intrinsic value to forecast potential stock price movements. Figure 1.3 Price forecasting based on intrinsic value of a stock. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Figure 1.4 Price forecasting based on intrinsic value of a stock. There are various ways to determine the degree of over or undervaluation in a stock, some of which include comparing P/E and earnings per share, EPS, ratios, or investigating to what extent a stock is trading at a premium or discount in relation to its net current asset value, debt, and other fundamentals. Fundamental analysis helps provide indications as to which stocks to buy based on prior company performance, that is, over the last accounting period. Some investors resort to more active asset allocation methods to try to time the market for a suitable stock to buy into or get out of, rather than just relying on the traditional buy and hold strategy. They resort to studying broad market factors and sector rotation models in order to buy into the best fundamentally performing stocks within a strengthening industry or sector. This method is popularly termed the top-down approach to investing. A bottom-up approach relies more on a specific company's fundamental performance. A buy-and-hold strategy in today's volatile markets may not represent the most effective way of maximizing returns while minimizing potential risks. As a result, many fundamentalists frequently look to various asset pricing and modern portfolio models like the Capital Asset Pricing Model, CAPM, to try to achieve the best balance between risk and expected returns over a risk-free rate, along what is called the efficient frontier. One of the problems with fundamental analysis is the credibility, reliability, and accuracy of the accounting practices and financial reporting, which is susceptible to manipulation and false or fraudulent reporting. There are various unscrupulous ways to dress up a poorly performing company or financial institution. A simple internet search will reveal numerous past and ongoing investigations related to such practices. The other problem is the delay in the financial reporting of a company's current financial state in the market. By the time the next audited report is completed and published, the information is already outdated. It does not furnish timely information to act upon, especially in volatile market environments, and, as a result, does not directly account or adjust for current or sudden developments in the market environment. Nevertheless, fundamental analysis does give valuable information about specific securities and their performances. Its main weakness is its inability to provide clear and specific short-term price levels for traders to act on. Therefore, fundamental information is better suited to longer-term investment. 5. 6. Decisions, as opposed to short-term market participation, where short-term price fluctuations and precise market timing may be of lesser importance. Fundamental data, on a broader scale, accounts for the overall underlying economic performance of the markets. Supply and demand reacts to the economic data released at regular intervals, which include interest rate announcements and central bank monetary policy and intervention. One example of how supply and demand in the markets are affected by such factors is the Swiss National Bank's (SNB) decision to maintain a 1.2000 ceiling on the foreign exchanges rate of the EUR/CHF, with respect to the Swiss franc. This creates a technical demand for the euro, and a corresponding supply in the CHF, around the 1.2000 exchange rate level. Many traders have acted and are still acting on this policy decision to their advantage, buying every time the rate approaches 1.2000, with stops placed at a reasonable distance below this threshold. The integrity of this artificial ceiling remains intact as long as the SNB stands steadfast by their policy decision to uphold the ceiling at all costs. See Figure 1.5. It behooves the analyst and investor to examine the actual decision-making process involved with investing in a stock based on intrinsic value. While it does provide an indication, with all else being equal, of the integrity of a certain stock relative to the universe of stocks available, there is a disruptive behavioral component that affects this process. It is not just the calculated or estimated intrinsic value that is an important element, but also the general perception or future expectation of this value that plays an arguably greater and more significant role in determining the actual share price of a stock. This may explain why shares prices do not always reflect the actual value of a stock. This disagreement between price and value is the result of divergence between the actual intrinsic value and perceived or projected value. Figure 1.5 SNB policy impacting on the value of the CHF. Source: MetaTrader 4. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Forecasting stock prices using information. Generally, information may be gleaned from various public sources such as newspaper reports, magazines, online bulletins, and so on, upon which market participants may then formulate an opinion about the market, making their own predictions about potential market action. Unfortunately, such publicly available information usually has little merit when used for forecasting purposes, as those more privy to non-public material information would have already moved the markets substantially, leaving only an inconsequential amount of action for latecomers to profit from, at the very most. This is where technical analysts have the unfair advantage of observing the markets moving on the charts and immediately taking action, regardless of the cause or reasons why such action exists. They are only interested in the effects such activity has on price. Technical analysts typically do not wait for news to be public knowledge prior to taking action or making a forecast based on a significant price breakout. The use of non-public material information potentially affords insiders substantial financial gain from such knowledge, as the release of critical or highly sensitive company information may cause a substantial change in the company's stock price. Hence, it is no great feat to be able to forecast potential market direction based on such prior knowledge, especially if the non-public material information is highly significant or headline-worthy. Needless to say, insider trading is illegal in the equity markets. But the possibility will always exist that it can occur, and in fact has on many occasions. Unfortunately, in unregulated over-the-counter (OTC) markets, nothing stops brokers from front-running large client orders, which is just another form of insider trading. Forecasting stock prices using technical analysis. Technical analysis is essentially the identification and forecasting of potential market behavior based largely on the action and dynamics of the market itself. The action and dynamics of the market is best captured via price, volume, and open interest action. The charts provide a visual description of what has transpired in the markets, and technical analysts use this past information to infer potential future price action, based on the assumption that price patterns tend to repeat or behave in a reasonably reliable and predictable manner. Let us turn our attention to some popular definitions of technical analysis. The following definition of technical analysis tells us that charting is the main tool used to forecast potential future price action. Technical analysis is the study of market action, primarily through the use of charts, for the purpose of forecasting future price trends. John Murphy, Technical Analysis of the Financial Markets, NYIF, 1999. The next definition of technical analysis tells us that the charting of past information is used to forecast future price action. 7. 8. Technical analysis is the science of recording, usually in graphic form, the actual history of trading, then deducing from that pictured history the probable future trend. Edwards and McGee, Technical Analysis of Stock Trends, Omnicom, 2007. Notice that the last two definitions specifically refer to the forecasting of trend action. It is interesting at this point to draw a parallel here with information used in fundamental analysis. Technical analysis is often criticized for the use of past information as a basis for forecasting future price action, relying on the notion that certain price behaviors tend to repeat. Unfortunately, virtually all forms of forecasting are based on the use of prior or past information, which certainly includes statistical, fundamental, and behavior-based forecasting. Companies employ accounting data from the most recent and even past quarters as a basis for gauging the current value of a stock. In statistics, regression line analysis requires the sampling of past data in order to predict probable future values. Even in behavioral finance, the quantitative measure of the market participants' past actions form the basis for predicting future behavior. The following definition of technical analysis tells us that it is the study of pure market action and not the fundamentals of the instrument itself. It refers to the study of the action of the market itself as opposed to the study of the goods in which the market deals. Edwards and McGee, Technical Analysis of Stock Trends, Omnicom, 2007. This next definition of technical analysis tells us that it is a form of art, and its purpose is to identify a trend reversal as early as possible. The art of technical analysis, for it is an art, is to identify a trend reversal at a relatively early stage and ride on that trend until the weight of the evidence shows or proves that the trend has reversed. Martin Pring, Technical Analysis Explained, 4th edition, McGraw-Hill, 2002. The following definition is most relevant in the formulation of trading strategies. It reminds the market participants that nothing is certain and we must weigh our risk and returns. Technical analysis deals in probabilities, never in certainties. Martin Pring, Technical Analysis Explained, 4th edition, McGraw-Hill, 2002. The next statement gives a behavioral reason as to why technical analysis works. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Technical analysis is based on the assumption that people will continue to make the same mistakes they have made in the past. Martin Pring, Technical Analysis Explained, 4th edition, McGraw-Hill, 2002. This definition by Pring stresses and underscores the point that there is a real reason and explanation as to why past price patterns tend to repeat. The tendency of price to repeat past patterns is mainly attributed to market participants repeating the same behavior. Although it is not impossible with sufficient and continuous conscious effort and strength of will, human beings rarely change their basic behavior, temperament, and deep-rooted biases, especially in relation to their emotional response to fear, greed, hope, anger, and regret when participating in the markets. The following statement about technical analysis explains its effectiveness in timing early entries and exits. Market price tends to lead the known fundamentals. Market price acts as a leading indicator of the fundamentals. John Murphy, Technical Analysis of the Financial Markets, NYIF, 1999. This definition by Murphy highlights a very important assumption in technical analysis, which is that price is a reflection of all known information acted upon in the markets. It is the sum of all market participants' trading and investment actions and decisions, including current and future expectations of market action. It also reflects the overall psychology, biases, and beliefs of all market participants. Therefore, the technical analysts believe that the charts tell the whole story and that everything that can or is expected to impact price has already been discounted. This assumption forms the very basis of technical analysis, and without it, technical analysis would be rendered completely pointless. Fundamental versus technically based market timing. Before proceeding any further, it is best to briefly explain the meaning of a few commonly used terms in trading and technical analysis. To go long means to buy to open a new position, to liquidate means to sell to close a position previously held, to go short means to sell to open a new position, to cover means to buy to close a position previously shorted. Both fundamental and technically based market timing aim to satisfy the same basic principle of buying low and selling high. There are 4 basic scenarios where this may occur. 1. Long at a low price and liquidate at a higher price. 2. Long at a relatively high price and liquidate at an even higher price. 9. 10. 3. Short at a high price and cover at a lower price. 4. Short at a relatively low price and cover at an even lower price. Listed below are the sum of the strengths of each approach with respect to timing the markets. Technically based market timing offers the ability to provide precise entry and exit prices, provide the precise time of entry and exit, provide real-time bullish and bearish signals. Provide real-time entry and exit price triggers, scale in and out based on significant price levels, time entries and exits based on volatility behavior of the underlying exit, extended trends at technically significant price reversal levels, time entries and exits based on market order flow, define percent risk in terms of significant price levels, use volume and open interest analysis to gauge strength of an underlying move in order to time entries and exits, use market breadth and broad market sentiment to gauge the strength of an underlying move in order to time entries and exits, forecast potential peaks for shorting or liquidating positions, as well as potential troughs for getting long and covering positions, via the use of cycle and seasonality analysis. Fundamentally based market timing offers the ability to gauge undervalued stocks with a potential to appreciate in value, but lacking information regarding the precise price or time to get long or to cover, gauge overvalued stocks with a risk of depreciating in value, but lacking in formation regarding the precise price or time to get short or to liquidate, screen and participate in fundamentally strong stocks in a sector or industry as part of an active asset allocation or rotation strategy, but lacking information regarding the precise price or time to get long. The fundamentalist versus technical analysts. Listed below are some characteristics of the fundamentalist and technical analyst. The fundamentalist is mainly concerned with intrinsic value, strives to understand the underlying causes for potential market moves, is focused on which company to participate in, can tell you which company to invest in, but cannot tell you the most advantageous moment to start participating in that stock. The technical analyst is mainly concerned with structure and dynamics of market and price action, is more concerned with the effects of potential market moves rather than the cause of them. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Cannot usually determine what the intrinsic value of an asset is or whether it is under or overvalued, but is able to determine precisely when to start participating, purely from the perspective of price performance. Is not concerned with the underlying factors that led to the rise in price. This is irrelevant for all practical purposes, as they believe that price is a reflection of all information available in the markets and therefore that is all that really matters. In short, from what we have covered so far, we know that technical analysis Uses past information, uses charts, identifies past and current price action, forecasts potential future price action based on historical price behavior, e.s. Especially the start of a new trend. Technical data and information. Technical analysts study market action. Market action itself is mainly comprised of the study of price action, volume action, open interest action, sentiment, market breadth, flow of funds. Of all the data that technical analysts employ, price is the most important, followed closely by volume action. Price itself is comprised of an opening, high, low, and closing price, normally referred to as OHLC data. OHLC data normally refers to the daily opening, high, low, and closing prices, but it may be used to denote the OHLC of any bar interval, from 1-minute bars right up to the monthly and yearly bars. 1.4 Classifying technical analysis. Technical analysis may be categorized into 4 distinct branches, that is, classical, statistical, sentiment, and behavioral analysis. Regardless of which branch is employed, all analysis is eventually interpreted via the various behavioral traits, filters, and biases unique to each analyst. Behavioral traits include both the psychological and emotional elements. See Figure 1.6. Classical technical analysis involves the use of the conventional bar, chart, and Japanese candlestick patterns, oscillator, and overlay indicators, as well as market breadth, relative strength, and cycle analysis. Statistical analysis is more quantitative, as opposed to the more qualitative nature of classical technical analysis. It. 11. 12. Figure 1.6 The 4 branches of technical analysis. Studies the dispersion, central tendencies, skewness, volatility, regression analysis, hypothesis testing, correlation, covariance, and so on. Sentiment analysis is concerned with the psychology of market participants, which includes their emotions and level of optimism or pessimism in the markets. It studies professional and public opinion via polls and questionnaires, trading and investment decisions via flow of funds in the markets, as well as the positions taken by large institutions and hedgers. Finally, behavioral analysis studies the way market participants react to news, profit and losses, the actions of other market participants, and with their own psychological and emotional biases, preferences, and expectations. Mean reverting versus non-mean reverting approach. The type of technical studies employed also depends on the approach taken by traders and analysts with respect to their personal preferences and biases regarding the action of price in the markets. Basically, traders either adopt a contrarian or a momentum-seeking type approach. Being more contrarian in their approach implies that they do not usually expect the price to traverse large distances. In fact, they are constantly on the lookout for impending reversals in the markets. In ES sense, they expect price to be more mean reverting, returning to an average price or balance between supply and demand. Those that adopt the mean reverting AP approach prefer to employ technical studies that help pinpoint levels of overbought and oversold activity, which includes divergence analysis, regression analysis, moving average bands, and Bollinger Bands. They prefer to trade consolidations rather than trend action. They normally buy at support and short at resistance. Limit entry orders are their preferred mode of order entry. Conversely, being more momentum-seeking in their approach implies that they usually expect the price to traverse large distances and for trends to continue to remain intact. They are constantly on the lookout for continuation-type breakouts in the markets. In short, the Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Figure 1.7 Mean reverting versus non-mean reverting approaches. They expect price to be more non-mean reverting, where demand creates further demand and supply creates further supply, both driven by a powerful positive feedback cycle. Those that adopt the non-mean reverting approach prefer to employ technical studies that help pinpoint breakout or trend continuation activity, which includes chart pattern breakouts, moving average breakouts, Darvas box breakouts, and Donchian channel breakouts. They prefer to trade trends rather than ranging action. They normally short at the breach of support and long at breach of resistance. Stop entry orders are their preferred mode of entry into the markets. See Figure 1.7. Advantages and disadvantages of technical analysis. The advantages of applying technical analysis to the markets are: it is applicable across all markets, instruments, and time frames, where price patterns, oscillators, and overlay indicators are all treated in exactly the same manner. No new learning is required in order to trade new markets or time frames, unlike in fundamental analysis where the analyst must be conversant with the specifics of each stock or market. There is no need to study the fundamentals of the markets traded or analyzed in order to apply technical analysis, since technical analysts believe that all information that impacts or potentially may impact the stock or market is already reflected in the price on the charts. Technical analysis provides a clear visual representation of the behavior of the markets, unlike in fundamental analysis where most of the data is in numerical form. 13. 14. It provides timely and precise entry and exit price levels, preceded by technical signals indicating potential bullishness or bearishness. It has the ability to also pinpoint potential time of entry via time projection techniques not available to fundamentalists. Fundamental analysis does not provide the exact price or time of entry. It makes the gauging of market risk much easier to visualize. Volatility is more obvious on the charts than it is in numerical form. The concerted effort of market participants acting on significantly clear and obvious price triggers in the markets helps create the reaction required for a more reliable trade. This is the consequence of the self-fulfilling prophecy. The disadvantages of applying technical analysis are: it is subjective in its interpretation. A certain price pattern may be perceived in numerous ways. Since every bullish interpretation has an equal and opposite bearish interpretation, all analysis is susceptible to the possibility of interpretational ambiguity. Unfortunately, all manners of interpretation, regardless of the underlying analysis employed, be it fundamental, statistical, or behavioral, are equally subjective in content and form. A basic assumption of technical analysis is that price behavior tends to repeat, making it possible to forecast potential future price action. Unfortunately, this tendency to repeat may be disrupted by unexpected volatility in the markets caused by geopolitical, economic, or other factors. Popular price patterns may also be distorted by new forms of trade execution that may impact market action, like automated, algorithmic, or high-frequency program trading where trades are initiated in the markets based on non-classical patterns. This interferes with the repeatability of classic chart patterns. Charts provide a historical record of price action. It takes practice and experience to be able to identify classical patterns in price. Though this skill can be mastered with enough practice, the art of inferring or forecasting future price action based on past prices is much more difficult to master. The practitioner needs to be intimately familiar with the behavior of price at various time frames and in different markets. Although classical patterns may be applied equally across all markets and time frames equally, there is still an element of uniqueness associated with each market action and time frame. It is argued that all market action is essentially a random walk process, and as such applying technical analysis is pointless as all chart patterns arise out of pure chance and are of no significance in the markets. One must remember that if this is the case, then all forms of analysis are ineffective, whether fundamental, statistical, or behavioral. Since the market is primarily driven by perception, we know that the random walk process is not a true representation of market action, since market participants react in very specific and predictable ways. Though there is always some element of randomness in the markets caused by the uncoordinated actions of a large number of market. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Participants, one can always observe the uncanny accuracy with which price tests and reacts at a psychologically significant barriers or prices. It is hard to believe that price action is the result of random acts of buying and selling by market participants where the participants are totally unencumbered by cost, biases, psychology, or emotion. The strong form of the efficient market hypothesis, argues that since the markets discount all information, price would have already adjusted to the new information, and any attempt to profit from such information would be futile. This would render the technical analysis of price action pointless, with the only form of market participation being passive investment. But such efficiency would require that all market participants react instantaneously to all new information in a rational manner. This in itself presents an insurmountable challenge to M. The truth is that no system comprising disparate parts in physical reality reacts instantaneously with perfect coordination. Hence it is fairly safe to assume that although absolute market efficiency is not attainable, the market does continually adjust to new information, but at a much lower and less efficient rate of data discounting. Therefore, technical analysis remains a valid form of market investigation until the markets attain a state of absolute and perfect efficiency. Another argument against technical analysis is the idea of the self-fulfilling prophecy, SFP. Proponents of the concept contend that prices react to technical signals not because the signals themselves are important or significant, but rather because of the concerted effort of market participants acting on those signals that make it work. This may in fact be advantageous to the market participants. The trick is in knowing which technical signals would be supported by a large concerted action. The logical answer would be to select only the most significantly clear and obvious technical signals and triggers. Of course, one can further argue that such signals, if they appear to be reliable indicators of support and resistance, would begin to attract an increasing number of traders as time passes. This would eventually lead to traders vying with each other for the best and most cost-effective fills. What seems initially like the concerted action of all market participants now turns into competition with each other. Getting late fills would be costly as well as reduce or wipe out any potential for profit. This naturally results in traders attempting to preempt each other for the best fills. Traders start vying for progressively earlier entries as price approaches the targeted entry levels, leading finally to entries that are too distant from the original entry levels, increasing risk and reducing any potential profits. This disruptive feedback cycle eventually erodes the reliability of the signals, as price fails to react at the expected technical levels. Price finally begins to react reliably again at the expected technical levels as traders stop preempting each other and abandon or disregard the strategy that produced the signals. The process repeats. Therefore, SFP may result in technical signals evolving in a kind of six-stage duty cycle, where the effects of SFP may be advantageous and desirable to traders in the early stages but eventually result in forcing traders into untenable positions. See Figure 1.8. 15. Figure 1.8 The idealized six-stage self-fulfilling prophecy cycle. 1.5 Subjectivity in technical analysis. As with most forms of analysis, technical analysis has both objective and subjective aspects associated with its application. It is objective insofar as the charts represent a historical record of price and market action. But it is subjective when the technical analyst attempts to analyze the data. Analyzing price and market action consists of three main activities, namely 1. Identifying price and indicator patterns. 2. Interpreting the data. 3. Inferring potential future price behavior. Analyzing price and market action is ultimately subjective because all analysis is interpreted through various behavioral traits, filters, and biases unique to each analyst or observer. Behavioral traits include both the psychological and emotional elements. As a consequence, each analyst will possess a slightly different perception of the market and its possible future behavior. Subjectivity in the choice of analysis and technical studies. The sheer number of ways to analyze an individual chart contributes to the overall level of subjectivity associated with each forecast. The problem is twofold. What is the most appropriate form of technical analysis that should be applied to a particular chart? What is the most appropriate choice of indicators to apply to a particular chart? 16. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Figure 1.9 A simple price chart. Source, MetaTrader 4. These are the usual questions that plague novices. The following charts depict the various popular forms of analysis that can be applied to a basic chart of price action. The following examples are by no means exhaustive. Figure 1.9 starts off with a plain chart devoid of any form of analysis. The next chart, Figure 1.10, shows the application of basic trendline analysis on the same chart, tracking the flow of price action in the market. Figure 1.10 trendline analysis on the same chart. Source, MetaTrader 4. 17. 18. Figure 1.11 moving average analysis on the same chart. Source, MetaTrader 4. In Figure 1.11, moving average analysis is now employed to track the same flow of price action and to provide potential points of entry as the market rises and falls. Figure 1.12 depicts the application of chart pattern analysis to track and forecast the shorter-term bullish and bearish movements in price. Figure 1.13 is an example of applying two forms of technical analysis, that is, linear regression analysis and divergence analysis to track and forecast potential market tops and bottoms. Notice that the market top coincided perfectly with the upper band of the linear regression line, with an early bearish signal seen in the form of standard bearish divergence on the Commodity Channel Index, CCI, indicator. Figure 1.12 chart pattern analysis on the same chart. Source, MetaTrader 4. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Figure 1.13 linear regression and divergence analysis on the same chart. Source, MetaTrader 4. Figure 1.14 is an example of applying a couple of additional forms of analysis to the basic linear regression band. In this chart, price action analysis is used in conjunction with volume analysis to forecast a potential top in the market, evidenced by the preceding parabolic move in price that is coupled by a blow-off. In Figure 1.15, volatility band, volume, and overextension analysis are all employed to seek out potential reversals in the market. We observe that price exceeds the upper volatility band, which may potentially be an early indication of price exhaustion, especially since it is accompanied by a significant volume spike. The moving average convergence divergence, MACD, indicator is also seen to be residing at historically overbought levels, which is another potentially bearish indication. Figure 1.14 linear regression and volume analysis on the same chart. Source, MetaTrader 4. 19. 20. Figure 1.15 volatility band, volume, and overextension analysis on the same chart. Source, MetaTrader 4. As we can see from just a few forms of analysis presented in the preceding charts, there are many ways to view the action of the markets, depending on the context of the analysis employed. For example, if the analyst is more interested in viewing and understanding the action of price within the context of overreaction or price exhaustion in the markets, he or she may opt to apply technical studies that track levels or areas of potential overreaction or price exhaustion. Technical studies that tracked such behavior include linear regression bands, Bollinger bands, moving average percentage bands, Keltner and Stark bands, areas of prior support and resistance, and so on. Alternatively, if the analyst is more interested in viewing and understanding the action of price within the context of market momentum, he or she may instead opt to apply breakout analysis of chart patterns, trend lines, moving averages, and so on. As long as the reason for using a particular form of analysis is clear, there should be no confusion as to what the studies are indicating. Contradictory, confirmatory, and complementary signals. There are many instances when two oscillator signals are in clear and direct opposition with each other. This is inevitable, as each oscillator is constructed differently. The mathematics underlying each oscillator varies with the purpose it is designed for, and in most cases, it involves the manipulation of price, volume, and open interest data. A few reasons for conflicting oscillator and indicator signals are: the mathematical construction of each oscillator or indicator is different. Each oscillator or indicator tracks a different time horizon. Two identical oscillators may issue inconsistent readings due to missing data. On one of the charting platforms, two identical oscillators may also issue inconsistent readings due to variations in The accuracy, quality, and type of data available on different charting platforms. The Handbook of Technical Analysis. Introduction to the art and science of technical analysis. For example, applying an oscillator that uses price, volume, and open interest as part of its calculation will yield inconsistent readings should one of the data be unavailable on the charting platform. The analysts may not be aware of the missing data and struggle to make sense of the inconsistency. The accuracy of the data is also of paramount importance for effective analysis of price and market action. Dropouts in the data as well as the inclusion or exclusion of non-trading days will cause inconsistent readings between charting platforms. There may also be variations in the oscillator readings should volume be replaced with tick volume, sometime also referred to as transaction volume. Tick volume tracks the number of transactions over a specified time interval, irrespective of the size of the transactions. It is also important to note that conflicting signals may not always be in fact conflicting. As pointed out, the time horizons over which each signal is applied may be different. In Figure 1.16 we observe that the CCI readings over the range of prices are markedly different. The 2-0 period CCI indicates a slightly overbought market whereas the 1-0-0 period CCI suggests that prices are slightly oversold. There is in fact no real conflict between the two apparently opposing signals. The indicators are merely pointing out that prices are slightly overbought or overextended in the short term, but over the longer term, prices are in fact slightly oversold, that is, relatively cheap. Therefore, instead of viewing the signals as opposing or contradictory, the astute trader immediately realizes that the most advantageous point for initiating a long entry would be when prices are cheap both in the long and short term. This is easily identified on the charts by looking for oversold readings on both the 20 and Figure 1.16 conflicting signals on the daily Alcoa Inc. chart. Courtesy of StockCharts.com. 21. 22. 100 period CCI within the area of consolidation, as indicated at point 1. Therefore, the trader may decide to go long once price penetrates the high of the candlestick indicate on the chart. In this example, we see conflicting signals actually complementing each other and affording the trader an advantageous entry at relatively low prices. The important point to remember is that any form of analysis may be employed, as long as the analyst is intimately familiar with the peculiarities associated with each form of analysis. It is better to be conversant with one form of analysis than to employ a slew of technical approaches without fully grasping the intricacies of each approach. This leads to confusion and ineffective analysis. It must be noted that combining technical studies will frequently result in both confirmatory and contradictory signals as we have seen, with many of the signals being also complementary as well. Only add studies once the first form of analysis is fully mastered. The practitioner must always remember that no form of analysis is always perfectly representative of the market, and it is inevitable that different forms of analysis will many times lead to conflicting signals. Subjectivity in pattern identification. As mentioned, interpretation and inference of potential future price action based on historical price behavior is essentially an exercise in subjectivity. Each analyst will interpret and infer future price action according to his or her own experience, knowledge, objectives, beliefs, expectations, predilections, emotional makeup, psychological biases, and interests. The identification of price patterns may also present some challenge to the novice practitioner. Occasionally, the markets will conveniently trace out various price patterns that may cause some confusion. Refer to Figure 1.17. Figure 1.17 Conflicting Chart Pattern Signals. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. In this example, we see two chart patterns indicating potentially contradictory signals. The ascending triangle is regarded as a bullish indication, while the complex head and shoulders formation is potentially bearish. Therefore, as price starts to contract, forming a symmetrical triangle, an analyst may be somewhat perplexed at the conflicting signals, being unable to provide or issue a clear forecast as to whether the market is indeed potentially bullish or bearish. One way to resolve this apparent conflict is to first identify the size of each pattern. The sentiment associated with larger patterns or formations will take precedence over that of smaller formations. These larger formations are more representative of the longer-term sentiment, whereas the smaller formations are more indicative of short-term sentiment. Hence, in our example, the bullish sentiment associated with the ascending triangle takes precedence over the bearish sentiment associated with the complex head and shoulders formation. Therefore, until price breaches the complex head and shoulders neckline, the entire formation may be regarded as a potentially bullish pattern. Following this simple rule helps reduce some of the subjectivity involved in reading price and chart formations. Figure 1.18 depicts an idealized scenario where all the chart formations are potentially bearish. There is no conflict in sentiment between these formations as they are all in perfect agreement. The smaller formations act as additional evidence and add to the overall bearish sentiment. There is also a lesser amount of subjectivity involved when reading the sentiment associated with formations that are in perfect agreement. Nevertheless, it should be noted that although such formations may appear somewhat more straightforward with respect to Figure 1.18 chart pattern with complementary signals. 23. 24. Inferring potential future price direction, any upside breakout of the larger descending triangle may well precipitate a vigorous and rapid rally in prices due to the unexpected nature of such a move. Traders must exercise caution, especially when shorting such a formation, as prices can quickly explode to the upside, caused by an avalanche of short covering. Interpretational and inferential subjectivity. This element of subjectivity with respect to interpretation and inference is not merely confined to applications in technical analysis. In fact, every form of analysis involves a certain amount of subjectivity and arbitrariness when it comes to its interpretation. For example, let us assume that the price of oil has risen significantly. This event in itself can be interpreted in two different ways. One fundamentalist may strongly believe that this rise in oil prices will impact the markets adversely as it will raise the underlying cost of commodities, whereas another fundamentalist may strongly believe that the rise in oil prices is a direct result of market demand, a bullish scenario indicating a healthy and growing economy. In another example, a technical analyst may strongly believe that an overbought oscillator reading is a clear indication that the trend is strong with further continuation expected in price, whereas another technical analyst may strongly believe that the overbought signal is a clear indication that the market may be already overextended and therefore expects a reversal in trend. The beginner quickly realizes, after some reflection, that for every bullish interpretation, there exists an equal and opposite bearish interpretation. This is one of the main reasons why forecasting is regarded as largely subjective. Subjectivity and selective perception. Human bias is another factor that adds to the degree of subjectivity when attempting to interpret technical signals. Chartists will many times ignore signals that conflict with their preconceived ideas of where the markets ought to be at any one time. They only select oscillators and indicator signals that support their analysis of the market. For example, a chartist uses three oscillators, the MACD, Relative Strength Index, RSI, and stochastics. The chartist has a bullish view of the markets and believes that it is about to break to the upside. All of the oscillators have bullish readings except for stochastics. The chartist ignores the stochastics signal because it does not agree with his or her view of the markets. On a subsequent occasion, it is MACD that is not in agreement with the chartist's view, and only the signals from the other two oscillators are heeded. This is known as selective perception. See Figure 1.19. Selective perception adds to the subjectivity of the forecast, as there is no fixed point of reference or basis for making decisions based on evidence. Choosing only signals that agree with one's view will lead to biased and erroneous interpretations and unfounded forecasts. In fact, it is when there are discrepancies in the signals that the chartist gains the most information from the markets, as it may be an indication that there could well be some form of underlying weakness in the markets. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Figure 1.19 Selective Perception and Conflicting Oscillator Signals. Subjectivity in determining an event, the point of entry. Identifying, interpreting, and inferring market action are not the only areas where subjectivity plays a significant role. The determination of the exact points of entry to and exit from the market is also subjective at the most fundamental level of observation. What appears to be essentially objective is also built on a foundation of subjectivity. An example will help illustrate the point. Refer to Figure 1.20. Figure 1.20 Example of subjective objectivity. 25. 26. Assume that a chartist is interested in identifying a market top via a trendline penetration. The chartist locates two significant troughs in an existing uptrend and draws a line connecting the two troughs, projecting that line into the future. Price eventually makes a top in the market and subsequently declines and penetrates the uptrend line, signifying the formation of a market top. This seems to be a totally objective exercise since the uptrend line and the point of penetration were clearly marked and recorded on the charts. Unfortunately, the objectivity ends here. Although each act of identifying the trend reversal was purely objective, the variables upon which the process of identification is based is determined subjectively by each chartist, according to their goals, biases, experience, and preferences. Another chartist could well have drawn a steeper trend line and declared that the penetration of this new trend line marks the true point of reversal in the market. As you can see, although each act of identifying the exact point of reversal is strictly objective in itself, the existence of alternative trend lines introduces an element of subjectivity as to which trend line penetration is the definitive indicator or signifier of the trend reversal. We can find another example of this subjective objectivity. Automated or program trading is usually regarded as a purely objective mode of trading where all the rules of engagement with the market are fully codified and mechanically executed. This removes all subjectivity with respect to the entries and exits. Just as in our previous example, the point of penetration of each trend line was also purely objective. However, should the automated trading software allow for some parameter adjustments, this instantly introduces an element of subjectivity as to which parameter adjustments are the definitive settings for a profitable trading campaign. Therefore, no matter how objective each individual act is, once the possibility of alternative acts exists, the issue of subjectivity arises. In a sense, each determination is individually objective, but collectively subjective. The very act of determining the exact entry point to initiate a trade is somewhat subjective. Let us assume that a trader is interested in initiating an entry at the break of an uptrend line. Price initially fails to exceed a previous peak, which is a bearish indication. Price subsequently declines and breaches the uptrend line, and in the process triggers a trade. Some questions that a trader may now ask are: at which point after the breakout do I initiate an entry into the market? What is a reasonable amount of price penetration required before an entry is initiated? Do I wait for the penetration bar to close first, or do I initiate an entry at some arbitrary point during an intraday violation of the trend line? What if the penetration bar closes too far away from the original trend line? Breach? How would I know if the violation is merely a false breakout? Should I allow for a larger penetration before initiating an entry in order to filter out potential false breakouts? If so, how much larger a penetration is required to filter out such breakouts? The answers to all of these questions really depend on the objectives of the trader and what he or she is attempting to achieve. There are essentially two ways. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Figure 1.21 Subjectivity in the Rules of Engagement. Of initiating an entry at the breakout of some price barrier. The first is to initiate an entry at some arbitrary point just after a breakout. The other is to initiate a trade based on some fixed rules of entry and exits. See Figure 1.21. Subjectivity arises not because the rules of engagement are unclear, but rather because of the number of choices available. Hence, each trader will select the rules of entry and exit that suit their personality, risk capacity, or familiarity with a certain mode of engagement. A trader could initiate a trade once price moves a certain distance away from the breakout, or once the penetration bar closes. Traders may even choose to enter the market after a certain amount of time has elapsed from a breakout. Figure 1.21 lists three main types of filters that traders frequently use to initiate an entry. Price, time, and algorithmic filters will be discussed in more detail in Chapter 5. Summarizing, even if the rules for identification, interpretation, and inference are rigidly codified, the very fact that we have choice renders the entire analysis subjective from the ground up. Hence the argument that technical analysis is subjective in fact represents a general comment on all forms of analysis. It is not unique to technical analysis. Here is a little exercise in subjectivity associated with pattern recognition. See Figure 1.22. Without looking at Figure 1.23, try to see if you can figure out the trend changes by drawing simple trend lines. After you have finished, refer to Figure 1.23 to see if you have drawn the same trend lines as indicated on the chart. There will most likely be a difference in the points chosen in drawing the trend lines. The very fact that you can draw alternate trend lines introduces an element of subjectivity in identification, interpretation, and forecasting. 27. 28. Figure 1.22 a basic 4-hourly bar chart of USD-CAD. Source, MetaTrader 4. Now go back to Figure 1.22 and try to identify some chart patterns, if you know some. After you have finished, turn to Figure 1.24 to see if you have drawn the same patterns. Were there differences in the chart patterns drawn? Do not worry if there are differences. It is merely a consequence of subjectivity. Subjectivity in pattern recognition diminishes with practice. Here is another example based on the same USD-CAD chart. Were you aware of the subtle angular symmetries in the USD-CAD? See Figure 1.25. Analysts also pay. Figure 1.23 Trendline analysis on the 4-hourly USD-CAD bar chart. Source, MetaTrader 4. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Figure 1.24 Chart Pattern Analysis on the 4-hourly USD-CAD bar chart. Source, MetaTrader 4. Attention to the angles of ascent and descent in the markets. A novice may not be able to clearly identify chart patterns, trend lines, or angular patterns at the very beginning. But with enough practice, the pattern recognition abilities will gradually improve, becoming more obvious as the skill in reading charts improves. As a consequence, the amount of subjectivity associated with identifying patterns will gradually diminish. Refer to Figure 1.26. Here is the same chart of the USD-CAD again. But this time, we see the underlying beauty and symmetry of price, tempered and forged by the expectation, psychology, biases, and emotions of all market participants. To a trained eye, a simple chart of price action is as beautiful as any work of art. For technical analysis is, in itself, an art. Figure 1.25 Angular symmetries on the 4-hourly USD-CAD bar chart. Source, MetaTrader 4. 29. Figure 1.26 Underlying market symmetry on the 4-hourly USD-CAD bar chart. Source, MetaTrader 4. 1.6 Basic assumptions of technical analysis. Technical analysis is based on a few fundamental assumptions. The first assumption is that market action, which includes price action, reflects all known information in the markets. The market discounts everything except acts of God. This means that the markets can only discount known information, expectations about known information, expectations about potential events. The market cannot discount unexpected events. Unknown information. Market action is representative of the collective trading and investment decisions of all market participants, which directs the flow of supply and demand in the markets. This implies that the technical analyst need only refer to the charting of market action, since all known information and expectation about such information has already been discounted by the markets. The actual cause or underlying reason driving demand or supply is irrelevant, as it is only the effect of such action that really matters, that is, prices rising or falling. Some detractors of technical analysis contend that the assumption that all information is absorbed or discounted by the market is flawed. They argue that, with the exception of illegal insider trading, price cannot possibly discount unexpectedly. 30. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Large block purchase of shares in the market before it occurs. The detractors are in fact perfectly correct in their contention, except for the fact that the markets do not actually discount unknown information or unexpected events. The market can only react to what is known or expected, which includes insider activity. It does not react to what is unknown or unexpected. Although insider information is non-public, it is still considered to be known information, since the action of insider buying and selling impacts market action and as such represents information in the markets. It may be more realistic to think of the market as in a continuous process of assimilating and adjusting to new market information, rather than an unrealistic full-blown discounting of all information instantaneously. What are the markets really discounting? It is not merely news, economic releases, or corporate data that the markets are discounting. The assumption is that it discounts everything. This includes information about actual events, expectation about actual events, information about expected events, expectation about expected events, expectation about the possibility of unexpected events. Some also argue that there are many other forms of discounting, like buying the rumor and selling on the fact. They are curious as to what the expectation should be in such a case. Should the expectation be that prices will appreciate once the good news is released, or should the expectation be that prices will fall once the good news is public knowledge, since everyone is in fact selling on good news? How would we know if the market is discounting the rumor itself, expectations about the rumor, expected good or bad news, actual news? In reality, the market discounts all of the above. Regardless of what the markets are discounting, be it quantifiable or otherwise, the end result is that price and markets action will ultimately reflect the collective expectation of all participants. Market discounting versus IMH. Efficient market hypothesis, IMH, states that for a market to efficiently discount and reflect all information perfectly, all of its participants must act on all information in the same rational manner instantaneously. Does this definition of IMH also apply the basic assumption in technical analysis that the market discounts everything? Detractors of IMH contend that the act of discounting everything is not realistic or is largely impossible. They argue that the problem lies in the action taken. 31. 32. By the participants. Not all participants will react to the same event or information in the same way, and in fact, some participants may act on it in a contrary fashion, that is, shorting the market rather than going long. They also argue that not all of the participants will react at the same time. Some will take preemptive action or act in anticipation of the event, while other participants will act during the actual receipt of the information. There will also be participants who may react long after the information is released. Hence, trying to achieve a certain level of coordinated action for efficient discounting will be virtually impossible. The detractors of IMH also contend that for the markets to discount all information effectively, all participants must have access to that information and must act on it. The market will otherwise be unable to discount or reflect all information effectively. This requirement itself presents a difficult challenge. They argue that it is virtually impossible to get all of its participants to act on all of the information. It is also unrealistic to expect all participants to have access to that information, and even if they do, we cannot expect the participants to be standing by at all times in readiness to act on such information. They further argue that information is never free. It is unrealistic to expect that all participants are able to afford the information, let alone all information. There is a very subtle difference between efficient discounting in IMH and basic market discounting in technical analysis. As far as market discounting in technical analysis is concerned, there is no requirement of perfect efficiency except for the requirement that it discounts everything that becomes known to it, which includes the sum total of all actions taken by its participants, be it in a timely or untimely, rational or irrational fashion. Market action itself represents the ultimate truth and is a direct consequence of the market discounting all information known to it, regardless of whether the information is perfectly efficient or otherwise. The market continues to discount all information and expectations of such information as and when it unfolds and becomes known to the market. The term efficiency, therefore, as far it applies to the basic assumption in technical analysis, refers to very act of discounting all information as it becomes known to the market, regardless of the type, quality, or speed at which it receives the information. For the technical analyst, price is, always, king and represents the ultimate truth in the market. The markets are never wrong. All market action is considered perfect and efficient under the basic premises of technical analysis. Hence, we see that the term efficient does not carry the same meaning or implications as in the case of MO. In MO, efficient has a very specific meaning. The premises upon which MO are constructed require that all new information be discounted immediately and rationally in order for the market to be perfectly efficient. Efficient under MO means that the market participants must react 1. Instantaneously to all market information. 2. Rationally to all market information. MO requires new information in order for prices to change. Bullish news will cause prices to rise and bearish news will drive prices down. Acting rationally means that all participants will make the same logical decision based on the new. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Figure 1.27 Efficient Market Adjusting to New Information. Information received. Instantaneously means acting or responding immediately to new information. Therefore, for the market to efficiently discount or reflect all information, all of its participants must act on all of the information in the same manner instantaneously. See Figure 1.27. MO contends that since the markets are efficient, there is no point in employing technical analysis, as prices would have already adjusted to the new information and the analyst would have no way of forecasting future action without such information. The reality is that there is discounting in the markets, but it is in no way perfectly efficient. In other words, the markets are at best semi-efficient. This is because it is impossible to have all market participants acting instantaneously and rationally. It is a physical and logistical impossibility in the physical world. A simple hand clap test will prove the point. If a large group of participants was asked to clap in response to a specific single event like the ring of a bell, we would find that there is little chance of observing a perfectly coordinated hand clap across the group once such an event occurred. As we have already discussed earlier, not all participants in the real world would react in exactly the same manner or arrive at the same logical decision based on the new information. Some market participants may have a different view of the markets and view the new information as inconsequential with minor impact on the markets, and may even trade against the new information. Also, there are a large number of strategies that one can employ to trade the markets based on the same information. As a result, when new bullish information is released, participants may enter a long position, immediately enter a short position based on an average upscale trading strategy. 33. 34. Figure 1.28 A semi-efficient market gradually adjusting to new information. Scale in more positions as the market rises, scale out positions that may have already been in profit, wait for prices to become overextended before fading the breakout. Even if the market participants were to act rationally and all make the same logical decisions based on the new information, they may not be able to act on the information instantaneously. They may have received delayed information or were not standing by in readiness to act on the information when it arrived. They may also find it physically impossible to act on all information, especially when information streams in continuously in very quick succession. They may also be unable to afford the cost of such information. As such, the discounting of new information will take place at a slower rate, with a semi-efficient market adjusting gradually to the new information as market participants compete with each other for the best fills. See Figure 1.28. Figure 1.29 is a 5-min chart of the EURIST depicting the markets adjusting to new information, in this case the non-farm payroll and unemployment report. Notice how prices swing back and forth as traders compete with each other in light of the new information. Price finally makes a top at the 61.8% Fibonacci projection, projecting up from point C level and begins consolidating. Nevertheless, IMH assumes three basic levels of information discounting. 1. The weak form. The weak form of IMH suggests that all current prices have already been fully discounted and, as such, reflect all past price information. Therefore, they cannot impact future prices. The application of technical analysis is therefore pointless and meaningless. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Figure 1.29. A semi-efficient market gradually adjusting to new information. Source: MetaTrader 4. 2. The semi-strong form. The semi-strong form of IMH suggests that all information, once public, is of little use as price would have already adjusted to the new information, making the use of such information unprofitable and pointless. Market participants would have little opportunity to take advantage of such information. This implies that even fundamental analysis is pointless and meaningless. 3. The strong form. The strong form of IMH suggests that all information, regardless of whether public or private, would have been already fully reflected in the current price. Consequently, all forms of analysis and forecasting are pointless and meaningless. Random walk. Closely related to the IMH is the concept of random walk. Random walk suggests that prices move in a purely random manner and that past prices do not have any influence on current price. Current price has no influence on future price. Markovian condition. All information is already incorporated into the current price. This would mean that there is no way whatsoever to forecast future action, and prices are as likely to go up as they are to go down. This renders all form of analysis and forecasting pointless and meaningless. Random walk is in a way related to IMH, insofar as current price represents the current state of all information. In random walk, prices do not adjust to any new information, unlike in IMH. Its motion is purely random or stochastic. 35. 36. Figure 1.30. Random walk, IMH, and their implications. So, are the markets following a random walk? As we already know, the markets are driven by perception and expectation and not by random acts of buying and selling. It is totally inconceivable that all participants invest in the markets in a purely random fashion, completely unencumbered by cost, emotions, psychology, and biases. As we already know, market participants tend to react in a highly predictable manner time and time again. It is the author's opinion that random walk is simply not a true representation of everyday market action. See Figure 1.30. Real-world discounting. In the real world, markets overreact and there is insider activity. With insiders buying and selling, prices adjust to reflect this information. See Figure 1.31. Once the new bullish or bearish information is released, the insiders would in fact be liquidating positions in profit, selling off the shares to the public. Figure 1.31. Insider activity impacting market action. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Figure 1.32. Markets overreacting to new information. Figure 1.32 shows the market overreacting to new information. We see the insiders accumulating shares prior to the release of the new information. The public joins in after the information is published. Public participation begins to increase as more participants join in the now obvious rally in prices. This contribution leads to the herding behavior that finally causes the market to overreact to the new information. This is exactly what the insiders are hoping for, in order to extract the greatest amount of profit. Eventually a top is formed as the market runs out of buyers and or money to invest. The activity subsides only to repeat again. Price versus value. One interesting question that many novices ask is whether the market is discounting price or value. In fact, a more fundamental question to ask would be whether price represents value. If it does, then how do we explain a stock valued at $10 rising to a price of $30 in the absence of any significant changes in its fundamentals? In reality, market action is merely the collective expectations of all its participants. What we are really trading is expectation. It has not very much to do with absolute intrinsic value, but rather its expected value. In short, current price is the result of expectations about future price and value. Market behavior repeats itself. The second assumption or premise of technical analysis is that market behavior has a tendency to repeat itself. This means that past price and chart patterns will provide a reasonable basis for forecasting potential future behavior. The underlying explanation for the repeatability of price and market behavior lies in the fact that market behavior is driven by human psychology, which seldom changes over time. The uses of past patterns to predict futures moves are grounded in the reliability and consistency of human behavior. 37. 38. Ironically, most equity valuation modeling and standard economic statistical indicators are based on past or historical information as well. How else are we able to make an intelligent assessment of future outcome without reference to past data? It is human nature to try to infer, extrapolate, generalize, and predict potentially probable future outcomes. The reason for the popularity of classical price and chart patterns lies in the fact that they are essentially visual in nature. Human beings have an innate tendency for pattern recognition, and as such there is a natural inclination to gravitate towards such forms of analysis. The reliability of pattern analysis tends to improve as more market participants start to employ such patterns in their day-to-day trading and forecasting. Unfortunately, there are some challenges to the reliability of using past action as a forecasting tool, some of which are: 1. The preempting effect will slowly erode the reliability of historical patterns as traders start to outbid or outsell each other in anticipation of the approaching technical trigger levels. Preempting is a direct result of the self-fulfilling prophecy. 2. The effect of widespread program trading will affect the reliability of historical pattern trading as programs are able to trade in ways not easily replicated by manual or human trading. 3. The ever-changing influx of new participants into the markets will slowly affect the reliability of chart and price patterns unfolding in the expected manner. Although human psychology remains largely predictable over the longer-term horizon, short-term patterns are sometimes impacted by new participants who have a slightly different approach than the usual participants in that market. The market tends to move in trends. Lastly, from the definitions given of technical analysis, it is generally accepted that the market has a tendency to move in trends. This explains the popularity of trend-based methodologies. Of course, it is not hard to understand the basis for the popularity of trend trading, since trend action affords market participants the greatest profit over the shortest possible duration in the markets. But if we analyze this statement more closely, we understand that the term trend is inconclusive. What actually is a trend? When is a trend and when does it cease to be one? There have been many attempts to define what a trend is objectively. Successively higher or lower peaks and troughs is one widely accepted method, and is by far the preferred mode of identifying a trend. But then this begs the next question, which is, what constitutes a peak or a trough? Significant containment of price below or above a trend line or sloping moving average may also be deemed a valid way of defining a trend. We shall delve into the specifics of defining trends, consolidations, and other formations in Chapter 5. Although trend following is popular, there are some challenges to using it, some of which are: inefficient trade sizing in volatile markets, inefficient profit capture during trends. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Inefficient performance in ranging markets, inefficient adaptation to more volatile trend action, inability to identify trend changes efficiently, possibility of negative slippage in fast-moving markets, possibility of large drawdowns due to the low winning percentages, reduced performance caused by whipsaw action during consolidations, influx of trend-capturing systems produces inefficient fills, ineffective back and forward testing. Finally, it is important to note that a trend in one time frame may be a sideways market in another. 1.74 Basic assumptions in the application of technical analysis. There are 4 underlying premises associated with the application of technical analysis, namely: 1. Price behavior is expected to persist until there is evidence to the contrary. 2. For every bullish indication or interpretation, there exists an equal and opposite bearish indication or interpretation for the same price behavior or phenomena. 3. Extreme bullishness is potentially bearish, and extreme bearishness is potentially bullish. 4. A technical tool or indicator has no real significance except for that attributed to it by market participants. The first premise is about preserving the status quo. It should be noted that most technical analysis is based on a set of assumptions. Most assumptions derive from one grand underlying premise, that being the preservation the prevailing price behavior. For example, a trend is expected to persist until there is evidence to the contrary. Hence a state of persistence is assumed to be the status quo. If a cycle is identified, it is assumed to persist until cyclic failure is clear and obvious. If the market is in consolidation, it is expected to continue to range until a breakout is identified. The second premise is also a fairly obvious, not only in relation to technical analysis but also with much of life. For example, an analyst may make a case for rising oil prices as the reason for a rise in the Dow Jones Index since it is indicative of increasing demand, representing evidence of a recovering economy. The same analyst may also make a case for rising oil prices as the reason for a decline in the Dow Jones Index due to the widely held perception of increasing cost, and hence bearish for the economy in general. Another example would be to find the stochastics at an oversold level and conclude that the current uptrend is strong since it is potentially or implicitly bullish. Alternatively, the stochastics could be at an overbought level, leading to the conclusion that the current uptrend is strong since an overbought level is regarded as explicitly bullish. 39. The third premise above is obvious when using oscillators such as stochastics, RSI, and MACD. A reading of 100% on the stochastics is extremely and explicitly bullish, but it is also regarded as a potentially or implicitly bearish condition since it is at a level where price may generally be regarded as being overextended or exhausted. There is an underlying expectation or assumption that a reversion to the means would eventually take place. Note that this may not always be true, for example, in the case of cumulative type indicators. A breakout above a rising channel is also explicitly bullish, but it is also regarded as implicitly bearish since it also represents a state of overextension or exhaustion in price, with respect to the rising channel formation. The fourth premise is specifically about the effects of the self-fulfilling prophecy. It is easy to understand why a largely concerted wave of buying or selling at various points on a price chart may cause a significant reaction in price. This concerted wave of buying or selling will generally be more pronounced if these points are significantly clear and obvious to most market participants using technical analysis. Hence we generally notice a larger than average penetration bar during trendline breakouts, especially if the trendline is significantly clear and obvious to most traders. This also implies that should an indicator be essentially faulty or illogical in its design, if enough participants risk actual capital based on its signals, it would begin to exhibit a greater level of reliability. The efficacy of technical analysis at various time frames. Technical analysis generally works more efficiently at time frames where there are fewer forms of analyses available. For example, on higher time frames like the daily, weekly, monthly, or yearly charts, fundamental analysis plays a very important role in helping to forecast potential market action. But at very low time frames like the 1-minute charts, fundamental analysis may not be as useful, especially if the stop size is very small. In essence, the smaller the stop size, the more important will be the role of applying technical analysis when trying to forecast very short-term movements in price. This is the main reason why technical analysis is generally more reliable at lower time frames. 1.8 Market participants. Market participants comprise the average investors and traders, financial institutions, commercial and central banks, hedgers, arbitrageurs, brokers, hedge funds, mutual and pension funds, and so on. Here are the 8 main categories of market participants. 1. Retail. 2. Institutional 3. Speculator 4. Supply side 5. Demand side 6. Professional 7. Investor 8. Novice. 40. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Figure 1.33 Market participants by way of time spent in the markets. Market participants may also be categorized as discretionary traders, non-discretionary traders. But there are many other ways of categorizing market participants. We can categorize them by the amount of time they spend in the markets or by the methodology that they employ when trading or investing in the markets. Figure 1.33 lists the 5 main groups of market participants by the amount of time they spend in the markets. Figure 1.34 lists the same 5 groups of market participants by way of the methodology that they employ when trading or investing in the markets. Figure 1.34 Market participants by way of trading and investing methodology. 41. Figure 1.35 Popular markets and instruments. Popular markets and instruments. Market participants may trade and invest in either the main markets or instruments that allow access to these markets. These instruments are also referred to as derivatives, since they are derived from the main underlying markets. For example, a market participant may participate in gold in several ways. By buying the physical gold itself, main market; by buying or selling a futures contract on gold, derivative; by buying or selling an options contract on gold, derivative; by investing in gold-backed ETF shares, derivative; by investing and trading gold via contracts for difference, CFD, derivative. See Figure 1.35 for a visual summary of popular markets and their derivatives. 1.9 Chapter Summary. Technical analysis is the study of market action. It is an extremely popular AP approach engaging potential market moves as well as identifying past activity in terms of patterns, proportions, and time. It involves the study of price action, volume, and open interest action, market breadth, sentiment data, and the flow of funds. It attempts to identify potentially repetitive patterns in the form of chart and bar formations, price cycles, and seasonality, based on the assumption that there is some reliable degree of repeatability associated with these technical formations. We shall delve more deeply into these aspects of technical analysis over the rest of this handbook. 42. The Handbook of Technical Analysis. Introduction to the Art and Science of Technical Analysis. Chapter 1 Review Questions. 1. What are the challenges to technical analysis? 2. A basic assumption in technical analysis is that the market discounts everything. IM also requires the discounting of all information. In what ways are they different? 3. Describe how an analyst may resolve conflicting signals or chart patterns. 4. Explain why identifying a trend change is largely a subjective exercise. 5. Is random walk a true reflection of the markets? 6. Describe the 3 levels of discounting new information under IMH. 7. What is a good definition of technical analysis? 8. List as many advantages and disadvantages of using technical analysis as you can. References: Edwards, Robert D., and John McGee. 2007 Technical Analysis of Stock Trends. New York, Omnicom. Kirkpatrick, Charles, and Julie Dahlquist. 2007 Technical Analysis, the complete resource for financial market technicians. Upper Saddle River, New Jersey, Pearson Education Inc. Murphy, John. 1999 Technical Analysis of the Financial Markets. New York, New York Institute of Finance, NYIF. Pring, Martin J. 2002. Technical Analysis Explained, The Successful Investor's Guide to Spotting Investment Trends and Turning Points. 4th ed. New York, McGraw-Hill. 43. Chapter 2. Introduction to Dow Theory. Dow theory lays the basic foundation for modern-day technical analysis. Its premises underpin the very study of market action analysis and have withstood the test of time. In this chapter, we shall be discussing the basic assumptions of Dow theory and its relevance in today's markets. 2.1 Origins and proponents of Dow theory. Charles H. Dow is credited for much of the early work that led to what is known today as Dow theory. Dow's successor, William P. Hamilton, carried on developing and organizing much of Dow's original early writings, which included the Wall Street Journal editorials that were published around the beginning of the 20th century. Hamilton's work culminated in his book The Stock Market Barometer. A close acquaintance of Dow's, S. A. Nelson, published a book about Dow's work entitled The ABC of Stock Speculation and was the first person to refer to Dow's concepts and ideas as the Dow theory. Robert Rhea, a student of Hamilton, was later responsible for much of the categorizing, refining, and formal codification of Dow's basic premises, which were learning objectives. After studying this chapter, you should be able to understand the basic concepts and assumptions of Dow theory. Apply the concepts of Dow theory to forecast potential entry and exit points in the market. Identify the strengths and weaknesses of applying Dow theory. Explain the importance of price and volume confirmation as a basis for determining potential market action. Highlight the current challenges to Dow theory. 45. Laid out in Rhea's book The Dow Theory. It was Robert Rhea's work that really developed Dow's theory and laid the basic foundation with three important assumptions. The first is that the primary trend is not susceptible to manipulation, although there is a possibility that it could occur over the shorter term. Rhea's second assumption was that the averages discounted everything and that price is a reflection of all information. Finally, Rhea proposed that Dow theory itself is not perfect and that investing according to its principles will not guarantee profitability. At most, it should be regarded as a set of guidelines for investing. Dow published, in 1884, a stock market average of 11 stocks that he later developed into a 1-2 stock industrial index and a 2-0 stock railroad average. Dow wanted to create an index of stocks to better reflect the general action of the markets instead of trying to gauge market behavior via individual stock action, which was at the time fairly erratic and open to manipulation. The index was meant to average out or smooth these erratic price movements. The action of the averages was meant to act as a barometer of the current market environment. Since then, the 1-2 stock industrial index has gradually evolved into 30 stocks and is known today as the Dow Jones Industrial Average. The railroad average is known as the Dow Jones Transportation Average. 2.2 Basic assumptions of Dow theory. There are 6 basic tenets of Dow theory, namely: 1. The averages discount everything. 2. The market has 3 trends. 3. Primary trends have 3 phases. 4. A trend persists until its reversal is indicated. 5. The averages must confirm one another. 6. Volume must confirm the trend. In addition to the 6 basic tenets, only closing prices are recognized in Dow theory. The averages discount everything, pricing and information. It is believed that the markets discount everything, except acts of God. This means that the market is the end result of all participatory action, which represents all information that may be known to the markets. The mechanism by which information is known to the market is that of actual participation via capital injection. Although the market cannot discount unexpected events, that is, acts of God or unknown information, it can absorb, react, and adjust to market shocks fairly rapidly. The pricing of all known information need not be instantaneous or be driven by rational participants. There is also no requirement that all participants always act on all information all of the time, or that they react in the same manner. Figure 2.1 depicts prices declining before September 11, 2001. Is the market trying to discount information that is not as yet known, or is it merely coincidental? 46. The Handbook of Technical Analysis. Introduction to Dow Theory. Figure 2.1 Is the market discounting unknown information? Courtesy of stockcharts.com. Figure 2.2 shows the gold market adjusting very rapidly to information about the same event. The market is attempting to discount all information once the information is made known to it. In short, the market action is the sum of all participatory activity, based on the aggregate of the participants' beliefs, biases, personal predilections, as well as future expectations. Price is the ultimate reflection and embodiment of everything that is knowable. As such, the technical analysts need not concern themselves with the causes or circumstances giving rise to various market action, but only with the effects of the underlying causes. Figure 2.2 Gold adjusting rapidly to new information. Courtesy of stockcharts.com. 47. 48. The market has three trends. The second assumption of Dow theory is that the market comprises three trends. Robert Rea explains, in his book The Dow Theory. There are three movements of the averages, all of which may be in progress at one and the same time. The first, and the most important, is the primary trend, the broad upward and downward movements known as bull or bear markets, which may be of several years' duration. The second, and most deceptive movement, is the secondary reaction, an important decline in a primary bull market or a rally in a primary bear market. The reactions usually last from 3 weeks to as many months. The third and usually unimportant movement is the daily fluctuation. Summarizing, the market is believed to express itself as three distinct trends, namely 1. Primary trend, major trend, lasting from months to years, long term. 2. Secondary reaction, intermediate trend, lasting from weeks to months, medium term. 3. Minor trend lasting from days to weeks, short term. See Figure 2.3. 1. The primary trend. The largest trend is by far the primary trend, which is normally expected to last from months to years. Rea hypothesized that primary trends are not susceptible to manipulation and therefore represent a more reliable. Figure 2.3 All three trends in the NYSE Composite Index. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Introduction to Dow Theory. Figure 2.4 An uptrend in terms of successively higher highs and lows. Barometer for investment decisions. It is sometimes referred to as the tides of the oceans. Although the primary trend usually lasts from months to years, Rea comment that is it very difficult to forecast the extent or duration of a primary trend. There are two types of primary trends, namely, 1. Primary bull trend, bull market. 2. Primary bear trend, bear market. In Dow theory, an uptrend is defined primarily as successively higher peaks and troughs. A downtrend is defined as successively lower peaks and troughs. Note in Figure 2.4 that the appearance of a lower high in an uptrend may represent an early indication that the uptrend may be coming to an end. In Dow theory, an indication of a trend continuation or reversal is signaled by the penetration of a previous peak or trough. As such, one of the main criticisms of Dow theory is that buy and sell signals arrive too late, usually missing out on 1/3 or more of the entire trend. According to Dow, it is more important to participate in a primary bull or bear trend once it has been confirmed or once it proves that it has the strength to penetrate old peaks or troughs. Dow believes that losing out on some potential profit for the added safety of participating in a confirmed trend is well worth the sacrifice. It should also be noted that all investment and trading decisions are based strictly on the primary trend alone, with the exception of trading lines that may form from the daily price fluctuations. See Figure 2.5. Figure 2.6 depicts a primary bull trend in gold that lasted approximately 12 years. Figure 2.7 depicts a primary bear trend in the 30-year Treasury bond yield that lasted approximately 23 years. It should be noted that if trends are defined via trendline violations rather than by the successive sequence of rising or falling peaks and troughs, there may be some discrepancies between exactly when a change in trend actually occurs, especially when different chart scaling is employed. Logarithmically. 49. 50. Figure 2.5 Buy and sell signals based on Dow theory. Figure 2.6 A primary bull trend in gold. Courtesy of stockcharts.com. Figure 2.7 A primary bear trend in the 30-year Treasury bond yield. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Introduction to Dow Theory. Figure 2.8 Bull market turning into a bear market with early trend change signals on a logarithmically scaled chart of the Nasdaq 100 index. Courtesy of stockcharts.com. Scaled charts tend to give earlier trend change signals since uptrend lines are violated sooner. Conversely, arithmetically scaled charts tend to give slower trend change signals as uptrend lines are violated much later. See figures 2.8 and 2.9. Sometimes it may be hard to decide which scaling to use in order to apply technical overlays in a manner that would provide consistent signals. If an analyst has been using logarithmically scaled charts on a regular basis, his or her interpretation of the price action may differ from an analyst who regularly uses arithmetically scaled charts. Figures 2.10 and 2.11 show Apple Incorporated displaying a more bearish flattening out type behavior on a logarithmically scaled chart, whereas the arithmetically scaled charts depict a stronger and steadier uptrend for the same stock over the same period. 2. The secondary trend or reaction. The secondary trend is also referred to as the secondary reaction because it moves or reacts in the opposite direction. Figure 2.9 Bull market turning into a bear market with late trend change signals on a arithmetically scaled chart of the Nasdaq 100 index. Courtesy of stockcharts.com. 51. 52. Figure 2.10 Bearish flattening type action on Apple Incorporated. Courtesy of stockcharts.com. Of the existing primary trend, it usually lasts from weeks to approximately 3 months, and frequently slightly longer. It is sometimes referred to as the waves on the tides. The secondary reaction usually retraces from 1 to 2/3 of the primary trend's range. Any retracement or correction beyond 2/3 on high volume usually signifies that the secondary reaction may in fact be a new primary bear market. It is important to note that Dow theory also stresses the importance and psychological significance of the 50% retracement level, a view shared by another prominent technician, W.D. Gann. A primary bull trend resumes its uptrend once price breaches the highest peak formed by the secondary reaction, while a primary bear trend resumes its downtrend once price breaches the lowest trough formed by the secondary reaction. Figure 2.11 Non-flattening type action on Apple Incorporated. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Introduction to Dow Theory. Figure 2.12 Primary bull market resuming its uptrend after breaching the highest peak of the secondary reaction on the Dow Jones Industrial Average. Courtesy of stockcharts.com. Figure 2.3 showed the NYSE Composite Index resuming its primary bull market around the beginning of 2011 after breaching the peak formed during the formation of the secondary reaction. Figure 2.12 depicts a 75% secondary recession on the Dow Jones Industrial Average. The primary bull market resumes its uptrend upon breaching the highest peak formed during the secondary reaction. Figure 2.13 depicts various secondary reaction retracements in the Eurust. 3. The minor trend. The minor trends are not regarded as important in Dow theory. In fact, Hamilton commented in his book, The Stock Market Barometer, that the stock market is not logical in its movements from day to day. Minor trends usually last from days to weeks. They are sometimes referred to as the ripples on the waves. Under Dow theory, the day's erratic fluctuations represent market noise and no investment decision should be based on such erratic activity, with the exception. Figure 2.13 Secondary reactions on the Eurust daily chart. Source, MetaTrader 4. 53. 54. Figure 2.14 Example of a line on the daily chart of the bust. Source, MetaTrader 4. Of lines being formed. Lines are simply narrow horizontal ranging formations on the daily chart. They are usually formed in anticipation of some significant news or economic announcement. These narrow consolidations usually result in strong breakouts. Dow theory recognizes lines as potentially profitable formations, even though they are essentially regarded as minor trends. A line is the only tradable formation under Dow theory other than inflection point breakouts in the primary trend. See Figure 2.14. We see that each of the three trends is defined by its duration and extent. We shall now look at primary trends in a little more detail. Primary trends have three phases. Primary or major trends have three phases. A primary bull or bear market consists of the following three phases. 1. Accumulation phase. 2. Trending phase. 3. Distribution phase. Accumulation normally occurs after a deep and rapid decline in prices following companies releasing very negative data. The uninformed market participants are usually extremely bearish at this point, selling off whatever shares they have left at any price available. The better informed market participants start accumulating shares at extremely cheap prices. The accumulation phase normally lasts longer than the distribution phase due to less capital and profit at risk. The trend phase consists of the uptrend and downtrend phase. The uptrend phase is driven by market participants expecting higher prices after an accumulation. The Handbook of Technical Analysis. Introduction to Dow Theory. The initial general sentiment tends to be slightly less bearish. The public begins to participate as rising prices becomes more obvious and as more bullish news is reported. At higher prices, margin debt starts to increase as the public scrambles to invest in the rapidly rising market. The uptrend phase tends to last longer than the downtrend phase due to less capital and unrealized profit at risk, at lower prices. The downtrend phase normally starts to accelerate as more companies start to report increasingly bearish news. The uninformed traders and investors begin to unload positions. As prices begin to fall unexpectedly, the public begins to liquidate positions. Bearish sentiment continues to intensify as prices sink to new depths. The downtrend phase tends to be shorter-lived than the uptrend phase, due to the larger amounts of capital and unrealized profit at risk, at higher prices. Distribution normally occurs after a prolonged and rapid rise in prices. Companies tend to outperform and most media and news headlines are extremely bullish. The uninformed market participants tend to be extremely optimistic, buying up whatever shares are available in the market at any price, normally referred to as being in a state of irrational exuberance. Margin debt is at extreme levels. The smart investors continue to liquidate shares in a very gradual manner during the distribution process, again careful not to drive down prices too rapidly so that they may continue to sell at the higher prices. The distribution phase is normally shorter in duration than the accumulation phase, due to the larger amount of capital and unrealized profit at risk at higher prices, at the top of the market. See Figure 2.15. Also, the longer the accumulation or distribution lasts, the greater will be its subsequent breakout move. See Figure 2.16. A trend persists until its reversal is indicated. In Dow theory, a trend is assumed to persist until there is evidence to the contrary. Trend changes are identified by a penetration of a previous significant peak or trough. Therefore, unless a prior support or resistance level is breached, the trend is assumed to be still intact. See Figure 2.17. Figure 2.15. The idealized three phases of a primary bull trend. 55. 56. Figure 2.16. A real-world example of the three phases of a primary bull trend. There are basically three types of reversal formations that will signal a change in the direction of the existing or predominant trend, namely 1. Failure swings. 2. Non-failure swings. 3. Double tops/bottoms. The term failure swing was first used by Wells Wilder in his book, New Concepts in Technical Trading Systems, when describing the oscillator swings on the Relative Strength Index, RSI, indicator. The three basic top reversal formations are illustrated in Figure 2.18. A breach of a prior support signals a. Figure 2.17. Primary bull trend terminated with a violation of a prior support level. Source, MetaTrader 4. The Handbook of Technical Analysis. Introduction to Dow Theory. Figure 2.18. Top reversal patterns. Potential change in the direction of the trend. It also represents a technical sell signal. Note that the non-failure swing formation provides a more conclusive sell signal at the penetration of the second or lower support level, rather than at the first higher support level. This is because the formation was still in the process of making a higher peak, so more evidence is required to ascertain that a potential trend change is indeed on the way. Nevertheless, many traders use the first higher support level to scale in or out of some positions, with the remainder of the position scaled in or out at the breach of the second lower support level. The three basic bottom reversal formations are illustrated in Figure 2.19. The same rationale applies except in reverse. The averages must confirm one another. In Dow theory, there is a requirement that both the industrials average and the railroad average must extend beyond their secondary peaks in order for a trend to be established, that is, the trend in one average must be confirmed by the other. Figure 2.19 Bottom reversal patterns. 57. 58. Figure 2.20 Confirmation of the averages. Average. In Figure 2.20, we observe that the industrials average penetrated its secondary peak at T1 while the railroad average penetrated its own secondary peak a little later at T2. Hence the uptrend was only confirmed at time T2. As far as Dow theory is concerned, the uptrend was not confirmed until the railroad average penetrated its own secondary peak at T2. In Figure 2.21, we observe that the Dow Jones Industrial Average breached its own secondary peak at T1, which was confirmed later by the Dow Jones Transportation Average breaching its own secondary peak at T2. It is at T2 that the uptrend in the markets was finally confirmed, according to the tenets of Dow theory. In Figure 2.22, we observe that the Dow Jones Industrial Average experienced a weak non-failure swing sell signal, signifying a change in the trend. The bearish signal was not confirmed by the Dow Jones Transportation Average, and this was therefore regarded as a bullish indication. There is non-confirmation of a reversal in the trend. The Dow Jones Industrial Average subsequently resumed its uptrend after penetrating its own secondary reaction peak. The concept of confirmation may also be applied to closely correlated markets. In Figure 2.23, we observe that the change in trend in silver was not as yet confirmed by gold, a closely correlated market. This may be viewed as either a bearish signal for gold or a bullish signal for silver. A penetration of gold's support would generally be a bearish sign for silver. In Figure 2.24, we see an example of the Russell 2000 Small Cap Index not confirming the sell signals in the S&P 500 Large Cap Index. This may be regarded as bullish for the S&P 500. Although both the S&P 500 and Russell 2000 have experienced deep reversals, this non-confirmation may be construed as an oversold indication on the S&P 500. The Handbook of Technical Analysis. Introduction to Dow Theory. Figure 2.21 Confirmation of trend continuation based on Dow Theory. Courtesy of stockcharts.com. Figure 2.22 Non-confirmation of reversal in trend on the Dow Jones Industrial Average. Courtesy of stockcharts.com. 59. 60. Figure 2.23 Non-confirmation between gold and silver. Courtesy of stockcharts.com. Figure 2.24 Non-confirmation of a trend reversal between the S&P 500 Large Cap Index and Russell Small Cap Index. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Introduction to Dow Theory. Volume must confirm the trend. In Dow theory, volume has to increase or expand in the direction of the existing trend, that is, volume has to confirm the trend. If volume does not expand in the direction of the existing trend, then this is seen as a sign of weakness in the trend and may potentially lead to a weakening or reversal of the existing trend. It should be noted also that volume is considered to be a secondary indicator. Expanding in the direction of the existing trend means that 1. In an uptrend, volume should be increasing. 2. In an uptrend, volume should be decreasing during a downside retracement. 3. In a downtrend, volume should be increasing. 4. In a downtrend, volume should be decreasing during an upside retracement. If any of the four conditions listed above is not met, the existing trend may be potentially weaker than expected and may lead to a reversal in the existing trend. In Figure 2.25, we see volume, in area A on the chart, expanding in the direction of the existing primary bull trend in gold. Notice that on average, volume has declined during the retracement phase, as seen in area B on the chart. This is essentially a bullish indication for gold. We therefore expect more upside moves in gold over the longer term. Figure 2.26 illustrates the volume action associated with the primary bull trend between 2006 and 2010 in the Gold Spider Gold Trust shares. We see volume expanding in the direction of the trend in period 1, 3, 7, and 9. For periods 2, 4, 6, 8. Figure 2.25 volume expanding in the direction of the existing primary bull trend in gold. Courtesy of stockcharts.com. 61. Figure 2.26 volume expanding in the direction of the existing primary bull trend in Gold Spider Gold Trust shares. Courtesy of stockcharts.com. And 10 we see volume declining whenever there is a correction or retracement in the gold ETF, which is bullish. This all fits in perfectly with the assumption that gold was in a primary bull market between 2006 and 2010 and is an extremely bullish indication for gold. Gold subsequently went north to over $180 per share. Only closing prices are recognized. In Dow theory, only closing prices are recognized. This means that regardless of how large the high and low price excursions may be on any one day, only the final closing price will be used. Furthermore, it does not matter how minuscule the amount that price closes above or below the previous day's closing price. 2.3 Challenges to Dow theory. There are many criticisms of Dow theory. Here are some of the more significant arguments against it. 1. Dow theory is more applicable to the equity markets. Detractors of Dow theory argue that the theory is unsuitable for application in faster-moving markets or across lower time frames. For example, a commodity trader would have to wait for months and maybe even years for a buy or sell signal based on the penetration of a previous peak or trough in the primary bull or bear trend. Hedgers would have few or no counterparties to take the other side of. 62. The Handbook of Technical Analysis. Introduction to Dow theory. The trade. Furthermore, the capital risk would be astronomically high if the trader is expected to place a stop-loss order based on the motion of the primary trend. 2. The primary trend is susceptible to manipulation. Monetary policies such as near-zero interest rates set by central banks over extended periods combined with colossal stimulus packages and quantitative easing, QE, to infinity-type operations impact the longer-term action of the markets by creating an artificially super bullish environment where even its participants have little or no fear of anything untoward happening to the markets. Collective energy market rigging and the latest Libor scandal are further evidence that markets have and will always be susceptible to manipulation. Hence, Dow's main reason for trading the primary trend is questionable in today's highly impacted markets. 3. The averages are not a true reflection and barometer of the market environment. Unfortunately, in today's markets, the majority of indices are themselves tradable and are therefore open to manipulation. For example, the VIX was meant to reflect the level of fear in the markets. Its main objective is somewhat thwarted by the large amount of speculative trading impacting the VIX. Physical gold prices are also at the mercy of heavy shorting in its corresponding ETFs, like the gold, or via its futures and options contracts. Such products never existed in Dow's time. 4. Only closing prices are recognized. Recognizing only the closing price ignores potentially large intraday ranges that may occur during the day's trading session. These important price rejection levels are totally disregarded. Furthermore, there seems to be some conceptual conflict between recognizing the smallest amount required to close higher or lower while at the same time discounting potentially large and significant day-to-day fluctuations, regarding them as merely noise. 5. The buy and sell signals based on the primary trend are safer. This may or may not be true, but detractors of Dow theory argue that such signals usually occur late in the trend and miss a large part of it. 6. The identification of a new primary trend. Due to the difficulty in establishing whether a retracement is part of a secondary reaction or the inception of a new primary trend in the opposite direction, investments based on the belief that the retracement is merely a secondary reaction will run a higher risk of losing capital should the market unfold contrary to what was expected. 7. The averages must confirm each other. The rationale behind this logic is that in a healthy economy, the goods produced by industry are in great demand, and this is evidenced by the amount of transport activity generated in trying to ship these goods to the consumers. Therefore, underperformance in either the industrial or transportation averages leading to non-confirmation would logically signal potential trouble in the economy. Unfortunately, the Dow Jones Industrial Average today is composed of many stocks that do not produce any physical product that requires shipping or transport. In general, many of today's companies are more involved in financial products, telecommunications, and insurance. This severely diminishes the effectiveness of confirmation between the industrials and the transports. Many practitioners today prefer 63. To look for confirmation between large cap and smaller cap indices like the S&P 500 and Russell 2000 as a more reliable barometer of market action. 2.4 Chapter Summary. As we have seen, Dow theory forms the basis for much of technical analysis in the 21st century. Although technical analysis has evolved significantly since Dow's time, many practitioners still regard the basic application of Dow theory as one of the most reliable approaches in determining and confirming the existence of a trend. The incorporation of the concept of market phases and volume confirmation within Dow theory has also significantly impacted the way investors and traders participate in the market, more than a century after its introduction. Chapter 2 Review Questions. 1. Describe the basic tenets of Dow theory. 2. Give examples of the primary trend being manipulated. 3. Is Dow theory still relevant in today's market? 4. Describe the main weaknesses of Dow theory. 5. Explain why volume should expand in the direction of the existing trend. 6. In what ways is accumulation similar to distribution? 7. Why is the secondary reaction more problematic than the primary trend? 8. What are the main differences between Dow's and Ralph and Elliott's determination of a trend? References. W. P. Hamilton. 2006 The Stock Market Barometer. New York, Cosimo Classics. S. A. Nelson. 2007 The ABC of Stock Speculation. Marketplace Books. Robert Rhea. 1994 The Dow Theory. Flint Hill, Virginia, Fraser Publishing Co. Richard Schabacker. 1997 Technical Analysis and Stock Market Profits. Upper Saddle River, New Jersey, FT Press. Jack Shanab. 2008 Dow Theory for the 21st Century, Technical Indicators for Improving Your Investment Results. Hoboken, New Jersey, John Wiley & Sons. 64. The Handbook of Technical Analysis. Chapter 3. Mechanics and Dynamics of Charting. Traditional charting is a two-dimensional matrix upon which technical data or information is viewed. It affords the practitioner a means of tracking technical data in a meaningful way, revealing various repetitive price pattern behavioral traits and market volatility. In addition, charting also clearly reveals price distortions and illiquidity in the market. It allows for the application of technical analysis such as the drawing of trend lines, channels, envelopes, and chart patterns on price, helping to uncover important price reaction levels, which are driven by the consistent underlying psychology and perception of all market participants. In this chapter, we shall cover the basics of chart construction and how technical data is displayed. 3.1 The Mechanics and Dynamics of Charting. There are many ways that a technical analyst can analyze and display market data. Data may be displayed either in a numerical or graphical form. All numerical data may be displayed graphically, if required. Analysts using numerical learning objectives. After studying this chapter, you should be able to Understand chart construction and how technical data is incorporated and displayed. Describe the process by which OHLC data is created and its relationship to various charts. Identify and differentiate between contango and backwardation and understand the connection with negative and positive roll yields. Understand the adverse effects of the bid-ask spread on trading performance. Construct various charts using constant measures of time, range, volatility, trade vol, UME, and number of transactions. Set up a volatility neutral chart for consistent viewing of price action. 65. 66. Information to study market action may also resort to various quantitative and statistical techniques in an attempt to predict future price direction and volatility. These quantitative analysts and statisticians employ various forms of time series and stochastic analysis and conduct back and forward testing on technical data. They also try to identify price anomalies and arbitrage opportunities using sophisticated software programs and high-speed data connectivity. More traditional analysts prefer to work using only a graphical representation of technical data, which comes in the usual form of a price time chart, where the vertical axis tracks the movement of price and the horizontal axis tracks the motion of time. The price axis may be scaled in an arithmetic, linear, or logarithmic ratio fashion. On some charts, the time axis may not always be plotted in equal increments or units of time, but rather acting more as a counter for new blocks of data rather than an explicit representation of the passing of time. On such charts, time is regarded as implicit along the x-axis. Traditional analysts study classical chart patterns, trend lines, window oscillators, overlay indicators, and various other price formations. Analysts who use charts to study technical data are called chartists. Note that quantitative analysts and statisticians also tend to use charts to display numerical data, although it is optional. Technical data. Some of the more common technical data or information employed to construct charts include price data, open, O, high, H, low, L. Close, C, transaction-related data. Volume, V. Open interest, OI, market breadth data. Advances, A, declines, D, total issues, T, up volume/down volume, UV, DV, new highs/new lows, NH, NL, bullish percent data. Sentiment data, put/call ratio, short interest ratio, specialist/public ratio, cash/asset ratio, investor and advisor poll data, margin debt, implied volatility, VIX. The Handbook of Technical Analysis. Mechanics and dynamics of charting. The majority of charts are simple price time charts, using the basic open, high, low, and close information, popularly referred to as OHLC data. Let us now turn our attention to how OHLC data is created. Quantization of price. In order to create OHLC data, we first need to specify the time interval over which price activity occurs. For example, let us assume that we are interested in identifying the opening, high, low, and closing prices over 5-minute intervals. We therefore need to separate or quantize price activity with respect to time, for each successive 5-min interval, or period. An interval or period may be of any duration, but the most popular intervals are 1 min, 5 min, 1 5-min, 1 hour, 4 hour, daily, weekly, monthly, and yearly. In our example, the price at the beginning and end of any 5-min interval represents the opening, O, and closing, C, price respectively, while the highest and lowest price within that period represents the high, H, and low, L, prices. In most cases, the closing price will also represent the opening price of the next 5-min interval, unless there is a gap in price. Figure 3.1 depicts price activity within a 5-min period. Price is quantized into 5-min intervals and is summarized into 4 pieces of information, namely the OHLC data. Note that OHLC data is also used to construct other representations of price activity like bar charts, Gann bars, and Japanese candlesticks. The range of a bar or candlestick is simply the absolute difference between the high and low price, that is, range equals H, L. Refer to Figure 3.2. To create OHLC data for bars and candlesticks over long GER periods, simply identify the 1. Opening price of the first period, O, 2. Closing price of the last period, C, 3. Highest price between the opening and closing price, H, 4. Lowest price between the opening and closing price, L. Figure 3.1 Filtering price action into 4 pieces of information, OHLC. 67. 68. Figure 3.2 Higher time frame price action represented by composite/combination bars, OHLC. We observe the creation of a 5-minute bar and candlestick in Figure 3.2 via such a process. This method may be used over any duration to create bars and candlesticks of longer or multiple periods, normally referred to as higher time frame bars and candlesticks. Hence, a 5-minute bar represents a bar that is associated with a higher time frame, unlike 5 or 10-minute bars. Figure 3.3 shows a series of OHLC-based bars and its equivalent candlesticks being formed by the quantization of price into 5-minute intervals or periods. Figure 3.3 The quantization, filtering, of price action. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.4 OHLC as the basis of most chart constructions. OHLC data is therefore simply a summary of price activity within a certain interval or period. The longer the duration of the interval or period of the resulting OHLC data, the higher will be the time frame associated with such bars and candlesticks. As can be seen in Figure 3.4, most charts are created from basic OHLC data, with the exception of the equivolume chart, which requires additional information on volume in order to construct its bars. In short, equivolume bars require ALC data, with V representing volume. Figure 3.5 illustrates 3 different representations of the same sequence of OHLC data in the form a line, bar, and candlestick chart. When viewing charts, it is always best to turn off the auto-scaling feature. Auto-scaling attempts to fill the entire screen with price activity. As such, the heights of bars and candlesticks constantly change, depending on whether price is ranging or trending. If prices are flat or ranging, it will expand all price activity and attempt to stretch it across the entire screen, making low volatility activity seem more volatile by increasing the height of all the bars and candlesticks on the screen. Conversely, when prices are trending, auto-scaling will shorten the height of all bars on the Figure 3.5 Examples of various OHLC-based charts. Source, MetaTrader 4. 69. 70. Figure 3.6 Example of auto-scaling misrepresenting volatility. Source, MetaTrader 4. Screen in order to fit in the trend action, making volatile price activity look less volatile. In short, the vertical scaling is not preserved or constant. Switching off the auto-scaling function normalizes volatility on the charts, allowing for more accurate price visualization. Referring to the top 2 charts in Figure 3.6, we observe a certain region of price activity, encircled, being portrayed as more volatile than it really is, by virtue of increasing the height of all its bars when prices across the screen are ranging or flattish. We see the encircled area of activity suddenly shrink in the top right chart once auto-scaling fits in a subsequent trend. In the bottom 2 charts, we see prices maintaining the bar heights in spite of a subsequent trend appearing on the screen. In short, auto-scaling makes it very difficult to gain familiarity with the subtle nuances of price behavior occurring at various time frames of activity. It drastically misrepresents volatility on the charts. Significance of OLC data. Although OHLC data is the result of filtering price activity over a specified interval or period, not all data have similar significance. The opening and closing prices are merely a function of time stamping, that is, of confining price activity to within an arbitrary time interval, see Figure 3.7. Once that interval is completed, the prices at that instant, i.e., on that timeline, mark the closing price of the previous bar and in most cases, the opening price of the new current bar. The situation is vastly different in the case of the high and low prices, which are created by actual market forces of supply and demand. The highs and lows represent areas of price rejection, caused by the responsive actions of market participants. Traders and investors are reacting to high and low prices by risking capital in the markets. This makes the high and low prices more significant when compared to opening and the Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.7 Significance of OHLC data. Closing prices. It should be noted that the longer the interval or period, the more significant will be the high and low prices formed. Nevertheless, opening and closing prices begin to gain more importance and attention from market participants, making such prices more reliable and actionable, if the durations between active trading sessions are longer. The opening and closing prices are created over a longer interval, i.e., belonging to a higher time frame bar or candlestick. There are larger price gaps between the previous closing and new opening prices. See Figure 3.8. Longer durations between active trading sessions increase the psychological importance and significance of opening and closing prices. As such, daily opening and closing prices are generally of greater interest to market. Figure 3.8 Significance of opening and closing prices. 71. Participants than the intraday opening and closing prices between the morning and afternoon trading sessions, since there is a longer duration of non-trading activity on an intraday basis as compared to periods of non-trading activity between the intraday trading sessions. In markets where the trading is continuous, opening and closing prices have lesser importance as compared to high and low prices, as in the case of the spot foreign exchange (FX) market, which trades continuously through the week from Sunday evening to the Friday close. Generally speaking, opening and closing prices are also of greater significance if they belong to a higher time frame bar or candlestick. Opening and closing prices belonging to a daily bar are psychologically more significant than those belonging to a 1 or 5 minute bar. Finally, the larger the price gap between the last closing and new opening price, the greater the significance and importance of the opening and closing prices. 3.2 Gap Action. 4 types of gaps. There are essentially 4 ways to define a gap, which is represented by a range of prices where no trading activity takes place. Type 1, a gap measured from the close of the previous bar to the open of the next or current bar. It is created instantaneously at the open. There is an instant jump in prices either up or down with no trading activity taking place between the two prices. Type 2, a gap measured from the high or low of the previous bar to the open of the next or current bar. It is created instantaneously at the open. There is no trading activity within that price range. Type 3, a gap measured from the highs or lows of the previous bar to the highs or lows of the next or current bar. It is created only after the next or current bar has closed. This is the gap usually referred to as a window in Japanese candlestick or bar charts. It is also the type of gap referred to frequently when studying breakaway, runaway, also called measuring or midway, and exhaustion gaps, although types 1 and 4 gaps are also sometimes referred to when studying such formations. Type 4, a gap measured from the close of the previous bar to the high or low of the next bar. It is created after the next or current bar has closed. There is no trading activity within the price range from the close of the previous bar to the low or high of the next or current bar. See Figure 3.9. It should be noted that a gap itself normally represents an area of support or resistance, depending on whether price is above or below it. This is especially so when the gap created is a Type 3 gap. The gap or price window increases in significance and importance with larger gaps. Prices are also generally expected to return to fill the gap at a later date, although there are many instances where this does not occur. Finally, it may be of interest to the reader to know that the average true range, ATR, is somewhat related to a Type 4 gap, where the true range is either the range of the new bar or distance between the close of the last bar and the high or low of the new bar, depending on whichever is greater. 72. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.94 Types of gapping action representing areas of non-trading activity. We shall be covering gaps in more detail in Chapter 5, where we will be analyzing gaps in relation to market phase. The four main types of gap covered are 1. Common gaps, 2. Breakaway gaps, 3. Runaway/continuation/midway gaps, 4. Exhaustion gaps. 3.3 Constant chart measures. There are 5 types of constant measure charts, namely 1. Constant time charts. Bar closes when a specified time interval is met, for example, candlestick charts, bar charts, equivolume charts. 2. Constant range charts. Bar closes when a specified excursion in price is met, for example, point and figure charts and Renko charts. 3. Constant volume charts. Bar closes when a specified volume is met, for constant transaction, tick, charts. Bar closes when a specified number of transactions, trades, is met. 5. Constant volatility charts. Bar closes when a specified amount of standard deviation or ATR is met. Constant time charts. Constant time charts quantize price activity into units of time, or intervals. Each bar is complete once a specified amount of time has elapsed. Hence, such charts are also referred to as interval charts. Below are the characteristics associated with constant time charts. The bar range is variable. The bar duration is constant. 73. 74. The bar volume is variable. The transactions per bar is variable. The bar volatility is variable. Examples of constant time charts include Japanese candlestick, bar, equivolume, and line charts. Constant time charts work effectively with both numerically and geometrically based overlay indicators. Refer to Chapter 8 for more on numerical, geometrical and horizontal based indicators. Non-constant time-based charts should use numerical and horizontal-based overlay indicators, since the time axis is not plotted in a linear fashion and hence will affect the application of geometrically based overlays such as trend line, channel, and traditional chart pattern analysis. This is the reason why non-constant time-based charts such point and figure charts employ bearish resistance and bullish support lines in place of conventional trend lines. Constant time charts represent the most popular form of chart construction. Bar charts. As seen in Figure 3.1, a bar chart is easily created via the quantization of price into specified time intervals or periods. Bar charts clearly depict levels of supply and demand in the market. Unfortunately, opening and closing prices are harder to read from a distance as the open and close markers may be too indistinct when the chart is populated with a large number of bars. Line charts. Line charts are created by connecting all of the closing prices. Each time interval creates a new closing price. Line charts do not provide much information about potential levels of supply and demand since they ignore high and low prices, which are the true indicators of market force. Nevertheless, because line charts filter out all information except closing prices, they are usually employed as a trend identifier or simple summary of price activity. Japanese candlestick charts. Japanese candlesticks are created in essentially the same manner as standard price bars, as seen in figures 3.1 to 3.3. The only difference is that the space between the opening and closing price is boxed up and is referred to as the real body. Real bodies may be filled or hollow depending on the configuration or relative position of the opening price to the closing price. Real bodies may also be represented as black or white candlesticks. Candlestick formations may be classified as follows. 1. Bullish or bearish. 2. Reversal or continuation. 3. Simple, double, or multiple. We shall be delving more deeply into candlestick formations in Chapter 14. For now, refer to Figure 3.10. As with price bars, it is not possible to determine whether the high or low prices were created first, since most of the INTRA bar price information has been filtered out. Equivolume charts. Equivolume charts are based on constant time-based bars, incorporating volume over a specified time interval and displaying it visually on the Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.10 Bullish and bearish Japanese candlesticks. The charts in terms of bar width, rather than height. Equivolume bars are constructed using high and low prices. Open and close prices are disregarded. Larger volume over a particular interval or period will result in a wider bar. Because of the variable bar width, the horizontal or time axis is not plotted in a linear fashion, even though equivolume bars represent constant time-based bars. As such, geometrically based overlay indicators such as trend lines, channels, and chart patterns are somewhat affected or distorted when applied to such charts. Figure 3.11 clearly depicts the nonlinear increments along the horizontal or time axis on the daily equivolume chart of Apple Incorporated. Notice that the trend lines intersect the Figure 3.11 comparing a Japanese candlestick to an equivolume chart. Courtesy of stockcharts.com. 75. 76. Vertical or price axis at different prices. Conversely, numerical and horizontal-based overlay indicators are not affected by the nonlinear axial increments on equivolume charts. Constant range charts. On constant range charts, each bar, box, or brick is complete once a specified excursion in price is met. Examples of constant range charting include Renko and point and figure charts. Below are the characteristics associated with constant range charts. The bar or box range is constant. The bar or box duration is variable. The bar or box volume is variable. The transactions per bar is variable. The bar or box volatility is constant. Point and figure charts. Point and figure charts represent the most popular form of constant range charting. Once a specified amount of price excursion is recorded or detected, a new bar is plotted. These bars are referred to as boxes. Point and figure charts are populated by continuation and reversal boxes. A continuation box specifies the minimum price excursion required for a new box to be plotted in the direction of the existing trend. The reversal size consists of a specified number of boxes required for a reversal to be plotted on the charts. The size of the boxes is arbitrarily chosen. For example, a $1 box size requires price to move at least $1 before a new box is plotted, and if the reversal size is 3 boxes, price will be required to move at least 3 times $1 equals $3 before a reversal may be plotted on the chart. Closing prices are normally used to determine the completion of a box, although many practitioners also use the high and low prices. Rising prices are indicated by a column of rising XS, whereas declining prices are indicated by a column of falling OS. As constant range charts, the time axis is nonlinear and as a consequence, geometrically based overlay indicators would exhibit inconsistent readings. This is the main reason why point and figure charting uses a unique form of trend lines which are not based on drawing a line between 2 points. Only one point is required and the trend lines rise and fall along 45 and 45-degree angles. See Figure 3.12. Renko charts. Renko charts are another form of constant range charting. The Renko bars are referred to as bricks. There are bullish white bricks and bearish black bricks. They are very similar to point and figure charting except that each new brick is plotted in a new column. A new brick is plotted once the minimum price excursion required for a new brick to be created is met. Since the creation of a new brick is not time dependent, the time axis is plotted in a nonlinear fashion. All reversals require price to move at least 2 bricks in the opposite direction. Hence, Renko charts are essentially 2-brick reversal charts. Again, the size of the brick is arbitrarily chosen. See Figure 3.13. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.12 A point and figure chart of Google Incorporated courtesy of stockcharts.com. Constant volume charts. In constant volume charts, a new bar is plotted once the minimum volume traded is met. Below are the characteristics associated with constant volume charts. The bar range is variable. The bar duration is variable. Figure 3.13 A Renko chart of iPath Dow Jones AIG Coffee Total Return Subindex. Courtesy of stockcharts.com. 77. 78. The bar volume is constant, the transactions per bar is variable, the bar volatility is variable. Since the creation of a new bar is not time-dependent, the time axis is plotted in a nonlinear fashion. Constant transaction, tick, charts. In constant transaction or tick charts, a new bar is plotted once the minimum number of transactions for a new bar to be created is met. Below are the characteristics associated with constant transaction charts. The bar range is variable, the bar duration is variable, the bar volume is variable, the transactions per bar is constant, the bar volatility is variable. Each transaction is represented by one tick. Therefore, 5 ticks indicate that 5 transactions took place. Note that the volume associated with each transaction is unspecified, though it may be inferred, depending on the market traded. The time axis for constant transaction charts is plotted in a nonlinear fashion. Constant volatility charts. In constant volatility charting, each new bar is plotted once the minimum price excursion for the creation of new bar is met. Below are the characteristics associated with constant volatility charts. The bar range is variable, the bar duration is variable, the bar volume is variable, the transactions per bar is variable, the bar volatility is constant. This difference between this form of charting and constant range charting is that the minimum price excursion required is determined by price volatility. For example, we could set up a chart whereby each new bar is plotted once the minimum price excursion of 2 times ATR is met. In a sense it is objective, as the bar size is determined by market volatility. Nevertheless, it is also subjective insofar as the choice and the number of multiples of ATR to be employed is concerned. Figure 3.14 illustrates the use of a point and figure chart where the box size is set to 1 times ATR. Notice its use of constant volatility charting to identify trends more effectively as compared to regular constant range charting, as seen on the right-hand side of the illustration. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.14 comparing constant volatility to constant range charting. Courtesy of stockcharts.com. Chart constructs with no measures of constancy. There exist certain chart constructs where there exist no measures of constancy. This implies that the range, duration, volume, number of transactions, and volatility of each bar is variable. Three-line break charts. Three-line break charts are unique in that they possess no measures of constancy. Once price closes above the previous high or below a previous low, a new line is created. Once 3 successive lines are created, a reversal may only be plotted if price meets or exceeds the low, or high, in an upside reversal, of the last 3 periods and a downside reversal. There are bullish white lines and bearish black lines. See Figure 3.15 for a comparison between 3-line break and Renko charting for the currency shares Euro Trust. Chart scaling. There are 3 basic types of scaling employed when creating price charts, namely the 1. Linear or arithmetic scale, 2. Ratio or logarithmic scale, 3. Square root scale. The most common scalings used are the linear and ratio scalings. The square root scale lies somewhere between the linear and ratio scales with respect to its scale increments. It is not commonly used on most platforms. 79. Figure 3.15 comparing 3-line break with Renko charting on the currency shares Euro Trust. Courtesy of stockcharts.com. In linear scaling, equal distances on the chart represent equal price changes. This would imply that equal price changes at higher prices would result in lower percentage changes. For example, a price change from $10 to $20 would represent a $10 change in price and a 100% change in price, that is, $20 $10 $10 times 100%. A price change from $90 to $100 would also represent a change of $10 in price, but at this higher price level, its percentage change is merely $100 $90 $90 times 100% equals 11.1%. Hence, for linear scaling, the percentage change is not preserved for equal units of price change. If Pn represents the nth price, then linear scaling simply means that Pn 1 is a constant for every equal distance move on the chart. See Figure 3.16. In ratio scaling, equal distances on the chart represent equal price percentage changes. This would imply that equal percentage changes at higher prices would result in larger price changes. For example, an equal percentage change of 100% based on a price change from $10 to $20 would require a price change of $90 at the $90 price level, that is, the price difference between the $180 and $90 price level. Hence, for ratio scaling, the price change is not preserved per equal units of percentage change. This also means that equal distances on the chart does not equate to equal percentage changes. Figure 3.16 Linear Scaling. 80. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.17 Ratio Scaling. If Pn represents the nth price, then ratio scaling simply means that Pn1/Pn1 is a constant for every equal distance move on the chart. Figures 3.17 and 3.18 show how the percentage increments need to rise to account for an equal price change. This formula represents what is also referred to as stock returns. The ratio scale tends to compress price action at higher prices and expand it at lower prices, whereas linear scaling represents price evenly across the entire price range. Consequently, for very large price differences, linear scaling will not represent price activity clearly at lower prices due to the ever-increasing price range that is made to fit on one chart. But it would reveal upper price activity with better clarity when compared to ratio scaling, which tends to compress upper price accretion, making it relatively more difficult to observe price patterns and volatility behavior. But a log scale would reveal lower price action with more clarity. In short, linear scaling provides better upper-end definition and visualization of prices, but relatively poorer clarity at lower prices. Ratio scaling provides better lower-end definition and visualization of prices, but relatively poorer clarity at higher prices. As a general guideline, use linear charts when the price range under observation is relatively small. For stock price ranges exceeding $100, it may be more appropriate to use ratio charting. It is also best to employ ratio charts for viewing. Figure 3.18 Ratio Scaling. 81. 82. Very long-term market action. This mainly applies to the equity markets. For charts based on futures or foreign exchange contracts, including any instrument being traded on very low margin, i.e., very high leverage, linear charts would be more suitable, as ratio charts would compress price too much at higher prices. When applying technical analysis to price, the type of scaling may affect the forecasting of potential support and resistance levels, introducing inconsistencies and discrepancies in the forecasted levels of potential price reaction. This affects all overlays that rely on geometry in their construction, such as trend lines, channels, and chart patterns. Consequently, if the scaling changes, the angles of all trend lines will also change accordingly, indicating different levels of potential support and resistance. Scaling does not affect overlays that are constructed numerically like moving averages and price envelopes. It also does not affect overlay indicators that indicate horizontal levels of support and resistance, like prior support and resistance levels, Fibonacci extensions, retracements, projections, and expansions, GAN 1/8 and 1/3 price retracements, GAN square of 9 price projections. It should be noted that if square root scaling is employed, it will indicate an uptrend line penetration that is later than that for ratio scaling but earlier than an uptrend line penetration based on a linear scale. This is rather disconcerting, as the majority of traders will react to violations of the uptrend line based on either linear or ratio scaling. Hence, a trader utilizing square root scale charting will find him or herself initiating entries and exits either too early or too late with respect to important and significant price reaction levels in the market. Insofar as drawing uptrend and downtrend lines using linear and ratio scaling, it behooves the practitioner to note the following. Uptrend lines are penetrated sooner while downtrend lines are penetrated lat-er on ratio or logarithmically scaled charts. Uptrend lines are penetrated later while downtrend lines are penetrated soon-er on linear or arithmetically scaled charts. See figures 3.19 and 3.20. Switching between linear and ratio scaling may also result in the following. Declining prices may take on a potentially bearish appearance with prices AC seal rating as they decline in a convex type fashion, resembling a downward parabolic move on ratio or logarithmically scaled charts. Rising prices may take on a potentially bearish appearance with prices decelerating as they rise in a concave type fashion, resembling a flattening out or rounding top formation on ratio or logarithmically scaled charts. Declining prices may take on a potentially bullish appearance with prices decelerating as they decline into a concave type fashion, resembling a flattening out or rounding bottom formation on linear or arithmetically scaled charts. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.19 comparing uptrend line penetrations on linear and ratio charts on the Spider Dow Jones Industrial Average. Courtesy of stockcharts.com. Rising prices may take on a potentially bullish appearance with prices accelerating as they rise, or rising evenly, in a convex type fashion, resembling an upward parabolic move, or steadily rising prices, on linear or arithmetically scaled charts. See figures 3.21 and 3.22. Figure 3.23 highlights the discrepancies between linear and ratio scaled charting when drawing price channels based on identical price inflection points. Geometrically based barrier overlays give rise to inconsistencies when compared using Figure 3.20 comparing downtrend line penetrations on linear and ratio charts on the U.S. Natural Gas Fund. Courtesy of stockcharts.com. 83. 84. Figure 3.21 comparing linear and ratio scaling on the daily chart of A123 Systems Incorporated courtesy of stockcharts.com. Figure 3.22 comparing linear and ratio scaling on the daily chart of Apple Incorporated courtesy of stockcharts.com. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.23 comparing channels on linear and ratio scaling on the daily chart of Energy Services of America Corp courtesy of stockcharts.com. Different chart scaling. Note that numerically based barrier overlays like moving averages are not affected by chart scaling and display no discrepancies in their readings. The bid-based chart and bid-ask spread charts are typically drawn based on bid prices, although many charting platforms also allow for the display of price action based on ask and mid prices. The use of bid-based price charts has a significant effect on trading chart patterns, pullbacks, and breakouts, by virtue of the spread between the bid and ask prices. It is also dependent on whether we are buying at the ask, buying at the bid, selling at the ask, selling at the bid. In general, trade performance is generally adversely affected when initiating long entries and executing long exits on bid-based charts. It does not specifically affect short entries or short exits. Nevertheless, since a trade consists of a buy and a sell, the bid-ask spread affects all trades. Initiating short entries on bid-based charts allows the trader to enter at the precise price level intended. For example, assume that we want to short at a prior resistance level of $10. Assume that the bid-ask spread, that is, the price difference, 85. 86. Figure 3.24 shorting resistance at the bid between the bid and ask price is 20 cents. The moment we see price on the bid-based chart test the $10 level, we enter a market order to short at $10. Ignoring the possibility of negative slippage for now, we are filled at $10. There seems to be no difficulty in establishing a short at the intended price. The outcome is similar to using a pending order to initiate a short entry. If we placed a sell limit order at $10, we should also be filled at that intended price or better. Even if the short represented an exit such as a stop loss or profit target, we would still be able to exit at the intended price. This is because we are shorting, i.e., selling to open or close a position, at the bid, i.e., sell, price. There seem to be no difficulties associated with initiating short entries or exits at the intended price on a bid-based chart. See Figure 3.24. Now let us turn our attention to long entries. Let us assume that we intend to go long on an upside breakout, initiating an entry 5 cents above the $10 breakout level. We see prices test the $10.05 level and we immediately initiate a market order. We then find out that we had actually entered at $10.25, instead of $10.05. This is because when we enter an order to buy, we need to accept the ask price, which is 20 cents above the bid price. Hence, even though we have initiated a long position at precisely the right time of entry based on a bid-priced chart, we nevertheless bought in at a higher price that we had intended. This is referred to as the problem of the expensive longs. See Figure 3.25. Assume now that we initiate the same entry, but this time using a pending order in the form of a buy stop entry order. We place a buy stop order to go long at $10.05, just as before. We later find that we were filled at exactly $10.05. Unfortunately, when the buy stop order was filled at the ask price of $10.05, the bid price was still below the $10 breakout level, being 20 cents below the ask price at $9.85. This essentially means that we have bought into a position before the breakout, based on the resistance level on bid-priced chart. This is referred to as the problem of the early longs. Traders therefore have no choice but to buy in at a relatively higher price, which reduces the profit potential, or to buy in too early at the exact intended price. Either way, the bid-ask spread adversely affects both long instantaneous and pending order entries. Let us now look at how the bid-ask spread affects long entries in declining markets. Let us now imagine that we intend to buy at the prior support level of $10. We see price test the $10 level and we immediately enter a market order to go long. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.25 going long at the breakout. We soon find out that we bought in at $10.20, that is, at the ask price. Again, we encountered the problem of the expensive longs. This occurred because the very moment the market order was filled, the ask price was 20 cents above the support level as viewed on a bid-priced chart. Assume now that we placed a pending order to buy in at $10. We soon find out that we were filled at exactly $10, that is, at the ask price that we had originally intended to be filled at in the market. Unfortunately, when we were filled at $10, the bid price was already below the support level at $9.80, as viewed on the bid-priced chart. This means that we bought into a support level after it was already breached. This is referred to as the problem of the late longs. See Figure 3.26. The bid-ask spread also affects the reward-to-risk ratios. The spread increases the probability of exiting at the stop loss promoting. Reduces the probability of exiting at the profit restricting. With market orders, the spread is deducted from the profit and added to the loss, which is reflected in the trading account. In Figure 3.27, a trader buys when the bid price was at $1. Since the bid-ask spread was 20 cents, the trader went long at $1.20. With a profit target at $1.50, the maximum profit would be 30 cents, instead of 50 cents. But for a stop size of 50 cents, the maximum would be 70 cents, instead of 50 cents. Hence the actual spread-adjusted reward-to-risk ratio, R/R ratio, is Figure 3.26 going long at support. 87. 88. Figure 3.27 buying based on bid prices on the charts. 0.43, and not 1. Hence the spread adversely affects the R/R ratio for instantaneous long market order entries executed based on bid prices. With pending orders, the spread is not deducted from the profit or added to the loss and is not reflected in the trading account. The spread cost is hidden within the dynamics of the pending order setup, such that to make a profit price has to traverse a greater distance, whereas for a loss price has only to move a relatively shortly distance. As such, for long entry pending orders, the spread does not alter expected the R/R ratio, but it does adversely affect the probability of securing a successful trade by virtue of the amount of work that the market has to do in order to generate profit and the ease of being stopped out. See Figure 3.28. To mitigate the adverse effects of the spread on the reward-to-risk ratio for instantaneous long entries based on bid prices on the chart, the trader needs to Figure 3.28 buying based on ask prices via pending orders. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Increase the ratio of target size and stop size over the spread. The most obvious way to accomplish this is to trade at a higher time frame or on a larger wave cycle. The larger the absolute size of the profit target and stop loss, the less will be the relative cost of trading against the spread. The spread affects the short-term trader the most, especially scalpers, and that is why they need to buy at the bid and sell at the ask price in order to reduce the cost of trading. A standard Level 1, L1, trading platform will not allow traders to buy at the bid or sell at the ask price. 3.4 Futures Contracts. Futures contracts were originally created to allow commodity producers a means of hedging against falling prices, and hence they are essentially a bearish mechanism. By shorting an equal amount in the futures market, producers need not worry about falling prices during harvest time. They have already locked in production costs and any potential profit, irrespective of future prices rising or declining. Depending on when the goods are ready for sale, producers may choose nearby or further out futures contracts to hedge their costs and lock in any profit. Unlike equity markets, in the futures market all contracts eventually expire, requiring the trader who intends to hold on to a position to roll over into the next available contract. Contracts are available at various expiration months, but usually every quarter in March, June, September, and December, extending out beyond a year in many cases. A futures contract is normally fairly illiquid through its lifespan until the last 3 to 6 months before expiry. Volume and open interest are greatest around 2 to 3 months before expiry. As it approaches expiry, volume subsides as traders begin rolling over into the next available contract. It should be noted that this decline in volume toward the expiry of a contract may cause some confusion and may even lead an analyst to believe that any trend present is potentially weak due to the decreasing volume and open interest. A quick peek at the next nearby contract will normally show that volume is in fact increasing over the same period as traders pile into the next contract. Hence, to gauge the true volume and open interest action across rollover points, a continuous chart should be employed. See Figure 3.29. Figure 3.30 shows the volume over the same period using a continuous contract. We observe that we are now able to visualize continuity in volume action across multiple contracts, rather than isolated instances of volume action within each separate futures contract. When trying to decide on the most appropriate contract to trade, look for the contract with the largest volume and open interest. This may not always be the nearby contract. It is also best to roll over slightly before expiry in order to avoid the volatility caused by traders exiting at the very last stages of the contract. The contract with the closest expiry is referred to as the nearby, nearest, or front month contract. The next available contract further out is referred to as 89. 90. Figure 3.29 comparing volume action on the daily chart of silver July and September 2011 futures. Courtesy of stockcharts.com. The next contract. It is the second further out contract with an expiry closest to the nearby contract. Contracts further out are also referred to as back month contracts. Traders may choose to continue rolling over into the next nearby or front month contract. They may also choose to only roll over into the next month contract, that is, 2 contracts further out, instead of rolling over into the next nearby contract. Once liquidity starts to subside, traders will normally start to roll over into the next nearby contract. Sometimes traders may also enter into 2 Figure 3.30 Volume Action on the Continuous Daily Chart of Silver. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.31 Identifying the front, next, and back month futures contracts. Futures contracts, one closer and another further out, to create a calendar spread or for other hedging purposes. The nearby or front month contract has a few distinguishing characteristics such as an expiration date closest to the current date, the narrowest bid-ask spread, the narrowest spread with respect to the spot price, the most liquid contract. Figure 3.31 shows quarterly contract months expiring over a 12-month period. Assume that we are currently in the month of March and that the March contract has already expired. We may now choose to participate in the June contract, which represents the nearby or front month contract. We may instead choose to participate in the next month or next nearby contract, that is, the September contract. We may even consider, depending on the trading strategy, to participate in a far out or back month contract like the December or following March contract. Futures contract delivery months are given a letter of the alphabet for identify cation purposes, namely, F for January, G for February, H for March, J for April, K for May, M for June, N for July, Q for August, U for September, V for October, X for November, and Z for December. When a futures contract approaches expiry, traders begin to roll over into the next nearest contract with the next closest expiry. The new contract may not be trading at the same price as the nearby expiring contract. It may be trading at a higher price, requiring the trader to pay a premium in order to participate in the new contract. In such cases, we say that the new contract is trading at a premium to the previous contract. Traders are required to roll over at a premium, and this will adversely affect the potential profitability of the trading campaign. It is not uncommon for successive new contracts to roll over at a premium, resulting in accumulated losses, diminishing profits along the way. Hence, it is actually possible to lose money by being long in a rising or sideways market if the rollover premiums are large enough. Rolling over at a premium causes the trader to experience negative roll yields. See Figure 3.32. 91. 92. Figure 3.32 Losses from negative roll yields. Sometimes, the next contract may be trading at a lower price, in which case the trader rolling over into the new contract will receive a payment. In such cases, we say that the new contract is trading at a discount to the previous contract. It is not uncommon for successive new contracts to roll over at a discount, resulting in accumulated gains, boosting profits along the way. It is therefore actually possible to make a profit by being long in a declining or sideways market if the rollover discounts are large enough. Rolling over at a discount causes the trader to experience positive roll yields. See Figure 3.33. Another interesting characteristic of futures contracts is that further out contracts may be trading at successively lower or higher prices compared to the nearby contract or spot price. When further out contracts are trading at successively higher prices when compared to the expected spot price at expiry, we say that the market is in normal contango. Conversely, if further out contracts are trading at successively lower prices when compared to the expected spot price at expiry, we say that the market is in normal backwardation. Sometimes, the terms contango and backwardation, especially when the term normal is dropped, may also be used loosely to mean that further out contracts may be trading at successively lower or higher prices compared to the nearby contract or current spot price. Viz. Figure 3.33 Profiting from positive roll yields. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.34 Simple contango observed on the daily chart of 2012 gold futures. Courtesy of stockcharts.com. Is of course an informal use of the terms, but nevertheless, it is common practice among futures traders. See Figure 3.34 for an example of this popular definition of simple contango. We observe the further out gold contracts trading at successively higher prices when compared to the nearby December contract. Although we observe simple contango, the contracts may or may not be in normal contango, which requires some knowledge of the expected or estimated spot price at expiry, in order to determine if normal contango actually exists. One important aspect about futures contracts is that futures prices always converge to the spot price at expiry. Hence, if a contract is in contango, and assuming that the spot price remains constant, it will eventually decline in price, experiencing negative yields as it converges toward the lower spot price at expiry or maturity. Conversely, if a contract is in backwardation, it will eventually rise in price, experiencing positive yields as it converges toward the higher spot price at expiry or maturity. Hence, in certain situations, especially with some mispricing, it may be possible to long a far-out backwardated contract and simultaneously short a nearby contract, gaining from the convergence as expiry approaches, irrespective of the future direction of price. In short, a gain is locked in without any directional risk involved. Again, profitability depends on the spread and aggregate trading costs accumulated over the period of convergence, toward expiry. See Figure 3.35. Figure 3.36 is an example of contango eroding returns in the natural gas market during 2009. Natural gas experienced a tremendous rally throughout 2009, which was not matched by the U.S. Natural Gas Fund, which tracks natural gas prices via futures contracts. Although the market was rising, rolling over at relatively large 93, 94. Figure 3.35 Convergence of spot and futures prices at expiration. Premiums actually resulted in a loss if traders rolled over continuously. We see the U.S. Natural Gas Fund experiencing excessive negative roll yield as it seriously underperforms gas prices. It should be noted that very short-term traders who trade individual contracts without having to roll over positions are not affected by negative roll yields, nor do they profit from positive roll yields. Figure 3.37 clearly shows the underperformance of the U.S. Natural Gas Fund with respect to prices in the natural gas market. As we have already seen, there may be a premium or discount gap between the nearby and the next contract. As far as traders are concerned, this only requires a payment or receipt of payment with respect to the price difference and number of contracts held at rollover. But for the chartist, the challenge is to find a way to preserve the continuity of prices across such price gaps. There are many ways to. Figure 3.36 Comparing performance on the continuous daily chart of natural gas and the U.S. Natural Gas Fund. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Mechanics and Dynamics of Charting. Figure 3.37 Relative Strength Chart of the Continuous Daily Chart of Natural Gas against the U.S. Natural Gas Fund. Courtesy of stockcharts.com. Represent disjointed data in a more meaningful manner. Here are some popular approaches. Unadjusted nearest futures contracts back, or spread, adjusted continuous contracts perpetual contracts. This simplest way to use charts of individual futures contracts is to just connect the nearest contracts without accounting for the gap, that is, unadjusted with respect to the price difference or spread between any two contracts. This approach preserves the actual sequence of nearby contract prices. It also serves as an accurate record of historical prices. Even so, it is not possible to apply technical analysis in a meaningful way to such concatenations of disjointed contract prices. It also makes back and forward testing impossible due to the gaps between prices, which are not representative of the actual price flow. See Figure 3.38. Figure 3.38 Unadjusted Nearest Futures Chart. 95. 96. Figure 3.39 Identifying price discrepancies between the continuous daily chart of gold and the December 2013 gold contract. Courtesy of stockcharts.com. Another way to use concatenate charts of individual futures contracts is to raise or lower the previous contract price at expiry, or at a certain n number of days before expiry, to match the new contract price. This is referred to as back adjusting, and it essentially removes the price difference or spread between contracts, creating a continuous flow of prices between the individual contracts. It is advantageous insofar as it allows for the proper and meaningful application of technical analysis. In addition, back-adjusted continuous charts always display the current price in the market and may therefore be used for trading purposes. It is also conducive to back and forward testing of trading strategies. Unfortunately, as a result of back adjusting, past prices do not reflect the actual traded contract prices during those periods. As such, past prices associated with significant peaks or troughs will continually change, as prices are back adjusted to match new contracts. In Figure 3.39, we observe that price peaks and the OHLC readings for November 7, 2011, differ between the continuous and the actual December 2013 gold contracts. Figure 3.40 shows how back adjusting is done. We observe the March contract expiring at $110. Since the June contract is trading at $120, the March contract is raised so that its expiration price matches the new price that the June contract is trading in the market. This has the effect of raising the historical prices associated with the troughs in the March contract from $80 and $90 to $90 and $100 instead. Once the June contract expires, the process repeats and the entire series of prices are once again raised or lowered, according to the price that the September contract is trading at in the market. If the entire The Handbook of Technical Analysis, Mechanics and Dynamics of Charting. Figure 3.40 Back adjusting in continuous charts. Series is raised by another $10 due to the September contract trading at a $10 premium. The historical prices associated with the troughs in the March contract will now be raised again from $90 and $100 to $100 and $110 instead. As can be seen, historical prices continue to undergo change and are adjusted to the net accumulated spread. Another disadvantage is that due to back adjusting, there is a possibility that past prices may become negative, especially if newer contracts are continually trading at a discount. This continual shifting of historical prices in back-adjusted continuous charts diminishes their use in relative strength analysis. Relative or comparative strength charts will not display accurate ratio relationships if past prices on continuous charts keep varying every time data is back-adjusted. In such cases, it would be better to use perpetual contracts, as prices are not back-shifted with each new front-month contract. Unfortunately, perpetual contracts do not display the current market price, but rather an estimated price, which is useless for trading purposes. It estimates the new or further out rollover contract price by means of a weighting factor, interpolating the contract price between expiration dates. Nevertheless, perpetual contracts are useful when used as a basis for constructing relative strength charts. It does not introduce as much distortion in the ratio relationship, unlike continuous charts. 3.5 Chapter Summary. In this chapter we learned how prices are filtered and used to construct various types of charts. We also observed how the bid-ask spread affects trading and R/R ratios, as well as how linear and ratio chart scaling affects geometrically based overlay barriers such as trend lines and channels. The discussion on futures contracts highlighted the challenges that chartists face when trying to make sense of a sequence of individual futures contracts and how backwardation and contango affected profitability. The various chart constructs mentioned in this chapter will be analyzed in greater detail in subsequent chapters. 97. Chapter 3 Review Questions. 1. Explain how OHLC data is derived. 2. Why should traders normalize their charts for volatility? 3. What are the factors that increase the significance of OHLC prices? 4. Describe the 5 measures of constancy in charting. 5. How does chart scaling affect the use of overlay indicators? 6. Explain the connection between contango and negative roll yields. 7. How does the bid-ask spread affect the reward-to-risk ratio? 8. Describe how back-adjusted continuous charts are constructed. References. Murphy, John. 1999 Technical Analysis of the Financial Markets. New York, New York Institute of Finance, NYIF. Nizan, Steve. 1994 Beyond Candlesticks. New York, John Wiley & Sons. Nizan, Steve. 2001 Japanese Candlestick Charting Techniques. New York, New York Institute of Finance, NYIF. Schwager, Jack D. 1996. Schwager on Futures. New York, John Wiley & Sons. 98. The Handbook of Technical Analysis. Chapter 4. Market Phase Analysis. Markets move in phases. Not being able to recognize market phases and their transitions will greatly disadvantage the practitioner. Market phase analysis can be applied across all time frames, deciphering long as well as very short-term market behavior. Via the application of multiple time frames, market participants will be able to clearly identify macro phase behavior and its impact on more diminutive micro phase action. In this chapter, we shall learn to interpret market phase via a multitude of technical approaches, both Eastern and Western. 4.1 Dow Theory of Market Phase. As we have learned from Dow theory in Chapter 2, a primary bull or bear trend consists of three phases, specifically 1. Accumulation phase, 2. Trending phase, 3. Distribution phase. This description of how markets rise and fall in various phases is now generally regarded as the basic underlying characteristic of market action. Learning objectives. After studying this chapter, you should be able to understand the structural and functional characteristics of the three market phases, forecast market phase accurately via its behavioral and cyclical properties, identify potential market regime changes via volume action, describe the inertial and momentum characteristics for each market phase. Identify specific price pattern formations associated with each phase, compare and contrast Eastern and Western approaches to interpreting market phases. 99. 100. Figure 4.1 Components of market phase. According to Dow theory, a primary trend typically spans from months to years in the equity markets. Due to the high leverage that is afforded traders in the futures markets, primary trends in the commodity futures markets tend to span relatively shorter durations. High leverage tends to induce greater volatility in the markets. This is an important point to bear in mind when attempting to gauge the average duration and extent of market phase behavior in such markets. Although Dow theory's original description of market phase relates primarily to the equity markets, the existence of these phases is found across all markets. In essence, there are only two basic phases, that is, the consolidation phase and the trending phase. The consolidation phase may be further subdivided into the accumulation and distribution phases. See Figure 4.1. Whether consolidation represents accumulation or distribution is only ascertained after the fact. That is, if the market rises after consolidating, we say that the consolidation represents accumulation, buying activity. Conversely, if the market declines after consolidating, we say that the consolidation represents distribution, selling activity. One of the objectives of technical analysis is to try to look for evidence to suggest whether accumulation or distribution is taking place during a consolidation. For example, it is observed that volume normally declines gradually during a consolidation. Very low levels of volume are usually a strong prognostication that the consolidation may potentially be coming to an end with a subsequent transition to a trend up or trend down phase. On a daily chart, consolidations normally lasts about 3 to 6 months, sometimes longer. See Figure 4.2. These phases are also evident on the lower, sub-hourly time frames. In Figure 4.3, we see micro-phase action on the 1-5-min Eurist chart. Market phase sentiment and participatory behavior. The psychological and participatory aspects associated with each market phase are briefly described as follows. The Handbook of Technical Analysis. Market phase analysis. Figure 4.2 The three phases in a primary bull trend on the daily chart of the Dow Jones Industrial Average Index. Courtesy of StockCharts.com. Accumulation phase. Accumulation normally occurs after a deep and rapid decline in prices. Companies tend to underperform with the release of very negative data, exacerbated by extremely bearish media headlines and news. The unsophisticated or uninformed market participants are usually extremely bearish at this point, desperately and frantically selling off all shares in the market at whatever price is. Figure 4.3. The three phases on the 1-5-min chart. Source: MetaTrader 4. 101. 102. Available. It is at this point that the informed or smart market participants start accumulating shares at extremely advantageous prices, in anticipation of a more bullish environment. This contrarian approach by the informed participants helps create a final and decisive bottom in the market, with very large responsive buying by the smart investors during the last stages of the preceding downtrend, in the form of a sell-off or selling climax, and into the nascent stages of a more prolonged accumulation phase. Smart investors continue to gather shares in a very gradual manner during the accumulation process, careful not to drive up prices too fast so that they may continue to take advantage of the low prices. Smart investors normally have deep pockets in order to engage in such contrarian-based participation. The accumulation phase normally lasts relatively longer than the distribution phase. This is due to the lower amount of capital at risk at lower prices, at the bottom of the market. Trend phase. The uptrend phase is normally fueled by traders and investors expecting either higher prices after an accumulation or lower prices after a distribution. Technical traders tend to get in much earlier, especially during a clear technical upside breakout from a consolidation, followed by the more market-savvy investors. Media and news headlines also tend to be more upbeat at the early stages of an uptrend. As the uptrend progresses and starts to become more obvious, the general public begins to become aware and attracted to the rising prices. Previously bearish participants are also beginning to cover their short positions. With increasingly bullish fundamental data released or reported by companies, public participation begins to increase rapidly. Regret bias is felt by increasingly more participants as prices rise higher, inviting those who miss out on the earlier prices to buy at every dip on the way up. Participants who sold off positions too early are also now regretting their decision and are similarly trying to get back in at any opportunity. At even higher prices, the mass of public participation, that is, the herd, starts to use more margin, to the extent of even borrowing funds in order to invest in the rapidly rising market. The markets continue to spiral to new heights in a vicious positive feedback cycle. The uptrend phase tends to be more prolonged than the downtrend phase, due to the lower amounts of capital at risk, at the lower, more affordable prices. The downtrend phase begins with a breakdown in prices from a distribution range, with increasingly bearish fundamental data reported by companies. As prices descend, the uninformed traders and investors begin to unload some positions. Previously bullish participants begin to liquidate their shares. Further unexpected declines in prices start to attract even more public attention, causing larger liquidation. As the threshold of pain and allowable margin limits is surpassed, this triggers an outflow of capital from the markets. Bearish sentiment continues to intensify as prices sink to new depths. The markets continue to plummet in a vicious positive feedback cycle. The downtrend phase tends to be shorter-lived than the uptrend phase, due to the larger amounts of capital, and unrealized profit, at risk, at the higher more expensive prices. Distribution phase. Distribution normally occurs after a strong and rapid rise in prices. Companies tend to outperform with the release of very positive data, accompanied by the most bullish media headlines and news. The unsophisticated. The Handbook of Technical Analysis. Market phase analysis. Or uninformed market participants tend to be extremely bullish at this point as they get caught up in a buying frenzy, buying up all shares in the market at whatever price available, popularly referred to as being in a state of irrational exuberance. Margin debt is skyrocketing. The informed or smart market participants start their campaign of selling off shares at these extremely advantageous prices, in anticipation of a more bearish action. As before, this contrarian approach by the informed participants helps create a final and decisive top in the market, with very large responsive selling by the smart investors during the last stages of the preceding uptrend, in the form of a blow-off or buying climax, and subsequently selling over a distribution phase. Smart investors continue to liquidate shares in a very gradual manner during the distribution process, again, careful not to drive down prices too rapidly so that they may continue to take advantage of the higher prices. The distribution phase normally lasts a relatively shorter time than the accumulation phase. This is due to the larger amount of capital and unrealized profit at risk at higher prices at the top of the market. Technical aspects of consolidations. Accumulation tends to have the following characteristics. It generally occurs at the end of a relatively rapid decline in prices and ideally in the proximity of a historical or significant prior bottom in the market. There is no evidence of lower troughs being formed. It represents the start of either a new primary bull market on a longer term horizon, or a new shorter-term uptrend if based on lower time frames. Accumulations tend to last longer than distributions. Volume begins to subside as a potential upside breakout approaches. The longer the accumulation process, the more powerful the subsequent breakout will be to either side of the range, typically accompanied by a surge in volume. Accumulations tend to experience lower volatility in contrast to distributions. Due to the lower prices and consequently lower capital at risk, distribution tends to have the following characteristics. It generally occurs at the end of a prolonged uptrend in prices and ideally in the proximity of a historical or significant prior top in the market. Signs of market exhaustion begin to manifest. There is no evidence of higher peaks being formed. It represents the start of either a new primary bear market on a longer term horizon, or a new shorter-term downtrend if based on lower time frames. Distributions tend to last for a relatively shorter period than accumulations. Volume begins to subside as a potential downside breakout approaches. The longer the distribution process, the more powerful the subsequent breakout will be to either side of the range, typically accompanied by a surge in volume. Distributions tend to experience much greater volatility in contrast to accumulation due to the higher prices and consequently greater capital and unrealized profit at risk. 103. Figure 4.4 Most popular technical levels signaling completion of a consolidation. Completion of a consolidation phase. When attempting to identify points between phases, the issue of subjectivity arises yet again, as it does fairly frequently in technical analysis. The question a trader or analyst would always ask is, at which point does the consolidation actually end? There is no absolute consensus or measure to determine the exact point in time or price at which a consolidation ends. It really depends on the approach and objectives of the trader or analyst. For example, some market practitioners look for a 3% to 5% rise above the highest peak from a consolidation range as evidence of compulsion, whereas others look for the minimum measuring objective, i.e., expected minimum price target, to be met before completion is confirmed, which is usually a price excursion equal to the range or height of the consolidation. But more popularly, most traders and analysts look for a clear and simple technical breakout from a consolidation range as potential evidence that the consolidation has completed. Even so, the price at which the breakout itself occurs depends largely on the type and degree of price filtering employed. See Figure 4.4. Logically, once a consolidation is complete, it also implies that a trend may already be in effect. 4.2 Chart Pattern Interpretation of Market Phase. Market phase can also be potentially identified by the type of chart patterns that manifest themselves at each stage of the three phases. Basically, most chart patterns belong to one of two groups, that is, reversal or continuation. Both the accumulation and distribution phases tend to be populated by reversal patterns. Interestingly, the majority of reversal and continuation chart patterns are usually also regarded as consolidation patterns, with the exception of V-tops and V. 104. The Handbook of Technical Analysis. Market Phase Analysis. Bottoms. The reason is obvious. The market, when expressing indecision, rest, or exhaustion, usually consolidates either by ranging or making relatively small corrective moves before resuming the existing trend or making a full-blown reversal. Therefore, a chart pattern is usually regarded as a consolidation pattern if it unfolds within a relatively confined and well-defined price range, lacks any significant trend component. Although V-tops and V-bottoms are reversal patterns that occur more frequently during distributions than accumulations, both of these patterns are not normally regarded as consolidation since they do not unfold within a relatively confined and well-defined price range, nor do they lack any significant trend component. As we will see in Chapter 13, chart patterns have both intrinsic and extrinsic bullish and bearish bias. Extrinsic bias may also be referred to as location-based sentiment. Intrinsic bias is the inherent bullish or bearish sentiment associated with a chart pattern that is independent of location and where sentiment is strictly based on the nature of the pattern. When extrinsic and intrinsic biases are in alignment, distributions and accumulations have a greater potential for reversals, making more reliable tops and bottoms in the market respectively. As for trends, when intrinsic bias is in alignment with the directionality of the trend, i.e., the trend sentiment, the potential for a continuation is usually greater. For example, an ascending triangle is intrinsically bullish, that is, it has a bullish bias. Regardless of where this pattern occurs with respect to past price action, it will always be inherently a bullish indication. If this bullish pattern is found at the price level of some historically significant market top, we say that it is extrinsically bearish, that is, the pattern is located at a significant resistance. However, if this pattern occurs at the price level of a historically significant market bottom, we say that this pattern is both intrinsically and extrinsically bullish. When the intrinsic and extrinsic biases are in agreement or aligned, the tendency for a reversal is potentially greater. If the ascending triangle occurs during an uptrend, and is not in proximity to any significant top or bottom in the market, the chances for a continuation are also greater as the intrinsic bias is in agreement with the direct diagonality of price, that is, a bullish pattern occurring in a bullish trend. Some chart patterns, like symmetrical triangles and horizontal channels, are essentially intrinsically neutral chart patterns with no obvious bias in sentiment. Some authors and practitioners classify them as continuation patterns, whereas others refer to them as reversal patterns. The only determining factor as to whether these patterns represent reversals or continuations must therefore lie beyond the pattern itself, that is, sentiment that is dependent on factors that are external or extrinsic to the pattern, like the direction of the preceding trend location with respect to historical extremes in price, location with respect to the phase of an underlying market cycle, location with respect to other supportive and resistive overlay barriers to price bullish or bearish divergent formations. 105. 106. When attempting to determine the reliability of potential reversals during the accumulation and distribution phases, or continuations during the trend phase, it is important to look for agreement between the intrinsic and extrinsic biases. Any disagreement is seen as an indication that a reversal or continuation may be inherently weak. Here is a summary of some common chart patterns and their associated intrinsic and extrinsic biases. Intrinsically bullish patterns. Bullish pennants, bullish flags, ascending triangles, inverted head and shoulders, rounding bottoms, cup and handles, falling wedges, double, triple, and multiple bottoms. Intrinsically bearish patterns. Bearish pennants, bearish flags, descending triangles, standard head and shoulders, rounding tops, rising wedges, double, triple, and multiple tops. Intrinsically neutral patterns. Symmetrical triangles, horizontal channels. Intrinsically bullish patterns with respect to trend sentiment. bullish pennants occurring in an uptrend, bullish flags occurring in an uptrend, ascending triangles occurring in an uptrend, inverted head and shoulders occurring in an uptrend, rounding bottoms occurring in an uptrend, cup and handles occurring in an uptrend, falling wedges occurring in an uptrend, symmetrical triangles occurring in an uptrend, horizontal channels occurring in an uptrend, broadening formations occurring in an uptrend. Intrinsically bearish patterns with respect to trend sentiment. Bearish pennants occurring in a downtrend, bearish flags occurring in a downtrend, descending triangles occurring in a downtrend, standard head and shoulders occurring in a downtrend. The Handbook of Technical Analysis. Market Phase Analysis. Figure 4.5 Phase-based charts patterns. Rising wedges occurring in a downtrend, symmetrical triangles occurring in a downtrend, horizontal channels occurring in a downtrend, broadening formations occurring in a downtrend. As a general guide, intrinsic bias and trend sentiment are in disagreement with each other for reversal patterns. Conversely, intrinsic bias and trend sentiment should be in agreement with each other for continuation patterns. For intrinsically neutral formations, their extrinsic bias or sentiment is derived from the trend sentiment. For example, a symmetrical triangle will adopt an extrinsically bullish bias in an uptrend and an extrinsically bearish bias in a downtrend. It is important to note that although broadening, diamond, and island formations are essentially intrinsically neutral, they are regarded as reversal formations. As such, their extrinsic sentiment or bias will be in disagreement with any prevailing or pre-existing trend sentiment. See Figure 4.5 for a visual summary of the various chart patterns normally associated with each phase, with reference to their intrinsic and extrinsic biases or sentiment. In Figure 4.6 we observe an inverted head and shoulders pattern as accumulation on the Eurist chart. Though we can state that the inverted pattern is intrinsically bullish, there is no evidence on the chart to indicate that it is also extrinsically bullish, as there is no information regarding the historical lower extremes in price, or its location with respect to the phase of an underlying market cycle or other overlay barriers. Notice the trend phase kicking in after the upside breakout. 107. 108. Figure 4.6 An inverted head and shoulders formation as accumulation on the Eurist chart. Source, MetaTrader 4. In Figure 4.7 we observe a standard head and shoulders pattern as distribution on the 1-5-min Eurist chart. Notice the pattern forming a potentially new consolidation after reaching its minimum price objective, that is, a 1:1 ratio projection of the height of the pattern, as measured from the neckline breakout. Figure 4.7 Head and shoulders formation as distribution on the 1-5-min Eurist chart. Source, MetaTrader 4. The Handbook of Technical Analysis. Market Phase Analysis. Figure 4.8 V-bottom formation as accumulation on the 4-hour USD-CAD chart. Source, MetaTrader 4. In Figure 4.8 we observe a very rapid accumulation phase in a V-bottom formation, which was preceded by an intrinsically bearish head and shoulders distribution phase on the 4-hour USD-CAD chart. Of all the reversal patterns, the V-type reversals are the hardest to forecast and anticipate due to their rapid ascension. They are normally only identified in hindsight. In Figure 4.9 we observe a symmetrical triangle as continuation within a trend phase. Although symmetrical triangles are intrinsically neutral, the existence. Figure 4.9 Symmetrical triangle as continuation in a trend phase on the Eurist chart. Source, MetaTrader 4. 109. 110. Figure 4.10 Bear flag formation as distribution on the sub-hourly Eurist chart. Source, MetaTrader 4. Of the pre-existing uptrend imbues the formation with an element of extrinsic bullishness. In Figure 4.10 we observe a bear flag formation triangle as continuation within a trend phase. The bear flag consolidation is confirmed once price violates the pattern. Notice the preceding distribution phase leading to a strong downside breakout. Note that the flag's intrinsic bias is in agreement with the bearish trend sentiment, which greatly increases the potential for a reliable downside follow-through, as observed on the chart. In Figure 4.11 we observe an accumulation range comprising two adjacent ascending triangles, swiftly followed by the trend phase in a powerful breakout, evidenced by the large upside gap in prices at the point of breakout. A new consolidation forms after some trending action, in the form of an ascending triangle. Prices subsequently break down and decline and fail to follow through as a bullish pattern. This drives home the point that technical forecasting is based on probabilities, and never on certainties. Although the trend sentiment and intrinsic bias were in perfect agreement, there is not enough information on the chart to determine if the triangle's extrinsic bias is bullish or bearish. Should the triangle have formed around the price level of a significant historical peak, then it would be deemed as extrinsically bearish. Nevertheless, as far as the trader is concerned, failed patterns oftentimes lead to a more powerful reaction and consequently a more profitable venture. In technical analysis, the element of surprise or of the unexpected should never be underestimated. Notice volume declining as breakout approaches. Note that the second ascending triangle is both intrinsically and extrinsically bullish, since it is forming within a clear and obvious support area in the market, as evidenced by the first ascending triangle. The Handbook of Technical Analysis. Market Phase Analysis. Figure 4.11 Ascending Triangles as Accumulation on the Daily iShares Silver Trust, SLV, chart. Courtesy of stockcharts.com. In Figure 4.12 we observe a symmetrical triangle acting as accumulation within a larger consolidation zone on the daily chart of gold. Although the symmetrical triangle is intrinsically neutral in sentiment, it is very clear that the symmetrical triangle pattern has bullish extrinsic bias, as it is located at a very well-established accumulation zone that has been tested by multiple bottoms. In proximity also lies additional barrier support in the form of a downtrend line. Notice the trend phase that ensues after a short return move to the triangle breakout barrier. Figure 4.12 Nested accumulations and consolidations on the daily chart of gold. Courtesy of stockcharts.com. 111. Figure 4.13 Ascending triangle as continuation on the sub-hourly Eurist chart. Source, MetaTrader 4. In figures 4.13 and 4.14, we observe an ascending triangle and a rounding bottom acting as continuation in trend phases. 4.3 Volume and open interest interpretation of market phase. Market phase can also be potentially identified by the type of volume action that manifests itself at each stage of the three phases. Figure 4.15 depicts a typical sequence of volume action as the market progresses to the next phase. Notice that Figure 4.14 rounding bottom / cup and handle as continuation on the 4-hour Eurist chart. Source, MetaTrader 4. 112. The Handbook of Technical Analysis. Market Phase Analysis. Figure 4.15 Phase-related volume action. Volume tends to decline to relatively low levels just prior to a phase transition. Hence, we may use volume as a timing indicator for forecasting potential phase transitions. Should an uptrend or downtrend be inherently weak, then this is normally indicated by a fall-off in volume during the trend phase. This is a sign of trend exhaustion and it signals a potentially earlier onset of a distribution or accumulation phase. See Figure 4.16. Besides phase-related volume action, open interest may also reveal potential phase behavior. For the most part, open interest action tends to correlate fairly. Figure 4.16 Trend exhaustion as indicated by volume action. 113. 114. Figure 4.17 Potentially strong reversal as indicated by open interest action. Closely to volume action. It is when they disagree or diverge significantly that additional evidence is obtained about potential future market action. If open interest increases during a consolidation instead of decreasing, the breakout move and subsequent trend tends to be much more rapid and extended. See Figure 4.17. Figure 4.18 is an intraday chart of ISIS Pharmaceuticals Inc. We see the extended distribution phase being violated by a downside gap in prices, accompanied by high volume. The trend phase then ensues with bullish volume divergence and subsequently transits into an accumulation phase. Note how volume gradually. Figure 4.18 Volume action during the trend and accumulation phases on the intraday ICIS Pharmaceuticals Inc. chart. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Market Phase Analysis. Figure 4.19 Price-based volume action on the hourly Facebook Inc. chart. Courtesy of stockcharts.com. Decreases as the accumulation progresses, signaling a potentially imminent breakout, be it to the upside or downside. Besides volume action acting as a timing indicator for potential breakouts, higher than normal volume at the initial stages of an accumulation or distribution is a strong indication that a bottom or top in the market has been formed. Figure 4.19 is an hourly chart of Facebook Incorporated. Notice how relatively large price-based volume, as opposed to the traditional interval or time-based volume, coincides with the distribution and accumulation zones, with the market testing the consolidation boundaries for additional liquidity. Hence, price levels associated with historically high volumes of activity represent potential levels of accumulation or distribution. 4.4 Moving Average Interpretation of Market Phase. Market phase can also be potentially identified by the behavior of moving averages at each stage of the three phases. Figure 4.20 displays a simple moving average as it encounters the trend and consolidation phases. Figure 4.20 Moving average action during the trend and consolidation phases. 115. Figure 4.21 Moving average action during the trend and consolidation phases on the daily Eurist chart. Source, MetaTrader 4. By applying popular multiple moving average lines, the behavior of moving averages with respect to trends and consolidations becomes more evident. Refer to Figure 4.21. When a trend is in effect, we observe that the multiple moving average lines start to diverge from each other. The greater the divergence, the stronger will be the ensuing trend. Therefore, when multiple moving average lines begin to converge, this represents an early indication of a potential consolidation. During trending phases, the moving average displays the minimum incidences of whipsaws, but during any consolidation phases it will exhibit a significant increase in whipsaw action due to the flattening out effect of averages in a sideways or ranging market. 4.5 Divergence and Momentum Interpretation of Market Phase. Market phase may also be identified to some degree via the use of divergence analysis. Divergence may be used to track the changes in price momentum, and therefore is extremely useful for identifying potential consolidations as well as the strength of a trend. Once divergence is observed, look for a slowing of the trend via the change in the underlying momentum, as indicated by the diverging momentum-based oscillators. See Figure 4.22. In Figure 4.23, we see accumulation in the form of an inverted head and shoulders pattern. The accumulation is further supported with standard bullish divergence on the moving average convergence divergence indicator, MACD. The left shoulder, head, and right shoulder coincided with the projected cycle lows that underlie 3M Company. The existence of this bullish confluence within the accumulation greatly increases the probability for a strong upside move. 116. The Handbook of Technical Analysis. Market Phase Analysis. Figure 4.22 Distribution indicating bearish divergence on the hourly Eurist chart. Source, MetaTrader 4. Figure 4.23 Accumulation indicating bullish divergence on the daily 3M Co chart. Courtesy of stockcharts.com. 117. Figure 4.24 Accumulation indicating bullish divergence on the 5-minute Gust chart. Source, MetaTrader 4. In Figure 4.24, we see a volume, MACD, and the relative strength indicator, RSI, all indicating bullish divergence with the price within the accumulation. Both the MACD and RSI are momentum-based indicators. We see momentum turning before price. This is particularly useful, especially at the tail end of a trend where a clear indication that a consolidation may be forming could help the trader anticipate an early entry. Note that for bullish divergence in volume, falling prices must be accompanied by decreasing volume. 4.6 Sentiment Interpretation of Market Phase. Accumulations and distributions are associated with various sentiment indications, resulting from the behavior of market participants as they respond to market news, price action, rumors, other participants' behaviors, brokers, and so on. As they swing back and forth between fear, greed, and hope in the markets, various identifiable patterns start to emerge that are repeated fairly consistently, especially when markets move to extremes. Sentiment indicators track these behavioral patterns via the aggregate sentiment, emotions, and psychology of market participants. It is at market extremes that these indicators are most accurate and reflective of the underlying mood of optimism or pessimism. Examples of some sentiment indicators are put-call ratios, arms index, odd-lot sales margin, debt. COT report VIX 118. The Handbook of Technical Analysis. Market phase analysis. Figure 4.25 Sentiment indicator behavior at accumulation and distribution. Short interest ratio, cash asset ratio, advance decline line, new highs, new lows, up volume, down volume, market vein reports bullish sentiment index. Figure 4.25 is a simple visual guide of how some sentiment indicators vary as the market swings between tops, distribution, and bottoms, accumulation. For a more detailed discussion of sentiment indicators, refer to Chapter 23. 4.7 Sakata's interpretation of market phase. Sakata's 5 methods is a unique Japanese approach for interpreting and understanding the markets, which originated with Munehisa Hanma. Under Sakata's approach, the market is divided into 5 distinct phases, as opposed to the conventional 3-phase model by Dow. The 5 distinct phases are 1. Sanzan 3 mountains. This is equivalent to the Western Triple Top formation, which represents the distribution phase. 2. Sansen 3 rivers. This is equivalent to the Western Triple Bottom formation, which represents the accumulation phase. 3. Sanku 3 gaps. This is equivalent to the Western Triple Gap formation, which occurs during the trending phase, popularly known as the breakaway, runaway, and exhaustion gaps. 119. Figure 4.26 Sakata's 5-phase model of accumulation, distribution, and trend. 4. Sanpei 3 thrusts. This represents the 3 trending phases between accumulation and distribution. This closely resembles Elliott's 3 impulsive numbered waves 1, 3, and 5. 5. Sanpo 3 methods. This represents the 3 corrections after each thrust. This somewhat resemble Elliott's 3 corrective waves lettered as A, B, and C in upcoming Figure 4.28. Sakata's 5 market phases are illustrated in Figure 4.26. We see that it is very similar in appearance to Elliott's. Elliott waves have specific rules and guidelines with respect to wave construction, whereas Sakata's 5-phase model is less rigid. Although Dow's 3-phase model of market phase may seem initially to be inconsistent with Sakata's 5-phase and Elliott's motive wave model, it can be shown, using simple chart patterns, that the 2 models need not necessarily be viewed as distinct from each other. Figure 4.27 depicts Sakata's 5-phase model operating within Dow's 3-phase market. It offers a plausible resolution between Eastern and Western approaches to market phase analysis. 4.8 Elliott's interpretation of market phase. Elliott described the markets as moving in an impulsive 5-wave up followed by a corrective 3-wave down motion. The trending phase is represented by impulse waves 1, 3, and 5. The accumulation phase is represented by the corrective waves 2 and 4, and in most cases including the entire ABC correction itself. Distribution is usually represented by the ABC correction. See Figure 4.28. Figure 4.29 depicts an Elliott wave count for gold from 2000 to 2012. Notice that volume gradually decreases over the span of each significant consolidation, as seen at points 1, 2, and 3. We observe that primary waves 1 and 2 occur. 120. The Handbook of Technical Analysis. Market phase analysis. Figure 4.27. Figure 4.28. Sakata's 5-phase model operating within Dow's 3-phase market. Elliott wave structure. The Elliott wave phase model on the weekly gold chart. Courtesy of stockcharts.com. Figure 4.29. 121. Within the accumulation phase, followed by the powerful wave 3 move during the first trend phase. Notice also that volume peaks out around the top of wave 5, within the new area of consolidation, in the form of an inverted head and shoulders pattern. The use of Fibonacci price and time projection techniques will help the practitioner gauge the potential termination and start of each wave within the 5-3 wave structure. For a detailed discussion of Elliott waves, refer to Chapter 18. 4.9 Cycle Analysis Interpretation of Market Phase. We may also use market cycles to determine if a price formation is potentially a reversal or a continuation. It all depends on where the formation unfolds with respect to the phase of the cycle. Once a cycle period is identified, it will be fairly simple to find out where the formations lie with respect to the cycle phase. As a general guideline, for formations unfolding on the same cycle degree, 1. Formations that lie in between cycle extremes tend to be continuations. 2. Formations that lie at cycle peaks tend to be distributions. 3. Formations that lie at cycle troughs tend to be accumulations. Note that if the intrinsic and extrinsic biases for the chart patterns are in agreement, reversals and continuations will potentially be more reliable. See Figure 4.30. In Figure 4.31, we see the intrinsically neutral symmetrical triangle adopting 3 distinct roles, representing accumulation at the bottom of the cycle, continuation in between the top and bottom of the cycle, and distribution at the top of the cycle. Hence the symmetrical triangle will adopt a bullish extrinsic bias at cycle troughs and bearish extrinsic bias at cycle peaks, while adopting the pre-existing trend sentiment between the cycle extremes. Figure 4.30 Using cycles to determine market phase. 122. The Handbook of Technical Analysis. Market phase analysis. Figure 4.31 Using cycles to determine market phase. In a similar fashion, we see the symmetrical triangle, in Figure 4.32, adopting 3 distinct roles, representing accumulation at the bottom of the uptrending channel, continuation in between the top and bottom of the channel, and distribution at the top of the uptrending channel. Had the pattern been an inverted head and shoulders pattern instead, the probability of a reversal at the bottom of the channel or a continuation in the middle of it would be potentially greater. Resistive and supportive confluences, comprising other overlay barriers such as Fibonacci levels and so on, help to yield more reliable forecasts of potential price reaction levels in the market. Figure 4.32 Using price channels to determine market phase. 123. 4.10 Chapter Summary. We have seen how various market phases may be determined and identified via the application of chart patterns, moving averages, volume and open interest, cycles, sentiment indicators, and Elliott wave analysis. We have also seen how Eastern and Western approaches to market phase may be complementary to each other. The ability to decipher phase transitions, i.e., market regime changes, gives the practitioner a significant edge in the markets with regard to the most appropriate technical tool or setup to employ. We shall now focus on the trend phase in more detail in the next chapter. Chapter 4 Review questions. 1. Define the term consolidation. 2. List 8 chart patterns that are intrinsically bullish. 3. Explain why the majority of chart patterns are consolidation patterns. 4. Describe how you would determine if accumulation is taking place. 5. Which sentiment indicators best describe distributions? 6. How would you use moving averages to gauge market phase? 7. Explain how you would use a cycle to determine market phase. 8. How do you use divergence to identify potential consolidations? References: Frost, A.J., and Robert R. Prechter. 1999 Elliott Wave Principle. New York, John Wiley & Sons. Morris, Gregory. 2006 Candlestick Charting Explained. New York, McGraw-Hill. Murphy, John. 1999 Technical Analysis of the Financial Markets. New York, New York Institute of Finance, NYIF. 124. The Handbook of Technical Analysis. Chapter 5. Trend Analysis. Trend trading has transfixed traders for decades with the promise of rapid profits. Countless books have been written expounding the virtues and advantages of such an approach. In this chapter, we shall attempt to unveil the underlying characteristics of trend action and how to decipher pure price action to better understand the behavior of the market. We will also discuss price filtering and the effective application of trade sizing and stop sizing with respect to technical trade setups. 5.1 Definitions of a trend. Classification of a trend according to Dow theory. In Dow theory, trends are classified and defined by their duration and extent. Primary or major trends are longer term and span from months to years. Secondary trends or reactions are medium term and span from weeks to months. Minor trends are shorter term and span from days to weeks. Learning objectives. After studying this chapter, you should be able to understand the significance of a market trend and its underlying characteristics, recognize the limitations of defining trend and market action, identify early indications of a potential market reversal, read the markets in terms of wave cycles of various degrees. Set up effective price filtering for more efficient entries, exits, and trend identification. Calculate the optimum trade size for breakout trades. Learn to use channels, trend lines, fan lines, and Drummond geometry to track market action. 125. The Handbook of Technical Analysis. Figure 5.1 Peak and trough representation of an uptrend. In Dow theory, an uptrend is defined using peak and trough analysis. An uptrend is represented by a series of successively higher highs, peaks, and lows, troughs, while a downtrend is represented by a series of successively lower highs and lows. This is the most popular definition of a trend. See figures 5.1 and 5.2. Definition versus absolute measure of a trend. The problem with definitions is that if price action does not unfold in a manner required under its definition, no trend would be recognized or even acknowledged. In addition, if price action was inordinately erratic or chaotic, the identification of a trend using peak and trough analysis may prove extremely challenging, if not impossible in some situations. All definitions impose limitations, which may lead to situations where an actual trend may not be acknowledged or recognized. Figure 5.2 Peak and trough representation of a downtrend. H. A downtrend unfolding. LH. L. LH. LL. LH. LL. LL. 126. Trend analysis. Figure 5.3 Limitation of Dow's peak and trough definition of a trend. See Figure 5.3. Under peak and trough analysis, trend actions in scenarios 1 and 2 satisfy the conditions for being classified as uptrends, because they exhibit a series of higher highs and lows. But what about trend actions in scenarios 3 and 4? There are no higher highs or lows in scenario 3, and no highs or lows whatsoever in scenario 4. Do we classify them as uptrends? Under Dow's peak and trough definition, they do not classify as uptrends. Nevertheless, in all four scenarios, price traversed from point A to point B. Do we then deny that trends existed in scenarios 3 and 4? Many practitioners believe that it may be better to define a trend by an absolute measure of distance traversed rather than by the behavior of price during a trend. To avoid the dependence on a particular price behavior as a means of identifying a trend, many practitioners choose to use other means of trend identification, such as price remaining above or below an overlay indicator, price remaining above or below an arbitrarily chosen price level, the absence of a reversal of a specified amount during a trend. One popular example of price remaining above or below an overlay indicator in order to qualify as a trend is best illustrated via the use of trend lines and moving averages. As long as price activity remains above a trend line in an uptrend, the uptrend is considered to be still intact. The converse applies for downtrends. This would obviate the need to inspect price behavior during a trend. In similar fashion, as long as price remains above a certain moving average, an uptrend is considered to still be intact. With respect to other price overlays, the trend is considered to still be intact if price remains above the Bollinger linear regression and moving average lower band in an uptrend, the converse for downtrends. Price remains above the lower boundary of a chart pattern in an uptrend, the converse for downtrends. 127. 128. Figure 5.4 Alternative definitions of an uptrend in effect. Some practitioners also define a trend by its ability to remain above or below some arbitrarily chosen price level. As long as price remains above a chosen support level, an uptrend is considered to still be intact. Similarly, as long as price remains below a chosen resistance level, a downtrend is considered to still be intact. This chosen price level may represent some historically significant support level in an uptrend or resistance in a downtrend, the violation of which would imply a very high probability of the trend reversing. A third method of identifying an ongoing trend is via the absence of a reversal of a specified amount during a trend. This third approach is employed on constant range charts such as point and figure and Renko charts. As long as the reversal size is not breached, the trend is still intact. See Figure 5.4. Describing consolidation and trends via wave cycles and degrees. It is also important to be able to describe and identify trends and consolidations in terms of wave cycles or degrees. We may describe any trend or consolidation in terms of wave cycles, which exist at various wave degrees. Below are the terms associated with a wave cycle comprising 3 degrees. Higher wave cycle, HWC, highest wave degree relative to the MWC and LWC. Medium wave cycle, MWC, a subwave of HWC and is of a lower degree than the HWC. Lower wave cycle, LWC, a subwave of both the HWC and MWC and is at the lowest wave degree. Note that the minimum number of wave degrees in any trend is 2. Figure 5.5 depicts a wave of 3 degrees. The Handbook of Technical Analysis. Trend Analysis. Figure 5.5 Trend action in terms of wave cycles and degrees. The MWC and LWC are both subwaves of the HWC and are regarded as wave cycles of lower degrees. It is critical that a trader be able to visualize price cycles on the chart. Without knowing which wave cycle is being traded, any of the following scenarios may result. Inability to select consistent breakout levels, inability to select effective stop-loss levels, inability to apply effective stop sizing, inability to distinguish between trend and consolidation mode, inability to determine the direction of the predominant trend. Elliott waves are studied in terms of wave cycles and wave degrees. Figure 5.6 depicts an Elliott wave count in terms of wave cycles and wave degrees. Refer to Chapter 18 for a detailed discussion of Elliott waves and the 5-3 fractal trend structure. Figure 5.6 Elliott wave in terms of wave cycles and degrees. 129. 130. Figure 5.7 Consolidation and trend action in terms of wave cycles and degrees. As seen in the Figure 5.7, a market may be both in trend and consolidation modes at the same time, depending on the wave cycle being observed. We may also define breakouts via the degree of the wave cycles. Figure 5.8 illustrates breakouts in terms of the wave degree being traded. Hence, we have breakouts based on waves of lower, medium, and higher degrees. In other words, the breakout level will depend on the wave degree being traded. Being aware of the wave degree being traded will allow the trader to size the stop loss effectively, according to the average wave amplitude and volatility associated with that particular wave degree. Volatility at one wave degree may not manifest at a higher or lower wave degree. Significance of higher wave degree reversals. There is a reason why turning points of larger wave cycles, or trends, are more significant than those of smaller wave cycles. It all has to do with wave degree convergence. When a large wave cycle, or trend, reverses, all the wave cycles of lower degrees reverse in sync with the larger wave cycle. It is at the point of reversal that all subwaves of the largest wave reverse together. It must be noted that waves of higher degrees need not reverse when waves of a lower degrees reverse. See Figure 5.9. Figure 5.8 breakouts in terms of wave cycles and degrees. The Handbook of Technical Analysis. Trend Analysis. Figure 5.9 Reversal of all subwaves. Reversals, corrections, and retracements. Reversals and retracements imply a turnaround in prices, and may be of any amount or degree. Corrections and pullbacks tend to imply a more shallow reversal or retracement, usually no more than a few %. Trends in terms of OLC data. Trend may also be defined in terms of individual open, high, low, and close, OHLC, data. Figure 5.10 depicts various trend activity with respect to the high, low, close, and mid/typical prices. Although we see that the market is flat in terms of peak and trough analysis, that is, there is no evidence of successively higher or lower peaks and troughs, we cannot deny the presence of some form of trending. Figure 5.10 Trend based on OHLC data. 131. Activity in terms of OHLC data. For example, the illustration in the middle of Figure 5.10 depicts a series of rising close prices. This is essentially a line chart in action. Hence, as far as close prices are concerned, it is clearly an example of an uptrend unfolding. The same argument applies to the other two examples as well. A trend may be defined in terms of high, low, and mid/typical prices. In fact, the Commodity Channel Index, CCI, oscillator and the floor traders pivot points are based on typical prices as an indicator of trend activity. 5.2 Quality of trend, 16 price characteristics impacting future price action and trend strength. The highest skill any trader can aspire to is the ability to read pure price action. This is an important skill because price is regarded as the most important indicator of potential future price action. When attempting to decipher the possible future action of price, we need to be familiar with 16 critical price characteristics that may potentially impact future price activity, namely variations in 1. Cycle amplitude Luke 4 Decreasing cycle amplitude in uptrends and downtrends. A decrease in cycle amplitude in an uptrend is an early indication that there may potentially be underlying weakness in the uptrend, see Figure 5.11. In similar fashion, a decrease in cycle amplitude in a downtrend is regarded as a bullish indication. Note that the up cycle amplitudes must, on average, be larger than the down cycle amplitudes for an uptrend to take place. Conversely, for a downtrend, the up cycle amplitudes must, on average, be smaller than the down cycle amplitudes. Nevertheless, it is the change in the successive up and down cycle amplitudes that are the most important characteristic for deciphering future price activity. Figure 5.11 Decreasing cycle amplitudes in an uptrend is bearish. 132. The Handbook of Technical Analysis. Trend Analysis. Figure 5.12 Decreasing cycle amplitudes in an uptrend. Figure 5.12 illustrates three idealized examples of changing cycle amplitudes. Contracting formations are bearish in an uptrend and bullish in a downtrend. Expanding formations, where both upper and lower boundary trend lines are pointing in an upwardly direction, are generally bullish in an uptrend. The converse applies to downtrends. The trend with steady and consistent cycle amplitude is regarded as bullish in an uptrend and bearish in a downtrend, and is generally regarded as the most reliable trend in terms of extent and duration. 2 cycle period. Decreasing cycle periods are also an early indication of potential weakness in a trend. A gradual reduction in the cycle period during an uptrend is an early indication that there may potentially be underlying weakness in the uptrend. In similar fashion, a gradual reduction in the cycle period during a downtrend is a bullish indication. See Figure 5.13. Figure 5.13 Decreasing cycle periods in an uptrend. 133. 134. Figure 5.14 break in bar retracement symmetry leading to a change in trend behavior. Source, MetaTrader 4. 3-bar retracement symmetry. A change in the number of bars in a retracement is also an early indication of a potential change in trend behavior. Figure 5.14 shows a change in the bar retracement symmetry leading to a strong upside move. 4. Average bar range. A decrease in the average bar range in an uptrend is an early indication of potential weakness in an uptrend. In a similar fashion, a decrease in the average bar range in a downtrend is a bullish indication. See Figure 5.15. We can track the bar range using the average true range (ATR) oscillator. Unlike average bar range, the ATR oscillator will account for gaps between the bars as well. Figure 5.16 shows a declining ATR during a steady uptrend in the Gold Spider Gold Trust shares. Although volume is bullish, the ATR is indicating otherwise. A large bearish candlestick completes the bearish picture. Price declined after the volume climax. Figure 5.15 decreasing bar range indicating potential trend weakness. The Handbook of Technical Analysis. Trend Analysis. Figure 5.16 decreasing bar range /ATR indicating potential trend weakness on the weekly chart of the Gold Spider Trust shares. Courtesy of StockCharts.com. 5. Price persistence. Continuity of trend action. Prices tend to persist for longer periods when price is of high quality. High quality prices have relatively small bar ranges, approximately equal bar ranges. When these two qualities are present, price tends to move in a predictable manner. The trends and reversals are clear and decisive, making the tracking of price action much easier for the trend trader. In this mode, prices exhibit relatively low levels of volatility. See Figure 5.17. 6. The average bar stochastic ratio, closing price compared to bar range. A gradual decline in close prices with respect to the bar itself is also an early indication of potential weakness in an uptrend. In a similar fashion, a gradual increase in close prices with respect to the bar itself is also an early indication of potential bullishness in a downtrend. We measure this increase or decline in close prices with respect to the bar itself as a ratio, and it is referred to as the bar stochastic. Unlike the standard stochastic oscillator, which compares the relative position of the closing price over the last n periods, the bar stochastic measures the relative position of the closing price within the bar itself. It is essentially a 1%K. A simple moving average of the bar stochastic ratio is used to monitor this price action behavior. See Figure 5.18. 135. 136. Figure 5.17 Variation in trend persistence on the hourly chart of GBPJPY. Source, MetaTrader 4. Figure 5.19 depicts a 3-period SMA of the bar stochastic, accurately identifying bearish divergences in uptrends and bullish divergences in downtrends. 7. Average candlestick real body to range ratio. A gradual decrease in the real body to candlestick range is also an early indication of potential weakness in an uptrend. In similar fashion, a gradual decrease in real body to candlestick range is a bullish indicator in a downtrend. A simple moving average of the real body to candlestick range ratio is used to monitor this price action behavior. See Figure 5.20. Figure 5.18 Declining bar stochastic ratio indicating trend weakness. The Handbook of Technical Analysis. Trend Analysis. Figure 5.19 A 3-period SMA of bar stochastic indicating bullish and bearish divergence on the weekly chart of Eurust. Source, MetaTrader 4. 8. Angular symmetry and momentum. Any change in the angular symmetry is also an early indication of potential bullishness or bearishness in the markets. In Figure 5.21, 3MCO is displaying consistent angular symmetry over a period of 3 years. Generally speaking, an increase in the angle of ascent is bullish for the stock, while a decrease is bearish. Trend lines 1 and 2 are also parallel, which is a strong prognosticator of potential bullishness. This is because trend line 1 was subsequently followed by a steady rise in share price, and we tend to expect this to also unfold in a very bullish manner after. Figure 5.20 declining average real body to candlestick range ratio indicating trend weakness. 137. 138. Figure 5.21 preservation of angular momentum on the hourly chart of 3M Co courtesy of stockcharts.com. A minor correction at point 3, which represents potential resistance from an overbought angular perspective. Note that a bearish rising channel is seen developing above trendline 2, helping to strengthen the case that a minor correction is highly probable. In fact, 3M Co went on to rise above $140 after correcting at point 3, not shown on the charts. In Figure 5.22, an upside acceleration in price is bullish whereas an upside deceleration in price is bearish. Similarly, a downside acceleration in price is bearish whereas a downside deceleration in price is bullish. Upside and downside acceleration is normally parabolic in nature. It should be noted that although an upside acceleration in price is bullish, the uptrend may not be self-sustaining if the rate of ascent was excessive. Such rapid increases in price usually end in a blow-off or buying climax with prices subsequently collapsing. Similarly, downside acceleration in prices may also end in a selling climax. The price action depicted in Figure 5.23 shows an even more potentially bearish scenario in an uptrend. Here we have both a deceleration in price as well as a diminishing bar range. Figure 5.22 acceleration and deceleration in trend momentum and the associated sentiment. The Handbook of Technical Analysis. Trend Analysis. Figure 5.23 diminishing angular momentum is an indication of potential weakening of a trend. In Figure 5.24, we see gold with a consistent trend rate of approximately $3.30 per day. Notice that once the trend rate changes, the behavior of the market also switches to a new regime, displaying greater volatility and larger swings in price. Again, the new trend rate of $10.30 may be unsustainable over the longer term. Gold prices in fact declined rapidly thereafter, not shown on the chart. 9. Barrier proximity. There is always a high probability that a trend may reverse as it approaches a strong and significant price barrier. In Figure 5.25, we observe the price for iShares MSCI Emerging Markets Fund rebounding after testing a strong and significant support level. We also notice the cycle-tuned stochastic indicating an oversold condition at the point of reversal. Figure 5.24 oversold barrier proximity leading to a reversal on the daily chart of iShares MSCI Emerging Markets. Courtesy of stockcharts.com. 139. 140. Figure 5.25 oversold barrier proximity leading to a reversal on the daily chart of iShares MSCI Emerging Markets. Courtesy of stockcharts.com. 10. Frequency and depth of trend-based oscillations. An uptrend is considered to be more reliable if it displays a reasonable number of oscillations. Oscillations should be fairly frequent and not too shallow or too deep. Such a trend is indicative of healthy profit-taking activity. With some profit taken off the table as the trend unfolds, traders and investors tend not to react as emotionally and irrationally at higher prices where the risk of losing pent-up and unrealized profit is greater. In Figure 5.26, the uptrend illustrated on the right-hand side displays relatively little profit-taking activity, with a relatively larger amount. Figure 5.26 frequency and depth of trend-based oscillations impacting on the persistence of existing trends. The Handbook of Technical Analysis. Trend Analysis. Figure 5.27 quality of trend-based oscillations impacting on the persistence of existing trends on the daily chart of Apple Incorporated courtesy of stockcharts.com. Of pent-up and unrealized profit at risk, there is a high probability that traders and investors will rapidly exit the market at the slightest hint of bearishness. This makes such a trend potentially more bearish at higher prices. In Figure 5.27, we see Apple Incorporated prices oscillating in a steady, rising channel. This was subsequently followed by rapidly rising price with the minimum of oscillations. As prices rise the second time toward the historical high in Apple, they do so in a similar uptrend rate with relatively little profit taking. Between timelines 1 and 2, we see the ATR declining as prices rise. This is a bearish indication. We see Apple prices decline substantially thereafter. Note that profit-taking activity in the form of price oscillations also occurs at various wave degrees within a trend. 11. Relative measure of consolidation size and duration. Trend interruptions are more significant if price formations are of greater magnitude, taller chart patterns. Price formations develop over a longer period, wider chart patterns. Larger trend interruptions normally tend to lead to a greater probability of a reversal. In a strong uptrend, a larger head and shoulders formation would be deemed more bearish than a smaller formation. Similarly, a larger rounding bottom formation would be more bullish than a smaller one in a downtrend. In short, size takes precedence over form. Moreover, the longer it takes for a consolidation to unfold, the greater will be its disruptive power with respect to the trend, should a reversal occur. 12. Third gap exhaustion. The appearance of a third gap in a trend is also an indication of potential trend exhaustion and a possible reversal. In Figure 5.28, we observe the prices of the Spider Industrial Average ETF making a top after 141. 142. Figure 5.28 Third gap indicating potential exhaustion in a trend on the daily chart of Spider DJ Industrial Average. Courtesy of StockCharts.com. The appearance of a third gap in the uptrend. This also coincided with overbought conditions on the cycle-tuned stochastic. Prices finally bottomed after the appearance of another third gap in the subsequent downtrend, which again coincided perfectly with the cycle-tuned stochastic at oversold. 13. Completion of the average period range. One of the most reliable characteristics of price activity lies with its average period range, with the period being any chosen duration of observation. For example, let us assume that the average daily range of a certain forex pair is 120 pips per day. This would essentially mean that any price activity beyond this average range in either direction prior to the completion of the trading day will be regarded as a potential sign of exhaustion and a reversal may be expected. It is important to note that these averages period ranges may also be associated with underlying wave cycles in the market. Once the average range is breached prematurely, the practitioner begins to look for various signs of a reversal, paying special attention to supportive and resistive confluences. The average period range may be obtained via either of the following approaches. The use of the average true range indicator, ATR, set to a reasonable look-back period on an interval chart of interest. By finding the two standard deviation value of bar range over a certain number of periods, the practitioner should conduct a simple backtest to find the most reliable look-back period for each of the above approaches. Note that with the latter approach, 90% of the period ranges will remain below the calculated value, the breach of which represents a greater degree of overextension or exhaustion. 14. Overextended price action with respect to an overlay barrier. Any price penetration above an uptrending line is generally regarded as a potential sign of the Handbook of Technical Analysis. Trend Analysis. Figure 5.29 Price Exhaustion. Exhaustion, with a reversal expected. Similarly, a reversal is expected for any price penetration below a downtrending line. It should also be noted that any short-term penetrations below an uptrending line or above a downtrending line are usually regarded as false breakouts rather than being specifically categorized as overextended. See Figure 5.29. 15. Volume spread action. The relationship between volume and price is most significant when price and volume exhibit extreme behavior. There are basically four scenarios where this relationship is of interest: very large bar range accompanied by very large volume. This is normally regarded as trend promoting, being a potentially bullish sign when the bar closes at or very near the high. In an uptrend, this would suggest a strong continuation of any existing uptrend, and reversal of any exiting downtrend. If the close was near or at the bottom of the range, then it would be regarded as potentially very bearish, suggesting a potentially strong continuation of any existing downtrend and reversal of any existing uptrend. Very large bar range accompanied by very low volume. This is normally regarded as trend inhibiting, although not necessarily as an indication of a potential reversal. It implies a lack of commitment underlying the price move. Very small bar range accompanied by very large volume. This is also normally regarded as trend inhibiting and is regarded as a significantly stronger indication of a potential reversal. It shows that even with such a large commitment in capital, there was no further extension in price, implying a strong opposition to the existing trend. This is popularly referred to as a squat bar. Very small bar range accompanied by very low volume. This is normally regarded as trend inhibiting, although not necessarily leading to a potential reversal. 16. Volume and oscillator divergence. The appearance of standard or reverse divergence between price and volume, or with any oscillators, may give an early indication of potential reversals or continuations in the market. Please refer to Chapter 9 for more on divergence analysis. 143. 5.3 Price and trend filters. 144. The exact point of entry and exit, or breakout and reversal, is determined by the type of filter and the extent to which it is employed. A trader can initiate trades based on intraday breakouts without the use of a filter, but that will not be an effective approach as it would make backtesting virtually impossible, rendering a profitable trading performance unrepeatable. There are three broad categories of filters, namely price-based, time-based, event-based. The entry trigger characteristic associated with each category of filter is as follows. Price-based filters indicate the exact price of entry but do not indicate when an entry will be initiated. Time-based filters indicate the exact time of entry but do not indicate the price at which an entry will be initiated. Event-based filters do not indicate the exact price or time of entry until an event has occurred. Within each broad category of filters, there are subcategories, namely 1. Price-based filters. I. Absolute measure. Fixed price excursion. 2. Relative measure. Percentage of breakout price. 3. Volatility measure. Multiples of average true range. Multiples of standard deviation. 2. Time-based filters. I. Duration of N closed bars. 3. Event-based filters. I. Algorithmic filters. Specific sequence of closed bars. Sequence of new highs or lows. 2. Event-based measure. Closing price violation barrier retest after a confirmed breakout. See Figure 5.30. There may be scenarios where two-stage filtering may be required in order to contain and limit the maximum risk allowable per any single trade, under the rules of money management. Without controlling the maximum risk allowable per any single trade, the trading system may eventually experience risk of ruin. This is why price-based filters are the preferred mode of filtering. The Handbook of Technical Analysis. Trend Analysis. Figure 5.30. The three modes of filtering. As an example, let us assume that a trader has decided to use a closing violation as the trigger for entry. The problem with closing violations is that prices may close too far beyond the entry level. To prevent this, an additional price-based filter is used to limit entry to within a specified distance. In essence, the trader is primarily employing the closing violation as an entry trigger, but is depending on the price-based filter to limit risk should the violation be overextended. In short, double filtering is especially useful when employing time or event-based filters, since these filters do not specify the exact price of entry, making the controlling of risk ineffective and inefficient, if not impossible. 5.4 Trend participation. Participating in the market. There are four basic ways of entering and exiting the markets, namely to go long, buying to open a new position, to go short, selling to open a new position, to liquidate, selling to close an old long position, to cover, buying to close an old short position. If a trader holds no open positions in the market, the trader is said to be in cash. To square a position is to exit it. Traders may also reduce or neutralize all directional risk by hedging their positions with equal and opposite positions in the market. Buying at the current price is also referred to as buying at the market. 145. 146. Figure 5.31 Participating in the market via the 4 basic entry and exit orders. Figure 5.31 depicts the actions of a market participant trading according to the principle of buying low and selling high, which involves any of the 4 following scenarios. Buying low and selling high and selling higher, selling high and buying back lower, selling low and buying back even lower. Orders for entering and exiting a position. There are 2 basic types of orders that will allow traders to participate in the market. Stop entry and stop exit orders. Essentially, stop orders are instructions to enter or exit a market immediately, at any price. A stop order cannot guarantee that an order will be executed, or filled at the specified price, but it can guarantee execution. When entering the market at the current price, we use a market order. Stop entry and stop exit orders may be placed in the market as pending or working orders. Once triggered, all stop entry and stop exit orders turn into market orders. Orders can also be placed instantaneously as market orders. For entry, either a buy stop or sell stop order may be placed. For exiting, if price moves adversely against a position, a stop exit order may be employed, normally referred to as a stop loss order. Pending stop entry orders are usually placed when a continuation in price is expected. Stop loss orders may experience additional loss under gapping price action due to negative slippage. Slippage is the difference between the specified order price and the actual filled price. Limit entry and limit exit orders. Limit orders are instructions to enter or exit a market at a specified price, or better. If the broker cannot fill the order at the specified price or better, the order will not be executed. Hence, limit. The Handbook of Technical Analysis. Trend analysis. Orders can guarantee that an order will be filled at the intended price or better, but they cannot guarantee that an order will be executed. Limit orders can only be placed in the market as pending or working orders. They cannot be placed instantaneously like stop or market orders. For entry, either a buy limit or sell limit entry order may be placed. For exiting, if price moves favorably with respect to a position, a limit exit order may be employed, normally referred to as a take profit order. Limit entry orders are usually placed when a reversal in price is expected. Profit take orders can potentially exit with greater profit under gapping price action. Only positive slippage is possible with limit orders. In order to enter or exit the markets, orders are placed with the brokers, giving them instructions on how to execute entries and exits. 1 Entries above the market. 4 entries above the market. A trader may place a buy stop entry order if the trader believes that prices will rise higher. Conversely, if a trader believes that prices will reverse at a certain level above the market, a trader may place a sell limit order at that price level. Being a limit order, entry is not guaranteed unless the broker can execute the order at the specified entry price, or better, that is, higher. To short above the market using a stop order, a trader may use a market if touched, MIT, sell order. 2 Exits above the market. For profit taking above the market, a trader may place a sell limit to exit, normally referred to as a profit take order. Being a limit order, exit is not guaranteed unless the broker can execute the order at the specified exit price or better, that is, higher. Conversely, for cutting loss above the market, a trader may place a buy stop order to exit, normally referred to as a stop loss order. Being a stop order, exit is guaranteed but the exact exit price is unknown. 3 Entries below the market. 4 entries below the market. A trader may place a sell stop entry order if the trader believes that prices will continue to decline. Conversely, if a trader believes that prices will reverse at a certain price below the market, a trader may place a buy limit order at that price level. Being a limit order, entry is not guaranteed unless the broker can execute the order at the specified exit price or better, that is, higher. To long below the market using a stop order, a trader may use a market if touched, MIT, buy order. 4 Exits below the market. For profit taking below the market, a trader may place a buy limit to exit, normally referred to as a profit take order. Being a limit order, exit is not guaranteed unless the broker can execute the order at the specified exit price or better, that is, higher. Conversely, for cutting losses below the market, a trader may place a sell stop order to exit, normally referred to as a stop loss order. Being a stop order, exit is guaranteed but the exact exit price is unknown. 5 entries and exits at the market. For entry at the current price, a market order is used. The entry is instantaneous, but there is no guarantee of being filled. 147. Figure 5.32 Entry and exit orders. At the indicated prices on the quote screen. Negative slippage may sometimes occur when placing market orders. Exit at the current market price is also executed via a market order. Being a stop order, exit is guaranteed but the exact exit price is unknown. Other orders include: day orders instruct the brokers to keep an order pending only until the end of the trading day. Good till cancelled orders instruct the brokers to keep an order active until further notice. Market on close orders to buy or sell are executed during the last minutes of the trading day, at or near the closing price. Contingent orders are orders that are executed once another order is filled or triggered. Examples include 1 cancel other, OCO, and 1 trigger other, OTO, orders. Refer to Figure 5.32 for a summary of entry and exit orders, above, below, and at the market. 5.5 Price inflation points the 4 modes of initiating trend capture. There are 4 simple ways of initiating or establishing an entry in the market, namely via overlay breakout entries. An entry may be initiated on an upside or downside breakout of a price overlay that may or may not be in the direction of the predominant trend. Overlay barrier entries. A barrier entry may be initiated at an overlay bound area that may or may not be in the direction of the predominant trend. A barrier entry means buying at a barrier support and shorting at a barrier resistance. Barrier entries also include buying or shorting at a retest of a barrier. 148. The Handbook of Technical Analysis. Trend analysis. Failed breakout entries. An entry may be initiated in the opposite direction after a failed breakout, which may or may not be in the direction of the predominant trend. Random entries. An entry may also be initiated in a random fashion. Pattern/sequence-based entries. Entries that are initiated after a particular sequence of bars have unfolded, algorithmic, or after a pattern is completed. For example, DeMark sequential and Japanese candlestick entries. General scenarios for market tops and bottoms. As we learned in Chapter 4, there are basically 3 variations of a market top and bottom. See Figure 5.33. Examples of a more complex top or bottom would be a head and shoulders formation, a broadening formation, an island, a diamond formation and a rounding top or bottom. Swing points and barrier strength. An inflection point such as a peak that is flanked by a larger number of bars on either side of the bar with the highest price is generally regarded as a more significant peak. As such, the resistance level associated with such a peak will be regarded as a significant and strong barrier to price. The resistance and support levels associated with peaks and troughs that are flanked by a smaller number of. Figure 5.33 Variations of market top and bottom reversals. 149. 150. Figure 5.34 Support and resistance role reversals. Bars on either side of the highest or lowest bar are considered to be less significant and reliable. And bars on either side of the highest peak or lowest trough is referred to as an inflection point of strength N. Support and resistance role reversals. In technical analysis, price barriers change roles once breached, that is, support turns into future resistance. Resistance turns into future support. This applies to all overlay barriers, which include channels, trend lines, pivot points, price envelopes, and so on. See Figures 5.34 and 5.35. Figure 5.35 Support and resistance role reversals. Source: MetaTrader 4. The Handbook of Technical Analysis. Trend analysis. Figure 5.36 Support and resistance role reversals on the 3-0 min chart of the Eurist. Source: MetaTrader 4. Figure 5.36 shows price finding support and resistance at prior peaks and troughs, as well on the rising channel on the 30-min chart of the Eurist. Notice the cycle-tuned stochastic oscillator providing additional confirmation at the support and resistance levels, being overbought at resistance and oversold at support. Trading in the direction of the trend. To trade or initiate positions in the direction of the existing trend means to buy in an uptrend and short in a downtrend. It is generally easier and safer to trade in the direction of the existing trend for a variety of reasons, some being: buying dips in an uptrend and selling rallies in a downtrend gets the trader into positions where positions are initiated at the most advantageous prices with the smallest stop size possible. The trader is able to hold onto positions initiated in the direction of the existing trend and as a consequence extract greater profit from the markets. Buying on a dip and selling into a rally are examples of retracement entries taken in the direction of the existing trend. Figure 5.37 illustrates buying on dips in an uptrend and selling into bear rallies in a downtrend. A trader may use simple up and down trend lines or channels to time the retracement entries. The use of a cycle-tuned oscillator will also help fine-tune the entries. 151. 152. Figure 5.37 buying dips and selling rallies. Trend filters. A trend filter helps to identify a trend amidst the market noise and price volatility. Below are 3 popular trend filters used to achieve such an objective, which is by no means exhaustive. Via a double moving average crossover, with the shorter crossing above the longer moving average signifying the start of a potential uptrend and the shorter crossing below the longer moving average signifying the start of a potential downtrend. Via longer-term oscillator signal line crossovers, with the oscillators crossing above its signal lines signifying potential longer-term bullishness and oscillators crossing below its signal lines signifying potential longer-term bearishness. Via the containment of prices above or below overlay barriers such as moving averages or trend lines, with price staying above the moving average or trend line signifying that an uptrend is still intact and price staying below the moving average or trend line signifying that a downtrend is still intact. One popular approach is to use the oscillator signal line crossovers in an uptrend or downtrend to time entries, with the use of either an MACD signal, or zero line crossover or a double moving average crossover as a trend filter. Figure 5.38 illustrates an MACD filtered stochastic crossover trigger to time entries into the market. Long entries are initiated every time the stochastic crosses above its signal line with the MACD above its zero line. Short entries are initiated every time the stochastic crosses below its signal line with the MACD below its zero line. The stop is placed just above the previous peak in a short position and. The Handbook of Technical Analysis. Trend Analysis. Figure 5.38 MACD filtered stochastic signal line crossover entries on the Eurist. Source, MetaTrader 4. Just below the previous trough in a long position. The stops are set to trail price by advancing to the next lower peak in a downtrend or to the next higher trough in an uptrend. Note that the divergence in the MACD helps to warn the trader of a potential reversal. Stop sizing issues related to stop placement. A stop is usually placed just below significant troughs for long positions in an uptrend and just above significant peaks for short positions in a downtrend. For entries too far from a significant peak or trough, a stop may be placed at some multiple of ATR or standard deviations away from the entry. Stop sizes associated with barrier entries will always be approximately the same size, as the significant peak or trough is usually the point of entry itself. The stop losses will therefore be placed just behind the barrier, depending on the extent of price filtering employed. Stop sizes associated with breakout entries present a completely different scenario. Stop sizes for breakouts will vary with each entry, since the significant peak or trough associated with each entry may vary in distance from the entry. See Figure 5.39. This presents a significant problem to traders risking a fixed percentage or fixed unit size per trade. The varying trade size associated with the changing stop size for breakout entries will affect the performance of the system, especially if A fixed percentage of current capital is exposed per trade and narrow stops are taken out frequently, causing significant loss. A fixed percentage of original capital is exposed per trade and wide stops are taken out frequently, causing significant loss. To resolve this issue, we use proportional stop sizing, which was first introduced by the author in the Wiley Trading Guide Volume 2. Proportional stop size. 153. 154. Figure 5.39 stop sizing dependent on breakout or barrier type entries. Ing limits the losses in either scenario by allocating a fixed percentage of original capital to narrow stops and a fixed percentage of current capital for stop sizes that exceed a fixed threshold size. The procedure for determining the proportional trade size is as follows. 1. Do a backtest to find the average stop size for at least 300 to 500 trades, if possible. 2. Calculate the 2 standard deviation value based on all the stop sizes in the sample. 3. Add this 2 standard deviation value to the average stop size, this represents the proportional stop size. 4. Determine the maximum percentage of current capital to risk for each trade and calculate its corresponding dollar value risk per trade. 5. Divide this dollar value risk per trade by the proportional stop size, this represents your proportional trade size. Therefore, the trader would initiate trades based on the proportional trade size for all trades where the stop size is at or below the proportional stop size. For stop sizes that exceed the proportional stop size, calculate the trade size by simply dividing the maximum dollar value risk per trade by the stop size. The term proportional refers to the percentage risk allocated per trade that is initiated for entries with stop sizes at or below the proportional stop size. For such entries, the percentage of risk will vary proportionally with the stop size, where the maximum risk will always be capped at the maximum percentage risk per trade. For a more detailed description of the trade sizing issues that plague traders, refer to Chapter 28. The Handbook of Technical Analysis. Trend analysis. 5.6 Trend lines, channels, and fan lines. Provisionary, tentative, and confirmed, valid, trend lines. A trend line is created by projecting a line forward into the future drawn from 2 significant inflection points. For uptrends, a line is drawn between 2 significant troughs and projected into the future, whereas for downtrends a line is drawn between 2 significant peaks and projected into the future. When drawing trend lines, lines must not cut through any price action at any point along the line. A trend line is said to be only provisionary or tentative until it is tested for the first time, that is, at the third point of price contact on the trend line. Once tested, it is then regarded as a confirmed or valid trend line. All trend lines are drawn between 2 inflection points except for bullish support lines and bearish resistance lines in point and figure charting, where only one reference point is used. Fan lines use 2 inflection points but only one point is located at a peak or trough, while the other is along a predetermined vertical axis. Note that the term tentative or valid is only applicable to conventional trend lines and not to fan lines. Short, medium, and long-term trend lines. A trend line may be defined as short, medium, or longer term depending on the amount of price activity it contains above or below it. Longer-term uptrend lines contain more price activity above them than shorter-term uptrend lines. The converse is true for downtrend lines. See Figure 5.40. Trend line support and resistance, the behavioral component. As mentioned in an earlier section, all price overlays, including trend lines, represent barriers to price action. As barriers, they provide support and resistance to price. Price approaching a trend line from above will potentially experience support. Figure 5.40 short, medium, and longer-term trend lines defined by the amount of price activity they support. 155. 156. At the trend line, while price approaching a trend line from below will potentially experience resistance. This occurs because most market participants will usually place buy orders above a barrier and short orders below it. Hence, when price AP prow CHES the barrier from above, the initial triggering of buy orders will cause an upside reaction, creating temporary support. When price approaches the barrier from below, the initial triggering of sell orders will cause a downside reaction, creating temporary resistance. As such, support and resistance are regarded as behavioral consequences of human psychology, biases, and emotions. Invalidating and redrawing trend lines. A trend line is invalidated once it is breached. This does not mean that it is thereafter unusable or ineffective. A head and shoulders neckline is a popular example of a trend line being invalidated when the formation is confirmed, that is, when the neckline is breached. Price very frequently retests the neckline after being breached. See Figure 5.41 for an example of an invalidated trend line and the redrawing of a new trend line. The new trend line is drawn between the new significant trough and the original lower trough in an uptrend. For downtrends, the new trend line is drawn between the new significant peak and the original higher peak. Once a trend line is invalidated, it is thereafter referred to as an internal line. So what actually constitutes a valid trend line penetration? The answer depends on the type and extent of filtering employed. If the trader were to apply the closing filter rule, then a valid trend line penetration would only be acknowledged once price closes beyond it. But what if price made a very significant intraday downside penetration but eventually closed back above an uptrend line? In such a situation, the penetration is usually regarded as significant but nevertheless invalid, based on the filter rule employed. As we can see, the implications can be Figure 5.41 confirming and invalidating trend lines on the 3-0-min chart of the Eurist. Source, MetaTrader 4. The Handbook of Technical Analysis. Trend analysis. Rather interesting. We yet again observe the problems with defining price action. The best way to resolve this dilemma is as follows. Use only price-based filters and avoid time and event-based filtering. This would allow the trader to decide exactly how much price excursion is required to represent a valid penetration of a trend line, or for that matter, any price barrier. Even if the amount of price excursion fails to be recognized as a valid penetration, this does not mean that a new trend line cannot be drawn. The trader will monitor price reactions at both the original and newly drawn trend lines. Use double-stage filtering when employing time or event-based filters to gauge valid trend line or price barrier penetrations. As long as the second filter is price-based, the trader would be able to identify a valid penetration once the price exceeds a specified price. As before, this does not preclude the drawing of a new trend line, even if the intraday or intraperiod penetration has not exceeded the second filter's validation price. Elements of trend line reliability. What constitutes a reliable trend line? Quite simply, a reliable trend line may be defined as a trend line that provides consistent support and resistance to price action. A trend line that experiences a lot of whipsaws is considered unreliable. Factors influencing trend line reliability include angle of trend line. A steep uptrend, that is, above 45 degrees, is usually regarded as less stable and may not be able to sustain itself over the longer term. Any trend line associated with such a trend is therefore deemed less reliable. A weak trend with a very shallow angle of ascent is also regarded as less stable, and any trend line associated with such a trend is also deemed less reliable. The most reliable uptrend line is one where the angle of ascent is approximately 35 to 45 degrees. Duration of trend line. Longer-term trend lines are generally regarded as more reliable than shorter-term trend lines. A longer-term trend line would have been in the market for a much longer period of time and would be more obvious to all market participants, be they short, medium, or longer-term traders. As such, a longer-term trend line will attract a larger number of buy orders above it and sell orders below it, and in the process transform into a stronger and more significant barrier to price. This makes longer-term trend lines more reliable. Longer-term trend lines also attract the institutional players, resulting in larger orders placed at the trend line, giving rise to a stronger inhibiting effect with respect to price. Number of price retests. The greater the number of retests a trend line experiences, the more indicative it is that traders are aware and paying attention to a trend line. Such a trend line will normally attract more orders around it as traders realize that it is rejecting price in a consistent manner. The clarity of the price retests, the more precise the retest, the more indicative it is that the market participants are aware of such a trend line. As before, this will attract more orders around the trend line, making it a more formidable barrier to price. 157. 158. Figure 5.42 Trendline Minimum Price Target Projection on the 30-min chart of the Eurist. Source, MetaTrader 4. Confluence with other indicators. The more confluence or convergence there is with other bullish or bearish indicators at the point of contact on the trend line, the stronger will be the rejection of price at the trend line. Preceding action, the contraction of cycle amplitude, cycle period, bar range, and body-to-range ratio are indications of a potentially weak uptrend and a potentially bullish downtrend. As such, this makes any trend line associated with such trends also suspect and unreliable over the longer term. Trendline measuring objectives. To forecast the minimum price target for a trend line, simply apply a 1-to-1 projection of the distance that price has moved farthest from the trend line from the breakout point. Figure 5.42 shows a typical 1-to-1 price projection from the breakout point. We see that prices bottomed very close to the minimum projected target. Strengths and weaknesses of trendline analysis. Strengths. Trend lines, being straight lines, will catch any trend changes effectively. Trend lines are able to identify trends without the need to identify specific price. Patterns and formations. It is simple to construct and may be applied across all time frames and markets with equal ease. A trend line is viewable across all time frames. Weaknesses. Trend lines, just like moving averages, are also subject to whipsaws and are less effective in erratic, volatile, or ranging markets. Because trend lines are geometrically based overlays, they are affected by the type of scaling used, that is, ratio or linear. The Handbook of Technical Analysis. Trend Analysis. Figure 5.43 Continuation and Reversal Trend Lines. Consolidation may cause a trend line to be breached at some point in time, in the absence of a legitimate trend reversal. Continuation and reversal trend line entries. We may also classify trend lines as reversal or continuation in the following manner. Trend lines that allow breakout in the direction of the existing trend are referred to as continuation trend lines. Trend lines that allow breakout in the opposite direction to the existing trend are referred to as reversal trend lines, see Figure 5.43. As such, the practitioner must ascertain which wave degree is being observed in order to determine whether a trend line breach is a continuation or reversal of the existing trend. Channel construction. Channels may also be created by projecting a trend line from a significant peak or trough that is parallel to the uptrend or downtrend line. Channels are useful in that they indicate potential entry levels, profit-taking levels, future price targets, stop-loss levels. Figure 5.44 illustrates the construction of a rising channel. First, draw an uptrend line based on two significant troughs, indicated at points 1 and 2. Then locate a significant peak above the trend line, which in this case would be the peak at point 3. Draw a line parallel to the uptrend line from the peak at point 3 and project it upward. This projected line is called the channel or return line. This 159. 160. Figure 5.44 Channels and channel transitions. Formation constitutes a rising channel. To draw a falling or declining channel, we first draw a downtrend line based on two significant peaks, indicated at points 4 and 5. We then draw a line parallel to the downtrend line from a significant trough, indicated at point 6, and project it downward. Notice that the trough at point 6 has violated the uptrend line, which may be an early indication of a potential trend change. We see the rising channel transitioning into a falling channel. Please refer to Chapter 13 for alternative approaches to constructing a price channel. Nested channels. Figure 5.45 shows silver price transitions within a larger falling channel. We say that the smaller channels are contained or nested within the larger channel. Channel nesting can occur at multiple levels, with large channels comprised of ever-decreasing channel sizes. In essence, channel nesting has fractal-like properties. Figure 5.46 depicts nested channeling on a chart of the USD-CAD. Notice the channels reacting at the Fibonacci retracements levels. Price target projection. Channels are extremely useful for projecting potential price targets. Figure 5.47 illustrates the use of the return line as a possible price target, providing resistance to the motion of price. The price targets at points 5 and 6 were forecasted accurately via channel projection. Anticipating channel breakouts. It also should be noted that if the subsequent price action fails to test either one of the channel boundaries, it may be an early indication of a possible channel breakout in the opposite direction of the failed price retest. A failure to test a channel bottom in the Handbook of Technical Analysis. Trend analysis. Figure 5.45 nested channel transitions on the 4-hour chart of silver. Source: MetaTrader 4. Uptrend and a channel top in a downtrend represent even stronger evidence of a potential continuation of the existing trend. This is especially so if the channel breakout bar is accompanied by large volume. Refer to Figure 5.14. Notice that price failed to test the lower channel boundary, which was followed by a strong continuation of the existing uptrend. Note also the large channel breakout bar at point A. Figure 5.46 nested channel transitions on the 4-hour chart of silver. Source: MetaTrader 4. 161. 162. Figure 5.47 channel projections on the Eurist chart. Source: MetaTrader 4. Sperandio and DeMark trend lines. Victor Sperandio introduced a powerful way of drawing trend lines in his book Trader Vic: Methods of a Wall Street Master. For more details about his approach, the reader is advised to read his book. There is no way the author can do justice here to Sperandio's superb approach. In short, Sperandio trend lines are constructed by connecting and projecting a line from a lowest trough to the highest minor trough preceding the highest peak for uptrend lines. Highest peak to the lowest minor peak preceding the lowest trough for downtrend lines. See Figure 5.48. Thomas DeMark introduced a more responsive approach to drawing trend lines in his book The New Science of Technical Analysis. The reader is advised to read his book for a full treatment of pivot selection process and other prerequisites necessary for the correct drawing of DeMark trend lines. What is presented here represents only a brief description of the method. In short, DeMark trend lines are constructed by connecting and projecting a line from the two most recent qualified troughs in an uptrend, the two most recent qualified peaks in a downtrend. See Figure 5.49. The trend line that is drawn using the two most recent troughs represents the correct approach to creating DeMark trend lines. The Handbook of Technical Analysis. Trend analysis. Figure 5.48 Sperandio uptrend and downtrend lines. Standard fan lines. Standard fan lines indicate a change in trend. They may be either accelerating or decelerating. The violation of the third fan line represents strong confirmation of a trend change. As with all types of fan lines, they provide support and resistance to price action. When support is breached, it turns into resistance, and vice versa. They are traded in a manner representative of any trend line. To construct accelerating fan lines, locate a significant higher peak and draw a downtrend line connecting this significant peak to gradually rising lower peaks. Only draw 3 downtrend lines. To construct decelerating fan lines, locate a significant lower trough and draw an uptrend line connecting this significant lower trough to gradually declining higher troughs. Only draw 3 uptrend lines. See Figure 5.50. Figure 5.49 DeMark uptrend lines. 163. 164. Figure 5.50 decelerating and accelerating fan lines. Fibonacci fan lines. Fibonacci fan lines are created in a slightly different manner as compared to standard fan lines. Here is how to construct a bearish Fibonacci fan line. Identify a significant Fibonacci retracement range. Draw a vertical line from the peak of the retracement range to the troughs. Price level. Divide the vertical line into 38.2, 50, and 61.8% levels. Project 3 lines from the trough, intercepting the 3 retracement levels located on the vertical line. See Figure 5.51. Speed lines. Edson Gould's speed lines also track the progress of a trend as it attempts to bottom or top. Speed lines are created in exactly the same way Fibonacci fan lines, except that the retracement ratios are 1/3 and 2/3. See Figure 5.52. Figure 5.51 Bearish Fibonacci fan lines. The Handbook of Technical Analysis. Trend analysis. Figure 5.52 1/3 decelerating speed lines. Other types of trend overlay indicators. Andrew's pitchfork. Andrew's pitchfork is a geometrically based price overlay indicator. The projected lines provide support and resistance to price action. The middle line is called the median. To construct a bearish Andrew's pitchfork, we need to find a significant peak. Identify a subsequent upside retracement back up to the peak, but not exceeding it. Find the midpoint between the retracement trough and the retracement peak. Draw and project a line from the significant peak through this midpoint, referred to as the median line. Project lines parallel to this median line from the retracement peak and retracement trough. The converse applies to bullish pitchforks. Figure 5.53 depicts daily silver prices finding support at the median line and upper band in a downtrend. Figure 5.53 price reacting to the Andrews pitchfork on the daily chart of silver. Source: MetaTrader 4. 165. Figure 5.54 Comparative analysis of popular retracement ratios. 5.7 Trend retracements. Retracements, Dow, Fibonacci, and Gann 1/3 and 1/8. There are various approaches to measuring trend retracements. Fibonacci retracements are based on various ratios related to the Fibonacci phi ratio. Dow paid particular attention to the 1/3 and 2/3 retracements, while Gann employed 1/3 and 1/8 retracement ranges. Probably the most important retracement percentage of all is the 50% retracement level. Both Gann and Dow regarded 50% as the most significant retracement percentage, with most major tops and bottoms forming around this retracement level. These retracement approaches will be dealt with in more detail in a subsequent chapter. For now, see Figure 5.54 for a table comparing the various retracement percentages used in the Fibonacci, Dow, and Gann approaches to trend retracement. We see strong convergence of retracement percentages around specific retracement ranges, especially the between the 33 to 38.2%, 50%, and 61.8 to 66% ranges. 5.8 Gaps and trends. Gaps help to define various stages within a trend, which helps to provide an indication of potential tops and bottoms in the market. There are basically 4 types of market gaps, namely 1. Common gaps, gaps that occur within a trading range, considered insignificant. 2. Breakaway gaps, gaps that are created as price breaks away from a consolidation or chart pattern. 3. Runaway/measuring/midway/continuation gaps, gaps that are created in a strong trend phase. There may be more than one runaway gap appearing in a strong trend. 4. Exhaustion gaps, gaps that are created at the end of a trend, after which a consolidation or reversal occurs. It is indicative of potential trend exhaustion. Figure 5.55 depicts the 4 types of market gaps on a weekly chart of wheat. We see common gaps within the consolidation phase followed by the trend-related gaps. We see prices top after the 3rd gap, which represents potential trend exhaustion. 166. The Handbook of Technical Analysis. Trend analysis. Figure 5.55 gaps defining the three phases of a trend on the weekly chart of wheat. Source, MetaTrader 4. In Figure 5.56, we see the same trend exhaustion occurring at a significant resistance level created by a strong price rejection at the high of a very bearish shooting star pattern. We also notice how the gaps help define the various phases of the market. It must also be noted that gaps tend to create areas of potential support and resistance. In Figure 5.55, we observe the gaps giving rise to subsequent levels of support in wheat. In Figure 5.57, we also observe gaps giving rise to areas of support and resistance on the 1-5-min chart of SPDF Gold Trust shares, gold. Figure 5.56 forecasting trend exhaustion using gap analysis on the weekly chart of wheat. Source, MetaTrader 4. 167. Figure 5.57 forecasting potential areas of support and resistance via gaps on the 1-5-min chart of gold courtesy of stockcharts.com. Notice how the cycle-tuned stochastic helps to corroborate the levels of support and resistance by being overbought at resistance and oversold at support. 5.9 Trend directionality. A unidirectional entry is a trade taken only in the direction of the existing trend, be it to the upside or downside. A bidirectional entry is a trade taken in either direction, depending on which way the breakout occurs. Figure 5.58 illustrates how very short-term or micro-unidirectional entries are equivalent to a longer-term or macro-bidirectional trading approach. Figure 5.58 Micro-unidirectionality as a basis for macro-bidirectionality. 168. The Handbook of Technical Analysis. Trend analysis. Assume that a trader only initiates a breakout in the direction of the existing trend. The trader would be initiating long position in an uptrend and short positions in a downtrend. Over the long term, this would be equivalent to a longer-term bidirectional trader entering the market on a breakout. Hence we see that even though a trader only trades in one direction at any one time, being unidirectional, over the longer term this would essentially result is trading bidirectionally in the market as the trend moves up and down. The only condition that would disrupt this equivalence would be if the unidirectional trader did not take every qualified trade. 5.10 Drummond Geometry. Drummond geometry was developed by Charles Drummond over a long period of time. Drummond geometry helps keep the trader on the right side of the markets. It basically consists of a short-term moving average referred to as the peel dot line and interbar trend lines. The reader is advised to refer to the Ultimate Trading Guide by John Hill, George Pruitt, and Lundy Hill for a detailed look at Drummond geometry. The peel dot line is represented by a simple three-period moving average of typical price. This moving average may be forward shifted by one period to provide an early prognostication of market sentiment. To be very brief, when price is above the peel dot, the market is regarded as bullish, and when price is below the peel dot, the market is expected to be bearish. Another approach that some practitioners take is to buy when the peel dot line turns up and sell when it turns down. Note that interbar trend lines connecting the highs and lows are also used to forecast potential support and resistance. See Figure 5.59. Figure 5.59 peel dot line indicating potential future direction on the weekly chart of the Eurust. Source, MetaTrader 4. 169. 5.11 Forecasting Trend Reversals. The following is a summary of characteristics associated with forecasting reversals via various forms of technical analysis. For detailed analysis of each approach, refer to the relevant chapters within this handbook. A volume divergence. Potential market reversals tend to be accompanied by diminishing volume in an uptrend or downtrend, indicating potential weakness in the trend. Extreme volume in the form of buying or selling climaxes, indicative of market tops and bottoms. B-chart patterns. Potential market reversals tend to be accompanied by bearish chart patterns occurring after a strong and prolonged uptrend, bullish chart patterns occurring after a strong and prolonged downtrend, the appearance of a large broadening, diamond, or island formation. C cycle analysis. Potential market reversals tend to be accompanied by Cycle peaks at market tops, cycle troughs at market bottoms, decreasing cycle amplitude during a trend, decreasing cycle period during a trend. De-oscillator analysis. Potential market reversals tend to be accompanied by overbought signals at market tops, oversold signals at market bottoms, bearish divergence with price at market tops, bullish divergence with price at market bottoms, oscillator crossing below its signal and equilibrium line at market tops, oscillator crossing above its signal and equilibrium line at market bottoms. E-candlestick formations. Potential market reversals tend to be accompanied by bearish candlestick formations at market tops, bullish candlestick formations at market bottoms. F. Intermarket relationship. Potential market reversals tend to be accompanied by bearish action in the broad markets leading to a top in the stock, bullish action in highly correlated markets leading to a bottom in the stock. G. Support and resistance levels. Potential market reversals tend to be accompanied by market tops at significant historical resistance levels, market bottoms at significant historical support levels. 170. The Handbook of Technical Analysis. Trend Analysis. 5.12 Chapter Summary. In this chapter, we dealt with issues concerning the definition and identification of a trend. We have also discussed various powerful trend indicators that helped identify the early onset of a trend. The practitioner is advised to pay particular attention to the 16 characteristics that may significantly impact the future of price action and potential strength of a trend. Chapter 5 Review Questions. 1. What is a trend? 2. Explain the disadvantages of defining market and price action. 3. What are the early indications of a potential reversal? 4. Briefly describe the 12 ways in which price action may be understood. 5. How can channel analysis help pinpoint potential reversals and continuations? 6. What are the factors that impact trendline reliability? 7. Explain the advantages of using proportional sizing. 8. In what ways are price-based filters more useful than time and algorithmic filters? References. Koval, Michael W. 2009. Trend Following. Upper Saddle River, New Jersey, FT Press. DeMark, Thomas. 1994. The New Science of Technical Analysis. New York, John Wiley and Sons. Hill, John, George Pruitt, and Lundy Hill. 2000. The Ultimate Trading Guide. New York, John Wiley and Sons. Sperandio, Victor. 1991. Trader Vic, Methods of a Wall Street Master. New York, John Wiley and Sons. 171. Chapter 6. Volume and Open Interest. Although price is regarded as the best indicator of potential future price behavior, volume and open interest offer additional evidence to corroborate bullish or bearish setups. Volume and open interest can indicate potential underlying weakness and also function as timing indicators for potential breakouts. Many novices misread declining volume as a weakness in a consolidation. The relationship between volume with bar range also offers critical insights into the actions of buyers and sellers, especially when extremely low or high volume is accompanied by unusually large or narrow bar ranges, respectively. Mastery over the interpretation of volume and open interest action is of paramount importance to the art and science of forecasting potential price activity in the markets. 6.1 The Mechanics of Volume Action. Dow Theory of Volume Confirmation. We learned in Chapter 2 that under the tenets of Dow theory, volume is expected to confirm the trend, that is, it should expand in the direction of the pre-existing or learning objectives. After studying this chapter, you should be able to understand the significance of volume action and its implications for market action. Recognize the early indications of potential trend weakness via volume and open interest divergence. Identify bullish and bearish signals on volume and open interest indicators. Forecast potential reversals and corrections in the market via volume cycles. Set up effective volume filtering for more efficient timing of entries and exits. Read volume across successive contract months in the futures markets. 173. 174. Predominant trend. Volume is regarded as a supporting or secondary indicator of potential future price action. To confirm the trend, volume should increase as price rises and decrease in any downside retracements in a pre-existing uptrend, bullish volume action. Volume should increase as price declines and decrease on any upside retracements in a pre-existing downtrend, bearish volume action. Any volume action contrary to the above is an indication that an uptrend may potentially be bearish and a downtrend bullish. Volume is an indication of market participation. It is the total number of shares or contracts traded over a specific time interval. When studying volume, the practitioner should always remember two basic principles, which are: 1. A rise in volume indicates that market participants are interested in seeing the price go higher in an uptrend or lower in a downtrend and are willing to buy higher in an uptrend or sell lower in a downtrend in order to participate in the unfolding market action. 2. A decline in volume indicates that market participants are losing interest in seeing the price go higher in an uptrend or lower in a downtrend and are more willing to buy lower in an uptrend and sell higher in a downtrend, if not exiting positions in the market. Notice that, in Figure 6.1, both rising and declining volume are regarded as bullish volume if both volume and price rise and decline together in a pre-existing uptrend. Conversely, both rising and declining volume are regarded as bearish volume if volume and price move in opposite directions to each other in a pre-existing. Figure 6.1 Volume confirming a pre-existing trend. The Handbook of Technical Analysis. Volume and open interest. Figure 6.2 Bullish volume expanding in the direction of the pre-existing trend on the continuous daily chart of gold. Courtesy of stockcharts.com. Downtrend. This shows that declining volume does not necessarily imply bearishness, and similarly, rising volume does not imply bullishness. This is a simple mistake that many novices make when trying to interpret volume action. The bullish or bearish sentiment associated with volume action depends on the direction of the price. In Figure 6.2, we observe volume expanding in the direction of the primary bull trend in gold, in which volume declines during a retracement, as expected. In Figure 6.3, we observe volume action that is not confirming the pre-existing trends. Here we see that both rising and declining volume are regarded as bearish volume if both volume and price move in opposite directions to each other in a pre-existing uptrend. This is an indication of a potentially weak or bearish uptrend. Conversely, both rising and declining volume are regarded as bullish volume if both volume and price rise and decline together in a pre-existing downtrend. This is an indication of a potentially bullish downtrend. Volume confirmation and divergence. This leads us naturally to the concept of volume confirmation and divergence. Simply put, volume divergence occurs whenever volume declines, irrespective of the direction of price. Volume convergence or confirmation occurs whenever volume rises, irrespective of the direction of price. Volume divergence implies that market participants are not interested in seeing prices rise or decline further. As prices rise and volume subsides, traders and investors indicate that they are less interested in participating in the upside move. 175. 176. Figure 6.3 Volume not confirming a pre-existing trend. This is bearish for an uptrend. Similarly, as prices fall and volume subsides, traders and investors indicate that they are less interested in participating in the downside move. This is bullish for a downtrend. When both volume and price rise together, traders and investors indicate that they are interested in participating in the upside move. We say that there is a convergence between price and volume, or that volume confirms price. This is bullish for an uptrend. When volume rises and prices decline, traders and investors indicate that they are interested in participating in the downside move. This is bearish for a downtrend. In short, volume convergence, that is, volume increasing, is an early indication of a potential continuation of the existing trend. Volume divergence, that is, volume decreasing, is an early indication of a potential reversal of the existing trend. It is important to note that, Unlike for standard price-based oscillators, the direction of price is irrelevant in the determination of volume divergence. Although the existence of divergence is not dependent on the direction of price, we still require knowledge of it in order to determine whether the divergence is bullish or bearish. It should also be noted that there is no reverse divergence classification associated with volume. Refer to Chapter 9 for a detailed treatment on the classification of divergence. Volume divergence always indicates potential weakness in an existing trend, whereas volume confirmation always indicates potential strength in an existing trend. In short, bullish divergence can only occur in a downtrend, indicating a possibility of a potential upside reversal in the trend. The Handbook of Technical Analysis. Volume and Open Interest. Figure 6.4 Volume Divergence and Confirmation. Bearish divergence can only occur in an uptrend, indicating a possibility of a potential downside reversal in the trend. See Figure 6.4. In Figure 6.5, we observe bullish volume divergence as ICIS Pharmaceuticals traces out a bullish rounding bottom. This is an example of divergence providing additional evidence of a bullish chart formation. Figure 6.5 Bullish volume divergence on the daily chart of ICIS Pharmaceuticals Incorporated courtesy of stockcharts.com. 177. 178. Figure 6.6 Bullish volume on the daily chart of Spider Gold Trust shares. Courtesy of stockcharts.com. In Figure 6.6, we observe bullish volume in periods 1 to 10, except in period 5, where the volume action was somewhat flat. Periods 1, 3, 7, and 9 display bullish confirmation, while periods 4 and 6 display bullish divergence. Periods 2, 8, and 10 display volume declining during a consolidation. In a consolidation, volume functions as a breakout timing indicator. We observe that at the end of periods 2, 8, and 10, price experiences either an upside or downside breakout whenever volume declines to its minimum for each period. Summarizing all possible divergent and convergent scenarios. Whenever volume and price are declining together, we have bullish divergence. Whenever volume and price are rising together, we have bullish confirmation. Or convergence. Whenever volume is declining and price rising, we have bearish divergence. Whenever volume is rising and price declining, we have bearish confirmation. Or convergence. Reading divergence for volume bars, smoothed volume oscillators, and open interest. As far as divergence is concerned, we can classify volume oscillators into two main groups, namely 1. Non-price-based volume oscillators. 2. Price-based volume oscillators. The Handbook of Technical Analysis. Volume and Open Interest. Price-based volume oscillators incorporate price data in their construction, whereas non-price-based volume oscillators only incorporate volume data in their construction. It should be noted that reading price-based volume oscillator divergence differs from reading non-price-based volume oscillator divergence. Some popular price-based volume oscillators include on-balance volume, OBV, accumulation/distribution line, ADL, Chaikin money flow Chaikin oscillator demand index Herrick payoff index. Some non-price-based volume oscillators include standard volume bars, smoothed volume, detrended volume, rate of change of volume, rock volume, percentage volume oscillator, PVO. Figure 6.7 summarizes the way divergence is read for each classification. The main difference between the two classifications is how bullish divergence and bearish confirmation are observed on the charts. Bearish divergence and bullish confirmation are read the same way for both classifications. Figure 6.7 Reading volume divergence on non-price-based versus price-based volume oscillators. 179. 180. Figure 6.8 Reading volume divergence on price-based versus non-price-based volume oscillators on the daily chart of the currency shares Euro Trust. Courtesy of stockcharts.com. Figure 6.8 depicts the difference between the smoothed and detrended, PVO, volume against the price-based ADL oscillator, and the way divergence is read for each classification. Volume as a timing indicator. Volume may also be used as a timing indicator for breakouts from consolidations. Whenever volume declines close to its lowest historical level, a breakout is expected. This is because all the buyers and sellers who are interested in participating in the stock or market have already done so. The majority of buyers who wanted to buy have already bought into the stock or commodity, and similarly, the majority of sellers who wanted to sell have already sold their positions. An accumulation of stop orders above and below the consolidation over the consolidation period will act as a catalyst for either an upside or downside breakout, once triggered. Hence, whenever the volume is testing a significant minimum or its lowest historical levels, a breakout is expected. We refer to this as a low-volume breakout signal. Note that there is no divergence reading during a consolidation. This is because price is essentially moving sideways and therefore it is not possible to distinguish between divergence or convergence, let alone bullish or bearish divergence. It should also be noted that there is a tendency for price to reverse when volume is at its minimum or lowest historical levels. We refer to the Handbook of Technical Analysis. Volume and open interest. Figure 6.9 Volume as a reversal and breakout timing indicator on the daily chart of Apple Incorporated courtesy of stockcharts.com. Such reversals as low volume reversals. In Figure 6.9, we observe price breaking out from an accumulation after volume declined to its lowest level. We also observe two low volume reversals just prior to the consolidation, at timelines 1 and 2. In Figure 6.10, we observe three consolidation breakouts occurring whenever the lowest or minimum volume level is tested. Notice an increase in volume on the breakout bars, as seen on bars 1, 2, and 3 in the chart. Volume-weighted average price/moving average, VWMA. A volume-weighted moving average, VWMA, may also be created to track overvalued and undervalued stock in the market. Typically, price is considered potentially bullish when it is above the VWMA, and bearish when below it. For a detailed calculation of the VWMA, refer to Chapter 11. In Figure 6.11, we notice price rising decisively every time it crosses above the VWMA and declining in a similar manner when it crosses below it. We also notice that the crossovers occur at the daily volume cycle peaks. It should be noted that the stock is regarded as undervalued if it lies below the VWMA and overvalued if it is above it. Hence many institutional traders deem it advantageous to only look for buy signals for a particular stock or market when it is undervalued with respect to the VWMA, and sell signals when it is above it. 181. 182. Figure 6.10 Volume as a breakout timing indicator on the daily chart of iShares Silver Trust. Courtesy of stockcharts.com. Volume buying and selling climaxes. A market top or bottom is usually accompanied by either relatively large or extreme volume, relatively low or minimal volume. Figure 6.11 VWMA on the daily chart of S&P 500 SPDRs courtesy of stockcharts.com. The Handbook of Technical Analysis. Volume and open interest. Figure 6.12 Selling climaxes signaled by the volume overbought level on the daily chart of ExxonMobil Corp courtesy of stockcharts.com. Here are the four possible scenarios for a top and bottom with respect to volume. 1. A market top associated with extreme volume is called a blow-off or buying climax. 2. A market bottom associated with extreme volume is called a sell-off or selling climax. 3. A market top associated with extremely low or minimal volume is called a low-volume top. 4. A market bottom associated with extremely low volume is called a low-volume bottom. In Figure 6.12, we observe a market bottom being created by a couple of selling climaxes on the daily chart of ExxonMobil Corp. We notice the extreme volume associated with each selling climax. We identify this extreme volume level as the upper overextended volume level. This upper volume level will serve as a signal for predicting potential market bottoms or tops. Notice that we have also identified a lower overextended volume level for forecasting less significant market corrections. In Figure 6.13, we observe a couple of blow-offs or buying climaxes at relatively high volume on the daily chart of Etrix UBS Bloomberg CMCI Food ETN. In Figure 6.14, we observe overextended volume levels in the Spider Gold Trust shares. The volume overextension level is identified by visual inspection and set at a level where only the most significant tops or bottoms are found in the Spider Gold Trust shares. Setting it at a lower level tends to result in more frequent signaling of less significant tops or bottoms. Notice the downside breakout of a 183, 184. Figure 6.13 volume blow-offs on the daily chart of Etrix UBS Bloomberg CMCI Food ETN. Courtesy of stockcharts.com. Significant support level at extreme volume. Note also that the overextended volume spikes are all above the rolling 100-day 2 sigma level. In Figure 6.15, we used a Bollinger Bandwidth oscillator to time volatility in the silver market. Notice the volatility spikes coinciding with volume overextensions, signaling market tops and bottoms. Many practitioners also filter out volatility below a certain threshold and regard it as noise. Figure 6.14 volume overextensions on the daily chart of Spider Gold Trust shares. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Volume and Open Interest. Figure 6.15, Volatility Filtered, Selling Climaxes on the Continuous Daily Chart of Silver. Courtesy of stockcharts.com. Tops and bottoms can also be formed on very low volume. Figure 6.16 depicts a series of low-volume reversals consisting of both low-volume tops and bottoms. We notice that a low-volume top or bottom is formed in the market whenever a lower volume threshold is tested, indicated by the timelines located at the circles shown on the daily chart of Apple Inc. Figure 6.16 low-volume, based reversals on the daily chart of Apple Incorporated courtesy of stockcharts.com. 185. 186. It is important to note that overextensions in volume can signal either a top or a bottom. Extreme buying and selling activity generates volume and can result in either a top or bottom. That is the reason why we cannot use the terms overbought or oversold with respect to volume extremes unless we are able to associate volume with either a top or bottom formation. Therefore, although we are able to pinpoint overextensions in volume, it is only possible to identify overbought or oversold levels in volume after a top or bottom has already formed, that is, in retrospect. Chart sensitivity to volume action. Figure 6.17 depicts volume action on different time frames. Notice that the daily and weekly volume action peaks in 2013, whereas the volume peaks in 2011 on higher time frame charts. We therefore see that lower time frame charts are more sensitive to volume action. At higher time frames, the overall trend or behavior of volume action is more obvious. Figure 6.17 volume action on the continuous multiple time frame chart of gold. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Volume and Open Interest. Volume action and the strength of a price barrier. An indication as to the potential strength and reliability of a price barrier may also be gauged from the action of volume at or across the point of support or resistance. Figure 6.18 shows two scenarios for resistance and support. Support and resistance formed at a volume peak are generally regarded as the most reliable and provide the strongest barrier to future retests. This is because even with the large surge in volume, price was still unable to penetrate the barrier. This gives traders confidence that the price barrier should hold up on future retests. Since expectation is everything in the market, this goes a long way to garner confidence in the barrier. Support and resistance formed across a volume dip or trough is considered less reliable since the reason for price not being able to penetrate the barrier is mainly due to a lack of interest or participation at the price barrier. Traders were not interested in taking price through the barrier. Hence the barrier only held up due to a lack of buying or selling pressure. In fact, there are 5 possible scenarios of volume action associated with support and resistance, which are 1. Volume increasing across support or resistance. 2. Volume decreasing across support or resistance. 3. Volume peaking at support or resistance. 4. Volume bottoming at support or resistance. 5. Volume flatlining across support or resistance. Volume increasing or decreasing across a barrier signifies a change in sentiment at the barrier, see figure 6.19. Increasing volume as price approaches the barrier gives the impression that there may be sufficient market force to drive price through it. But figure 6.18 price barrier strength and reliability. 187. 188. Figure 6.19 volume action associated with support and resistance. As prices start to reverse at the barrier, volume picks up, driving price away from it with either bearish or bullish confirmation. Conversely, decreasing volume as price approaches the barrier gives the impression that there may be insufficient market force to drive price through it. But as prices starts to reverse at the barrier, volume declines even further. Decreasing volume across support and resistance tends to see a retest of the barrier, and in more extreme circumstances, may even see price return to penetrate the barrier. Finally, flatlining volume across support and resistance does not provide enough information about potential future action of price with respect to the barrier. Filtering volume action. There are numerous ways to filter volume in order to identify the most significant volume action, some of which include employing a moving average filter, a volatility filter, prior volume peaks, volume cycles. Setting up a smoothed volume filter. A smoothed volume filter is simply a moving average based on volume, instead of price. To select the most effective look-back period, a simple backtest may be required to identify the amount of filtering that is appropriate for a particular trade setup. Some practitioners also employ some multiple or harmonic based on the dominant trading cycle period, usually setting the moving average to either the dominant cycle period or one half of it. In either case, whenever volume spikes above this overextended moving. The Handbook of Technical Analysis. Volume and Open Interest. Figure 6.20 A smoothed volume filter on the daily chart of USD-JP. Source, MetaTrader 4. Average line, it is considered to be significant and may potentially lead to a top or bottom forming in the stock or market. See figure 6.20. Setting up a 2 or 3 sigma volume filter. Alternatively, we may also filter out all volume except for the most significant surges using a 2 or 3 standard deviation, i.e., sigma, filter, also called a volatility filter. This is easily constructed by applying either a 2 or 3 standard deviation Bollinger Band on volume, also referred to as a 2 or 3 sigma filter. It should be noted that only the Bollinger upper band is used. A standard deviation oscillator may also be used, but it is less useful as it does not provide the overlay by which an overextension can easily be identified as it crosses over the threshold. Figure 6.21 depicts a 3 sigma volume filter signaling the most significant volume surges, which tend to result in the most significant tops and bottoms in the market. Volume filtered inflection points. Many practitioners also use volume as a means of filtering out price inflection points. They only use peaks and troughs that are considered significant, that is, those that are associated with above average volume, to construct trend lines and channels. In figure 6.22, we shall use tick volume, transaction volume, as a basis for selecting significant inflection points. We draw a simple tick volume overextension level or threshold via visual inspection, making sure that only the most significant peaks in tick volume appear at or above the threshold. Inflection points 1, 2, and 3 are associated with overextended tick volume and so are used to construct a channel. A trend line is drawn from point 1 to point 2. A parallel line is then projected from point 3. Notice that price reacts to the channel at point X, which represented a short-term buying opportunity before the market reversed downward, violating the rising channel. In figure 6.23, we use the same daily chart of USD-JP to construct an alternative price channel. This time we construct a trend line from points 1 and 2 and project a parallel line from point 3. We immediately notice a large bearish 189. 190. Figure 6.21a3 sigma volume filter on the daily chart of USD-JP. Source, MetaTrader 4. Candlestick breaching this parallel uptrend line. If we project another parallel line from point 4, and retrace it back in time, we see that it coincides perfectly with the trough that was formed at point X around the end of January 2011. Although this was done retrospectively, it is nevertheless now part of a valid rising channel. If we continue to project another two parallel lines from points 5 and 6, we notice that the new channel also contains price effectively, providing resistance and support at the channel top and bottom, respectively. This chart depicts the near-perfect underlying angular symmetry in the silver market. This again shows the importance of constructing chart patterns based on significant inflection points. Relative and absolute volume. Absolute volume is not as important as relative volume in technical analysis. It is the change in volume that provides the Figure 6.22 channel based on tick volume filtered inflection points on the daily chart of silver. Source, MetaTrader 4. The Handbook of Technical Analysis. Volume and open interest. Figure 6.23 channels based on tick volume filtered inflection on the daily chart of silver. Source, MetaTrader 4. Most information about potential price action in the markets. Rising and declining volume provide useful information about the level of interest or participation at various prices and indicate whether an ongoing trend is bearish or bullish. In contrast, historical or significant volume peaks and troughs, i.e., volume overextensions, provide a future reference level for signaling potential tops or bottoms in the market. It should also be noted that a change in volume is not an absolute requirement for a trend to develop or unfold. A trend can persist over prolonged periods on flat volume. The other interesting characteristic about studying relative levels in volume is that of bull versus bear market volume. Bull market volume tends to outweigh bear market volume for a variety of reasons, a few being: many investors prefer to hold on to losing positions in a falling market in the hope that the positions will eventually rebound to break-even or profitability. These participants are displaying what is called loss aversion bias. Many investors believe that unrealized losses are not real losses and so are willing to hold on to losing positions. This willingness to hold on does not contribute to the overall trading activity in a bear market. Investors and traders have the ability to use house money or profit to further fund new positions in a rising bull market. More investment funds start to market their services in a bull market, attracting more potential investors to participate in the market. Absolute volume is useful for identifying potential price rejection levels based on significant or historical prices. It is also useful when comparing the amount of participation across different stocks, sectors, industries, or commodities in the search for greater liquidity, especially when trying to gauge the total volume turnover with respect to the total number of outstanding shares in a stock. This will provide information about the absolute level of participation in a stock. 191. 192. Volume distortions. A surge in activities such as arbitrage, program trading, and high-frequency trading, HFT, may also distort and misrepresent the traditional meaning or representation of volume. As such, the volume information that traders use and rely on to read market action may not in fact be totally indicative of true volume action in the classical sense. Volume open interest interplay. Open interest is simply the total amount of outstanding contracts in the futures and options markets. Unlike stocks, all futures and options contracts eventually expire. Open interest is therefore the number of unliquidated long or short contracts. Each contract consists of a long and corresponding short position. These contracts are in a sense still active, or open. Open interest increases when a new long and corresponding short position are initiated, and decreases when both the long and corresponding short position are exited. Open interest remains unchanged when either the long or short position is replaced by a new position, but not both at the same time. Generally speaking, open interest is interpreted the same way as volume. It is indicative of the level of interest or participation in seeing price rise or fall. Open interest divergence is therefore read in the same way as non-price-based volume oscillators. When prices, volume, and open interest are all rising, this is indicative of a bullish market, predominantly driven by buying pressure. Conversely, when prices are rising but both volume and open interest are declining, this is indicative of a bearish market, predominantly driven by shorts covering their positions and longs leaving the market. For declining markets, rising volume and open interest is bearish and is predominantly driven by short selling. Falling volume and open interest is bullish in a declining market, mainly due to the diminishing number of long positions being liquidated and short positions being initiated. It shows that the market participants are less interested in seeing the market decline further. As far as trading is concerned, a trader should look for appropriate buy signals when price, open interest, and volume are all rising. Conversely, a trader should look for a suitable exit in order to liquidate long positions if rising prices are accompanied by declining open interest and volume. In a declining market, traders should look for appropriate signals to go short if both the open interest and volume are rising, and rapidly seek to cover all short positions when both the open interest and volume start to decline together. In Figure 6.24, we observe a bullish confirmation between volume and silver prices with volume peaking at 0.1, at the highest price. But we notice bearish divergence between open interest and price. This is an early indication that many longs are liquidating as prices rise. We subsequently see silver prices retrace significantly. It should be noted that the level of open interest may be indicative of the nature of a potential reversal or breakout. For example, if open interest is very high, the ensuing reversal may be significantly more rapid, due to the large amount of open contracts liquidating and covering. Volume versus tick, transaction, volume in the over-the-counter, OTC, foreign exchange, FX, market. Many brokers offer tick volume instead of actual volume. The Handbook of Technical Analysis. Volume and open interest. Figure 6.24, open interest indicating bearish divergence on the continuous daily chart of silver. One tick represents one trade. Tick volume therefore represents transaction volume. One transaction can be comprised of one contract or 1,000 contracts. Although tick volume does not represent actual volume, there still exists a very strong COR relation between actual volume and tick volume may be used as a proxy for actual volume, as far as comparing relative levels of overbought and oversold. Breadth volume and the arms index. The arms index, or TRIN, incorporates breadth volume, advances, and declines. It is simply the ratio of TRIN equals advances / declines / up volume / down volume. In short, a rising but not overbought tick and a falling but not oversold TRIN represent a bullish signal where the trader looks for an appropriate long entry. Conversely, a falling but not oversold tick and a rising but not overbought TRIN represent a bearish signal where the trader looks for an appropriate short entry. For longer-term trading, when tick is oversold, i.e., above its 2 sigma level on a weekly chart, and TRIN is overbought, i.e., near or above the 3.0 level on the daily charts, this signals a bullish scenario and the trader looks for an appropriate long entry. Conversely, if the tick is overbought and the TRIN is oversold, this signals a bearish scenario and the trader looks for an appropriate short entry. In Figure 6.25, we observe both the tick and TRIN at oversold levels. This indicates short-term bullishness on the 1-min chart of the S&P 500 large cap index. We subsequently see the index rising. 193. 194. Figure 6.25 tick / TRIN interplay indicating bullishness on the daily chart of the S&P 500 large cap index. Courtesy of stockcharts.com. In Figure 6.26, we see a short-term downtrend in the S&P 500 accompanied by a bearish rising TRIN. We also notice that the tick is largely absent of activity between 1:45 p.m. and 2:45 p.m. This represents a short-term bearish signal. Two-dimensional volume analysis. We may also analyze volume two-dimensionally, via volume by price, volume by time. Volume by time represents the total volume traded over a specified time interval or period. Volume by price identifies the total volume traded at each price level. Figure 6.27 depicts a large volume turnover around the $17 price level in SLV. This level therefore represents a significant support. Notice that this volume information is not obvious from conventional volume bar action. In figure 6.28, we see a lot of volume turnover between $77 and $86 on the daily chart of 3MCO. This price range represents the most traded range, with some resistance coming in at the $90 to $92 level. These price ranges represent potential future support and resistance levels in 3MCO. The Handbook of Technical Analysis. Volume and Open Interest. Figure 6.26 tick/trend interplay indicating bearishness on the daily chart of the S&P 500 large cap index. Courtesy of stockcharts.com. Figure 6.27 volume by price identifying strong support on the daily chart of iShares Silver Trust, SLV. Courtesy of stockcharts.com. 195. 196. Figure 6.28 volume by price versus volume by time on the daily chart of 3MCO courtesy of stockcharts.com. We may also use this two-dimensional form of volume analysis to locate the most significant support and resistance levels in the market. To do this, we first locate the largest volume by price range. In figure 6.29, we selected the $74 to $80 range as the range with the most significant volume by price. We then locate the largest volume by time intervals. We find the area of intersection of these two large volume representations. This area of intersection is indicated on the chart as Figure 6.29 locating significant support and resistance using two-dimensional volume analysis on the daily chart of 3MCO courtesy of stockcharts.com. The Handbook of Technical Analysis. Volume and Open Interest. Two white boxes. The last step is to locate the closest peak or peaks above the area of intersection. This will potentially represent the most significant and reliable resistance level within the price formation. To locate the most significant support level, we locate the closest trough or troughs below the area of intersection. This will potentially represent the most significant and reliable support level within the price formation. We see both significant support and resistance levels acting as effective barriers to price action on the daily chart of 3MCO. Volume to bar range, spread, relationship. The relationship between bar range, spread, and volume may also be used to forecast potential breakouts and reversals. The four basic combinations of bar range and volume are: 1. Narrow range on low volume. Low volume rest bar indicates a potential for reversal, especially during a strong and rapid up or down trend. For weak to average trends, it tends to indicate a point of rest. It reflects a lack of participation. See example 1 in figure 6.30. 2. Narrow range on high volume. High volume reversal bar indicates a strong potential for a reversal. In an uptrend, price remains confined to a narrow range on very large volume. If the volume represented buying pressure, the range would be much wider. Hence, this is indicative of sellers attempting to take control. It is a bearish signal. The converse applies for downtrends. See example 2 in figure 6.30. 3. Wide range on low volume. Low volume reversal bar indicates a potential for reversal as the large price move was backed or supported by a relatively low amount of participation. It reflects a lack of interest. The longer the price bar on low volume, the more bearish it is in an uptrend and bullish in a downtrend. See example 3 in figure 6.30. 4. Wide range on high volume. High volume continuation bar indicates a potential for continuation as the large price move was backed and supported by a very large amount of participation, that is, interest in seeing price continue. It is bullish in an uptrend and bearish in a downtrend. See example 4 in figure 6.30. Figure 6.30 volume bar range relationship. 197. 198. Figure 6.31 high volume reversal bars on the daily chart of Power Shares DB US Dollar Bullish Fund. Courtesy of stockcharts.com. In figure 6.31, we observe two narrow range candlesticks on high volume at points 1 and 2. Notice how price subsequently reverses rapidly in the opposite direction after the formation of these high volume reversal bars. We also see a low volume breakout signal near the apex of the descending triangle formation during the month of August. Notice the large volume surge on breakout. In figure 6.32, we observe a narrow range candlestick on high volume around the beginning of November, which led to a significant rebound in price in the US dollar index bullish fund. Figure 6.32 high volume reversal bar on the daily chart of Power Shares DB US Dollar Bullish Fund. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Volume and Open Interest. Figure 6.33 high volume reversal bar on the daily chart of Power Shares DB US Dollar Bullish Fund. Courtesy of stockcharts.com. In figure 6.33, we see another example of a high volume reversal bar occurring around May 23, 2011. Notice the bearish divergence in volume and on the MACD leading up to the high volume reversal bar. This is a bearish scenario, and is regarded as potentially more reliable since the bearish reversal bar occurred within a larger downtrend. We see prices decline after its formation. We also see a high volume continuation bar indicated at point X. Similarly, high volume continuation bars are regarded as potentially more reliable if they occur in the direction of the predominant trend. In figure 6.34, we see a high volume reversal bar occurring around the end of October 2011. This reversal bar also occurred at a historically overextended volume level, as indicated on the chart. Constant volume charts. Constant volume charts are especially useful for pinpointing reversal bars on high or low volume. Since the volume is fixed for each bar, it will be relatively easy to identify potential reversal bars by just referring to the bar range alone and its height in relation to the rest of the bars. In figure 6.35, we see two types of reversals bars. The narrow range bar is bearish and is indicative of sellers taking control, while the wider range bar is indicative of a lack of interest in the price rise. 199. 200. Figure 6.34 high volume reversal bars on the daily chart of Power Shares DB US Dollar Bullish Fund. Courtesy of stockcharts.com. Volume leading price versus price leading volume. Does volume lead price? Most practitioners will agree that without participation, that is, volume, price will be unable to move in a significant manner. Nevertheless, technical buy and sell signals need not require much volume for them to appear on the charts. For example, a small breakout of a very significant trend line may precipitate a larger breakout, inviting tremendous volume as the penetration becomes more obvious. In such cases, price may be seen leading volume. With the widespread use of technical analysis today, there may be a greater tendency for price to lead volume more frequently. Volume cycles in the financial markets. We may anticipate potential price action using volume peak cycles that occur on an intraday basis in the markets. The intraday volume cycle normally peaks around 1:30 p.m. to 2:30 p.m. GMT. At these volume peaks, price will either reverse or continue, but very rarely remain unchanged. We see this occurring on the 30-min Eurist chart as seen. Figure 6.35 constant volume charts indicating bearish reversal bars. The Handbook of Technical Analysis. Volume and Open Interest. Figure 6.36 volume cycle peak reactions at support and resistance on the 30-min chart of Eurist. Source, MetaTrader 4. In figure 6.36, almost every price reversal on the Eurist occurs at an intraday tick volume peak. This is especially useful if price is retesting a previous support or resistance level. Many practitioners also prefer to employ a bidirectional or straddle entry, catching price whichever way it traverses during a volume peak, since price rarely remains unchanged after a cycle peak. In Figure 6.37, we observe price successfully rebounding off trendline retests at points 1, 4, and 5, which all occurred during a tick volume cycle peak. These support levels were further corroborated by a cycle-tuned stochastic oscillator. Figure 6.37, stochastic filtered, tick volume cycle peak reversals on the hourly chart of Eurist. Source, MetaTrader 4. 201. 202. Indicating oversold conditions. Notice that at points 2 and 3 the trend line failed to support price. Notice that at both these points, the stochastic did not indicate a clear oversold condition, as seen at points X and Y. Volume on non-constant time charts as seen in Chapter 3, some examples of non-constant time-based charts include point and figure charts, Renko charts, 3-line break charts. The time axis is not plotted in a linear fashion for non-constant time-based charts. This affects the angle of geometrically based overlay indicators like trend lines, channels, and chart patterns. Equivolume charts are unique. Although each bar is based on a constant time interval, the width of the bars varies with respect to volume. This results in the time axis being plotted in a nonlinear fashion, just as in the case for non-constant time-based charts. In Figure 6.38, we observe a discrepancy in the violation of the trend lines between both types of charting. Figure 6.38, discrepancy in trendline penetrations on the daily chart of Apple Incorporated, courtesy of stockcharts.com. The Handbook of Technical Analysis. Volume and Open Interest. 6.2 Volume Oscillators. There are numerous volume-based oscillators and indicators, with some of the more popular ones being Volume-Weighted Moving Average, VWMA, Accumulation Distribution Line, ADL, On Balance Volume, OBV, Chaikin Money Flow. Chaikin Oscillator Demand Index, Herrick Payoff Index, NYSE Up/Down Volume Line. We analyze oscillators for bullish and bearish signals using the 8 standard methods of observation. Refer to Chapter 8 for more on oscillator analysis. 1. OBOS overextended levels. 2. Equilibrium and zero line crossovers. 3. Signal line crossovers. 4. Price oscillator divergence. 5. Geometrically based oscillator pattern analysis. 6. Numerically based oscillator pattern analysis. 7. Horizontally based oscillator pattern analysis. 8. Oscillator on oscillator analysis. Price-based volume indicators, the OBV and A/D line. The on-balance volume, OBV, oscillator is simply a cumulative or running total of each period's volume added or subtracted from a running total depending on whether the current period's close is higher or lower than the preceding period's close price. If the current period's close is higher than the preceding period's close price, the current period's volume is added to the running total. If it is less than the preceding period's close price, the current period's volume is subtracted from the previous running total. If the closing price remains unchanged, no volume is added or subtracted from the running total. The disadvantage of using the OBV is that its absolute value or reading is dependent on the start date. Nevertheless, this does not affect the changes in the relative value of the OBV line. As such, all 8 oscillator analysis methods may still be employed to determine bullish and bearish signals. One major weakness of the OBV oscillator is that the current period's volume is added or subtracted from the cumulative total regardless of the current period's price behavior. For example, assume that the current period's bar closes just below the previous period's close price. This would mean that the current period's volume would be subtracted from the running total regardless of the fact that the current bar may have made a new significant high, way above the previous bar's high. To redress this issue, many practitioners prefer to use the ADL, Chaikin Money Flow, CMF, or the 203. 204. Figure 6.39 OBV indicating bullish divergence on the daily chart of Citigroup Incorporated, courtesy of stockcharts.com. Chaikin oscillator. In Figure 6.39, we see the OBV indicating bullish divergence on the daily chart of Citigroup Incorporated. Prices rebound strongly thereafter. In figure 6.40 we observe the OBV indicating bearish divergence on the daily chart of copper. Prices fell strongly thereafter. Price-based volume indicators, the accumulation distribution line, ADL. The accumulation distribution line, or ADL, is calculated as follows. Simply calculate the value of the multiplying factor, CL, HC, /HL, times current. Figure 6.40 OBV indicating bearish divergence on the daily chart of copper. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Volume and open interest. Periods volume and add this value to its running total. This running total represents the ADL. Notice that if CL equals HC, then CL equals HC 2C equals H plus LC equals H plus L/2. This means that when the current bar closes at its midpoint, no volume is added or subtracted from the running ADL. The further up price closes from the midpoint, the more volume is added to the running total. Similarly, the further down price closes from the midpoint, the more volume is subtracted from the running total, since the expression CL HC turns negative. This redresses the insensitivity of the OBV in responding to price behavior when adding or subtracting volume. The ADL accounts for the current bar's price AC when incorporating volume. It should be noted that no matter how wide the range is for the current bar, the maximum volume added will always be the day's total volume, and not some multiple of it. This is clearly seen by replacing the close price with the high in the expression CL HC /HL, giving HL, HH, /HL, equals 1. Hence the day's total volume is the maximum volume that can be added or subtracted from the cumulative ADL. In figure 6.41, we observe the ADL indicating bullish confirmation, whereas the volume bars are indicating bearish divergence. The volume bars are indicating an underlying weakness in the uptrend. The trader should wait for price confirmation of a reversal before participating in the market. In figure 6.42, we observe that when the OBV and ADL are rising or falling together, the price will trend in a decisive manner, and whenever the two oscillators are moving in opposite directions, there is a tendency for price to range. Figure 6.41 The ADL oscillator indicating confirmation on the hourly chart of Eurust. Source, MetaTrader 4. 205. 206. Figure 6.42 OBV and ADL signaling trend and range mode on the daily chart of ExxonMobil Corp courtesy of stockcharts.com. Or consolidate. This is useful for gauging behavioral or regime changes in the market. It may be potentially helpful for traders deciding whether to employ a trend-following or range-bound strategy. Price-based volume indicators, the Chaikin money flow and Chaikin oscillator. The Chaikin money flow, CMF, is calculated in a manner similar to the ADL. First calculate the value of the multiplying factor, CL, HC, /HL, times current period's volume. Let this value be S. Then calculate the n-period sum of S and divide this by the n-period sum of volume. This will represent the n-period CMF. Just as for the ADL, create a running total for CMF. The Chaikin oscillator is then calculated by simply subtracting a longer-term EMA from a shorter-term EMA of the running total. In figure 6.43, we see the Chaikin oscillator generating an earlier sell or bearish signal when compared to the CMF. We also see the oversold levels on both oscillators indicating a potential market bottom in copper around the month of October 2011. Non-price-based volume breadth indicator, the NYSE up/down volume. The NYSE up/down volume indicator is the ratio of advancing volume over declining volume. Being non-price-based, divergence is read in the same manner as for volume bar action and smoothed and detrended volume. In figure 6.44, we observe the NYSE U/D indicator signaling an early bearish signal that was later confirmed by the NYSE Composite Index. The Handbook of Technical Analysis. Volume and open interest. Figure 6.43 The Chaikin money flow and Chaikin oscillator signaling a potential reversal on the daily chart of copper. Courtesy of stockcharts.com. Open interest indicators, the COT report and Herrick payoff index. The Herrick payoff index uses open interest in its calculations. As such, it may only be used with futures and options. It incorporates price in its calculations, and as such divergence readings should be observed in the same manner as all other price-based volume oscillators. As with all volume oscillators, bearish signals are. Figure 6.44 NYSE up/down volume line generating an early bearish signal. Courtesy of stockcharts.com. 207. Indicative of money flowing out of the market, whereas bullish signals suggest money flowing into the market. The Herrick payoff index may be scrutinized for bullish and bearish signals using any or all of the 8 modes of oscillator analysis. Finally, the Commitment of Trader, or COT, report is released every Friday. It reports all open positions held by the commercials, hedgers, non-cash positions, non-commercials, hedge funds, financial institutions, large traders, and for the aggregate position of small traders. Traders and investors use the COT report to identify potential tops and bottoms in the market by looking for changes in the net commercial or non-commercial open positions, as well for a test of any significant or historical open interest levels. 6.3 Chapter Summary. In this chapter, we have observed how volume and open interest play a critical role in helping to decipher potential price and market action. We have also seen how price-based volume oscillators are interpreted differently from non-price-based volume indicators. We shall be applying most of what we have learned in this chapter, with particular emphasis on volume divergence and filtering volume accretion, throughout the rest of this handbook. Chapter 6 Review Questions. 1. What is the difference between volume and tick volume? 2. Describe bearish and bullish volume. 3. How is volume divergence distinct from standard oscillator divergence? 4. How would you use volume as a timing indicator? 5. Describe the various modes of volume filtering. 6. Describe the relationship between volume, open interest, and price. 7. Which is more useful, absolute or relative volume? 8. How are volume cycles useful and where would you normally find them? References. Arch Ellis, Stephen B. 2001. Technical Analysis from A to Z. New York, McGraw-Hill. Arms, Richard W., Jr. 1989. The Arms Index. Homewood, Illinois, Dow Jones Irwin. Colby, Robert W. 2003. The Encyclopedia of Technical Market Indicators. New York, McGraw-Hill. Morris, Greg. 2006. The Complete Guide to Market Breadth Indicators. New York, McGraw-Hill. 208. The Handbook of Technical Analysis. Chapter 7. Bar Chart Analysis. The study of bar chart patterns forms the basis of pure price action analysis. It represents the most fundamental skill that every technician should possess in order to be adept in technical analysis. In this chapter we shall cover various single, double, triple, and multiple bullish and bearish price bar patterns commonly used by practitioners of technical analysis. 7.1 Price bar pattern characteristics. Construction of a price bar. A standard price bar comprises an open, O, high, H, low, L, and close, C, price, normally referred to by its acronym, OHLC. Price activity may be quantized over a specified duration or time interval and summarized into OHLC data. For example, Figure 7.1 depicts 5 minutes of price activity, which may be represented by a bar. The range of the bar is simply the absolute distance between the high to low, HL. To summarize price activity over longer durations, comprising multiple intervals, simply use the opening price of the first interval, closing price of the last interval, and the highest and lowest prices over the entire duration observed. See Figure 7.2. Learning Objectives. After studying this chapter, you should be able to understand the significance of bar chart analysis and its use in forecasting potential tops and bottoms in the market. Recognize the early indications of potential trend change via commonly used bar chart patterns. Identify buy and sell signals via single, double, triple, and multiple bullish and bearish bar formations. Read bar action behavior more effectively via the 16 price and volume reversal characteristics. 209. 210. Figure 7.1 Construction of a price bar. In Figure 7.3, we observe price activity over a series of 5-minute intervals and the corresponding graphical representation of OHLC price bars for each interval represented below. Classification of price bar formations. There are 3 basic ways to classify price bar formations, namely via 1. The number of bars that make up the formation. Single bar formations, double bar formations, triple bar formations, multiple bar formations. Figure 7.2 Constructing a higher time frame price bar. The Handbook of Technical Analysis. Bar chart analysis. 2. The intrinsic bias or sentiment associated with the price bar formation, bullish formations, bearish formations. 3. The directional expectations of the formation, continuation formations, reversal formations. 7.2 Price bar pattern characteristics. Bar reversals and continuations may be classified in single, double, triple, and multiple bullish and bearish patterns. A bullish pattern in an uptrend and a bearish pattern in a downtrend are considered to be continuations patterns. Similarly, a bearish pattern in an uptrend and a bullish pattern in a downtrend are considered reversal patterns. In short, whenever the intrinsic and trend sentiments agree, the pattern is considered a continuation pattern. Intrinsic and trend sentiments disagree, the pattern is considered a reversal pattern. We say that the trend sentiment is bullish for uptrends and bearish for downtrends. Intrinsic sentiment is the inherent bullish or bearish bias that is associated with a particular pattern. For example, the intrinsic sentiment is bearish for a standard head and shoulders pattern and bullish for an inverted head and shoulders pattern. Hence, an inverted head and shoulders pattern in an uptrend is considered a continuation pattern since the trend and intrinsic sentiment are both in agreement, that is, they are both bullish. For more on intrinsic sentiment bias, refer to Chapter 4. We shall now look at various generic bullish and bearish formations of single, double, triple, and multiple bar reversal patterns. For bearish patterns, we assume Figure 7.3 A series of price bars representing each period's price activity. 211. 212. Figure 7.47 Basic single and double bar bearish reversal patterns. That the existing trend is up, with the reverse for bearish patterns. This is because in order to be classified as a reversal pattern, trend sentiment must be in disagreement with the pattern's intrinsic sentiment or bias. 7 Generic single and double bar bullish and bearish reversal formations. In Figure 7.4, we see various single and double bar bearish reversal patterns OC occurring in an uptrend. As a general rule, a close below a previous bar's close or low is considered bearish, especially if the previous bar is a large or wide-ranging bar. Narrow range bars occurring within a 2-bar pattern should generally be formed on low volume, indicating uncertainty in an uptrend. Large bars closing at or near their lows should generally be formed on high volume in an uptrend. It should also be noted that some practitioners consider these patterns as continuation patterns when they occur in a downtrend. In Figure 7.4 are the 7 basic single and double bar bearish reversal patterns commonly found in uptrending markets. Similarly, a bearish 2-bar pattern is considered potentially more reliable if the last bar is an overextended bar that closes at or near its low on high volume. In Figure 7.5, we see various single and double bar bullish reversal patterns occurring in a downtrend. As a general rule, a close above a previous bar's close or high is considered bullish, especially if the previous bar is a large or wide-ranging bar. Narrow range bars occurring within a 2-bar pattern should generally be formed on low volume, indicating uncertainty in a downtrend. Large bars closing at or near their highs should generally be formed on high volume in a downtrend. In most cases, a bullish 2-bar pattern is considered potentially more reliable if the last bar is an overextended bar that closes at or near its high on high volume. The Handbook of Technical Analysis. Bar chart analysis. Figure 7.57 basic single and double bar bullish reversal patterns. 6 generic triple price bar reversal formations. In figures 7.6 and 7.7, we see 6 basic triple bar bearish reversal patterns occurring in an uptrend. As a general rule, the larger the gaps, the more bearish will be the pattern upon completion. Also, the larger the range of the first and third bars, the more reliable will be the reversal pattern. For most triple bar patterns, the middle bar usually occurs on low volume, except possibly for pattern 1 where larger volume is also considered more bearish. This is because the buyers failed to keep the closing price near or above the midpoint of the bar and instead allowed the sellers to drive price to close at or near the low of the bar. A bearish 3-bar pattern is generally considered more reliable if the last bar is an overextended bar that closes at or near its low on high. Figure 7.6 basic triple bar bearish reversal patterns. 213. 214. Figure 7.7 basic triple bar bearish reversal patterns. Volume. Similarly, a bullish 3-bar pattern is considered potentially more reliable if the last bar is an overextended bar that closes at or near its high on high volume. In figures 7.8 and 7.9, we see 6 basic triple bar bullish reversal patterns occurring in a downtrend. 4 generic multiple price bar reversal formations. In figure 7.10, we see 4 basic multiple bar bearish reversal patterns occurring in an uptrend. As a general rule, the larger the gaps the more bearish will be the reversal pattern. Also, the numerous bars between the first and last bars should generally occur on low volume, except possibly for pattern 2 where high volume is also indicative of. Figure 7.8 basic triple bar bullish reversal patterns. The Handbook of Technical Analysis. Bar chart analysis. Figure 7.9 basic triple bar bullish reversal patterns. Sellers attempting to keep the closing prices at or near the low of each wide-ranging bar. Normally, low volume on the numerous bars between the first and last bar in pattern 2 indicates that the wide-ranging bars are not supported by sufficient demand and hence bearish. In short, extremely high or low volume occurring on the numerous wide-ranging bars between the first and last bar indicates bearishness in an uptrend. A bearish pattern is considered potentially more reliable if the last bar in a multiple bar pattern is an overextended bar that closes near or at its low on high volume. In figure 7.11, we see 4 basic multiple bar bullish reversal patterns occurring in a downtrend. As before, wide-ranging bars between the first and last bar in figure 7.104 basic multiple bar bearish reversal patterns. 215. 216. Figure 7.114 basic multiple bar bullish reversal patterns. Pattern 2 can also occur on high or above average volume, indicating bullishness. Narrow-ranging bars between the first and last bar on low volume is also indicative of potential bullishness. A bullish pattern is considered potentially more reliable if the last bar in a multiple bar pattern is an overextended bar that closes near or at its high on high volume. 2 simple continuation bars. As far as continuation bars are concerned, figure 7.12 depicts 2 patterns where a bullish continuation in price is expected. Note that large volume occurring on a bullish second bar is an indication that the trend may still be potentially strong. Figure 7.122 basic continuation bar patterns. The Handbook of Technical Analysis. Bar chart analysis. In pattern 1, the second bar breaches the high of the previous bar on high volume. In pattern 2, price retraces to the 50% level of the previous bar and subsequently rebounds on high volume, breaching the previous bar's high. The reverse applies for bearish continuation bar patterns. 16 main price and volume action reversal characteristics. Besides studying the individual price behavior associated with each bar pattern, the practitioner should also be aware of the 16 basic price and volume action characteristics that are indicative of a potential reversal, namely 1. Decrease in price cycle amplitude. 2. Decrease in price cycle period. 3. Change in bar retracement symmetry. 4. Decrease in average bar range. 5. Lack of the quality of price persistence. 6. Decrease in average bar stochastic ratio. 7. Decrease in average candlestick real body to range ratio. 8. Changes in angular symmetry and momentum. 9. Proximity to a price barrier. 10. Reduction in frequency and decrease in depth of trend-based oscillations. 11. Appearance of relatively larger and longer-lasting consolidations. 12. Appearance of an exhaustion gap. 13. Completion of the average range for the period under observation. 14. Overextended price action with respect to a price barrier. 15. Price accompanied by extremely high or low volume. 16. Standard divergences between price, volume, and oscillators. These reversal indications above apply equally to Japanese candlestick analysis. The trader and analyst should always be wary of any price bar formation that is accompanied or preceded by any of the 16 price action characteristics listed above. These characteristics are strong indications of a potential change in trend or price retracement. Please refer to Chapter 5 for a detailed discussion of these reversal characteristics. One of the most important price reversal characteristics is that of barrier proximity, listed as item 9 on the list. Reversal patterns are most reliable at significant price barriers. For example, a bearish key reversal day is more reliable when it occurs at a significant resistance level. Similarly, a bullish exhaustion bar is more reliable at a significant support level. Figure 7.13 will help illustrate some of these price reversal characteristics. The daily chart of the National Bank of Greece is an example of price action characteristic 14, depicting an overextended or overbought price bar with respect to a volatility barrier, namely the Bollinger Upper Band. This will be potentially even more bearish if the overbought price bar was associated with an extreme reading in volume. The overextended price bar is further preceded by an exponential rise in price, which is an indication of a rapid change in angular momentum, as described. 217. Figure 7.13 overextension preceded by an exponential rise in price. In price action characteristic 8, such increases in price are usually unsustainable and are therefore potentially bearish. Price also depicts a lack of oscillations during the rapid run-up. This is a potentially bearish indication as there is a lack of healthy profit-taking activity, as described by price action characteristic 10. Hence it is always best to gauge the degree of bearishness or bullishness associated with any price bar formation with respect to the 16 price and volume reversal behavior characteristics. All price bar formations should be read in the context of these 16 price and volume reversal characteristics. This will afford the trader and analyst a more accurate and consistent assessment of the overall likelihood for potential price reaction or reversal. 7.3 Popular bar reversal patterns. Key reversal bar. A bearish key reversal bar forms a higher high than the previous bar and closes near or below the close of the previous bar. Price may open with a large gap up in the direction of the uptrend and close on high volume. The wider the key reversal bar, the more reliable will be the bearish follow-through action to the downside. The appearance of any of the 16 price and volume reversal characteristics only strengthens the degree of bearishness associated with the pattern. The exact converse applies to bullish key reversal bars in a downtrend. In Figure 7.14, we observe a bullish key reversal bar occurring on high volume. Price subsequently rebounded in rapid fashion. In Figure 7.15, we observe a bearish key reversal bar occurring on above average volume on the daily chart of Apple Inc. The bearish key reversal bar opens above the high of the previous bar, forms a new high, and subsequently closes below the previous bar's close. Note that in many cases, a rapid follow-through to the downside may not always unfold. The market occasionally consolidates or hovers slightly below or around a bearish key reversal bar before declining. We see this occurring between the 16th and 23rd of July on the chart. In Figure 7.16, we observe a bullish Q reversal bar occurring on high volume on the daily chart of ITC Holdings Corp. We observe some of the 16 price reversal. 218. The Handbook of Technical Analysis. Bar chart analysis. Figure 7.14 bullish Q reversal day on the daily chart of Apple Incorporated courtesy of stockcharts.com. Characteristics occurring with the pattern. The bullish Q reversal bar forms below the lower Bollinger Band, indicating an overextended or oversold condition with respect to volatility. We also see the Stochk RSI at oversold. Both of these conditions indicate a greater potential for a bullish reversal. Note also that the Q reversal bar closed near its high on extreme volume, indicative of a selling climax. 2 bar reversals. In Figure 7.17, we observe a typical 2-bar bearish reversal on the daily chart of the TSX Composite Index. The first bar closes near its high while the second closes near its low. It would be preferable if the 2 bars had wider ranges. Figure 7.15 bearish Q reversal day on the daily chart of Apple Incorporated courtesy of stockcharts.com. 219. 220. Figure 7.16 bullish Q reversal day on the daily chart of ITC Holdings Corp courtesy of stockcharts.com. Figure 7.17 bearish 2-day reversal on the daily chart of TSX Composite Index, courtesy of stockcharts.com. The Handbook of Technical Analysis. Bar chart analysis. Figure 7.18 bearish 3-bar reversal on the daily chart of Apple Incorporated courtesy of stockcharts.com. Also see bearish divergence with the Commodity Channel Index, CCI, oscillator. Price subsequently declined in rapid fashion. Triple bar reversals. In Figure 7.18, we observe a 3-bar bearish reversal occurring in a clear and strong uptrend on the daily chart of Apple Inc. The first bar closes near its high while the third closes near its low. There is also bearish divergence with the plus DM oscillator. In Figure 7.19, we observe a 3-bar bullish reversal occurring on the daily chart of ITC Holdings Corp. Notice that the middle bar occurs on below average volume while the first and third bars close on high volume. Figure 7.19 bullish 3-bar reversal on the daily chart of ITC Holdings Corp. courtesy of stockcharts.com. 221. 222. Figure 7.20 bullish 3-bar reversal on the daily chart of ITC Holdings Corp. courtesy of stockcharts.com. In Figure 7.20, we observe a 3-bar bullish reversal occurring on the daily chart of ITC Holdings Corp. The entire pattern occurs on an oversold condition on the Stochk RSI. Note that the last bar closes between the Bollinger Bands, which is bullish. This pattern corresponds to pattern 5 in Figure 7.9. In Figure 7.21, we observe a 3-bar bullish reversal occurring on the daily chart of Newmont Mining Corp. Notice that the middle bar occurs on below average volume while the first and third bars close on high volume. The large third bar closing near its high is an indication of added bullishness. This is followed by a bearish outside day formation with the outside bar closing near its low on high volume. Notice that the outside day formation engulfs 4 previous bars. Figure 7.21 bullish 3-bar reversal on the daily chart of Newmont Mining Corp. courtesy of stockcharts.com. The Handbook of Technical Analysis. Bar chart analysis. Figure 7.22 bullish 3-bar reversal on the daily chart of TSX Composite Index. Courtesy of stockcharts.com. In Figure 7.22, we observe a 3-bar bullish reversal occurring on the daily chart of TSX Composite Index. Notice the large middle bar occurs on lower volume as compared to the first bar, which is bullish. This pattern corresponds to pattern 6 in Figure 7.9. Multiple bar island reversals. In Figure 7.23, we see a bearish island formation occurring on overbought conditions on the stochastic oscillator, on the daily chart of Direxhan Daily Goldman ERS 3X shares. Notice that the entire formation occurs on low volume, indicating a lack of conviction by the market participants. The gap up is followed by a gap down, isolating the formation. Outside bars. Outside bars are bars that engulf one or more preceding bars. The preceding bars are contained within the range of the outside bar. This pattern is generally considered a reversal pattern. The larger the outside bar, the more bullish or bearish will be the signal for a reversal. Many practitioners also consider the outside bar as a continuation pattern if the outside bar closes near or at the high, in the direction of the existing uptrend. The larger the number of preceding bars that are contained or encompassed within the range of the outside bar, the greater will be the tendency for producing stronger breakouts. Outside bars should close at or near their high or low for a more reliable reversal or continuation. The outside bar should also close on high volume. This pattern is similar to engulfing patterns in Japanese candlestick analysis. In Figure 7.24, we see a large bearish, a close in the opposite direction of the uptrend, outside bar encompassing 11 preceding bars on the daily chart of ITC Holdings Corp. An uptrend line violation coinciding with a bearish breakout of an outside bar should provide a reliable signal for a short entry. 223. 224. Figure 7.23 Bearish Island Reversal on the daily chart of Direxhan Daily Gold Miners Bear 3x shares. Courtesy of stockcharts.com. Inside bars. Inside bars are considered reversal bars. For a more reliable reversal pattern, the first bar should be as wide as possible, occurring on high volume, whereas the second bar should be as narrow as possible, occurring on very low volume. In Figure 7.25, we see two inside bars forming and testing the same resistance level. The high of both inside bars 1 and 2 exceeded the upper Bollinger Band, but systematically closed below it, which is usually regarded as an indication of price. Figure 7.24 Bearish Inside Day Reversal on the daily chart of ITC Holdings Corp. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Bar Chart Analysis. Figure 7.25 Bearish Inside Day Reversals on the daily chart of ITC Holdings Corp. Courtesy of stockcharts.com. Exhaustion. We also see bearish divergence occurring between the Stochastic RSI and the inside bar at point 2. In Figure 7.26, we see three successively lower inside bar formations occurring on the daily chart of Silver Wheaton Corporation. Each inside bar formation was formed below the Bollinger Band, indicating potential price exhaustion, and especially so if the declines were also accompanied by bearish volume. We also see a bearish outside bar forming in late August 2013, after which prices declined. Figure 7.27 depicts inside and outside bars occurring on the daily chart of Al Acer Gold Corp. Notice that the bullish and bearish patterns line up perfectly with the stochastic oscillator overbought and oversold indications. Inside bars are somewhat related to their Japanese candlestick equivalent, namely the harami pattern. All outside bars may be regarded as Japanese candlestick engulfing patterns, but not all inside bars are regarded as harami patterns. It is a question of internal proportions. A harami requires that the Figure 7.26 Inside Day Bullish Reversals and Outside Day Bearish Reversal on the daily chart of Silver Wheaton Corporation. Courtesy of stockcharts.com. 225. 226. Figure 7.27 Various Inside Day, Outside Day, and 3-bar reversals on the daily chart of Alicer Gold Corp. Courtesy of stockcharts.com. Narrow range candlestick be no more than 1/4 to 1/3 the range of the larger preceding candlestick. But an inside bar has no such restrictions. Exhaustion bars. Exhaustion bars are regarded as reversal bars. In an uptrend, they open above the previous bar's high. The larger the bar, the more bearish it will be within the context of an uptrend. There is no gap between the exhaustion bar and the subsequent bar, unlike in single bar island formations. The exhaustion bar should close at or near its low in an uptrend. The reverse is true for bullish exhaustion bars in a downtrend. In Figure 7.28, we see a bullish exhaustion bar forming a bottom on the daily chart of J.P. Morgan Chase & Co. Figure 7.28 Bullish exhaustion bar on the daily chart of J.P. Morgan Chase & Co. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Bar chart analysis. Figure 7.29 Emotion spike bar on the daily chart of Mad Catz Interactive Incorporated courtesy of stockcharts.com. Price spikes. In emotional markets, price often produces a spike as a result of increased volatility. These bars are usually wide-ranging bars accompanied by high volume. In Figure 7.29, we see a large emotional price spike on high volume on the daily chart of Mad Catz Interactive Inc. We also notice a typical 3-bar bearish reversal forming a top in the stock. Pin bars. Pinocchio bars or pin bars are single-bar misrepresentations of market strength or weakness. It is an intra-period price penetration of some barrier, suggesting a potential breakout. Price rapidly retraces back below resistance or back above support. A upside pin bar breakout gives traders a false impression of bullishness in a downtrend, whereas a downside breakout gives traders a false impression of bearishness in an uptrend. Pin bars normally breach the following common price barriers. Moving averages, levels of resistance or support trend lines. Pin bars differ from exhaustion bars. Exhaustion bars do not usually provide a false impression of price penetrating a barrier. Pin bars may also be an artifact of specialists running stops. In Figure 7.30, we observe a pin bar breaching support on the daily chart of Micron Technology Inc. Many traders would have been fooled into initiating a short position upon seeing the breach of support. Pin bars are usually breakouts that form on low volume. 227. 228. Figure 7.30 bullish pin bar on the daily chart of Micron Technology Incorporated courtesy of stockcharts.com. Failed support and resistance-based breakout entries. Pin bars are single bar breakouts of any price barrier. A more general form of price bar patterns providing false impression of strength and weakness are basic false breakouts based on the violation of support and resistance, which may be based on single or multiple bars. A false breakout of support or resistance occurs when there is a non-failure swing. In Figure 7.31, we observe a false upside breakout of a prior resistance level. A short is initiated once price retraces back below the resistance level with a stop loss placed just above the high of the breakout. Victor Sperandio referred to this as a 2B entry in his book Trader Vic, Methods of a Wall Street Master. In Figure 7.32, we observe numerous false upside and downside breakout entries on the daily chart of silver. A long or short is normally initiated at a close below resistance in a false upside breakout or a close above support in a false downside breakout. Figure 7.31 bearish, non-failure swing, false breakout short entry. The Handbook of Technical Analysis. Bar chart analysis. Figure 7.32 false support and resistance breakouts on the daily chart of silver. Courtesy of stockcharts.com. Dinapoli double repo pattern. In Figure 7.33, we observe a bearish double repo reversal pattern. This pattern was introduced by Joe Dinapoli in his book Trading with Dinapoli Levels. The reader is advised to consult the original text for a detailed and complete discussion of the double repo pattern. In short, the double repo pattern generates a sell signal in an uptrend once it closes above and below a 3-day SMA twice. The 3-day SMA is forward shifted by 3 days. According to Joe Dinapoli, the patterns must be preceded by at least 8 to 10 days of bullish price action. The topping formation should not exceed 8 to 10 bars. In Figure 7.33, we observe a bearish double repo pattern preceding a rapid decline in the continuous daily chart of sugar prices. The reverse applies in a downtrend. Figure 7.33 Dinapoli's double repo pattern on the continuous daily chart of sugar. Courtesy of stockcharts.com. 229. Figure 7.34 bullish and bearish Hikaki breakout pattern. 7.4 Volatility base D breakout patterns. Hikaki pattern, the failed breakout reversal entry. The Hikaki pattern is characterized by an entry initiated after an initial failed breakout of an inside bar. Figure 7.34 is an illustration of a bullish Hikaki pattern where a false breakout inside bar was followed by an upside breakout. In this pattern, we only take the re-entry in the opposite direction of the failed breakout. Similarly, we see a bearish Hikaki pattern with an initial false upside breakout. The short entry was later initiated once price reversed and violated the low of the inside bar. The breakout should occur within 3 bars of the initial failed breakout. Hikaki means to trap or ensnare. Figure 7.35 depicts a bullish Hikaki pattern forming a bottom on the daily chart of the iShares Emerging Market Fund, which is seen coinciding with the Figure 7.35 bullish Hikaki pattern on the daily chart of iShares Emerging Markets Fund. Courtesy of stockcharts.com. 230. The Handbook of Technical Analysis. Bar chart analysis. Figure 7.36 bullish and bearish Williams OOPS entry pattern. Linear regression lower band support. We see the Hikaki pattern forming on high volume, representing a selling climax in the stock. Note that stochastics is also in an oversold condition. Williams OOPS entry. Figure 7.36 depicts an example of Larry Williams OOPS entry approach consisting of a bar opening beyond the range of the previous bar. A sell-stop entry order is placed at the high of the previous bar if the new bar opens above the previous bar's high. A stop loss is placed at the new bar's high. Similarly, a buy-stop entry order is placed at the low of the previous bar if the new bar opens below the previous bar's low. A stop loss is placed at the new bar's low. In both cases, if price reverses, a stop and reverse order is initiated at the stop loss levels. We may also look to Japanese candlestick morning and evening start formations, including the piercing line and dark cloud cover candlestick patterns, to find patterns conducive to Larry Williams OOPS setup. It is best to look for a bullish OOPS pattern in an uptrend and a bearish OOPS pattern in a downtrend. Refer to Larry's book How I Made $1 Million Trading Commodities for more details. In Figure 7.37, we see a bearish OOPS pattern on the daily chart of Dynegy Inc. Figure 7.37 bearish OOPS entry pattern on the daily chart of Dynegy Incorporated courtesy of stockcharts.com. 231. 232. Figure 7.38 ID/NR6 pattern. ID/NR47 breakouts. The inside day narrow range pattern or ID/NR pattern is a volatility breakout pattern. An ID/NRN pattern denotes an inside day breakout from the narrowest bar over the last n days. In Figure 7.38 we observe an ID/NR6 pattern where we see an inside bar breakout. The last bar is the narrowest bar of the last 6 days. This pattern has no bearish or bullish sentiment associated with it. The breakout can occur in either direction. In Figure 7.39 we observe an inside month/NR5 pattern breakout where we see an inside bar breaking out to the upside on the monthly chart of Dynegy Inc. Figure 7.39 inside month/NR5 pattern on the monthly chart of Dynegy Incorporated courtesy of stockcharts.com. The Handbook of Technical Analysis. Bar chart analysis. 7.5 Chapter Summary. In this chapter we discussed the dynamics of bar action and how it is potentially indicative of future price activity, especially when accompanied by significant indicator and volume action. We also looked at various breakout patterns that may prove effective in catching continuations or reversals in the market. Chapter 7 Review Questions. 1. What is the difference between exhaustion bars and pin bars? 2. Why is the ID/NR7 pattern referred to as a volatility breakout pattern? 3. What are the main characteristics of a Q reversal day? 4. Describe the 16 price and volume reversal characteristics. 5. Explain how volume impacts bar chart pattern analysis. 6. Describe 2 triple bar bearish patterns and how you would trade them. 7. Describe the ideal conditions for an inside bar reversal. 8. Describe how you would use oscillators to help gauge the degree of bearishness or bullishness of various bar reversal patterns. References: Bollinger, J.A. 2001. Bollinger on Bollinger Bands. New York, McGraw-Hill. DeMark, Thomas. 1994 The New Science of Technical Analysis. New York, John Wiley and Sons. Dinapali, Joe. 1969. Trading with Dinapali Levels. Sarasota, Florida, Coast Investment Software Incorporated. Kirkpatrick, Charles, and Julie Dahlquist. 2007 Technical Analysis, the complete resource for financial market technicians. Upper Saddle River, New Jersey, Pearson Education. Pring, Martin J. 2002. Technical Analysis Explained, The Successful Investor's Guide to Spotting Investment Trends and Turning Points. 4th ed. New York, McGraw-Hill. Sperandio, Victor. 1991 Trader Vic, Methods of a Wall Street Master. New York, John Wiley and Sons. Williams, Larry. 1979 How I Made $1 Million Trading Commodities. New York, Windsor Books. 233. Chapter 8. Window oscillators and overlay indicators. Oscillators and indicators have fascinated traders and analysts since the first average was created. Oscillators and indicators can help reveal underlying strengths and weaknesses of price action, which would not have been obvious otherwise. In this chapter we will learn about the construction and proper application of oscillators and various overlay indicators to help better forecast potential reversals and breakouts in the markets. 8.1 Defining indicators and oscillators. Classification of oscillators and indicators. Indicators are subdivided into two categories. 1. Overlay indicators. Overlay indicators are plotted on the same chart as price action, as well as window oscillator action. They represent barriers to price or window oscillator action, that is, they provide support and resistance at various price and oscillator levels. It should be noted that window oscillator learning objectives. After studying this chapter, you should be able to understand the significance of oscillators and indicators and how to use them to forecast reversals and breakouts in the market. Describe the difference between overlay indicators and window oscillators. Identify and differentiate between various types of overlay indicators and understand how chart scaling affects each type of indicator. Set up multiple timeframe charts to better observe price and indicator action. 235. 236. Action plotted on the price chart does not represent a valid or meaningful overlay indicator, and as such does not provide support and resistance. For example, a standard moving average convergence divergence, MACD, or relative strength index, RSI, oscillator plotted on the price chart itself will not interact with price in any meaningful way. Conversely, overlay indicators plotted on window oscillator action do represent a valid and meaningful overlay indicator, and as such provide a valid barrier to oscillator action. For example, an overlay indicator such as a Bollinger Band plotted on an RSI window-based oscillator would indicate levels of overbought and oversold in the RSI. Finally, there are four types of overlay indicators, namely A. Numerically based overlays. These overlays forecast future price barrier levels mathematically. For example, a Fibonacci upside price target based on 161.8% expansion of the range AB from C is calculated as C plus 1.618 times AB. B. Horizontally based overlays. These overlays forecast future price barrier levels based on prior resistance and support levels. Forecasts are therefore independent of time, that is, they do not vary with the passing of time. Price gaps, rising and falling windows, are also a horizontal overlay indicator of potential future support and resistance. Although such forecasted reaction price levels do not vary with time, it is important to note that such recession levels may still be invalidated, especially when breached a significant number of times. It should be noted that some numerically based indicators such as Fibonacci ratio and Gann's square of 9 price projections may also be classified as horizontally based overlays, unlike numerically based indicators such as moving averages and Bollinger Bands. See geometrically based overlays. These overlays forecast future price barrier levels via the drawing of diagonal trend lines or lines that are projected from particular peaks and troughs, also referred to as price inflection points. Since they are diagonal, forecasts of potential barrier levels based on these overlays will vary over time, and the forecast of potential barrier levels will depend on when price tests these overlays. In other words, the forecasts of potential future price barrier levels depend on the geometry of the barrier created. Algorithmically based overlays. These overlays forecast future price barrier or breakout levels based on a specific sequence of bar or candlestick ascension. Some examples include 2-bar breakouts, Guppy's count-back line, and DeMark's TD sequential indicator. Two-window oscillators. These are mathematically derived indicators that are normally based on open high-low close, OHLC, data, volume, and open interest. There are two types of window oscillators, namely, A-bounded oscillators, values or readings of window oscillators that range from 0 to 100%, we say that the oscillator has been normalized. The advantage of using a bounded oscillator is that it provides a meaningful way of comparing relative levels of overextension, that is, relative levels of overbought and oversold, between different stocks or markets over the same number of periods. The main disadvantage is that during strong trend action, the values or readings tend to remain at overbought. The Handbook of Technical Analysis. Window oscillators and overlay indicators or oversold for extended periods, and as such provide little useful info. Other than that, a strong trend is in effect. The unbounded oscillators, the values or readings of unbounded window OS. Dilators have no upper or lower limit. Note that although unbounded window oscillators have no theoretical upper or lower limit, some unbounded window oscillators do have a lower limit of 0, such as volume, ADX, Bollinger bandwidth, and average true range, ATR. These window oscillators are therefore referred to as being semi-bounded. The main advantage of employing an unbounded oscillator is that it provides historical levels of overbought and oversold. These historical levels of overbought and oversold are specific to a particular stock or market at a selected time frame, and care should be taken when used to compare the degree of overextension between different stocks or markets. An unbounded window oscillator may sometimes be converted into a bounded window oscillator via normalization, confining the range of window oscillator ascension between 0 and 100%. Normalization will always convert a point-based oscillator, example MACD, momentum, CCI, ATR, ADX, etc., into a percentage-scaled oscillator, ranging between 0 and 100%. It should be noted that some practitioners refer to unbounded oscillators as window indicators, rather than oscillators. This is mainly due to the fact that an unbounded oscillator need not actually revert back to its central or equilibrium value. Values can rise or fall indefinitely with no indication of whether they will revert to equilibrium levels. As such, many practitioners prefer to use the term indicator, as many unbounded oscillators tend to not oscillate around their equilibrium levels but rather trend in one or the other direction. Unbounded oscillators that tend to trend include those that employ a net running or cumulative total of all past values, such as the net advance decline line, OBV, and so on. See Figure 8.1 for comparisons between bounded and unbounded window oscillators. Notice that overlays may be applied to window oscillators as well. See Figure 8.2 for a flowchart summary of indicator classification. Chart scale sensitivity and invariance. Chart scaling only affects indicators that are geometrically based. As such, it does not affect window oscillators, as the values of all window oscillators are numerically determined, that is, mathematically calculated. It also does not affect overlays that are numerically and algorithmically determined. For example, a simple moving average represents the average of end-period closing prices, irrespective of whether the chart was scaled arithmetically, linear-based, or logarithmically, ratio-based. The average price of end-period closing among prices is scale invariant, that is, it does not change with scaling. Another example of scale invariance involves algorithmically determined overlays. Assume that we wanted to buy at the breach of a 5-day high. Once we have identified such a pattern, we would initiate a long position once price breaches the 5-day high. Again, we see that such sequence bar patterns are unaffected by scaling. The high prices will still have the same. 237. 238. Figure 8.1 Overlay, Bounded, and Unbounded Technical Indicators. Courtesy of stockcharts.com. Values, irrespective of the scaling employed. Horizontally based indicators like support and resistance are also scale invariant. Horizontal overlays are indicators where the forecasted price depends only on the price axis. Time is not an element in its forecast. Unlike support and resistance, trendline forecasts of potential future barrier levels are time dependent. The potential support provided by an uptrend line depends. Figure 8.2 Classification of Technical Indicators. The Handbook of Technical Analysis. Window oscillators and overlay indicators. Figure 8.3 Geometrically based overlays displaying non-scale invariance. Courtesy of stockcharts.com. On when price tests it, the more time has elapsed, the higher will be the trendline support level when tested by price. Trendlines are a form of geometrically based overlay indicators. Unfortunately, geometrically based overlays are the only group of indicators that are not scale invariant. Forecasted prices vary with the scaling employed. For example, two trendlines based on different scaling would forecast different future support and resistance levels. In Figure 8.3, we see that for uptrend lines, ratio scaling produces earlier penetrations as compared to linear scaling. The compression that occurs at higher prices on ratio-scaled charts affects the angle of all trend lines, which are based on the geometrical relationship between inflection points. In short, scaling does not impact the forecasts of potential future price barrier levels if the overlay indicator is numerically, horizontally, or algorithmically based. Static and dynamic overlay indicators. Finally, a distinction has to be made between static and dynamic overlay indicators and their relationship with numerically, horizontally, geometrically, and algorithmically based overlay indicators. Static overlay indicator forecasts are not dependent on the time element, and as such include all horizontally and algorithmically based overlays, as well as many numerically based overlays. The forecasted price reaction level does not change over time, unless it is invalidated and a new forecast is required. Hence all horizontal overlay indicators like support and resistance are clearly static overlay indicators. Static overlays include 239. Prior support and resistance levels Fibonacci projection, retracement, extension, and expansion levels Gann square of 9 price projection levels Gann squaring of the high and low price projection levels Gann's 1/3 and 1/8 retracement levels Floor traders pivot points support and resistance levels reward to risk ratio price target levels. Price targets often represent levels of potential support and resistance. Gartley butterfly pattern-based price projection levels parabolic SAR levels chandelier exit-based price levels horizontal channel-based price levels. Dynamic overlay indicator forecasts are dependent on the time element and as such include all geometrically based overlay indicators and some numerically based overlays. The forecasted price level varies over time. The exact forecasted price reaction level is only known once price tests or is in proximity to the overlay. Some dynamic overlays include Bollinger Bands moving average bands Keltner bands Stark bands Ichimoku overlays linear regression bands Andrews pitchfork trend lines rising and falling channels chart patterns Wolf waves. 8.28 Ways to analyze an oscillator. There are 8 basic ways to use a window oscillator to indicate potential buy, bullish, and sell, bearish, signals, namely 1. OBOS overextensions 2. Equilibrium and zero line crossovers 3. Signal line crossovers 4. Price oscillator and oscillator divergence 5. Geometrically based oscillator pattern analysis 6. Numerically based oscillator pattern analysis 7. Horizontally based oscillator pattern analysis 8. Oscillator on oscillator analysis 240. The Handbook of Technical Analysis. Window oscillators and overlay indicators. It should be noted that many practitioners require that buy and sell reversal signals based on window oscillators require price confirmation, that is, price is required to breach an overlay indicator. Just because an indicator issues a bearish or bullish reversal signal does not necessarily mean that prices have reversed or broken through a barrier. The signals may be based on oscillator action, but the trigger for entry or exit must always be based on price action. Oscillator values breaching overlays do not represent price confirmation but are regarded as merely a signal of potential bullishness or bearishness. For a valid price confirmation, price may breach any of the following overlays: numerically based overlays, horizontally based overlays, geometrically based overlays. Nevertheless, the most reliable and popular overlays used for price confirmation are prior support and resistance levels, simple trend lines, moving averages, and chart pattern breakouts or reactions. OBOS overextended levels. Overbought and oversold. OBOS levels are indicative of overextensions in price, where a potential reversal in price is expected. It should be noted that an overbought signal is first and foremost an indication of a strong uptrend in effect, with a high probability of a potential bearish reversal. Similarly, an oversold signal is first and foremost an indication of a strong downtrend in effect, with a high probability of a potential bullish reversal. As such, price confirmation is required when trying to identify reversals. These overextensions may occur at expected percentage levels or may be formed at levels specific to the stock or market itself. Overextensions may be identified as follows. 1. For bounded oscillators, overbought is represented as relatively high percentage readings, usually at or above 70 or 80%, depending on the oscillator employed. Oversold is represented as relatively low percentage readings, usually at or below 20 or 30%, depending on the oscillator employed. 2. For unbounded oscillators, overbought is represented as historical or significant peaks in the oscillator. Oversold is represented as historical or significant troughs in the oscillator. The overbought, OB, and oversold, OS, levels for two popular bounded oscillators are defaulted at stochastics, OB, 80%, OS, 20%. Note that many practitioners upshift these OBOS levels to OB, 90%, OS, 30%, to account for the upside bias in certain markets or during strong and prolonged uptrends. RSI, OB, 70%, OS, 30%. 241. 242. Figure 8.4 Various buy, bullish, and sell, bearish, signals generated by divergence, signal crossovers, chart patterns, and overextensions. Source, MetaTrader 4. The OB and OS levels for unbounded oscillators are CCI oscillator, OB, plus 100, OS, 100. Note that these values are measures of volatility. This oscillator coincides well with the Bollinger Band 1 standard deviation values. The plus or minus 200 levels also match the Bollinger Band plus or minus 2 standard deviation, or sigma, bands. Standard deviation oscillator, OB, plus 1 or plus 2 sigma, OS, 1 or 2 sigma. Most unbounded oscillators do not have widely accepted levels of overextension. This is because such levels are specific to a particular stock or market. Historical oscillator action. Figure 8.4 depicts various signals being generated by oscillator divergence, chart patterns, overextensions, and signal crossovers. Figure 8.5 depicts a historically significant overbought level on the MACD unbounded oscillator. On the daily chart of Amazon.com Incorporated, notice that every time the MACD tests or exceeds the overbought level, this was followed by a reversal or correction in price, as seen at timelines 1 to 6. These overextension levels are best determined via visual inspection. Figure 8.6 depicts overbought and oversold levels on the cycle-tuned bound-edge stochastic oscillator. Notice that the oversold levels coincided perfectly with bottoms in the silver markets, as indicated by all of the up arrows. Note that although the stochastics and RSI have default values for the overbought and oversold levels, our example used the historically significant overbought and oversold levels, which were determined via visual inspection, in lieu of the conventional 80 and 20% OB and OS levels respectively. The Handbook of Technical Analysis. Window oscillators and overlay indicators. Figure 8.5 overbought at historically significant MACD levels on the daily chart of Amazon.com incorporated courtesy of stockcharts.com. Equilibrium and zero-line crossovers. Another way a window oscillator can indicate buy or sell signals is via the crossing of the equilibrium value, which is represented by any of the following penetrations. 50% level crossing in bounded oscillators, zero-line crossing in unbounded oscillators. Figure 8.6 oversold on the stochastic oscillator on the daily chart of silver. Source, MetaTrader 4. 243. 244. Bounded oscillators fluctuate between 0 and 100% and hence their central or equilibrium value would be at the 50% level. Unbounded oscillators have no upper and lower limits, and as such the zero level would best represent the central or equilibrium level. Signals are indicated as follows. Oscillator crossing above its equilibrium level is a buy, bullish, signal. Oscillator crossing below its equilibrium level is a sell, bearish, signal. It must be noted that these only represent signals and should not be regarded as triggers for entry. The main reason why oscillator signals should be regarded as merely indications of potential sentiment and not actionable signals is mainly due to the possibility of misrepresentation resulting from a phenomenon referred to as divergence. With divergence, higher highs in price may be accompanied by lower highs in the oscillator, causing market participants to initiate shorts or liquidate positions in the market without evidence that price is actually reversing. Figure 8.7 depicts the bounded RSI 50% equilibrium level crossovers generating buy and sell signals on the daily chart of Goldman Sachs Group Incorporated. Notice that, using the defaulted look-back periods for the RSI and the Commodity Channel Index, CCI, the buy and sell signals generated by both oscillators are nearly identical. The unbounded CCI generated signals via its zero-level crossings. Figure 8.7 RSI 50% level crossovers generating buy and sell signals on the daily chart of Goldman Sachs Group Incorporated courtesy of stockcharts.com. The Handbook of Technical Analysis. Window oscillators and overlay indicators. In fact, this coincidence of buy and sell signals by both oscillators in the chart example in Figure 8.7 above creates false consensus and may lead the TRAD-ER into a false sense of confidence. Many oscillators will tend to give the same buy and sell signals because they are highly correlated, being constructed using the same underlying price data. This similarity between oscillators is referred to as multicollinearity. In this case, the RSI is collinear with respect to the CCI. To mitigate the adverse effects of multicollinearity, it is best to use oscillators that are derived from data other than price alone. For example, a combination of stochastics, Chaikin's Money Flow Index, which incorporates volume, and some other sentiment or market breadth oscillators like the McClellan oscillator or put/call ratio will yield significantly less collinearity. Many novice traders make the mistake of putting on a combination of price-based momentum oscillators CCI, stochastics, ROC, rate of change, the MACD, and the MOM, momentum, oscillators all at the same time. This produces an uncanny agreement between all these oscillator signals in generating buy and sell signals which overwhelms the novice trader and leads him or her into a false sense of confidence, believing that this agreement represents a strong signal. In short, collinearity provides redundant information. In Figure 8.8, we observe the effects of multicollinearity across the RSI, MACD, and ROC, all of which are displaying similar divergences and crossover signals. Figure 8.8 multicollinearity on the daily chart of Apple Incorporated courtesy of stockcharts.com. 245. 246. Figure 8.9 MACD signal line crossovers generating buy and sell signals on the daily chart of Goldman Sachs Group Incorporated courtesy of stockcharts.com. Signal line crossovers. Buy and sell signals may also be generated via signal line crossovers. A signal line is a smoothed version of the original oscillator, that is, it is a moving average of the original oscillator values. As such, it will lag the original oscillator action. Signals are indicated as follows. Oscillator crossing above its signal line is a buy, bullish, signal. Oscillator crossing below its signal line is a sell, bearish, signal. It is important to note that many practitioners consider an upside crossover, oscillator crossing above its signal line, to be significantly more bullish if it occurs in proximity to an oversold level. Similarly, a downside crossover, oscillator crossing below its signal line, would be regarded as significantly more bearish if it occurs around an overbought level. The defaulted signal line for the MACD is usually a 9-period exponential moving average of the MACD. Figure 8.9 depicts MACD signal line crossovers generating buy and sell signals on the daily chart of Goldman Sachs Group Incorporated, as seen at the vertical time lines. We see that the MACD signal line crossovers are fairly effective in forecasting tops and bottoms in the stock. Price oscillator divergence. Divergence between price and the oscillator indicate potential bearish or bullish reversals. Signals are indicated as follows. Standard bullish divergence between price and the oscillator is a bullish setup awaiting price confirmation. It is represented by lower troughs in price being accompanied by higher troughs in the oscillator. A potential upside reversal is expected. The Handbook of Technical Analysis. Window oscillators and overlay indicators. Figure 8.10 bullish and bearish divergences accurately forecasting reversal on the daily chart of bust. Source, MetaTrader 4. Standard bearish divergence between price and the oscillator is a bearish setup awaiting price confirmation. It is represented by higher peaks in price being accompanied by lower peaks in the oscillator. A potential downside reversal is expected. Reverse bullish divergence between price and the oscillator is a bullish setup awaiting price confirmation. It is represented by higher troughs in price being accompanied by lower troughs in the oscillator. A potential upside continuation is expected. Reverse bearish divergence between price and the oscillator is a bearish setup awaiting price confirmation. It is represented by lower peaks in price being accompanied by higher peaks in the oscillator. A potential downside continuation is expected. For George Lane's bull and bear setups, refer to Chapter 9. In Figure 8.10, we observe bullish and bearish divergences forecasting potential reversals with uncanny accuracy on the daily bust chart. Please refer to Chapter 9 for more on divergence. Note that although divergence can also be identified between oscillators, it is the divergence between price and an oscillator that is regarded as more pertinent. Figure 8.11 displays various divergences between the S&P 500 large cap index and both the S&P bullish percent index and the MACD. This is a good example of using oscillators based on price and market breadth as a means to mitigate the adverse effects of multicollinearity. Geometrically based oscillator pattern analysis. Buy and sell signals may be derived from applying geometrically based overlay indicators to window oscillators. Overlays that are usually employed include trendlines channels. 247. 248. Figure 8.11 price oscillator divergences on the daily chart of the S&P 500 large cap index. Courtesy of stockcharts.com. Chart patterns apex reactions. Signals are indicated as follows. Oscillator breaching a geometrically based overlay to the upside is a buy, bullish, signal. Oscillator testing a geometrically based overlay from below is a sell, bearish, signal. Oscillator breaching a geometrically based overlay to the downside is a sell, bearish, signal. Oscillator testing a geometrically based overlay from above is a buy, bullish, signal. See Figure 8.12. We see the geometrical overlays, on the momentum oscillator, MOM, generating buy and sell signals upon violation of trend lines and chart patterns on the 30-min chart of the Nikkei 225. We also see a projected channel bottom buy signal. The Handbook of Technical Analysis. Window oscillators and overlay indicators. Figure 8.12 oscillator chart pattern-based buy and sell signals on the 30-min chart of Nikkei 225. Source, MetaTrader 4. Numerically based oscillator pattern analysis. Just as for geometrically based overlays, buy and sell signals may also be derived from applying numerically based overlay indicators to window oscillators. Overlays that are usually employed include Bollinger Bands, moving averages, moving average bands, Fibonacci levels, linear regression bands. Signals are indicated as follows. Oscillator breaching a numerically based overlay to the upside is a buy, bullish, signal. Oscillator testing a numerically based overlay from below is a sell, bearish, signal. Oscillator breaching a numerically based overlay to the downside is a sell, bearish, signal. Oscillator testing a numerically based overlay from above is a buy, bullish, signal. See Figure 8.13. We observe that the RSI is finding support at the lower Bollinger Band. Prices also bottomed every time the RSI found support at the lower band. Notice that the actual oversold was a fair distance below the Bollinger Band oversold levels. This method effectively catches bottoms in a rapidly rising market, without requiring the RSI to decline all the way down to test the 30% oversold line. 249. 250. Figure 8.13 oscillator chart pattern-based buy and sell signals on the daily chart of Starbucks Corp courtesy of stockcharts.com. Horizontally based oscillator pattern analysis. Buy and sell signals may also be derived from applying horizontally based overlay indicators to window oscillators. Hence, practitioners look for prior support and resistance in the oscillators for potential bullish and bearish indications. Signals are indicated as follows. Oscillator breaching a resistance level is a buy, bullish, signal. Oscillator displaying resistance at a prior oscillator resistance level is a sell. Bearish, signal. Oscillator breaching a support level is a sell, bearish, signal. Oscillator displaying support at a prior oscillator support level is a buy, bull. Ish, signal. See Figure 8.14. Oscillator on oscillator analysis. Buy and sell signals may also be derived from the interaction between window-based oscillators. We have already seen an example of indicator on oscillator analysis in Figure 8.13 where the RSI reacted at the upper and lower Bollinger Bands. Similarly, oscillator on oscillator analysis may also render useful information. The Handbook of Technical Analysis. Window oscillators and overlay indicators. Figure 8.14 oscillator support and resistance based buy and sell signals on the 30-min chart of Nikkei 225. Source, MetaTrader 4. One such example is the stochastic RSI, where the stochastic of RSI values are calculated and plotted as a window oscillator. Practitioners look for potential bullish and bearish indications via any of the previous 7 approaches to analyzing an oscillator. In Figure 8.15, notice that the stochastic RSI pinpoints potential buying dips, indicated at the dotted timelines, in an uptrend on the daily chart of Apple Inc. Figure 8.15 oscillator on oscillator analysis on the daily chart of Apple Incorporated courtesy of stockcharts.com. 251. 8.3 cycle period, multiple time frames, and lagging indicators. Oscillator optimization via the dominant half-cycle period. Oscillators and most overlays will normally tend to generate more effective buy and sell signals if they are tuned to the dominant half-cycle period. This will result in the oscillator issuing buy and sell signals based on the wave cycle of interest and not merely via its default look-back period, which may produce too few or too many signals with respect to the wave cycle traded. There are 3 ways to calculate the half-cycle look-back period via any of the following formulas, where n is the dominant cycles period, refer to Chapter 12 for examples of calculations for each formula. 252. n plus 1, / 2, and round up if n is even, n/2, plus 1, and round down if n is odd, and 2n plus 3, / 4, round to closest integer. For example, assume that we are interested in using the stochastic to generate buy and sell signals. From figure 8.16 we observe that the average dominance cycle period on the daily bust chart, from 2005 to 2007, was on average 75 days, where a new cycle trough was formed at the same wave degree. The half cycle would then be, using the second formula above, 75 halves, plus 1 equals 38.5 days. We round this down since n is odd, 75, making the half cycle 38 days. We therefore tune our stochastic's look-back period to 38 periods. We see that it tracked and forecast the cycle troughs perfectly, including troughs during the period after the sample period was taken out of sample data. Note that the standard 1/4 period. Figure 8.16 cycle-tuned stochastic tracking the cycle troughs effectively on the daily bust chart. Source: MetaTrader 4. The Handbook of Technical Analysis. Window oscillators and overlay indicators. Default setting generated too many oversold signals as compared to the cycle-tuned oscillator. Oscillator analysis on multiple time frames, MTF. Oscillators and overlays of various time frames may be plotted on the same chart for more effective comparison of oscillator action and its relationship to price action. Assume that we intend to set up a chart to display the 5-minute, 1 5-minute, and 1 hour RSI. We use a 5-minute interval chart as our basic chart. We first need to find the multiplying factor, MF, in order to calculate the look-back periods of the higher time frame RSIs. MF, for a 15 minutes interval chart, equals 15 minutes / 5 minute equals 3 MF, for a 60 minutes interval chart, equals 60 minutes / 5 minute equals 12. So, our 1 5-min RSI is obtained by multiplying the RSI standard default look-back period by 3, giving 14 times 3 equals 42 periods. Therefore, a 42 period RSI on a 5-min chart will represent a 1 5-min RSI. Similarly, an hourly RSI is displayed on a 5-min chart if we increase its look-back period to 14 times 12 equals 168 periods. For oscillators like the MACD, we need to increase all the variables via the MF. We use the same method to plot multiple time frame moving averages and other overlays on charts. For example, to display an hourly 20 period moving average on a 5-min chart, we need to plot a 20 times 12 equals 240 period moving average. This would represent a 20 period moving average as seen on the hourly chart. It should be noted that there will be very small discrepancies between an actual 20 period moving average on an hourly chart and a 240 period moving average on a 5-min chart, although they both essentially track the same average. Lagging indicators. Oscillators, being derived mainly from price, are usually lagging price action. But this does not mean that leading indications are not possible. Divergence is one form of oscillator analysis that is regarded as a leading indicator. Another example of leading indicators is the early reversals that tend to occur in momentum oscillators, normally reversing or slowing down before price. Horizontally and geometrically based overlays are also forms of leading indicators. Not all numerically based overlays are leading indicators. For example, Fibonacci projection, extension, expansion, and retracement are forms of leading indicators, but moving averages are not. 8.4 Input data. We may also create new oscillators from other oscillators. For example, if we replace price by RSI values for each period, we will create what is referred to as a Stoch RSI window oscillator. Let C be the current closing price, Ln be the lowest price of the last n periods, and Hn be the highest price of the last n periods. The raw %K is given by %K equals CLN / HNLN. 253, 254, Figure 8.17 Creating the Stochastic RSI from normalizing the RSI. Courtesy of stockcharts.com. Replacing C with current RSI value RSIC, LN with the lowest RSI value of last n periods RSILN, and HN with the highest RSI value of last n periods RSIHN, we get Stoch RSI equals moving average of RSIC RSILN slash RSIHN RSILN. The Stoch RSI is a bounded oscillator, due to the nature of the normalizing equation above. See figure 8.17. It shows the stochastic, Stoch RSI, and RSI Window oscillators, in descending order on the charts. The defaulted look-back period for the Stoch RSI is 14 bars. Notice that the Stoch RSI provides faster and more responsive signal action as compared to the original RSI. Data drop-off effect. The drop-off effect is fairly obvious when an oscillator or overlay drops off an old data point and substitutes it for a new one, preserving the length of the look-back period. Let us use a simple moving average to illustrate the effect. Assume that we create a 7-period simple moving average of the following prices: $7, $4, $3, $3, $2, $4, $5. The average would be $28/7 equals $4. Assume that we now move on to the next data point, dropping the last price of $7 and adding a new data point at $4. $4, $3, $3, $2, $4, $5, $4. The new average will now be $3.57. The percentage change is $4, $3.75 slash $4 times 100% equals 10.75%. If we now replace the original last price of $7 with $9, the Handbook of Technical Analysis. Window oscillators and overlay indicators. New percentage change will be $30/7, $3.57 slash $30/7 times 100% equals 16.72%. This illustrates that when dropping off large values and replacing them with smaller values, the average will account for this change by making sudden up and down moves, causing the moving average values to be more erratic. To reduce the impact of the drop-off effect, we could select longer look-back periods, use more front-weighted moving average-based oscillators, example exponential or linear weighting. 8.5 Trend trading using oscillators. We may use oscillators to time continuations and breakouts in the direction of the existing trend. It is always best to trade in the direction of the larger existing trend. To do this effectively using oscillators, we look for the following signals to join and trade in the direction of the larger existing or predominant trend. In an existing uptrend, a buy signal is represented as oscillator crossing above the equilibrium line. Oscillator crossing above its signal line. Oscillator is at oversold or rising back above oversold levels. Oscillator displaying bullish standard or reverse divergence with price. Oscillator violating a chart pattern or trend line to the upside. In an existing downtrend, a sell signal is represented as oscillator crossing below the equilibrium line. Oscillator crossing below its signal line. Oscillator is at overbought or declining back below overbought levels. Oscillator displaying bearish standard or reverse divergence with price. Oscillator violating a chart pattern or trend line to the downside. 8.6 Window oscillators. We shall now turn our attention to a few popular indicators, such as MOM, ROC, MACD, stochastics, and so on. These oscillators are referred to as momentum oscillators since they track the underlying acceleration and deceleration of price action. Momentum tends to weaken and strengthen before price. It is this quality that makes such oscillators effective in forecasting potential trend changes. Unfortunately, momentum oscillators are not very useful during a strong and prolonged up or down trend, as they tend to remain at overbought and oversold for long periods. During such periods, it would be better to use price overlay indicators such as support and resistance, trend lines, moving averages, channels, envelopes, and volatility bands to signal any potential trend change. The use of a trend change indicator such as the average directional index, ADX, may also prove useful in gauging the beginning and end of a trend. Finally, it is always best to fully master the use and interpretation of one oscillator well instead of using multiple oscillators and not being entirely familiar with. 255. 256. Any of them. Each oscillator has its individual characteristics and it takes time to familiarize oneself with them. Nevertheless, the trader should understand that oscillators only generate trade signals, not trade triggers. Rock, tracking momentum via the ratio method. The rate of change oscillator, rock, tracks the percent or ratio change in price over n periods. Note that some practitioners also use a smoothed version of the rock for better visualization of price behavior, especially if there is significant volatility. Although the rock usually uses closing prices, some practitioners also use typical price, mid-price, and weighted close prices. The general rock formula is rock equals latest price n periods back, / price n periods back. If we multiply the rock value above by 100%, we get the percentage representation of ratio change. As such, a $10 change from $1 and $90 will be displayed differently. For example, $11 $1 / $1 times 100% equals 1000%, $110 $100 / $100 times 100% equals 10%. A $10 rise over 10 periods starting from $1 has a larger rock value when compared to a $10 rise over 10 periods starting from $90. As such, assuming that prices rise $10 per every 10 periods, we would see the rock flatten out as prices rise. This may induce the practitioner to believe that the uptrend is starting to weaken. When prices are flat or beginning to flatline, the rock will decline to zero. For the rock to remain flat, price needs to be rising at a steady rate. If rock is rising, this indicates that price is accelerating, with respect to prices n periods ago. As per any oscillator, the rock may be analyzed for buy, bullish, and sell, bearish, signals using any of the 8 forms of oscillator analysis described in a previous section. See Figure 8.18. We see the rock remaining flat during a constant rate of ascent in price, as expected. We also see the rock declining as prices start to range. Note that the zero-line crossovers indicate buy and sell signals and the historically overbought levels, at points 1 to 3, forecast tops and bottoms accurately on the daily chart of Goldman Sachs Group Incorporated. Notice how the rock momentum oscillator reverses before price at points 1 to 3. This is the most important and useful characteristic of momentum oscillators. MOM, tracking momentum via the difference method. Momentum can also be tracked using the difference method. Instead of calculating the ratio as in an rock oscillator, the MOM tracks the price difference over the last n periods. Although the MOM usually uses closing prices, some practitioners also use typical price, mid-price, and weighted close prices. The general MOM formula is MOM equals latest price n periods back. The Handbook of Technical Analysis. Window oscillators and overlay indicators. Figure 8.18 Rock action of the daily chart of Goldman Sachs Group Incorporated courtesy of stockcharts.com. The MOM oscillator does not exhibit the nonlinearity experienced by rock oscillators. When prices are flat or beginning to flatline, the MOM will decline to zero. For the MOM to remain flat, price needs to be rising at a steady rate. If MOM is rising, this indicates that price is accelerating, with respect to prices n periods ago. The MOM may be analyzed for buy, bullish, and sell, bearish, signals using any of the 8 forms of oscillator analysis described in a previous section. In most ways, it is identical to rock action. MACD and MACD histogram. Created by Gerald Appel, the MACD stands for Moving Average Convergence Divergence. The MACD is created by detrending 2 moving averages with each other and plotting the difference as a window oscillator. Detrending removes the trend component, leaving only the difference in values. In the case of the MACD, detrending is simply the subtraction of the values of the 2-6 period exponential moving average from the 1-2 period exponential moving average. MACD equals 12 period EMA 26 period EMA. In figure 8.16, we notice that every time the 1-2 day EMA tests or crosses the 2-6 day EMA, the MACD line tests the zero level, refer to the solid vertical arrows. This is because the difference between the two EMAs is zero. Whenever the two EMAs start to diverge, the MACD starts to move away from the zero line, and when they converge the MACD moves toward its zero level. If the 1-2 period EMA crosses above the 2-6 period EMA, the MACD rises above the zero level, and whenever the 257, 258, Figure 8.19 MACD action of the daily chart of Goldman Sachs Group Incorporated courtesy of stockcharts.com. 1-2 period EMA crosses below the 2-6 period EMA, the MACD falls below the zero level. The MACD histogram is a double detrended oscillator. It is the difference between the MACD and its 9-period signal line. Again, as we can see from figure 8.19, every time the MACD tests or crosses over its signal line, the histogram moves to its zero level, shown by dotted vertical arrows. The histogram tends to react faster than the MACD by reversing before it. Detrending removes the lag from oscillators, and as such, double detrending creates an even more responsive oscillator. The MACD and its histogram may be analyzed for buy, bullish, and sell, bearish, signals using any of the 8 forms of oscillator analysis described in a previous section. In figure 8.20 we see historically overbought levels in the MACD signaling potential tops in the hourly USD-JP. Average true range, ATR. Created by Wells Wilder, the average true range tracks the volatility associated with price activity. It does this by tracking the true range of each bar over a specified number of periods and finding the average of that value. True range is defined as the largest of the 3 following price ranges. The range of the current bar, the difference between the previous close and the current high, the difference between the previous close and the current low. The Handbook of Technical Analysis. Window oscillators and overlay indicators. Figure 8.20 MACD overbought levels signaling potential tops on the 4-hour chart of USD-JP. Source, MetaTrader 4. ATR is a simple moving average of true range. It is used as a means of sizing a stop loss. Stop sizes are usually some multiple of ATR. The ATR has the following characteristics. An increase in price volatility increases the value of the ATR. Falling ATR values in an uptrend is a bearish indication. Rising ATR values in an uptrend is a bullish indication. Falling ATR values in a downtrend is a bullish indication. Rising ATR values in a downtrend is a bearish indication. High or extreme values of ATR usually accompany price peaks and troughs. In the market, Figure 8.21 displays true range action on the daily chart of gold. The look-back period is set to 1 period, indicating that we are observing true range rather than the average true range. We see true range signaling a correction in gold every time it surpasses the historically overextended level. The stochastic oscillator. Created by George Lane, the bounded stochastic oscillator tracks the relative position of the current price or latest close as a percentage of the price range over a specified number of periods, measured from the lowest low of the range. It is called the raw %K. See figure 8.22. We see that the closing price is 83.3% of the range over a look-back period of 1 bar. The raw %K is usually defaulted to a look-back period of 14 bars. A 1-4-day look-back period was originally used to track the monthly commodity half cycle. Let C be the closing price, Ln be the lowest low of the last n periods, and Hn be the highest high of the last n periods. There are 2 representations of the 259. The Handbook of Technical Analysis. Figure 8.21 True range action of the daily chart of gold. Source, MetaTrader 4. Stochastic oscillator, the fast and the slow. In each representation, there are two lines, one called the %K and its corresponding signal line called the %D. In the fast version of the stochastics we have the fast or raw %K and fast %D. The fast stochastic is calculated as follows. Faster raw %K equals CLN, slash, HNLN, times 100% fast %D equals 3 period simple moving average of raw %K. In the slow version of the stochastics we have the slow %K and slow %D. The slow stochastic is calculated as follows. Slow %K equals 3 period simple moving average of raw %K. Slow %D equals 3 period simple moving average of slow %K. Assume OHLC. Open high 1.4590 1.5020. Low 1.4900. Close 1.5000. 1.4950. 1.4900. O. K equals 83.3%, bounded between 0 and 100%. Figure 8.22 percentage of price range. 260. 1.5020 100% 1.5000. C 83.3%. 1.5000 1.4900 times 100 1.5020 1.4900. 0% L. Window oscillators and overlay indicators. The default look-back period for the fast or raw %K is 14 periods. If we smooth the %K by creating a simple 3-period moving average of it, we call this the fast %D. If we further create a 3-period simple moving average of fast %D, we get the slow %D. In short, the fast %D line is a smoothed version of the raw %K line and the slow %D line is a double smoothed version of the raw %K line. The %D line is used to determine overbought and oversold levels, 50% level crossovers, divergence, and signal line crossovers. When using the raw %K, the fast %D represents its signal line, and when using the slow %K line, the slow %D becomes its signal line. As far as signal line crossovers are concerned, whenever the fast %K line crosses above the fast %D signal line, it represents a buy, bullish, signal. Whenever the fast %K crosses below the slow %D signal line, it represents a sell, bearish, signal. Whenever the slow %K crosses above the slow %D signal line, it represents a buy, bullish, signal. Whenever the slow %K crosses below the slow %D signal line, it represents a sell, bearish, signal. The stochastic oscillator may be analyzed for buy, bullish, and sell, bearish, signals using any of the 8 forms of oscillator analysis described in a previous section. Overbought and oversold levels are defaulted at 80% and 20%, respectively. Figure 8.23 shows a cycle-tuned stochastic tracking the tops and bottoms in silver with uncanny accuracy. Note that the historical overbought and oversold values were used instead of the standard 20 and 80% overextension levels. It is done via visual inspections and it is usually a better reflection of the behavior of market participants. We may say that when using historically. Figure 8.23 cycle-tuned stochastic tracking tops and bottoms effectively on the daily silver chart. Source, MetaTrader 4. 261. Extreme levels that the stochastics overextension levels are behaviorally tuned. A higher frequency of alternation between overbought and oversold signals is also an indication of potentially greater short-term participation in the markets. Note that silver reversed at the Fibonacci retracement levels while the oscillator was at overbought. It should be noted that the %K formula represent a normalizing process. It is in fact identical to the RSI normalizing process. To normalize data means to bind it with a range of values, with an upper and lower limit. One disadvantage of normalization in the stochastic oscillator is that it tends to produce erratic swings between the overbought and oversold levels, especially when the price range associated with the %K look-back period is very narrow. Relative Strength Index, RSI. Created by Wells Wilder, the RSI tracks the stock's underlying strength in terms of its average gain and loss of over the last n periods. Let the average gains over the last n periods be G and the average loss over the last n periods be L. Relative strength, Rs, is defined as Rs equals G/L. RSI equals 100/100/1 plus G/L. Rearranging, we get RSI equals 100 times G/G plus L. This is similar to the stochastic normalization process where the maximum value in the numerator will always be equal to or less than the value in the denominator. Wells Wilder used a 1-4 period lookback and smoothed the RSI data using the Wilder's averaging, which is a form of exponential moving average. The RSI is less volatile than the stochastic action and may be a good replacement for the stochastic in volatile markets. The RSI oscillator may be analyzed for buy, bullish, and sell, bearish, signals using any of the 8 forms of oscillator analysis described in a previous section. Overbought and oversold levels are defaulted at 70% and 30%, respectively. Many practitioners regard a confluence of buy and sell signals occurring on both the stochastic and RSI oscillators as more reliable. One approach is to first look for a dip below the oversold level on both these oscillators. Once the readings rise back above the oversold level on both oscillators, a buy signal is issued. The reverse is true for sell signals. In Figure 8.24, we observe a buy signal as both oscillator readings rose above the oversold level on the daily chart of Starbucks Corp. The trigger for entry would normally be the high of the candlestick or bar associated with the observed buy signal. 8.7 Overlay Indicators. As we have already seen, overlays are classified into 4 categories, namely numerically based overlays, geometrically based overlays. 262. The Handbook of Technical Analysis. Window oscillators and overlay indicators. Figure 8.24 Buy signal and trigger on the daily chart of Goldman Sachs Group Incorporated courtesy of stockcharts.com. Horizontally based overlays, algorithmically based overlays. Price interacts with these overlays, finding support and resistance. The best forms of support and resistance are resistive and supportive clusters or confluences. A concentration of bullish and bearish indicators within a narrow price range will normally result in a strong price barrier. We have covered most of these overlays in other sections of this handbook, so we will not repeat them here. We shall instead now turn our attention to floor traders' pivot points. What are floor traders' pivot points? The floor traders' pivot points is a trend following and volatility indicator. It is a numerically based overlay. Depending on the range of the previous day, it will project various levels of resistance, R1, R2, R3, etc., and support, S1, S2, S3, etc., for the next day. It also projects a pivot point level, PP, around which the day's action unfolds. To construct these pivot points, first find the previous day's typical price. This represents the next day's pivot level, PP. To construct the first pivot support level, we project the difference between the previous day's high and PP downward from the PP price. Similarly, to construct the first pivot resistance level, we project the 263, 264. Figure 8.25 Constructing the first pivot resistance and support level. Difference between the previous day's low and PP upward from the PP price. See Figure 8.25. We can clearly see why it is called the pivot point. It is around this PP that the previous day's volatility is incorporated into the next day's projections. If the previous day was volatile, it would tend to create a larger range. This will affect the next day's projection levels. Note that if the previous day's close was above its mid-price, the new projected levels would all be raised the next day. Hence, it is essentially a trend-following overlay indicator. To construct the second pivot support level, we subtract the previous day's range from the PP, and to construct the second pivot resistance level we add the previous day's range to the PP. See Figure 8.26. We see that by adding yesterday's range, we are incorporating yesterday's volatility into the current day's projections. Hence, it is essentially an indicator of potential future volatility. To construct the third pivot support level, we subtract the previous day's range from the first support level, and to construct the third pivot resistance level we Figure 8.26 constructing the second pivot resistance and support levels. The Handbook of Technical Analysis. Window oscillators and overlay indicators. Figure 8.27 constructing the third and fourth pivot resistance and support levels. Add the previous day's range to the first resistance level. And in similar fashion, the fourth support level is constructed by subtracting the previous day's range from the second support level, and to construct the fourth resistance level we add the previous day's range to the second resistance level. See Figure 8.27. A popular way to gauge the day's action is to identify if price has opened below or above the PP. If it has opened below the PP, the current day's prices are expected to drift lower, and if it has opened above the PP, the current day's prices are expected to drift higher. The violation of the second support or resistance levels indicate a strong downtrend or uptrend is in effect, while the third resistance and support levels represent extreme overbought and oversold levels, respectively. If the day is quiet and non-eventful, prices should stay within the first pivot support and resistance levels. See Figure 8.28 for price interacting with these pivot point levels. Besides using pivot point levels for initiating entries, many practitioners use the levels as a basis of exiting a position. Figure 8.28 Price reacting to pivot points on the daily chart of Goldman Sachs Group Incorporated courtesy of StockCharts.com. 265. 8.8 Chapter Summary. In this chapter, we looked at various classifications of indicators and oscillators and how they apply to price and market action. It is important to note that indicators and oscillators are especially effective in predicting reversals when they coincide with price barriers like support/resistance, trend lines, channel-bound RIES, and floor traders' pivot levels. Chapter 8 Review Questions. 1. What is the difference between overlay and window oscillators? 2. Describe the four types of overlay indicators with one example of each type. 3. What are the advantages and disadvantages of an unbounded oscillator? 4. Explain scale and variance. 5. What is the difference between static and dynamic overlay indicators? 6. What are the 8 ways to analyze an oscillator? 7. Explain how to set up the hourly and 4-hour MACD on a 1-5 min chart. 8. What are the differences between the rock and mom momentum oscillators? References. Arch Ellis, Stephen B. 2001. Technical Analysis from A to Z. New York, McGraw-Hill. Colby, Robert W. 2003. The Encyclopedia of Technical Market Indicators. New York, McGraw-Hill. 266. The Handbook of Technical Analysis. Chapter 9. Divergence Analysis. Divergence, when used in conjunction with other indicators, offers one of the most effective ways of forecasting potential reversals and continuations in price and market action. It may be derived from a variety of sources and technical data. Divergence can also be found on all wave degrees and time frames. It is particularly useful when identified between non-correlated data series. One of the earliest and possibly the most significant application of divergence can be found in development of Dow theory, where divergence between the Dow Industrials and Transportation averages is commonly regarded as an important barometer of potential future market action. We will also attempt to bring some definitional clarity and coherence to terms such as standard and reverse divergence, direction, confirmation, continuation, and reversals with respect to divergence analysis. Learning objectives. Upon completing this chapter, you should be able to Understand the narrow and the broader meanings and interpretation of divergence and convergence. Employ the concept of confirmation to categorize divergence, differentiate between standard, reverse, bullish, and bearish divergence, recognize and forecast divergent signal alternation between standard and reverse. Divergence, distinguish between George Lane's setups and contemporary reverse divergence, appreciate the directional implications of divergence in terms of wave degrees, cycles, and trend referencing, apply divergence analysis to the market via an integrated approach. 267. The Handbook of Technical Analysis. 9.1 Definition of divergence. Generally speaking, divergence occurs when two data or time series exhibit motion in opposing directions. But as will be shown shortly, this is not always the case. 9.1.1 Main and supporting data series. When trying to determine if divergence exists, we compare the main data series to its supporting data series. The main data series may have one or more supporting data series. In technical analysis, the main data series is usually price itself, while the supporting data series comprises various oscillators and indicators. Nevertheless, both the main and supporting data series may be comprised of any of the following, and are by no means limited to the following list. Price oscillators, overlay indicators, volume open interest, market breadth indicators, sentiment indicators, relative strength chart. In order to accurately and sensibly define divergence and convergence, we must first clarify what is meant by opposing directions. 9.1.2 Defining direction in divergence analysis. Motion can only take place in three possible directions, namely up, down, or sideways. Some practitioners contend that sideways motion does not constitute a true trend. Nevertheless, for the purpose of defining divergence, this contention does not invalidate or detract from the analysis. This gives rise to 6 possible combinations for moving in opposing directions. 1 data series is up while the other is sideways. 2 1 data series is up while the other is down. 3 1 data series is sideways while the other is up. 4 1 data series is sideways while the other is down. Note: moving in opposing directions is defined as one data series moving in 2 out of 3 possible directions while the other data series is moving in the remaining direction. 268. Divergence analysis. 5 1 data series is down while the other is up. 6 1 data series is down while the other is sideways. The following 3 combinations are regarded as moving in the same general direction. 1 Both data series are moving up. 2 Both data series are moving sideways. 3 Both data series are moving down. 9.1.3 Determining direction in divergence analysis. When trying to ascertain whether a data series is moving up or down, we examine the sequence of peaks and troughs, or swing highs and swing lows, respectively, to identify the direction of the data series over a specified number of cycles or oscillations. Slope, or angle, between 2 data points to identify the direction of the data series over a specified range or duration of data, especially in the absence of visible peaks and troughs. It must be noted that in order to determine direction by comparing peaks and troughs, the formation of the subsequent peak or trough must first be firmly established. A peak or trough is usually defined and established via the application of some kind of filter. As seen in an earlier chapter, the establishment of peaks or troughs is strictly based on price filtering. Time-based filters are not applicable, as a certain amount of price excursion is required to establish a new peak or trough. It is interesting to note that some practitioners also resort to using regression lines in order to establish the direction of the data series, in the hope of achieving greater consistency when analyzing divergence. But it will be shown that such an approach will only lend itself to standard and not reverse divergence analysis. Before proceeding any further, it should be stressed that establishing direction in divergence analysis differs slightly from that of conventional trend analysis, having basically 4 ways to establish direction. Generally speaking, the determination of direction depends exclusively on the definition being employed. For example, an uptrend may be defined as a series of higher peaks and troughs, while a downtrend may be depicted as successively lower peaks and troughs. Notice that both peaks and troughs must be moving in the same direction in order to be deemed a trend. However, in divergence analysis, as will be described shortly, it suffices that the direction of the current larger trend may also be determined solely by comparing adjacent peaks or troughs. Note that this unique definition of direction is only applied when attempting to determine the direction of the current larger trend across a single oscillation at the lower wave degree and is never used to determine the direction of the prior or subsequent larger trend, both of which are defined via the conventional approach to trend analysis. Therefore, directional discrepancy between the data series at the current larger trend may be based on a very specific definition, as opposed to the conventional definition of trend analysis. 269. 270. Figure 9.1 Defining direction using adjacent peaks, highs. An example may help illustrate this point. See Figure 9.1. In the process of trying to gauge direction using adjacent peak-to-peak analysis, we need to determine if the subsequent peak is higher, lower, or flat with respect to the previous peak. Similarly, when comparing adjacent troughs to establish direction, we must determine if the subsequent trough is higher, lower, or flat with respect to the previous trough, as depicted in Figure 9.2. Figure 9.2 Defining direction using adjacent troughs, lows. The Handbook of Technical Analysis. Divergence analysis. This unique approach for determining direction is only employed at the point of non-confirmation and nowhere else. This definition of trend or direction may also seem somewhat lacking or unusual when compared to the usual strict requirement for both higher peaks and troughs in an uptrend and similarly for both lower peaks and troughs in a downtrend. One way to resolve this disparity is to imagine a trend line connecting the adjacent peaks or troughs. Once we do this, we realize that we are in fact defining trend in the same way that a trend line does, by employing just 2 points. It would therefore be particularly useful at this point to subclassify direction or trend analysis in the following manner, as it relates specifically to divergence analysis. Multiple peak and trough analysis is used to define and analyze uptrends and downtrends across multiple peaks and troughs, where an uptrend may be defined as successively higher peaks and troughs and a downtrend as successively lower peaks and troughs. In divergence analysis, this conventional approach to analyzing trends may be used to establish the direction of the prior, current, and subsequent larger trend. Slope analysis is used to define and analyze uptrends and downtrends, a. when peaks and troughs are not clearly visible or accessible, and b. when multiple peaks and troughs are visible but are observed as a slope at a higher wave degree. In divergence analysis, slope analysis may be used to establish the direction of the prior, current, and subsequent larger trend. When slope analysis is used, only standard divergence analysis applies. Reverse divergence is excluded from the analysis and is not accounted for, as its use would lead to definitional ambiguity. Slope analysis is also applied to trend lines or regression lines. Adjacent peak-to-peak analysis is used to define direction between two adjacent peaks, representative of the market rising and falling across a single cycle on the lower wave degree. In divergence analysis, it may be used to establish the direction of the current larger trend. This kind of analysis should not be employed to determine the direction of general trends, which includes the prior and subsequent larger trends, unless reducible to two peaks at a higher wave degree. Adjacent trough-to-trough analysis is used to define direction between two adjacent troughs, representative of the market rising and falling across a single cycle at the lower wave degree. In divergence analysis, it may be used to establish the direction of the current larger trend, but it should not be employed to determine the direction of general trends, which includes the prior and subsequent larger trends, unless reducible to two troughs at a higher wave degree. It is imperative to be aware that, when comparing adjacent peaks between two data series, there are 9 possible combinations that encompass motion in all possible directions of the current larger trend, 6 for moving in opposing directions, and 3 for moving in the same general direction. The total number of combinations expands to 18 when we also start to compare successive troughs in order. 271. Figure 9.3 Defining direction of the current larger trend. To determine direction of the current larger trend, see Figure 9.3. Boxes 1, 2, 9 are based on adjacent peak-to-peak analysis, and boxes 10, 2, 18 are based on adjacent trough-to-trough analysis. Boxes 1, 5, 9, 10, 14, and 18 depict both data series moving in the same direction, lacking directional properties called divergence and convergence. As mentioned earlier, when peaks and troughs are not available or visually accessible to determine direction, we simply refer to the angle or slope between two data points. In such cases, the existing 12 combinations that depict motion in opposing directions between the two data series collapse back to 6. But in order to identify which of the 6 combinations indicate bullishness or bearishness in the main data series, we first need to understand the concept of divergence. 9.2 General concept of divergence. The term divergence is a constant cause of confusion in technical analysis, especially to the uninitiated. This is further exacerbated when practitioners occasionally employ the term convergence to imply divergence and vice versa. We shall now attempt to resolve these inconsistencies in the usage of the terms divergence and convergence by first introducing another important concept in technical analysis called confirmation. 272. The Handbook of Technical Analysis. Divergence analysis. 9.2.1 Concept of confirmation in divergence analysis. The terms confirmation, non-confirmation, and price confirmation are used in very specific ways when dealing with divergence. Confirmation and non-confirmation are used to describe whether the main and its supporting data series are in directional agreement with each other or otherwise, respectively. Price confirmation, applicable and relevant only to the main data series, relates to some qualifying action in price that subsequently establishes or confirms the validity of an initial bullish or bearish divergent setup, by way of penetration of some price barrier. Being in agreement means that the successive peaks and troughs in the supporting data series are moving in the same general direction with the peaks and troughs in the main data series at the same wave degree. Implies a continuation of the current larger trend, i.e., current trend at the next higher wave degree to the oscillations that formed the peaks and troughs. Agreement may also be represented by the slopes of the data series pointing in the same general direction, that is, either up or down, especially when peak and trough analysis is not available or possible. The oscillators and indicators in the supporting data series indicate the potential for further price extension or momentum in the direction of the current larger trend or direction of motion. See Figure 9.4 for confirmation via adjacent peak-to-peak and trough-to-trough analysis. Figure 9.4 Confirmation via adjacent peak-to-peak, left, and trough-to-trough, right, analysis indicating agreement between price and oscillator. Note: confirmation exists when the main and supporting data series are in agreement with each other at the same wave degree. 273. 274. Figure 9.5 Non-confirmation via adjacent peak-to-peak, left, and trough-to-trough, right, analysis indicating disagreement between price and oscillator. Non-confirmation occurs when the main and supporting data series are in disagreement with each other. This means that the peaks and troughs in the supporting data series are not moving in the same general direction with the peaks and troughs in the main data series, implying a potential reversal or weakening of the current larger trend. The oscillators indicate a possible decrease in price momentum. Non-confirmation is considered potentially more reliable if it is supported or corroborated by at least 3 weekly or non-correlated supporting data series. See Figure 9.5 for non-confirmation via single peak-to-peak and trough-to-trough analysis. Figure 9.6 is a chart of the Eurist foreign exchange pair. We see confirmation and non-confirmation at various points on the chart, from both adjacent peak-to-peak as well as trough-to-trough analysis. Figure 9.6 Confirmation and non-confirmation in the Eurist via adjacent peak-to-peak and trough-to-trough analysis. Source: MetaTrader 4. The Handbook of Technical Analysis. Divergence analysis. Figure 9.7 Non-confirmation and confirmation via conventional trend or multiple peak and trough analysis indicating disagreement and agreement between price and oscillator. Confirmation and non-confirmation may also be depicted as agreement and disagreement between general trends in the data series, that is, across multiple peaks and troughs, which represent conventional trend analysis. See Figure 9.7 for confirmation and non-confirmation, based on multiple peak and trough analysis. Non-confirmation here may also be referred to as slope divergence, since the slopes of the two data trends are in opposition with each other. Figure 9.8 illustrates confirmation and non-confirmation using slope analysis, since the peaks and troughs are not clearly visible on the chart. Slopes pointing in the same general direction indicate confirmation. 9.2.2 Trend referencing in divergence analysis, the prior, current, and subsequent trends. Non-confirmation may potentially result in either a continuation or reversal in price, depending on the type of divergence involved. It is useful to refer to price. Figure 9.8 Non-confirmation and confirmation via slope analysis indicating disagreement and agreement between price and oscillator. 275. The Handbook of Technical Analysis. Action leading up to the technical or divergent setup as the prior larger trend, that is, the prior trend of one higher wave degree to the waves that formed the peaks or troughs. The unfolding price action, post-setup, is referred to as the subsequent larger trend. The current larger trend may either be a continuation or reversal of the prior trend. Similarly, the subsequent larger trend may be a continuation or reversal of the current or prior larger trend. See Figure 9.9. We refer to the prior and subsequent trend of progressively higher or lower peaks and troughs as the larger trend, or trend at the next higher wave degree. The establishment of divergence is normally based on the sequence of peaks and troughs at one higher wave degree than the oscillations that created it at the point of non-confirmation. Hence, when comparing the peaks and troughs between the main and supporting data series, both divergence and convergence must be observed at the appropriate or corresponding wave degree in order to remain analytically consistent. The term corresponding refers to price action at the same wave degree. It is impossible to determine and interpret confirmation and non-confirmation correctly without the ability to recognize and distinguish between wave degrees. 9.2.3 Wave degrees in divergence analysis. In Figure 9.10, we see price moving up and down, that is, oscillating at a lower wave degree. This upward succession of higher peaks and troughs forms a trend at the next higher wave degree, called the larger trend. Figure 9.9 Trend referencing pre- and post-technical setup/signal. Note: the price action at the point of non-confirmation is referred to as the current larger trend, the direction of which may be determined using adjacent peak-to-peak or trough-to-trough analysis, slope analysis, or conventional trend analysis. 276. Divergence analysis. Figure 9.10 cycles at a lower wave degree forming a larger trend. Figure 9.11 illustrates wave cycles or oscillations at three different wave degrees. We observe price rising simultaneously on all three wave degrees, namely at the one lower wave degree between points P and Q, R and S, and so on to next or first higher wave degree between I and 2, 3 and 4, V and 6, and so on 3, second higher wave degree between 1 and 2. It is obvious that peaks 2 and 4 are formed from the oscillatory action at the lower wave degree between points G and Y, indicating a rise at a higher wave degree. As we shall see later, it is important to identify the wave degree that we are trying to establish as confirmation or non-confirmation, in order to tell whether the subsequent price action is a continuation or reversal of a trend at the first or second higher wave degree. Figure 9.11 Trends at various wave degrees. 277. The Handbook of Technical Analysis. The relationship between wave degrees is relative. Referring again to Figure 9.11, if the alphabetical oscillations A, B, C, A, B, C, etc., represent the lower wave degree, then oscillations I to 12 would represent the next higher wave degree and we call it the current larger trend. However, if oscillations I to 12 represent the lower wave degree, then oscillations 1 to 3 would represent the next higher wave degree and we now call this the current larger trend. 9.2.4 Reversal and continuation in terms of wave degrees. Before we delve further into the topic of divergence per SE, let us first refer to a couple of examples to better understand the meaning of reversal and continuation with respect to wave degrees in a trend. This is a critical step in understanding how standard and reverse divergence is subsequently defined. In Figure 9.12, we see higher peaks in price accompanied by lower peaks in the supporting data series giving rise to non-confirmation based on adjacent peak-to-peak analysis. Price subsequently makes successive lower peaks and troughs. We say that there is a reversal of the current larger trend, or trend at the next higher wave degree. As will be explained later, standard divergence indicates a potential reversal in the current larger trend. The case for reverse divergence is a little more complicated. Referring to Figure 9.13, we observe an upside reversal of the current larger trend, with higher peaks and troughs in the eurist. Figure 9.12 Reversal of the current larger trend. Note: the current larger trend is always one wave degree higher than the oscillations that created it. 278. Divergence analysis. Figure 9.13 Subsequent reversal of the current larger trend, eurist. Source: MetaTrader 4. In Figure 9.14, lower peaks in price are accompanied by higher peaks in the supporting data series giving rise to non-confirmation at the current larger trend based on adjacent trough-to-trough analysis. Price continues to make successive lower peaks and troughs. We say that there is a continuation of the current larger trend. As will be explained later, reverse divergence implies a potential continuation in price, which we now understand to mean a continuation at the next higher wave degree, or of the current larger trend. We shall now observe the progression of the three main trends around a divergent setup. In Figure 9.15, the prior larger downtrend was followed by non-confirmation. Using adjacent trough-to-trough analysis, we see the current larger trend depicting a falling market, which subsequently reversed to the upside. Hence the subsequent larger trend is a reversal of both the current and prior larger trends. Figure 9.14 Continuation of the current larger trend. 279. 280. Figure 9.15 Reversals based on adjacent trough-to-trough analysis. It should be noted that the directions of the prior and subsequent larger trends are wholly determined using conventional peak and trough analysis, and in the absence of visible peaks and troughs, slope analysis is applied. In Figure 9.16, the subsequent larger trend represents a continuation of the current larger trend and a reversal of the prior larger trend. 9.2.5 Continuation and reversal indications independent of price direction. As we have already seen, confirmation and non-confirmation depend on whether there is any directional agreement between the data series or otherwise, where confirmation suggests a potential continuation of the current larger trend. Figure 9.16 Reversals and continuation based on adjacent peak-to-peak analysis. The Handbook of Technical Analysis. Divergence analysis. However, it must be noted that some indicators and oscillators in the supporting data series may indicate potential continuation and reversal irrespective of the direction of price. They also do not require disagreement with price for non-confirmation or agreement for confirmation. Some examples of these oscillators and indicators include volume bar action, moving average of volume, open interest, and average true range, where rising peaks and troughs, and slopes, indicate confirmation, whereas falling peaks and troughs, and slopes, indicate non-confirmation, regardless of the direction of price in the main data series. Only the direction of the supporting data series is relevant and it is the only determining factor of the potential strength or weakness underlying the trend. But to determine bullishness or bearishness, the direction of price is still required. 9.2.6 Narrow interpretation of divergence and convergence. Whenever the corresponding peaks or troughs between the main and supporting data series are moving toward each other, we say that the two data series are converging on each other. Notice that during convergence, the main and supporting data series are moving in opposite directions, as defined in section 9.1.3, and hence there is non-conformation. The illustrations in boxes 4, 7, 8, 13, 16, and 17 in figure 9.3 display convergence. Alternatively, whenever the corresponding peaks or troughs between the main and supporting data series are moving away from each other, we say that the two data series are diverging from each other. Referring to figure 9.3, illustrations in boxes 2, 3, 6, 11, 12, and 15 display divergence. Notice that during divergence, as in convergence, the main and supporting data series are moving in opposing directions, indicating non-conformation. Therefore, we say that both convergence and divergence exhibit directional discrepancy. Convergence and divergence have bullish and bearish indications. Convergence of corresponding peaks or troughs between the data series is normally considered bullish, whereas its divergence is regarded as bearish. This is mainly attributed to the fact that the direction of the oscillators in the supporting data SC rise is usually regarded as a prognostication of future price action. Consequently, rising peaks or troughs in the supporting data series are an indication of potential strength, and further upside in price is expected regardless of whether there is non-confirmation or otherwise. Similarly, falling peaks or troughs in the supporting data series are an indication of potential weakness, and further downside in price is therefore expected. One question arises, however, when referring to scenarios depicted in boxes 5 and 14 in figure 9.3, where no successively higher or lower peaks and troughs are observed, essentially depicting price traversing sideways. Since divergence or convergence is non-existent in both scenarios, does that imply confirmation? As discussed earlier, confirmation must also indicate a potential for further price extension or momentum in the direction of the current larger trend. We observe no divergent or convergent behavior associated with the scenarios. 281. The Handbook of Technical Analysis. Depicted in boxes 5 and 14, and the oscillators in the supporting data SC rise do not appear to indicate any further price extension or momentum in the direction of the current larger trend. Hence, the term confirmation is undefined in sideways formations and is best reserved for situations where a clear and obvious trend is in effect. 9.2.7 Broad interpretation of divergence. It is customary to use the term divergence in a broader sense to describe any disagreement or non-confirmation between the main and supporting data series. Herein lies the confusion. Under this wider definition, all combinations depicted in figure 9.3 are now categorized as divergent, with the exception of 6 combinations, 4 of which have no disagreement, namely 1, 9, 10, and 18, and the remaining 2 being undefined, that is, 5 and 14. 9.2.8 Convergence and divergence under the broad interpretation of divergence. As will be shown later, a convergence of troughs and a divergence of peaks would, under this broader interpretation, be referred to as standard bullish and standard bearish divergence, respectively. The situation is a little more complicated for reverse divergence, depending on whether the reverse divergence is predicated on George Lane's bull and bear setups, or on the newer school of thought where reverse divergences are expected to represent a pure continuation of the current larger trend. Nevertheless, regardless of whichever it is based on, reverse divergence will, in the initial stage, still represent a continuation of the current larger trend under both approaches. With this in mind, a convergence of peaks and a divergence of troughs would, under this broader interpretation, be referred to as reverse bearish and reverse bullish divergence, respectively. 9.2.9 Directionally and non-directionally aligned slope divergence and convergence. Divergence and convergence may also be categorized according to how much the two data series are directionally aligned with each other at the current larger trend. See figures 9.17, 9.18, and 9.19. Note: under the broad interpretation, any and all non-conformation is regarded as divergent, and this therefore also includes any data series that are convergent on each other. As such, divergence is a consequence of both the main and supporting data series moving toward or away from each other. 282. Divergence analysis. Figure 9.17 Directionally aligned slope divergence and convergence. In Figure 9.17, we see that between timelines A and B, the slopes of the current larger trends of the main and supporting data series are moving away or diverging from each other. Subsequently, between timelines B and C, we see that the slopes of the current larger trends of the two data series are now moving toward or converging on each other. In Figure 9.18, we also see divergent and convergent action both occurring in the same general direction, but this time to the downside. In both cases, there is no Figure 9.18 Directionally aligned slope divergence and convergence. 283. 284. Figure 9.19 Non-directionally aligned divergence and convergence. Significant directional discrepancy, as the slopes of all data series are moving in the same general direction, namely either up or down, when diverging and converging at the current larger trend. They do not exhibit motion in opposing directions, based on the definition of direction given in section 9.1.2. In Figure 9.19, we observe the slopes of two data series diverging from each other between timelines A and B, and subsequently converging on each other between B and C. This time, however, significant directional discrepancy exists as the slopes of both data series are now moving in opposing directions, with one rising and the other declining when diverging and converging at the current larger trend. From these examples, we may conclude that, at the current larger trend, two data series may move away from, or toward each other, in the same general direction, giving rise to directionally aligned slope divergence and convergence, respectively. Two data series may move away from, or toward each other, in opposing directions, giving rise to non-directionally aligned slope divergence and convergence, respectively. Figures 9.17 to 9.19 depict general trends, where it is clear that successive peaks and troughs in each data series are moving in the same direction, regardless of whether there is divergence or convergence with some other data series. We already know that when attempting to determine direction for general trends, we may use conventional trend or multiple peak and trough analysis, that is, identifying successively higher peaks and troughs for uptrends and successively lower peaks and troughs for downtrends. The Handbook of Technical Analysis. Divergence analysis. Note: the use of peak-to-peak or trough-to-trough analysis to determine divergence is only applicable if we are looking for non-conformation between two adjacent peaks or troughs at the current larger trend. Consequently, if we are looking for divergence across multiple peaks and troughs, we must use conventional trend or slope analysis instead. This has significant implications in the determination of bullishness or bearishness in divergence analysis, as we shall see in the following section. September 2, 10 Slope analysis and slope divergence. Once it is determined that adjacent peak-to-peak or trough-to-trough analysis is not applicable, the practitioner may then resort to conventional trend analysis. When applying slope analysis, any disagreement between the slope in price and its supporting data series shall be referred to as slope divergence. The term slope divergence has also been employed by William Blau, in his book Momentum, Direction, and Divergence, to refer to divergence between a moving average and an oscillator. Though Blau uses the term in a more specific and proprietary fashion, we will use it to refer to any divergence, under the broad interpretation, that is identified by comparing slopes between data series that are formed by either multiple peaks and troughs trending in opposing directions, figure 9.7, price excursions devoid of any visible peaks and troughs, figure 9.8. We see that there is an overlap between slope analysis and conventional trend analysis when multiple peaks and troughs are observed, but slope analysis distinguishes itself from conventional when slopes are formed in the absence of peaks and troughs. Assuming that the oscillator or indicator in the supporting data series represents momentum, this would directly imply that a rising oscillator is potentially bullish for price and a declining oscillator is conversely bearish. Alternatively, under the narrow interpretation, this means that convergence between price and the oscillator always implies potential price bullishness, whereas divergence always implies potential price bearishness. We can therefore also refer to these, under the broad interpretation, as bullish or bearish slope divergence. As seen in section 9.1.3, there are only 6 combinations of divergence under the broad interpretation, and 3 more indicating non-divergence. As will be discussed later, this interpretation of slope divergence aligns perfectly with that of standard divergence analysis. Therefore, when encountering slope divergence, we can interpret it in the same manner as that of standard divergence in order to determine the bullish and bearish bias of any setup. Hence, bullish slope divergence may be regarded as standard bullish divergence and bearish slope divergence as standard bearish divergence. In most situations, peaks and troughs are clearly visible on the charts, making the identification of bullish or bearish divergence a fairly simple task. However, there may be occasions when the peaks and troughs are not obvious on a chart. 285. The Handbook of Technical Analysis. Especially when the path of the data series approximates a straight line. This is a common occurrence when viewing data on higher time frames, which tends to filter out the lower wave cycles, or when data trends strongly with little or no retracement during the trend. Also, divergence between the data series at a lower wave degree does not necessarily indicate divergence at a higher wave degree, though it may signal a potential directional change. This means that we must exclude reverse divergence setups when applying slope analysis. Reverse divergence analysis in the absence of visible peaks and troughs would introduce interpretational ambiguity. Referring to figure 9.20, we observe trends with no visually apparent peak and trough oscillations. As a result, standard divergence analysis is applied, giving us only 2 possible outcomes, namely either standard bearish or standard bullish divergence. Figure 9.21 shows the 6 possible combinations for standard divergence in the absence of peaks and troughs. They are identical to those found in figure 9.3 in boxes 2, 3, 6, 13, 16, and 17, as well as boxes in figure 9.28 that coincide with standard divergence based on adjacent peak-to-peak and trough-to-trough analysis. Figure 9.20 slope divergence as standard divergence in trends without peak and trough oscillations. Note: when peak and trough analysis is not available or possible, we treat and interpret the directional discrepancy as standard divergence, where diverging data series is bearish and converging data series is bullish for the main data series. 286. Divergence analysis. Figure 9.21 standard slope divergence in the absence of peaks and troughs. In figure 9.22, we observe peak and trough oscillations at a lower wave degree giving rise to a trend at a higher wave degree, that is, the current larger trend. If the current larger trend itself does not also oscillate, then it will not be possible to employ peak and trough analysis to the next larger trend in order to determine its direction. Furthermore, performing peak and trough analysis on the lower wave degree oscillations will not accurately describe the action of the next larger trend. Therefore, slope analysis is employed to determine the direction of the next larger trend. Figure 9.22 The larger trend is devoid of peaks or troughs. 287. 288. September 2, 11 degree of confirmation and non-confirmation in slope divergence. It should be obvious that under the broader definition and interpretation of divergence, both directionally aligned divergence and convergence are not considered divergent, since the slopes of the 2 data series are not in disagreement, that is, pointing in opposing directions. Does this mean that directionally aligned divergences and convergence represent confirmation? It would be fairly reasonable to assume that divergent and convergent behaviors have different implications and that they both cannot imply a continuation of the current larger trend. Only one would be biased toward the continuation of the current larger trend while the other would be biased toward a weakening or reversal of that same trend. The best way to reconcile this incongruity is to resort to a relative measure, that is, by analyzing the degree of disagreement between the slopes of the data series. In figure 9.23, we see the slopes of two data series trending to the upside. Although the slopes of both data series are generally moving upward and not in opposing directions, they are nonetheless not rising at similar or identical rates. Each data series is rising at a different rate, evinced by the angle of ascent. As long as the supporting data series is rising at a lower rate than the main data series in an uptrend, or falling at a higher rate than the main data series in a downtrend, we have directionally aligned slope divergence. See figure 9.24. As price rises, once the slope of the supporting data series falls to the horizontal and below, we have non-directionally aligned divergence. Similarly, in a downtrend, once the slope of the supporting data series rises to the horizontal and above, we have non-directionally aligned convergence. The broad definition of divergence only applies to non-directionally aligned divergence and convergence. See figures 9.25 and 9.26. As we have seen, the various degrees of confirmation and non-confirmation between the data series increases and diminishes with the amount of agreement. Figure 9.23 Varying degrees of directionally aligned slope divergence in an uptrend. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.24 Varying degrees of directionally aligned slope divergence in a downtrend. Between the data series. When dealing with non-directionally aligned divergence, non-confirmation is represented by significantly clear and obvious disagreement. But with directionally aligned divergence, as seen in figure 9.25, non-confirmation is technically absent as rising peaks and troughs in price are matched with rising peaks and troughs in the supporting data series, and similarly for declining peaks and troughs in a downtrend. The only distinguishing factor is the strength or degree of agreement present. A strong positive correlation between the slopes of the two data series implies a greater degree of confirmation. Figure 9.25 Increasing degrees of non-confirmation and divergence. 289. The Handbook of Technical Analysis. Figure 9.26 Increasing degrees of non-confirmation and convergence. The degree of non-confirmation may therefore be represented by the amount of divergence or convergence present between the data series. The larger the amount of directionally aligned divergence or convergence between the data series, the greater the degree of disagreement and its potential impact on price. A steeper slope or angle of ascent in the supporting data series is more bullish for price, and vice versa. Consequently, the greater the degree of divergence between the data series, the more bearish it is for price. The greater the degree of convergence between the data series, the more bullish it will potentially be for price. In conclusion, if confirmation and non-confirmation are treated as relative measures of agreement and disagreement, then it will be possible to attribute directionally aligned divergence and convergence with a sense and degree of bullish and bearish bias. Therefore, in conclusion, data series trending in the same general direction may still impact price in a bullish or bearish manner, by the degree of disagreement or disparity between the slopes of the data series. The data series do not need to move in opposite directions in order to impact price. Note: in non-directionally aligned divergence, disagreement is either present or not, whereas in directionally aligned divergence, disagreement and consequently non-confirmation is measured by degrees. 290. Divergence Analysis. 9.3 Standard and Reverse Divergence. With greater clarity on reversals, continuations, and the various approaches to defining trend and direction, we are now ready to deal with the topic of standard and reverse divergence. Standard divergence is also referred to as classic, common, regular, or reversal divergence, whereas reverse divergence is popularly referred to as hidden, inverted, trend, or continuation divergence. George Lane used reverse divergence as part of his bull and bear setups. Unfortunately, there is still a fair amount of definitional confusion in technical analysis, especially when dealing with reverse divergence, as there seems to be two distinct schools of thought on the matter. It is important to remember that standard and reverse divergence are regarded as non-directionally aligned divergence and are interpreted under the broader definition. Standard and reverse divergence refer specifically to non-conformation in the current larger trend. When determining the nature and type of the divergence involved, we must account for the wave degree at which the divergence is being observed or identified approach used when applying reverse divergence type of analysis used to determine divergence, i.e., slope, adjacent peak/trough, or conventional peak and trough trend analysis. In general terms, standard divergence occurs when only price, and not the supporting data series, is making equal or higher peaks, based on adjacent peak-to-peak analysis. Only price, and not the supporting data series, is making equal or lower troughs, based on adjacent trough-to-trough analysis. There is a non-directionally aligned discrepancy between the slopes in price and the supporting data series. More specifically, standard divergence consists of any of the following 12 setups. 1. Price is making higher peaks while the oscillator is making lower peaks. 2. Price is making higher peaks while the oscillator is making equal peaks. 3. Price is making equal peaks while the oscillator is making lower peaks. 4. Price is making lower troughs while the oscillator is making higher troughs. 5. Price is making lower troughs while the oscillator is making equal troughs. 6. Price is making equal troughs while the oscillator is making higher troughs. 7. Price slope is rising while the oscillator slope is flat. 8. Price slope is rising while the oscillator slope is falling. 9. Price slope is flat while the oscillator slope is falling. 10. Price slope is flat while the oscillator slope is rising. 11. Price slope is falling while the oscillator slope is flat. 12. Price slope is falling while the oscillator slope is rising. 291. 292. Figure 9.27 Non-divergence at the current larger trend using adjacent peak-to-peak and trough-to-trough analysis. In general terms, basic reverse divergence occurs when only price, and not the supporting data series, is making equal or lower peaks, based on adjacent peak-to-peak analysis. Only price, and not the supporting data series, is making equal or higher troughs, based on adjacent trough-to-trough analysis. More specifically, basic reverse divergence consists of any of the following 6 setups. 1. The oscillator is making lower troughs while price is making higher troughs. 2. The oscillator is making lower troughs while price is making equal troughs. 3. The oscillator is making equal troughs while price is making higher troughs. 4. The oscillator is making higher peaks while price is making lower peaks. 5. The oscillator is making higher peaks while price is making equal peaks. 6. The oscillator is making equal peaks while price is making lower peaks. Remember that slope and reverse divergence are mutually exclusive and that slope divergence is treated and interpreted in a similar manner to standard divergence. There are 6 out of 18 possible combinations where successive peaks and troughs between the two data series are pointing in the same direction, indicating non-divergence in the current larger trend. See Figure 9.27. The remaining 12 consist of 6 combinations each, for standard and reverse divergence, where the successive peaks and troughs between the two data series are pointing in different directions, as illustrated in figures 9.28 and 9.29, respectively. 9.3.1 Bullish and bearish divergence. Before delving any further, let us first turn our attention to the directional implications of divergence. Divergence may be categorized as either bullish or bearish, sometimes also referred to as positive or negative, respectively. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.28 Representations of standard divergence at the current larger trend using adjacent peak-to-peak and trough-to-trough analysis. It is imperative to realize that price is expected to subsequently follow through in the direction of the supporting data series at the next higher wave degree when applying standard divergence analysis. Therefore, if the supporting data series is moving to the upside, price is also expected to eventually move to the upside, and we say that we have bullish divergence. Conversely, if the supporting data series is moving to the downside, price is expected to eventually move to the downside, and we say that we have bearish divergence. It is assumed that the supporting data series is reflecting the underlying strength, with increasing momentum, or weakness, with diminishing momentum, in price. Regardless of its current direction, price is expected to eventually converge on the supporting data series. This is the reason why some practitioners also call this bullish convergence, adding to the confusion. What these practitioners are actually doing is applying the narrow definition of divergence. Under the narrow definition, bullish non-confirmation is referred to as bullish convergence. Additionally, bearish non-confirmation is referred to as bearish convergence under reverse divergence analysis. Figure 9.29 representations of reverse divergence at the current larger trend using adjacent peak-to-peak and trough-to-trough analysis. 293. The Handbook of Technical Analysis. Note: bullish and bearish divergence are determined solely from the directional relationship between peaks and troughs, or slope, at the observed wave degree between the two data series, irrespective of the direction of the trend at the next higher wave degree. Bullish, or positive, divergence implies that price will either reverse to the upside, continue rising to the upside. Bearish, or negative, divergence implies that price will either reverse to the downside, continue declining to the downside. With respect to reverse divergence, price is expected to continue in the direction of its current larger trend, moving in the opposite direction to that of the supporting data series. Unfortunately, there are two approaches in reverse divergence with contrary outcomes. In either case, if the supporting data series is moving to the upside, price is expected to move to the downside, and we say that we have reverse bearish divergence. Conversely, if the supporting data series is moving to the downside, price is expected to move to the upside, and we say that we have reverse bullish divergence. It is customary in technical analysis to assume that the supporting data series is reflecting the underlying strength or weakness in price. Regardless of its current direction, price is expected to eventually converge on the supporting data series in George Lane's bull and bear setups. 9.3.2 Defining standard bullish and bearish divergence. Accordingly, standard divergence may now be associated with either a bullish or bearish bias, as follows. Standard bearish divergence occurs when only price, and not the supporting data series, is making equal or higher peaks, or when the slopes between the two data series are diverging. Standard bullish divergence occurs when only price, and not the supporting data series, is making equal or lower troughs, or when the slopes between the two data series are converging. See illustrations 2, 3, 6, 13, 16, and 17 in figures 9.43 and 9.44. Standard bearish divergence indicates a potential reversal to the downside of the current larger trend as observed at the point of non-confirmation, seen in 294. Divergence analysis. Figure 9.30 Standard bearish divergence via adjacent peak-to-peak analysis. Figure 9.30. Falling peaks in the supporting data series indicate diminishing M momentum, which is potentially bearish for price. Figure 9.31 illustrates standard bullish divergence where a potential reversal to the upside current larger trend is observed at the point of non-confirmation. Rising troughs in the supporting data series indicate strengthening momentum, which is bullish for price. Price is expected to reverse and subsequently move in the direction of the supporting data series in both standard bullish and bearish divergences. Examples given in figures 9.30 and 9.31 expand on illustration 3 in figure 9.43 and illustration 16 in figure 9.44, respectively. Figure 9.32 is a chart of price and its moving average convergence divergence, MACD, indicator displaying standard bullish and bearish divergence. Also, Figure 9.31 Standard bullish divergence via adjacent trough-to-trough analysis. 295. 296. Figure 9.32 Standard Bullish and Bearish Divergence. Source, MetaTrader 4. Included are the price confirmation levels where the breakout of a prior support or resistance level confirms bullish or bearish divergence setup and provides a price trigger for participatory action. Though divergent setups are normally traded at the breakout of some price barrier, more experienced traders sometimes also employ standard divergence to help them initiate counter-trend entries like buying on the dips or selling into the rallies. The use of various price barriers and indicator overlays, which include previous supports and resistances, trend lines, price channels, popular moving averages, and various volatility bands, may be used to help identify potential supportive and resistive confluences where buy and sell limit entry orders may be placed for a counter-trend entry, with stop losses positioned slightly beyond the confluence zones. Time projections of cyclic highs and lows, apex reaction timelines, and Gann's squaring of time technique may also be used to pinpoint potential reversals at the projected price barriers. Counter-trend trades are far more insidious and difficult to initiate, as the entries must be made during the nascent and less obvious stages of divergence where the art of anticipating potential entries is more difficult to master. Breakouts from divergent setups are significantly easier to identify and trade. Another way to take advantage of buying dips and selling rallies when divergence is identified at the current larger trend is to initiate breakout trades at a lower wave degree, where entries based on price confirmation are more easily achieved. We shall see some examples of this shortly. Logically speaking, comparing peaks in a rising market and troughs in a falling market makes sense as market participants are psychologically more inclined to focus on new highs in a rising market and conversely on new lows in a falling market in order to make important trading and investment decisions, and it is for the Handbook of Technical Analysis. Divergence analysis. This reason that it is referred to as standard divergence. However, reverse divergence involves comparing peaks in a falling market and troughs in a rising market and may be somewhat counterintuitive. 9.3.3 Defining reverse bullish and bearish divergence. The case for reverse divergence is not as straightforward, as there are two distinct approaches, one predicated on George Lane's bull and bear setups and a more contemporary approach that anticipates a contrary outcome. Reverse divergence normally suggests a potential continuation of the current trend at one higher wave degree, simply referred to as the current larger trend. In George Lane's bull and bear setups, this continuation is expected to be short-lived as price is expected to resume its original trend at the second higher wave degree. Traders frequently employ reverse divergence to help identify tradable breakouts, as well as tops or bottoms if employing bull or bear setups. The main difference between the two approaches is fairly easy to identify and may well serve as a guide when in doubt. 1. The first approach requires a continuation of the current larger trend, with traders looking for an upside or downside breakout in price. For the sake of clarity and convenience, we shall refer to divergences associated with this contemporary approach simply as reverse bullish or reverse bearish divergence. Price moves in opposition to the direction indicated by the supporting data series at the point of non-confirmation in the current larger trend. 2. The second approach also requires a similar initial continuation of the current larger trend, but this is expected to be eventually followed by a reversal, with traders usually looking to enter the market at tops or bottoms formed by this reversal. We shall henceforth use the same terms that George Lane originally attributed to this type of divergence, namely as bull and bear setups. Price eventually follows in the direction indicated by the supporting data series at the point of non-confirmation. It is important to bear in mind that, when analyzing the market via slope divergence, neither approach to reverse divergence applies anymore, and the setup is interpreted using standard divergence. In short, reverse divergence only exists when adjacent peak-to-peak or trough-to-trough analysis is used. Therefore, there are no chart examples of reverse divergence based on conventional trend or slope analysis. Reverse divergence, in terms of bullish or bearish bias, may be reclassified into 4 distinct categories, to accommodate both approaches, as follows. 1. Bull setups occur when only price, and not the supporting data series, is making equal or lower peaks. Price is expected to initially reverse, making lower peaks and troughs until a bottom is formed, followed by a subsequent reversal to the upside, making higher peaks and troughs, representing an uptrend at the next higher wave degree. The rationale behind the bearishness is 297. 298. Figure 9.33 reverse divergence seen in the early stages of a bull setup. Follows, rising peaks in the supporting data series indicate increasing momentum, which reflects underlying strength in price, and therefore are potentially bullish for price. See figure 9.33. The divergence setup itself includes both the non-confirmation as well as the anticipated long entry signal. Figure 9.34 shows a bull setup between points A and B on FXI, iShares FTSE China 25 Index Fund, NYSE. We see price continuing its downtrend, as expected after a reverse divergence setup. A reversal is anticipated in a bull setup and channel projection analysis identified a potential bottom in the index. Figure 9.34 a bull setup on FXI. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Divergence Analysis. Fund. Price confirmation of the setup is seen at point C, where price violates a couple of price barriers in the form of a downtrend line TL1 and 10-day SIM PLE moving average. The trader looks to initiate a long position at the break of either price barrier, as the current larger trend is expected to reverse to the upside. We also see the stochastics in an overbought position prior to price confirmation, which is bullish for the fund. A more aggressive entry would be one where a trader initiates a long position at the break of the high at point D of the lowest bullish candlestick, in proximity to the area where channel projection anticipates a bottom. The initial stop losses are positioned just below the low of the lowest candlestick, for all entries. With respect to wave degrees, it should be noted that if the prior larger trend was originally to the upside, then this bull setup is expected to eventually resume the original prior larger trend. In figure 9.35, we see the current larger trend reverse twice in a bull setup at points 1 and 2 after penetrating the lower trough and higher peak respectively, establishing a continuation of not only the prior larger trend, but also of the trend that is one wave degree higher than the subsequent larger trend, referred to in figure 9.35 as the second higher wave degree. Reverse bearish divergence also occurs when only price, and not the supporting data series, is making equal or lower peaks. But in this case, price is expected to continue to make lower peaks and troughs, establishing the subsequent downtrend at the next higher wave degree. The underlying rationale for bearishness is as follows: although rising peaks in the supporting data series indicate increasing momentum, price still fails to rise above its previous peak, which is potentially bearish for price. Any astute reader will immediately realize that this will lead to definitional inconsistencies when the same rationale is applied to standard divergence. This apparent contradiction will be dealt with shortly. This type of divergence may also be likened to a failed bull setup, although trying to determine how much of a downside price excursion is required in order to invalidate the setup is subjective at best. Price moves. Figure 9.35 bull setup as continuation at the second higher wave degree. 299. 300. Figure 9.36 reverse bearish divergence. In opposition to the direction indicated by the supporting data series at non-confirmation. See figure 9.36. In figure 9.37, we identify a reverse bearish divergence setup between points A and B on United States Natural Gas Fund, NYSE. The current larger trend is expected to continue to the downside, in an already declining market. The setup is confirmed once price penetrates the prior support at point 1. Traders will normally initiate short positions around the breakout with stop losses located just above the highest point at B, trailing price all the way down until the stop is taken out. Shorts may also be entered at the retest of the prior support, now turned resistance. In this example, we see 3. Figure 9.37 reverse bearish divergence on courtesy of stockcharts.com. The Handbook of Technical Analysis. Divergence Analysis. Fairly correlated oscillators, that is, the Relative Strength Index, RSI, MACD, and Commodity Channel Index, CCI, accompanying price, rendering the AP parent agreement between them somewhat less credible, with the potential of misleading the trader or analyst into a false sense of confidence. Since all are constructed around price, these oscillators tend to give similar signals much of the time. We say that the oscillators are collinear. It is best to choose oscillators and indicators that provide a greater degree of independent signaling. If a longer-term trend was originally to the downside prior to the divergence setup, then this bearish setup is expected to lead to the resumption of that original prior larger trend, recognized also as a continuation at the second higher wave degree. In Figure 9.38, we see the price continuation violating point 1, which confirms the subsequent larger downtrend, and in the process establishing a downside continuation of a trend at the second higher wave degree, that is, 1 wave degree higher than the subsequent larger trend. 3 bear setups occurs when only price, and not the supporting data series, is making equal or higher troughs. Price is expected to initially continue to make high ER troughs and peaks until a top is formed, thereafter reversing to resume the subsequent downtrend at the next higher wave degree. The rationale behind the bearishness is as follows: falling troughs in the supporting data series indicate diminishing momentum, which reflects underlying weakness in price, and therefore is potentially bearish for price. Price eventually follows through in the direction indicated by the supporting data series at non-confirmation after a short upside continuation of the current larger trend. See Figure 9.39. In Figure 9.40, we see a bear setup between points A and B on IYT, iShares DJ Transportation Average Index Fund, NYSE. Using channel projection techniques based on trendline TL1, we identify a potential top in the market, after which price confirmation of the bear setup in the form of either the violation of the uptrend line TL2 at point F or 20-day exponential moving average. Figure 9.38 reverse bearish divergence as continuation at second higher wave degree. 301. 302. Figure 9.39 reverse divergence seen in the early stages of a bear setup. At point E is anticipated. Traders would normally initiate a short position at either point E or point F, with all stops positioned just above the highest high of the formation preceding the breakouts. We also see standard bearish divergence on the MACD and its histogram between points C and D, which is bearish for the fund. Once price retests TL1 after the breakout, many trad ERS would have already executed either a full exit or partial scale out of short positions, with most protective stop losses rolled down in a defensive move to lock in earlier profits. Figure 9.40 a bear setup on IYT. Courtesy of StockCharts.com. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.41 reverse bullish divergence. For reverse bullish divergence also occurs when only price, and not the supporting data series, is making equal or higher troughs. But in this case, price is expected to continue to make higher peaks and troughs, establishing the subsequent uptrend at the next higher wave degree. This type of divergence may also be likened to a failed bear setup. The underlying rationale for bullishness is as follows: although falling troughs in the supporting data series indicate diminishing momentum, price still fails to penetrate below its previous trough, which is potentially bullish for price. As in all reverse divergences, price moves in opposition to the direction indicated by the supporting data series at non-confirmation. See Figure 9.41. In Figure 9.42, we observe that there is a reverse bullish divergence setup between points A and B, as well as on a higher wave degree between points B and C. This double divergence on Pfizer Incorporated is regarded as more bullish than if it is accompanied by simple divergence. We see agreement between the MACD and Chaikin Money Flow, CMF, Oscillators. This is a much better combination of oscillators than that observed in Figure 9.37, as the degree of collinearity between the MACD and CMF is significantly less. This is largely because the CMF oscillator takes into account volume information, and not just that of price alone. The current larger trend is expected to continue to the upside, with further price excursion being potentially precipitated by a penetration of either the prior resistance or 2 zero-day simple moving average, indicated by price confirmation points 1 and 2, respectively. Traders will normally attempt to trade the breakout around the prior resistance and moving average. Further bullish signals prior to breakout include the CMF turning positive and the MACD signaling a bullish crossover with its signal line. This dual interpretation of reverse divergence is summarized in illustrations 4, 7, 8, 11, 12, and 15, in figures 9.43 and 9.44. 303. 304. Figure 9.42 Reverse bullish, double, divergence on Pfizer Incorporated, NYSE. Courtesy of stockcharts.com. Figures 9.45 to 9.47 are chart examples of various standard and reverse divergences in action. In Figure 9.46, a series of consistent cyclic lows is identified on 3M stock. Standard bullish divergence can be found between points 1 and 2, while standard bearish divergence can be found between points 5 and 4, as well as between. Figure 9.43 Bullish and bearish, standard and reverse, divergence part 1. The Handbook of Technical Analysis. Divergence analysis. Figure 9.44 Bullish and bearish, standard and reverse, divergence part 2. Points 4 and 6. Reverse bearish divergence is seen between points 3 and 4, while reverse bullish divergence is seen between points 7 and 8, as well as between points 8 and 9. A few instances of agreement between the oscillators can be observed between points 1 and 2, as well as between points 7 and 8. The Doble divergence arising from the alignment of the MACD and CMF oscillators between points 1 and 2 gave rise to a significant pullback in price from around. Figure 9.45 The 4 standard and reverse divergences in action. Source, MetaTrader 4. 305. 306. Figure 9.46 Combining standard and reverse divergences with cycle projections. Courtesy of stockcharts.com. $66, which incidentally also coincided with the projected cyclic low near point 2. Integrating time and price projections is normally assumed to yield a more reliable analysis. In Figure 9.47, we see alternating standard and reverse divergent signals between the Dow Jones Industrial and Transportation averages. Figure 9.47 Divergences between the Dow Jones Industrial and Dow Jones Transportation averages. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Divergence Analysis. 9.3.4 The Divergence Master Heuristic. We can summarize the expected or potential follow-through action in the main data series as follows. If successive adjacent peaks in both the main and supporting data series are pointing in different directions, we expect price in the main data series to be bearish and subsequently fall in price, and if successive adjacent troughs in both the main and supporting data series are pointing in different directions, we expect price in the main data series to be bullish and subsequently rise in price. This simple but powerful rule of thumb makes isolating and identifying bullish and bearish divergences an almost effortless task. This heuristic is applicable to both standard divergence and the contemporary approach to reverse divergence analysis. However, keep in mind that this heuristic only applies to the initial stage of a bull and bear setup where a short-term continuation of the current larger trend is also expected before an eventual reversal. 9.3.5 Standard and reverse divergence as continuation and reversal at higher wave degrees. Continuation and reversal may exist at a certain wave degree but not at another. As we have already seen, a reversal at one wave degree may represent continuation at a higher wave degree, which in turn could easily represent a reversal at an even higher wave degree. This leads us logically to the relationship between divergent setups and various wave degrees. In the following illustrations, we shall observe standard divergence leading to a reversal of the prior larger trend, while reverse divergence is being followed by a continuation of the prior larger trend. See figures 9.48 to 9.51. Figure 9.48 standard bearish divergence leading to reversal of the current and prior larger trends. 307. 308. Figure 9.49 standard bullish divergence leading to reversal of the current and prior larger trends. Figure 9.50 reverse bearish divergence leading to continuation of the current and prior larger trends. Figure 9.51 reverse bullish divergence leading to continuation of the current and prior larger trends. The Handbook of Technical Analysis. Divergence Analysis. In figures 9.52 to 9.55, we now instead observe standard divergence leading to a continuation of the current prior trend, whereas reverse divergence is being followed by a reversal of the prior larger trend. Therefore, we must be extremely careful when employing terms like continuation and reversal in divergence analysis without first specifying which wave degree or trend is being observed. Figure 9.52 standard bearish divergence leading to reversal of the current and continuation of the prior larger trend. Figure 9.53 standard bullish divergence leading to reversal of the current and continuation of the prior larger trend. 309. 310. Figure 9.54 reverse bearish divergence leading to continuation of the current and reversal of the prior larger trend. Figure 9.55 reverse bullish divergence leading to continuation of the current and reversal of the prior larger trend. 9.3.6 Rationale underlying contemporary reverse divergence, the momentum principle, overreaction, overbought/oversold, chronology, and contrarianism. There is no real definitional conflict between the rationale underlying standard divergence and bull/bear setups. This is because in both types of divergences, price is expected to follow through in the direction of the supporting data series as indicated at the point of non-confirmation. Therefore, with bull and bear setups, any continuation of the current larger trend is regarded as merely temporary and may be understood to represent some short-lived expression of overreaction in the Handbook of Technical Analysis. Divergence Analysis. The markets which would eventually precipitate a reversal. This makes sense since the supporting data series is regarded as representative of the potential underlying momentum in price. We may refer to this as the momentum principle. However, this is not the case with the contemporary approach to reverse divergence, where price is expected to move in the opposite direction to the supporting data series, that is, against the natural flow of the underlying momentum. So far, we have managed to reconcile standard divergence with the bull and bear setups by combining the momentum principle and short-term overreaction in the markets. Unfortunately, if reverse divergence is explained using the momentum principle, we very rapidly run into difficulty. Numerous attempts have been made to reconcile and make some sense of reverse divergence, with the most popular introducing a chronological element in order to obviate definitional inconsistencies. Unfortunately, it does very little to explain why divergence should be read one way for standard and another for reverse divergence. Briefly, the chronological approach states that standard divergence should be viewed prospectively whereas reverse divergence is best viewed retrospectively. In simple terms, it means that standard divergence is regarded as forward-looking and predictive, whereas reverse divergence is but a record of what has transpired. We shall now examine the definitional inconsistencies that arise when using the chronological approach to explain standard divergence. Let us first apply the chronological approach to reverse divergence, where it seems to explain why continuation of the current larger trend occurs. In reverse bullish divergence, troughs continue to rise in the main data series, showing strength in spite of falling troughs in the supporting data series that should indicate some underlying weakness in the main data series. This is therefore bullish for price and the current larger trend is expected to continue to rise. In reverse bearish divergence, peaks continue to fall in the main data series, showing weakness in spite of rising peaks in the supporting data series that should indicate some underlying strength in the main data series. This is therefore bearish for price and the current larger trend is expected to continue to decline. Before applying the chronological approach to explain standard divergence, let us first apply the momentum principle to standard divergence. In standard bullish divergence, falling troughs in the main data series show weakness, whereas rising troughs in the supporting data series indicate the possibility of some underlying strength or gain in momentum in the main data series. This is potentially bullish for price and the current larger trend is expected to subsequently reverse to the upside. In standard bearish divergence, rising peaks in the main data series show strength, whereas falling peaks in the supporting data series indicate the possibility of some underlying weakness or loss in momentum in the main data series. This is potentially bearish and the current larger trend is expected to subsequently reverse to the downside. 311. 312. As we already know, the momentum principle lends itself naturally to standard divergence, as does the chronological approach to reverse divergence. Now if we apply the chronological approach to standard divergence, we run into the following inconsistencies. 1. In standard bullish divergence, troughs continue to fall in the main data series, showing weakness in spite of rising troughs in the supporting data series that should indicate some underlying strength in the main data series. This is therefore bearish for price and the current larger trend is expected to continue to decline. 2. In standard bearish divergence, peaks continue to rise in the main data series, showing strength in spite of falling peaks in the supporting data series that should indicate some underlying weakness in the main data series. This is therefore bullish for price and the current larger trend is expected to continue to rise. As we can clearly observe above, explanation 1 is wholly inconsistent and contradicts what is expected of standard bullish divergence, and explanation 2 is similarly inconsistent and contradicts what is expected of standard bearish divergence. Therefore, if we accept the chronological explanation for standard divergence, this will introduce serious ambiguity as it yields a diametrically opposed forecast to that indicated when applying the momentum principle. Another approach we can adopt in order to explain reverse divergence would be to assume that it is representative of some form of contrarian behavior. This implies that market participants are willing to take a trade contrary to the evidence available with the belief that following the herd is ultimately unprofitable. But this line of reasoning also eventually leads to some inconsistency, especially if applied to standard divergence. In fact, such a contrarian would go long when encountering standard bearish divergence and short on standard bullish divergences. In effect, the conclusions reached using a contrarian approach are similar to those of the chronological approach, whereby traders long standard bearish divergences and short standard bullish divergences. For all practical purposes, the chronological and contrarian approaches are functionally identical. A better explanation may be had by considering overbought and oversold levels. Some practitioners refer to overbought and oversold levels in the supporting data series as an explanation for subsequent price moves during reverse divergence. For example, it is argued that in the case of bearish reverse divergence, prices are expected to continue to fall as the indicator is already at or approaching overbought levels. Similarly, with bullish reverse divergence, prices are expected to continue to rise as the indicator is already at or approaching oversold levels. This is by far the most logical and reasonable explanation for the continuation of price in reverse divergence scenarios. The distinction between a setup being one of reverse divergence or a bull and bear setup is also of great concern, since both types of divergences start out as a continuation of the current larger trend. How does one distinguish between the two setups? At which point does a reversal of the continuation represent part of a bull/bear setup, and how can we distinguish this reversal from the one that would inevitably occur in a reverse divergence setup? In other words, at which point does the Handbook of Technical Analysis Divergence analysis. A bull or bear setup actually fail. Though it may be somewhat difficult to resolve this conceptually, on the practical side, the trader could easily employ a bidirectional approach such as initiating a straddle breakout around the price level where a reversal is expected in a bull/bear setup. Should the reversal entry fail, the trader would subsequently re-enter in the opposite direction, expecting further continuation. Of course, the only downside in any bidirectional entry mechanism is the unfavorable buildup of oscillational losses across the straddle. So in summary, the overbought/oversold rationale is probably the best explanation for price continuation during reverse divergence. The momentum principle only works to explain standard divergence, but cannot account in any way whatsoever for reverse divergence, while the chronological and contrarian approach works well to explain reverse divergence. This unfortunately begs the question of why we should not apply the chronological or contrarian approach to standard divergence as well. Maybe the real answer lies in the level of popularity of certain approaches. Applications of technical analysis evolve over time, and if there is sufficient interest in a particular approach or technique, it may ignite a self-fulfilling prophecy whereby traders and investors start to trade in accordance with the new interpretation, influencing market and price action. Furthermore, for every interpretation, there will exist an equal and opposite proposition. Therefore, only through continuous market observation and constant forward testing will it be possible to determine the most reliable approach in the market. 9.3.7 Double divergence. Divergence can be simple, double, or even complex. There are numerous representations of double divergence. Generally speaking, double divergence is considered stronger evidence for a potential reversal or continuance of the current trend. Let us now examine a few different representations of double divergence. What follows are 4 basic classifications of double divergence, and these are by no means exhaustive. 9.3.7.1 Contiguous peak-to-peak and trough-to-trough divergence. This type of double divergence is characterized by having 2 contiguous or successive divergent setups that are of the same type. Some practitioners refer to 3 or more such successive divergent setups as multiple divergence. See Figure 9.56. 9.3.7.2 Inter-peak or trough double divergence. This type of double divergence is characterized by having one divergent setup contained within a larger divergent setup where both divergences are of the same kind, which therefore reinforces its bullish or bearish signal. This type of double divergence is not commonly found in the markets. Figures 9.57 to 9.60 illustrate the 4 double divergence setups. In all the following illustrations, point C is the focal or pivot point of both the smaller and larger divergent setups. Figures 9.59 and 9.60 may also refer to bear and bull setups, respectively. 9.3.7.3 Interwave cycle/degree divergence. This type of double divergence is characterized by having one of 2 divergent setups formed at a higher wave. 313. 314. Figure 9.56 Standard bullish double divergence on BlackBerry. Courtesy of StockCharts.com. Figure 9.57 Standard bearish double divergence, inter-peak. The Handbook of Technical Analysis. Divergence analysis. Figure 9.58. Figure 9.59. Figure 9.60. Standard bullish double divergence, inter-trough. Reverse bullish double divergence, inter-trough. Reverse bearish double divergence, inter-peak. 315. 316. Figure 9.61 Interwave cycle divergence of similar type. Degree. It is not necessary that both divergences be bullish or bearish, nor do they need to be of the same type, but any alignment between the 2 setups would potentially reinforce the signal. Figure 9.61 illustrates an interwave cycle divergence with similar divergent setups, whereas Figure 9.62 shows a chart of FXE currency shares Euro Trust, NYSE, with interwave cycle divergence comprising dissimilar divergent setups, that is, reverse and standard bullish divergence. Figure 9.62 Inter-wave cycle divergence on FXE. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Divergence Analysis. 9.3.7.4 Inter-oscillator double divergence. Besides the MACD divergence seen in Figure 9.62, we also observe its histogram displaying similar divergences, which in itself is another form of double divergence. Many practitioners look for this combination of double MACD divergence for a potentially more reliable signal. 9.3.8 Multiple divergence. Any chart comprising two or more divergent setups is normally referred to as a multiple divergence setup. Multiple divergence is also sometimes loosely referred to as complex divergence, but this may not always be appropriate. Having numerous overlapping or alternating divergent setups may indeed be seen as complex. However, complex divergences, in their simplest forms, may be represented by a simple divergence between two oscillators in the supporting data series that are at different phases to each other. 9.3.9 Complex divergence. Complex divergence may be represented by any of the following. Triple or multiple divergences. Phase-based divergences between oscillators. Extensive overlapping or alternating divergent setups. We shall see numerous examples of these complex divergences throughout the rest of this chapter and handbook. September 3, 10 detrending and double detrending, inter-moving average divergence. Detrending allows the trader and analyst to isolate and quantify the difference between two data series by removing the trend component from the data. The most well-known example of detrending is the MACD, which is constructed by detrending two exponential moving averages, EMA, of 12 and 26 periods. The MACD therefore isolates the spread or difference in price at every point along the two moving averages. Whenever the two moving averages converge on each other, the value of the MACD declines, approaching a minimum value of 0 at the point where the two moving averages meet. Conversely, any divergence between the two moving averages increases its value, positively for upside divergences and negatively for downside divergences between the two moving averages. The greater the divergence between the moving averages, the farther away the MACD will move from its central or zero equilibrium value. Divergence between the two moving averages represents confirmation of the upside or downside trend and therefore implies a continuation, whereas convergence suggests a weakening of the current trend and therefore implies a reversal. Note: the convergence of two moving averages indicates a slowing of the trend, whereas divergence indicates a strengthening of the trend. 317. 318. As the MACD rises and falls, peaks and troughs will form, allowing for further divergence analysis between the MACD and price itself. Detrending can also take place between the MACD and its own signal line, thus creating the MACD histogram. The histogram therefore represents a quantitative measure of the amount or degree of divergence between the MACD and its own signal line. Since the MACD itself is a product of detrending two moving averages, it follows that the histogram represents a double detrended oscillator. Finally, one advantageous property of detrending is that it removes or reduces lag, or latency, in the original oscillator, and as a result, the detrended oscillator responds more rapidly to price fluctuations. Double detrending creates an even more responsive oscillator. This is particularly useful when attempting to analyze divergences at the lower wave degrees. In Figure 9.63, we see the MACD indicator quantifying the difference in value between the 12 and 26-day EMAs. For example, at point X, the difference in value between the two moving averages is found to be 20 cents. Upon tracing a vertical line between those 2 points on the moving averages, we see that it intersects the MACD at the expected value of 20 cents, indicating that the MACD is indeed representative of the amount of convergence and divergence between the two moving averages and not merely a qualitative tool. Notice that the trend component associated with the moving averages is absent from the MACD. In the same manner, the histogram quantifies the difference between the MACD and its own signal line. In general, we observe that every time the MACD moves away from the zero or equilibrium level, we see a trend in effect. Every time the two moving averages diverge, a strong trend is present, and when they converge, we notice a slowing of the trend. Figure 9.63 Creating divergence from detrending. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Divergence analysis. Every time the two moving averages meet, the MACD has a value of 0, that is, it will be at the 0 level, see vertical lines I to V. Every time the MACD and its signal line meet, the histogram has a value of 0, see sample points A to D. The histogram reacts faster than the MACD, identifying divergences at a low ER wave degree, see standard bearish divergence between points 1 and 2, and standard bullish divergence between points 3 and 4. There is a standard bullish double divergence between points 5 and 6, where both the MACD and its histogram display rising troughs. There is also double divergence at points 5 and 6, resulting from two overlapping standard divergence setups, one occurring between point 5 and 6 with another from the lowest point in the MACD to point 6. September 3, 11 Divergence as leading indicator. Divergence provides one of the best early warnings of an impending trend change or reversal. It transforms a lagging indicator into a leading indicator. Although that may be the case, it is nevertheless prudent to only act when there is price confirmation, which provides a price-based trigger for entry, as well as evidence to support a bullish or bearish forecast. As with any technical tool, divergence should be used in conjunction with other technical indicators. The objective is to locate a higher probability entry around supportive and resistive confluences. Figure 9.64 shows how divergence is used in conjunction with other indicators to locate potential reversals in gold, ZASD. The windows at the bottom of the chart show the accumulation/distribution line, along with a cycle-tuned stochastic oscillator. The overbought and oversold levels in the stochastic are indicated on the chart as OB and OS, respectively. Timelines 1 to 8 mark the points in the gold market when the overbought level was tested. Point A, which represents resistance, is the first actionable point. Figure 9.64 Divergence as a leading indicator. Source, MetaTrader 4. 319. The Handbook of Technical Analysis. Where a trader could initiate a short position as price validates the downtrend line at its third point of contact. At this point, we see the stochastics at overbought at timeline 3, which is bearish for gold. We also observe reverse bearish divergence between the peaks located at timelines 2 and 3, indicating a potential downside continuation of the current larger trend. In similar fashion, we see standard and reverse bearish divergence acting as a leading indicator between points B and E, with the downtrend line providing resistance between C and E. The stochastics are also all at overbought at these points. This combination of divergence with other non-correlated oscillators and overlay indicators together create high probability entry points for traders interested in establishing short positions in gold. September 3, 12 volume bar action, open interest, and ATR divergence. The rules for interpreting divergence are markedly different when it comes to volume bar action, open interest, and average true range, ATR. We cannot employ terms like standard or reverse divergence. We are only able to describe a setup as either bullish or bearish and divergent or confirmatory. The rules of interpretation are as follows. Rising prices with declining volume bar action represent bearish divergence. Rising prices with rising volume bar action represent bullish confirmation. Declining prices with rising volume bar action represent bearish confirmation. Declining prices with declining volume bar action represent bullish divergence. Note that the rules above also apply to the moving average of volume and to open interest and the ATR. Declining volume or open interest in a rising market is bearish, as it indicates that there is an increasing lack of participation and interest in seeing prices go higher. Conversely, rising volume in a rising market indicates increasing interest and participation, which is bullish. Declining volume or open interest in a falling market is bullish, as it indicates that there is an increasing lack of participation and interest in seeing prices go lower, whereas an increasing volume would suggest that market participants are interested in seeing price go lower, which is bearish. It is also important to note that extreme volume in a rising market may no longer be an indication of bullishness, but rather one of potentially increasing bearishness as the market blows off and heads south in a rapid decline. The same applies to extreme volume in a falling market. Tib. When it comes to interpreting divergence, and for that matter any other technical indication, it is wise to remember that as a general rule extreme bullishness is potentially bearish and extreme bearishness is potentially bullish. 320. Divergence analysis. Figure 9.65 volume bars, open interest, and ATR divergence. Figure 9.106 is a good example of this general rule in action. We observe a significant blow-off in silver during the 2011 rapid run-up in price. The top in silver was accompanied by extreme volume and declining open interest, which we see, in retrospect, as representing a potentially bearish setup. Finally, as far as open interest is concerned, a declining open interest in a rising market indicates diminishing volatility, which may adversely impact the persistence of the current trend and is therefore deemed bearish. Similarly, a declining ATR in a falling market also indicates diminishing volatility and by the same argument is deemed bullish. From figure 9.65, it is clear that these indicators will signal divergence and confirmation irrespective of the direction of price. A decline in these indicators always signals divergence, whereas a rise signals confirmation. However, in order to determine if the divergence and confirmation are bullish or bearish, we need to ascertain the current direction of price. It is important to distinguish volume bar divergence with that of other volume indicators and oscillators. Volume indicators like OBV, Chaikin money flow, percentage volume oscillator, accumulation distribution line, ADL, and money flow index, MFI, are all interpreted using conventional standard and reverse divergence analysis, and are never interpreted in the same manner as volume bar, open interest, and ATR divergence. The disparity between volume bar divergence and other volume oscillator divergence is obvious, especially during a pronounced selling climax. As volume surges during a decline, reflected by rising volume bars, volume oscillators tend to decline instead. This is because volume oscillators are constructed to take into account price. Note: the rules for interpreting volume bar divergence are completely different from those for volume oscillator divergence. 321. 322. Figure 9.66 volume bar divergence during a sharp decline. Source: MetaTrader 4. Action: where volume is subtracted during falling prices. This disparity only affects selling climaxes and not blow-offs. In figure 9.66, we observe that during a sharp decline in the Eurust, the volume bars peaked, whereas all three volume oscillators, that is, the MFI, ADL, and the OBV, spiked downward. Notice also that the moving average of volume is also interpreted using the same rules as for volume bar action. In figure 9.67, we see volume bar divergence indicating a bearish confirmation, which is reinforced by the ADL signaling a reverse bearish divergence in the Eurust. Figure 9.67 volume bar and volume oscillator divergence. Source: MetaTrader 4. The Handbook of Technical Analysis. Divergence analysis. 9.4 Price confirmation and divergence CE analysis. Confirmation and non-confirmation represents the potential for price to either reverse or continue at the current larger trend. In other words, it is merely evidence that the market is either inherently weak or strong. We still require some form of qualifying action in the main data series in order to prove or confirm that the divergence setup in the main data series is actually reversing or continuing with its current larger trend as a result of that divergence. This proof is referred to as price confirmation and is normally based on the penetration of some significant price barrier in the main data series. Price confirmation is never sought in the supporting data series. Divergence should only be confirmed by some form of qualifying price action and not on any indicator or oscillator action. Once price has violated a significant price barrier in the main data series, we say that there is price confirmation of the divergence setup. If price does not prove prove itself by unfolding in the expected manner with respect to its larger current trend, we say that the divergence setup is still unconfirmed by price. Price confirmation in the main data series is best determined by penetration or violation of any significantly clear and obvious price barriers, which include support or resistance levels, indicator overlay barriers, psychological levels, example double and triple zero-digit prices. Some popular examples of indicator overlay barriers include trend lines, moving averages, chart patterns, floor traders pivot points, Ichimoku clouds, fixed percentage envelopes, volatility bands, Fibonacci-based ratio levels, and Gann levels. Conventionally, support and resistance, trend lines, and moving averages are still the preferred price barriers for price confirmation. The exact point of entry when initiating a long or short position based on the level of price confirmation depends on the entry filter employed, which may include any of the following: price-based filtering, time-based filtering. TIB. Divergence must only be confirmed by price alone, via the penetration of some significant price barrier. Note: a divergent setup is seen as a bullish or bearish signal, while price confirmation is regarded as a trigger for participatory action. 323. 324. Algorithmic-based filtering, exogenous event-based filtering. To further increase the potential strength and reliability of the qualifying accession, price confirmation is potentially most reliable when accompanied by at least 3 weekly or non-correlated oscillators or indicators. All 3 non-correlated oscillators and indicators indicate divergence and are in agreement with each other. All 3 non-correlated oscillators and indicators also indicate non-conflicting double or multiple divergences. The expected time of breakout for price confirmation occurs in proximity to projected cycle lows for upside breakouts and cycle highs for downside breakouts. If the 3 supporting data series are in some way correlated, there is a possibility that the corresponding oscillators and indicators may provide similar or identical bullish and bearish signals. We say that the oscillators and indicators are multicollinear. See Figure 9.37. This misleads the analyst or practitioner into believing that the apparent agreement between the oscillators and indicators are in some way strong and reliable signals. In order to reduce the effects of multicollinearity within the supporting data series, it is best to avoid introducing supporting data series that are based on the same technical data, which can be categorized into various fields, some of which include price, volume, open interest, market breadth, sentiment. This requires that if one of the supporting data series is a momentum indicator, then the other supporting data series should be an indicator or oscillator derived from some other technical data field like volume, open interest, market breadth, sentiment, and so on. This will greatly mitigate the undesirable effects of multicollinearity between the various indicators and oscillators that make up the supporting data series, providing for potentially more independent and reliable signals. Time-based projections derived from standard cycle analysis, Fibonacci time zones, Gann's squaring of time, or triangle apex reaction analysis may also be advantageous in pinpointing the time of breakout. See figures 9.68 to 9.83 for some idealized examples of price confirmation using moving averages, trend lines, support and resistance, chart patterns, and confluence-based breakouts on the all 4 types of divergences. Price confirmation for bull and bear setups is not specifically depicted in the following examples, but they only require an extra step, with price confirming the breakout from the expected reversal after the initial continuation of the current larger trend. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.68 Price confirmation of standard bullish divergence via a trendline breakout. Figure 9.69 Price confirmation of standard bullish divergence via a resistance breakout. 325. 326. Figure 9.70 Price confirmation of standard bullish divergence via a moving average breakout. Figure 9.71 Price confirmation of standard bullish divergence via a channel breakout with 3 non-correlated indicators. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.72 Price confirmation of standard bearish divergence via a trendline breakout. Figure 9.73 Price confirmation of standard bearish divergence via a support breakout. 327. 328. Figure 9.74 Price confirmation of standard bearish divergence via a moving average breakout. Figure 9.75 Price confirmation of standard bearish divergence via a supportive confluence breakout with 3 non-correlated indicators. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.76 Price confirmation of reverse bearish divergence via a trendline breakout. Figure 9.77 Price confirmation of reverse bearish divergence via a support breakout. 329. 330. Figure 9.78 Price confirmation of reverse bearish divergence via a moving average breakout. Figure 9.79 Price confirmation of reverse bearish divergence via a triangle formation breakout with 3 non-correlated indicators. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.80 Price confirmation of reverse bullish divergence via a trendline breakout. Figure 9.81 Price confirmation of reverse bullish divergence via a resistance breakout. 331. 332. Figure 9.82 Price confirmation of reverse bullish divergence via a moving average breakout. Figures 9.84 to 9.86 show 3 different price confirmations applied on the same bar chart. This illustrates the point that the choice of price barrier for confirmation is essentially arbitrary. It is therefore best to choose a significantly clear and obvious price barrier for a more reliable entry or forecast. Figure 9.83 Price confirmation of reverse bullish, double, divergence via a triangle formation breakout with 3 non-correlated indicators. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.84 Price confirmation of standard bearish divergence via a trendline breakout. Source, MetaTrader 4. Figure 9.85 Price confirmation of standard bearish divergence via a moving average breakout. Source, MetaTrader 4. 333. The Handbook of Technical Analysis. Figure 9.86 Price confirmation of standard bearish divergence via support breakouts. Source, MetaTrader 4. 9.4.1 Price confirmation in contiguous divergent setups and follow-through. Sometimes, price oscillates continuously between divergent setups. A continuous sequence of divergent setups may appear to yield simultaneous bullish and bearish signals. In technical analysis, bullish and bearish signals occurring simultaneously are normally regarded as conflicting signals and are therefore largely non-actionable by market participants. However, signal conflicts in divergent setups are potentially actionable. Actionable, with respect to divergent setups, means the ability to initiate a trade based on price confirmation. Consequently, signal conflict does not necessarily preclude participatory accession. The conflicting signal overlap only occurs at a higher wave degree and does not affect trading opportunities if we seek price confirmation at a lower wave degree, where traders can potentially take advantage of such setups. Figure 9.87 depicts an apparent area of overlapping bullish and bearish signals at the higher wave degree. Although the overlap exists at the higher wave degree, this does not prevent it from being a tradable setup. Once a divergent setup has been identified at the higher wave degree, the trader may initiate a trade once price has confirmed the. Note: although the divergent signals may conflict, it does not preclude the possibility of price confirmation. 334. Divergence Analysis. Figure 9.87 Conflicting signal overlap and opposing divergent setups. Setup at a lower wave degree. The penetration of a higher peak or lower trough may be used as a price barrier for price confirmation. Alternatively, a moving average may also be employed to catch the reversal at the lower wave degree. Figure 9.88 shows price motion at a higher wave degree originating from oscillations at a lower wave degree. We see the same area of conflicting signals as in figure 9.87. After establishing reverse bullish divergence at the higher wave degree, the trader may initiate a long entry at point A upon the breach of the first, second, or even third higher peak at the lower wave degree, depending on the parameters of the entry filter employed. Alternatively, an upside violation of a downtrend line or moving average based on the lower wave degree may also be used as an entry trigger. Similarly, a trader may use the breach of a lower trough to initiate short entry at point B after establishing standard bearish divergence at a higher wave degree, with the downside violation of the uptrend line or moving average based on the lower wave degree as alternate entry triggers. As long as price confirmation is not wholly dependent on resistance or support levels based on the prior peak or trough at the higher wave degree, then signal conflicts will, in most cases, not adversely impact participatory action. For example, in figure 9.89, a reverse bullish divergent signal overlaps a reverse bearish divergent signal. We observe that the reverse bullish divergent setup failed to gain confirmation at the prior resistance level based on the peak at point 3. The reverse bearish divergent setup also failed to gain confirmation at the prior support level based on the trough at point 2. Therefore, seeking price confirmation at the next lower wave degree is preferable in most cases. 335. 336. Figure 9.88 trading the conflicting signal overlap at a lower wave degree. Figure 9.89 failure to achieve price confirmation at the higher wave degree. The Handbook of Technical Analysis. Divergence analysis. But there are situations where price confirmation at the higher wave degree is necessary, especially when it relates to forecasting the direction of the subsequent larger trend where we require the violation of a higher peak or lower trough in order to determine whether it is uptrending or downtrending. Finally, once prices reverse and the divergent setup achieves price confirmation, we say that there is follow-through of the setup. It should be obvious by now that for any setup, follow-through is easier to achieve at the next lower wave degree. Therefore, in spite of overlapping areas of conflicting signals at the higher wave degree, it does not affect participatory action at the lower wave degree as there is a high level of follow-through from one setup to another. 9.5 Signal alternation between standard and reverse divergence. As briefly discussed in the previous section, there may be situations where standard and reverse divergence formations may overlap and even alternate in succession, resulting in what initially appears to be contradictory signals. We shall examine 20 general scenarios where the data series trend, range, expand, and contract with respect to each other. There are only 6 idealized scenarios exhibiting signal alternation. We shall assume for convenience that all data series action unfolds contiguously in a consistent manner and displays no irregular action. 9.5.1 Heuristic for determining if signal alternation is present. We can formulate a general rule of thumb for deciding if signal alternation exists between the main and supporting data series. Signal alternation exists if all 3 conditions below are satisfied. 1. Peaks between the 2 data series are trending in different directions. 2. Troughs between the 2 data series are trending in different directions. 3. Peaks and troughs within each data series are trending in the same direction. In the following 6 illustrations, we find that signal alternation only occurs when both the main and supporting data are trending in opposite directions, i.e., non-directionally aligned divergence. Figures 9.90 and 9.91 show 2 out of the 6 idealized scenarios where there is signal alternation. 9.5.2 Heuristic for determining no signal alternation. Signal alternation between standard and reverse divergence does not occur when both the main and supporting data series are trending in the same direction. Both the main and supporting data series are exhibiting contrasting sideways formations, i.e., one data series expanding while the other is contracting. 337. Figure 9.90 Signal alternation in opposing, divergent, data trends. Both the main and supporting data series are exhibiting similar sideways formations, i.e., both data series expanding or contracting together. One data series is expanding or contracting while the other is flat or trending. Figures 9.92 and 9.93 show 2 out of the 14 idealized scenarios where there is no signal alternation. 9.6 More examples of divergence. In the following sections, we shall examine some real-world charts with various types of divergences in action. 9.6.1 Examples of price-to-price divergence. In this section we shall look at divergence between stocks, funds, futures contracts, and various indices in lieu of oscillators and indicators. Figure 9.91 Signal alternation in opposing, convergent, data trends. 338. The Handbook of Technical Analysis. Divergence analysis. Figure 9.92 No signal alternation between expanding and contracting formations. 9.6.1.1 Examples of intermarket divergence. The main challenge when attempting to identify divergence between stocks, commodities, and various indices is to determine which instrument would best represent the main data series. It behooves the analyst to refer to the momentum principle, described in section 9.3.6, as a guide to determining the most appropriate choice for the main data series. The momentum principle states that the main data series is expected to follow through in the direction of the supporting data series, as far as standard divergence is concerned. Therefore, based on a similar rationale, the task is to identify the stock, commodity, or index that leads the one under observation. In short, the leading instrument will represent the supporting data series, and the instrument or market under observation in the main data series is expected to follow through in the direction of the leading market or instrument. As for the application of reverse divergence analysis, we shall resort to either the contrarian or chronological approach and expect a continuation in price in main data series. Figure 9.93 No signal alternation between contracting and expanding formations. 339. 340. Figure 9.94 Intermarket divergences. Courtesy of stockcharts.com. Figure 9.94 shows the various divergences that exist between the Dow Jones Industrial Average and the Dow Jones Transportation Average over a period of 5 months. The transportation is represented by the line chart. Assuming that the Dow Jones Transportation Average represents the supporting data series, we expect the industrials to follow through in the direction indicated by the transports for standard divergence and in the opposite direction to the transports in reverse divergence. We see that the industrials do in fact react to the transports in the manner expected fairly consistently, as evinced by the price excursion at points 1 to 4. For example, we see the industrials declining at point 2 after a standard bearish divergence setup and subsequently rising, as expected, at point 1 after a reverse bullish divergence setup. The industrials rise again in similar consistent fashion at point 3 after a second reverse bullish divergence setup and decline, as expected, at point 4 after another standard bearish divergence setup. This is all predicated on the assumption that the transports lead the industrials. In figure 9.95, it is assumed that the Baltic Dry Index will lead the broader market, represented by the S&P 500 Large Cap Index, SPX. The Baltic Dry Index is a fairly accurate barometer of future economic activity, which in a way is analogous to the relationship between the Dow transports and industrials. Unlike the previous example where adjacent peak-to-peak or trough-to-trough analysis is employed, divergence is identified in this example using conventional trend and slope analysis. Therefore it can only be interpreted in terms of standard bullish or bearish divergence. We see the two indices diverge after a prolonged period of being fairly positively correlated. Based on our assumption, this setup is therefore bearish for the broad market. Another way to identify divergence between two data series that have a consistent history of being very positively correlated is to look for periods when the correlation starts to break down. This can be seen in figure 9.96 at points A and B. The chart tracks the market action of the S&P 500 against an inverted volatility index, VIX. This is done to help better visualize the relationship between the two. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.95 Intermarket Divergence. Courtesy of stockcharts.com. Indices. We can see a significantly strong and consistent correlation between the two data series. But at points A and B, we observe larger than average divergences in correlation between the two indices. Figure 9.97 brings up a very important point. When two markets are normally positively correlated, we look at divergence as a deviation from the norm. However, when markets are normally negatively correlated, we instead look at Figure 9.96 Intermarket Correlation and Divergence. Courtesy of stockcharts.com. 341. 342. Figure 9.97 Naturally Divergent Markets. Courtesy of stockcharts.com. Convergence as a deviation from the norm. Many markets have a natural inverse relationship with other markets. In such cases, divergence is actually represented by the two markets converging on each other, albeit only briefly. In Figure 9.97, the convergence begins around timeline A. 9.6.1.2 Examples of inter-contract price divergence. Using ratio spikes to gauge potential reversals, we may also look for divergences between the prices in back and front months of a futures contract. We simply construct a ratio or relative strength chart of two contract months and add a fixed percentage envelope or volatility band to it. In Figure 9.98, we see reversals in silver being accurately forecasted, at points 1 to 9, whenever the 20-day percentage band violated at the 5% breakout level, based on the March and May 2012 contracts. Breakouts to either side of the band give equally valid signals and provide a fairly easy and consistent way of gauging potential reversals in silver. Larger violations of the threshold are usually preceded by more significant selling climaxes or blow-offs, as evinced by the large price ratio spike at point 7. In Figure 9.99, reversals in Brent crude oil are accurately predicted, at points 1 to 13, every time the thresholds on the fixed percentage envelope are tested or breached. Threshold A represents a lower percentage threshold while B is set at a higher percentage. The ratio spikes that test threshold B are usually associated with larger reversals in Brent crude oil. The threshold percentage levels may be set either via back testing or simply by careful visual inspection. The first significant reversal drove oil down to about $107.40. The subsequent pullback was accurately identified at point 1 where the ratio spike tested the lower percentage threshold. The pullback was followed by an extended run-up in oil prices. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.98 Forecasting reversals in silver via inter-contract divergence. Courtesy of stockcharts.com. 9.6.1.3 Examples of price to net commercial, COT report, divergence. Though a reading of the entire COT report is necessary for a proper analysis, we shall only focus on the historical open interest relationship between the USD index futures and the net non-commercials for the purpose of this brief analysis. In Figure 9.100, we observe that the net non-commercial activity exhibited. Figure 9.99 Forecasting reversals in Brent crude oil via inter-contract divergence. Courtesy of stockcharts.com. 343. 344. Figure 9.100 Forecasting reversals via USD index futures to net non-commercials divergence. Significant bearish divergence around 2008 to 2009 and again in 2010. This was followed by bullish divergence in 2011. From this perspective, the net non-commercials seems to be an accurate indicator of future market action, especially when significant divergence occurs around the historic highs and lows, as indicated on the chart. 9.6.1.4 Examples of price to seasonal divergence. Divergence may also be derived from non-confirmation between current price and its expected seasonal price. Seasonal prices may be averaged over 5, 10, 20, or even 30 years, with some providers excluding outlier events in order to give a more representative price that is free from various distortions. The mode of averaging may also differ between providers, ranging from simple to weighted averages. The supporting data series will be comprised of the seasonal prices. It is best to use at least one short and another longer-term seasonal chart in order to identify any discrepancies or change in market behavior. All divergences should only entail participatory action once there is clear and significant price confirmation. The Handbook of Technical Analysis. Divergence Analysis. 9.7.1.5 Examples of relative performance divergence. This is another type of divergence that is based on the percentage performance of two data series over the same period of observation. It is a relative measure because the performances are measured as a ratio or percentage rather than as a spread based on absolute price or index point differences. The most recent percentage performance depends on the initial point of reference or comparison over a specified period, i.e., the performance at each point is compared to the price or index level at the start of the observed period and is measured as a percentage of this initial price or index level. In Figure 9.101, the housing index is making lower peaks in terms of percentage performance while the SPY ETF is making higher peaks, where the period of comparison extends from June 1, 2010 to March 13, 2013. In this example, the housing index is assuming the role of supporting data series and is therefore indicating future bearishness in the broad market, represented in this example by the SPY ETF. In a sense, performance charts are useful in that they normalize performance by comparing percentages instead of absolute values, making comparison across various markets and instruments more accessible and meaningful. To compare the relative percentage or ratio performance of two data series as a function of price at each point rather than with the initial price of the observed period, we resort to the use of relative or comparative strength charts. Figure 9.101 Relative bearish divergence between the housing index, PHLX, and the SPY ETF. Courtesy of stockcharts.com. 345. 346. 9.6.2 Examples of price to overlay indicator divergence. In this section, we shall examine divergence between price and various overlay indicators. 9.6.2.1 Examples of price to moving average divergence. The amount of divergence between price and its own moving average plays a key role in the forecasting of potential reversal and continuations in the market. To determine the amount of divergence present, we detrend price with its moving average in the same way that the MACD is created, which is by detrending two moving averages. In Figure 9.102, a price oscillator was used to isolate and quantify the amount of divergence between price and its moving average. The MACD was used in the example below with a period setting of 1 for price and 100 for the exponential moving average that we would like to observe. One advantage of using a price oscillator is that it identifies the potential overbought and oversold levels in the stock, as indicated from 1 to 5. Notice that the projected overbought and oversold levels coincide with bottoms and tops in the stock. 9.6.3 Examples of overlay to overlay indicator divergence. In this section, we shall examine divergences between three popular overlay indicators, namely moving averages, Bollinger Bands, and regression lines. Figure 9.102 Forecasting reversals in GE via overbought and oversold levels in the price oscillator. Courtesy of stockcharts.com. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.103 Forecasting consolidations and trends via multiple moving average divergence and convergence. 9.6.3.1 Examples of intermoving average divergence. The most popular indicator that is founded on intermoving average divergence is the MACD. As mentioned in an earlier section, we may use the divergence created between the peaks and troughs in the MACD and price itself to forecast reversals and continuations in the market. We could also study the divergent behavior of various popular moving averages to better understand the nature and character of the market under observation. In Figure 9.103, we see multiple moving averages in action. Diverging averages indicate continuation while converging averages indicate a slowing of the trend and potential reversal. This diverging and converging behavior within the group of moving averages is of immense interest to the practitioner as it provides a means of forecasting potential consolidations and breakouts, by observing the average rate at which the group of averages contracts and expands. 9.6.3.2 Examples of Bollinger Bandwidth Divergence. We shall use the broad definition of divergence when referring to Bollinger Bandwidth divergence. Slope analysis is used when analyzing bandwidth divergence, and therefore this excludes reverse divergence from the analysis. The fluctuations in the bandwidth reflect the degree of divergence between the upper and lower bands. Under the narrow definition of divergence, these fluctuations represent the diverging and converging action between the bands. It is important to understand that we cannot use terms like standard, bullish, or bearish with bandwidth divergence. This is because the bandwidth 347, 348. Figure 9.104 Forecasting reversals in the Russell 2000 Small Cap Index with Bollinger Bandwidth Divergence. Courtesy of stockcharts.com. Divergence provides no directional information with respect to future price action, hence it is not possible to determine if a divergent setup is bullish or bearish. Bandwidth divergence tracks the volatility in the market, and therefore converging bands represent periods of lower volatility while diverging bands represent periods of greater volatility. Bandwidth divergence is particularly useful in predicting potential breakout moves in the market, especially after an extended period of low volatility. Trades based on taking advantage of these low volatility breakouts are popularly referred to as squeeze plays. Reversals at historical overbought bandwidth levels. In Figure 9.104, the reversal in the Russell 2000 Small Cap Index, indicated at points 1 to 6, coincides fairly consistently with the test of the historical overbought or extreme level on the Bollinger Bandwidth indicator. The upper extreme level represents periods of high volatility, whereas the lower extreme reflects periods of low volatility. Point May 6th be of particular interest to traders as it represents a supportive confluence comprising a projected channel bottom and a prior support level, accompanied by a Bollinger Bandwidth divergence peak. Hence, point 6 represents a high probability entry. As far as trading at points 7 and 8 is concerned, as with any divergent setup, there must be some form of price confirmation to trigger an entry. Assuming that we use the 20-day moving average, which happens to represent the central value of the Bollinger Band, as the barrier required for price confirmation, no trade would have been initiated at points 7 or 8 as there was no decisive closing penetration of the moving average at either points. The Handbook of Technical Analysis. Divergence Analysis. Figure 9.105 Forecasting reversals in silver with Bollinger Bandwidth divergence. Courtesy of stockcharts.com. Figure 9.105 is yet another example of using extreme Bollinger Bandwidth divergence to forecast potential reversals in price. The Bollinger Bandwidth is set to a lower look-back value of 5 days in order to increase its responsiveness to rapid price excursions and market shocks. We see two selling climaxes occurring at points 1 and 2, both of which were accompanied by large volatility spikes in the Bollinger Bandwidth. This first spike demarcates the historical volatility level, which will later serve as a threshold for potential future reversals. We see this volatility threshold being subsequently violated, with silver forming a new bottom at point 2. The peaks of the volatility spikes lie well above its noise floor, indicating that the two bottoms are high sigma events. The noise floor is also fairly well contained, fluctuating within a 15% band. 9.6.3.3 Examples of inter-regression line divergence. Some practitioners also employ the use of a regression line to determine the direction of a particular trend of interest. When using regression lines, slope analysis is employed, with all non-confirmation being either standard bullish or bearish divergence. As a result, reverse divergence is excluded from the analysis when employing regression lines to determine direction. 9.6.4 Examples of price to volume and open interest divergence. In Figure 9.106, we see significant long-term bearish divergence in silver between price and open interest, between timelines A and B. The volume action displays bullish confirmation and eventually peaks at point 1. As pointed out in section September 4, 14, any extremely bullish formation is potentially bearish, and vice versa. We 349. 350. Figure 9.106 price to volume and open interest divergence in silver. Also see medium-term bearish divergence indicated between point 2 and timeline B. Rising volume accompanied by declining open interest is indicative of a rally fueled by short covering. Though not displayed on the chart, it may be interesting to be aware of the fact that the market vein sentiment readings for silver were at extreme overbought levels prior to silver peaking in 2011. Sentiment indicators are most reliable at market extremes and should therefore be incorporated into any analysis of divergence at historic or significant price levels. Finally, market participants should only initiate short positions or exit previously profitable long positions upon price confirmation. 9.6.5 Examples of oscillator-to-oscillator divergence. Divergence between two different oscillators is referred to as inter-oscillator divergence, whereas that between two identical oscillators is called intra-oscillator divergence. The two basic measures of divergence between oscillators are that of direction and phase. Divergence stemming from directional discrepancies is most commonly employed. It is harder to locate phase discrepancies between oscillators that usually peak and trough in lockstep with each other. That is the reason why when a phase discrepancy arises, it is regarded as a strong indication of a potential reversal. 9.7.5.1 Example of inter-oscillator divergence, directional discrepancy, using OBV-ADL indicator pair divergence to gauge market regime change. One particularly useful technique for forecasting market behavior or regime change is via the combined use of the OBV and ADL. Whenever there is non-confirmation between the OBV and ADL, price action will fairly frequently be volatile and erratic. However, when there is confirmation between these two, the Handbook of Technical Analysis. Divergence Analysis. Figure 9.107 Forecasting regime changes in ExxonMobil Corporate via OBV-ADL divergence. Courtesy of stockcharts.com. Indicators. Price action will usually be less volatile with more pronounced trends. This ability to gauge market behavior will be of great benefit to directional traders who want to avoid choppy action and only participate when the market is more predisposed to trending action. See Figure 9.107. 9.6.5.2 Examples of inter-oscillator divergence. Phase discrepancy. Phase differences are easily identified by locating peaks or troughs in the oscillators that are not in sync or aligned with each other. Though phase difference is ideally associated with sinusoidal action and is therefore perfectly identifiable and quantifiable, this is unfortunately not the case in semi-random markets where wave cycles are at best transient and seldom symmetrical. Before looking at our next example, let us first define phase divergence. When examining phase divergence, the following guidelines apply. 1. When peaks are asynchronous, it is regarded as potentially bearish for price. 2. When troughs are asynchronous, it is regarded as potentially bullish for price. 3. When peaks are asynchronous, no oscillator peak should lag the peak in price. 4. When troughs are asynchronous, no oscillator trough should lag the trough in price. Figure 9.108 displays a chart of the continuous contract in wheat, with two oscillators, the 60-day rolling CCI and the MACD as the supporting data SC rise. We notice that for the most part peaking in the CCI and MACD is fairly synchronous. But at timeline A we see the CCI peaking before MACD and price. 351. 352. Figure 9.108 Forecasting reversals in wheat via phase divergence. Courtesy of stockcharts.com. Such phase divergences are regarded as stronger bearish signals. Guideline 3, above has not been breached. 9.6.5.3 Examples of intra-oscillator divergence, directional and phase divergence. Just as for inter-oscillator divergence, we also look for both directional and phase discrepancies in intra-oscillator divergence. Although the oscillators are identical, the look-back period will be different. A longer look-back period will generate slower oscillations at a higher wave degree, while a shorter setting will generate more rapid oscillations at a lower wave degree. Since the two oscillators are of identical construction, the faster oscillations at the lower wave degree represent, in a sense, the harmonics of the larger oscillations at the higher wave degree. This is analogous to a guitar string being plucked, where the largest wave produces the lowest note with the smaller waves producing the harmonics and higher overtones. Figure 9.109 is a chart of spot bust displaying intra-oscillator divergence between a 100-day and 10-day price oscillator. Figure 9.110 shows phase divergence at timelines 3 and 6. The two oscillators are synchronous at all the other timelines indicated. 9.6.6 Example of price to market breadth divergence. We may also employ divergence between price and market breadth indicators to forecast potential reversals. In Figure 9.111, the two indicators plotted are the Handbook of Technical Analysis. Divergence Analysis. Figure 9.109 Forecasting reversals in bust via intra-oscillator, directional, divergence. Source, MetaTrader 4. S&P 500 bullish percent index and the MACD. We observe that every time the bullish percent index tests its overbought level, as seen at timelines 1 to 4, the market eventually reverses. We see two non-correlated indicators providing almost identical signals. We also see that the market reacts in a consistent manner to the bullish and bearish divergences by following through with either an upside or downside move initiated at or soon after price confirmation. Figure 9.110 Forecasting reversals in bust via intra-oscillator, phase, divergence. Source, MetaTrader 4. 353. Figure 9.111 Forecasting reversals in the S&P 500 via market breadth divergence. Courtesy of StockCharts.com. 9.7 Chapter Summary. As we have seen, divergence may be observed in a variety of technical setups. It is always best to obtain price confirmation when using divergence. This is because in some cases, the indicators will remain in a state of persistent divergence with price or another data series, such as in the case of serial or multiple divergences. The use of weekly or non-correlated data series will also help increase the probability of a divergent signal being more reliable, circumventing the adverse and misleading effects of multicollinearity. One aspect not discussed in this chapter is that of divergence between implied and historical volatility. Option traders are particularly interested in observing divergence between implied and historical volatility as a guide for gauging the most appropriate options strategy to employ. When the level of implied volatility is significantly overbought with respect to itself and also higher than the corresponding historical volatility, a reversion to the mean is usually expected in the form of a potential volatility crush. Finally, practitioners interested in using divergence as a tool for price projections may also want to refer to Constance Brown's book Technical Analysis 4. 354. The Handbook of Technical Analysis. Divergence Analysis. The Trading Professional, where she employs the spread or differential between various inflection points as a basis for price projections. Chapter 9 Review Questions. 1. Describe the main challenges in the application of divergence analysis. 2. Explain how the adverse effects of multicollinearity could be avoided or reduced. 3. Describe George Lane's bull and bear setups and discuss the challenges in identifying such setups. 4. Give examples where volume divergence may be ineffective. 5. Describe the relationship between divergence and price momentum. 6. Describe an ideal divergence setup and its underlying weaknesses. 7. What are the methods for identifying divergence? 8. Explain how you would trade a divergent setup. References. Blau, William. 1995 Momentum, Direction, and Divergence. New York, John Wiley & Sons. Brown, Constance M. 1999. Technical Analysis for the Trading Professional. New York. McGraw-Hill. Lebeau, Charles, and David W. Lucas. 1992 Technical Trader's Guide to Computer Analysis of the Futures Market. Homewood, Illinois, Business 1 Irwin. Pring, Martin J. 2002. Technical Analysis Explained, The Successful Investor's Guide to Spotting Investment Trends and Turning Points. 4th ed. New York, McGraw-Hill. 355. Chapter 10. Fibonacci Number and Ratio Analysis. The application of Fibonacci numbers and ratios in technical analysis is pervasive. It is probably one of the most popular and widely used overlay indicators in technical analysis. In this chapter, we shall study the application of Fibonacci numbers and ratios to the financial markets and how we can use them to identify potential key reversal and breakout levels. 10.1 The Fibonacci Number Series. Leonardo Fibonacci, in his historic 1202 book entitled Liber Abaci, Book of the Abacus, introduced to Western civilization a special sequence of numbers known as the Fibonacci series. Before learning how Fibonacci numbers and ratios are used in the financial markets to forecast potential support and resistance levels, let us first turn our attention to the source and derivation of these interesting numbers and ratios. Learning objectives. After studying this chapter, you should be able to understand the proper application of Fibonacci numbers and ratios to price action, calculate Fibonacci retracement, extension, expansion, and projection levels, identify Fibonacci-based resistive and supportive confluences, use Fibonacci time projection to forecast potential market reversals. Understand the relationship between Fibonacci, Dow, and Gann levels. Understand how chart scaling affects different Fibonacci operations. Identify the issues associated with trading Fibonacci price and time targets. 357. 358. 10.1.1 The Fibonacci series. A simple mathematical expression that describes a Fibonacci series is given as follows. F equals F plus Fn plus 1 Nn1. Where Fn represents the current number, Fn1 the previous number, and Fn plus 1 the next number in the Fibonacci series. Alternatively, due to the iterative nature of the mathematical expression, it may also be expressed as F equals F plus Fn n1 n2. Where Fn1 and Fn2 represent the immediately previous two numbers of the sequence. Regardless of the way it is mathematically expressed, every number in the Fibonacci sequence is the sum of its last two previous whole numbers. Therefore, starting with Fn1 equals 0 as the previous number and Fn equals 1 as the current number in the series, we obtain Fn plus 1, the next number in the Fibonacci series. By repeating or iterating the process for each new Fn, 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, 377. Where we see that 1 plus 0 equals 1, 1 plus 1 equals 2, 2 plus 1 equals 3, 3 plus 2 equals 5, 5 plus 3 equals 8, and so on, ad infinitum. 10.1.2 The French Connection, the Lucas series. A variant of this iterative series may be constructed by changing the initial two numbers of the series, that is, by starting with Fn1 equals 2 and Fn equals 1 instead of Fn1 equals 0 and Fn1 equals 1. This new series is popularly referred to as the Lucas series, after Édouard Lucas, a French mathematician. Similarly, by iteration via the Fibonacci sequence, we obtain 2, 1, 3, 4, 7, 11, 18, 29, 47, 76, 123, 199, 322. Where we see that 2 plus 1 equals 3, 3 plus 1 equals 4, 4 plus 3 equals 7, 7 plus 4 equals 11, 11 plus 7 equals 18, and so on, ad infinitum. Letting Ln be the current number in a Lucas series, the relationship between the Lucas and Fibonacci number series is given by the mathematical relationship L equals F plus 2 Fnn1. Let us examine this formulaic relationship a little more closely. As we have seen, the 10th Fibonacci number in the sequence given above is 34. Hence, via this mathematical expression, the corresponding 10th Lucas number should be L10 equals F10 plus 2 F9 equals 34 plus 2, 21, equals 34 plus 42 equals 76, which turns out to be the expected answer. As we shall see later, Fibonacci, as well as Lucas, number counts are extremely popular technical tools commonly used to forecast potential top and bottom reversals in the markets, especially when they are used in conjunction with other. The Handbook of Technical Analysis. Fibonacci number and ratio analysis. Overlay indicators such as Bollinger Bands, Japanese candlesticks, Ichimoku clouds, conventional trend lines, and price channels. To further help increase the probability of identifying these potential reversals, traders and analysts often also seek supporting evidence of overbought and oversold conditions in conventional window oscillators such as stochastics, Commodity Channel Index, CCI, Moving Average Convergence Divergence, MACD, Rate of Change, ROC, and the Relative Strength Index, RSI, during such reversals. 10.1.3 Philosophical significance of the Fibonacci iterative series. We can clearly see that the next number in the Fibonacci series, Fn plus 1, i.e., new information, is the direct result of Fn, i.e., current information, interacting with Fn1, past information.